what I'm going to cover in this marathon, like whatever the video that you're watching right now, let us consider this as a part 1 video. In this, I have covered up to almost every chapter except return of income. Except return of income, right now what you're watching covers 100% syllabus of all these chapters with amendments. Remember, because forget about amendment, I'm doing a new marathon, guys. Whether amendments included, you don't have to, this is amended material altogether. This is amended material. For example, you know, you see PGBP, one of the amendment I'll show you in PGBP. Just a minute. For example, you see PGBP. Okay, this is house property. 1 minute. So you see this PGBP. I hope you know, right? In PGBP, we have a provision called 40B, partnership form. That's the major amendment. That's one of the major amendment. What amendment happened here? For example, you see book profit calculation, remuneration, working partners remuneration calculation, you see here. So everything is amended, guys. There is a new TDS section which is introduced, that is 194T. But of course, I cover this point in TDS revision. In TDS book of ICA, this section is not separately given. It is only given in the PGBP, but that is also relevant for our exams. See, simple, one point I just want to tell is, this is the latest marathon. This is the latest marathon. I covered each and every topic with amendments. Wherever amendment is there, I specifically highlighted what amendment happened. Previously, what was the provision? Now, what was the provision? And guess what? The major chapter where amendments happened, where you know, capital gains. That is a major chapter where lot of amendments happened. That is capital gains. And what? Guess what? I already added 2.5 hours revision. Approximately 2.5 hours you will find capital gains revision. You know, approximately capital gains, major amendments. That is one. And another chapter where major amendments happened is TDS and TCS provisions. Approximately in 5 sections, TDS rates have been changed. Earlier 5%, now it is 2%. Simple. You don't have to worry. You just look at the timestamp below, click on the timestamp and go. Like, okay, first day, no, when you're seeing, timestamp won't be there because it's a live, you know, we are presenting this in live. That's it. By the way, sir, where can I get this book? Honestly, and I'm telling you, undoubtedly, I'm telling you, this is the best book for income tax you ever find in the industry. Mark my word, read each and every provision, especially heads of income, chapter 6 deductions and all. For example, you see chapter 6 deduction. You see set off and carry forward. For example, under optional tax regime, what? Under default tax regime, what to do? Okay. For example, you see under optional tax regime, default tax regime, no change at all in set of rules except wherever green background is there. You see here green background is there, right? There only under optional tax regime, default tax regime difference is there. That too in set off and carry forward, nobody will tell you regarding unabsorbed depreciation what treatment within the, you know, discussion. You see headwise I arranged. Even in the revision class also I covered the same way in the set off and carry forward. So undoubtedly I'm telling you, one of the best book on income tax ever you will find. The kind of clarity you get is enormous. Mark my word. That's it. Okay. So why late? Start working. By the way, if at all any of you have any, if any of you want to enroll into this book, just simple open our websites restofcma.com, or you can say caramharsha classes. If you type also, you will get this recommendation. Okay, like for example caramharsha, you just type caramharsha, you get the first recommendations rest of a CMA. Getting it? So here, you know, go to books, CA intro. So you can find here only income tax book 400 rupees, which is including courier, man. Courier is 150 rupees for us. Getting it? Packing charge and all 30 rupees for us. Hardly we are literally selling the book at 200, 220 rupees, honestly. So out of pocket cost is for us 180, 200 rupees. Getting it? You can get with question bank also. And one more thing, in the marathon, what I'm going to do, you know, I'm going to add AMT total income problem videos also. Especially in total income, you have a problem in ICO book. 10 AA, AMT, default tax regime put together, 35 AD put together. That problem also I am solving in AMT. Remember, go in the same order, watch in the same order in which I uploaded the class. Don't directly go to some random timestamp, and also watch at standard speed, because some of these students might feel I'm going slow, some feel might be I'm going fast. You just arrange the speed adjustment in the YouTube, but if at all you want to watch at a higher speed, never watch beyond 1.2x speed. And entire income tax I'm covering in 14 hours. Less than 14 hours I'm covering 100% syllabus of income tax except return of income, which is hardly a 4 marks weightage. That's it. This is the information about income tax. So what else? Why late? Start watching. Get a clarity like never before on the income tax. Getting it? By the way, those of you who are looking for a detailed course on income tax, my course is also available. My EO, exam oriented regular class, which is 100 hours only, it is already available on the same site. You can enroll into that. Getting it? EO fast track is going to start in April first week, which is just 50 hours, where we discuss each and every provision and we solve mainly problems. 55 hours. Literally, EO fast track is going to be also one of the best product that you are going to see. Getting it? That's it. So this is about entire, income tax, all that. Okay, take care, all the very best. Yeah, let's begin basic concepts revision. Okay, so what is this? In basic concepts, mainly the topics that are dealt is tax computation. Getting it? Agriculture income discussion is there, and we have something called income. Certain incomes will be there which are taxable in the same year, not in the assessment year. Getting it? But that topic will be discussing with some other head of income. Getting it? And we are also having something called black money related taxation. That also we will be discussing along with some other head of income. Specifically speaking, in other sources I will discuss. In other sources when we are doing revision, right? That time I will discuss these these topics. So mainly agriculture income we are going to cover, tax computation we are going to cover, a brief overview of the income tax also we are going to cover. And in tax computation, we have how many parts? Basic tax computation is there. In the basic tax, again, special rates is there, normal rates is there, and we have surcharge computation. Then we have a rebate computation, then relief computation. Marginal relief for surcharge is there. Again, relief for rebate is also there. 87A, default tax regime, correct? Yes. So all this we are going to cover. And we all know that in income tax, we have two tax regimes. One is what? Default tax regime. Another one is called optional tax regime. Optional tax regime, in exam they will not give you optional tax regime like that. They will give you the word SSE has exercised option of shift out of default tax regime. They will give you this sentence. SSE exercised option. What option? Shift out of default tax regime. That's how they'll give you. How do they say SSE want to go for TTR? How do they say? They will say that SSE not exercised. SSE not exercised. Same sentence they'll copy. SSE not exercise the option of shifting out of default tax regime. Shifting out of DTR means what? Optional. SSE exercised that option. If SSE does not exercise the shift out, means he is choosing for default tax regime. This is one sentence which they will give. Sometimes straight away, if the examiner is with a little common sense, okay, he will straight away tell you that SSE chosen default tax regime, SSE chosen optional tax regime. Optional tax regime is also called as normal tax regime. Optional tax regime is also called as regular provisions of income tax. Clear? That's it. So this is how they give you. Now, the moment it is default tax regime, you need to remember the tax rates are different. The tax rates, they were all amended. Remember, the tax rates were amended. Earlier, no, in default tax regime, for January 25 attempt, getting it, or for May 24, September 24 old, getting it, where the problems are based on previous year 23-24. Getting it? That time the slab rates are what, in default tax regime, up to 30, 3 to 6, 5%, 6 to 9, 10%, 9 to 12, 15%, 12 to 15, 20%, beyond 15, 30%. This is the old tax rates. But for May 25 exams onwards, September 25 exam, Jan 26 exam, financial year 24-25 is applicable. For you, Finance Act number 2, 2024 is applicable. Finance Act number 2, 2024 is applicable. For you, all the problems in exam will be previous year 24-25. Under default tax regime, now the tax rates have been changed. For May 25 exams onwards, the tax rates have been changed. What are the tax rates for default tax regime? Up to 3 lakhs slab, 0. 3 lakh to 7 lakh. By the way, why to take that stress? We have in the book. So this is the material. The PDF is available on the website. You can download. Okay, now just a minute. So this is the default tax regime related tax rate. What is the tax rate? Up to 3 lakhs, 0. Second slab is what? 3 to 7 lakhs, 5%. Third slab is what? 7 to 10 lakh, 10%. Fourth slab is what? 10 to 12. Remember, here the slab is only 2 lakhs. Only 2 lakhs alone is taxable at 15. Again 12 to 15, 20. Beyond 15 lakh it is 30%. Let us calculate tax also here. Up to 3 lakhs 0. 3 to 7 means 4 lakhs, right? 4 lakh into 5% how much? 20,000. 7 lakh to 10 lakh is 3 lakh, right? 3 lakh into 10% how much? 30,000. 10 lakh to 12 lakh, 2 lakhs is there, right? Into 30 means 30,000. And here 3 lakh into 20, 60,000. More than 15 lakh. If at all more than 15 lakh is that, that's okay. Up to 15 lakh rupee income. Up to 15 lakh rupee income. How much is the tax liability? 1,40,000. So in exam, if at all default tax regime is there, some income is given in MCQ, because tax computations will be asked in MCQ also. In MCQ, if a tax computation is given, default tax regime is given. That too, by the way, these incomes are which incomes? Normal incomes are, special incomes are. Special incomes I will discuss little while later. Getting it? Now, for normal incomes, up to 15 lakh rupee income, if at all income is more than 15 lakh, you need not compute every time. Up to 15 lakh, thumb rule, 1,40,000 is the basic tax. After 15 lakh, how much ever is there, multiplied by 30%. Normal incomes only. Easy. Yes, sir. This is the tax rate in default tax regime. Correct? Before amendment again, it is 3 to 6, 6 to 9, 9 to 12. That and all. That is not applicable for May 2025 exams. For May 2025 exams, 0 to 3, 3 to 7, 7 to 9, 9 to 12. Correct? No. 7 to 10, 7 to 10, 10 to 12, 12 to 15, above 15. Remember, all these slab rates are applicable for only normal incomes, not special incomes. Correct? That's it. Now, okay, SSC's tax rates under default tax regime is like this. What benefit SSC is getting here? I mean, what are the conditions for this? The conditions are discussed under each head of income separately. Technically, even though default tax regime in ICA book is in the first chapter, it should not be discussed in first chapter, because in the default tax regime, it is linked with various head of incomes. The conditions are linked with various head of incomes. We will discuss about those conditions in the respective chapters revision class. Able to understand? It is not correct for us to discuss in the basic concepts. In basic concepts, tax rates alone you should remember. Tax rates alone you should remember. And in order to pay tax at concessional rate like this, you need to forego, you need to leave, you need to sacrifice so many exemptions, so many deductions. And what are all the sacrifices? What are all the deductions that you should compromise? We will discuss in the upcoming chapters. Clear until now? Now, this is default tax regime. By the way, default tax regime, optional tax regime, by the way, I am talking about which SSCs? Individual, HUF, AOP, BOI, artificial judicial persons. These are the people which I am talking about. For corporate society, local authority, partnership firm, LLP, company, foreign company, tax rates are different. Yes or no? Tax rates are different. We'll discuss a little while later. Are you clear until now? Then under optional tax regime, what is the slab rate for individuals? Or else, what is the slab rate for all of them? Up to 2.5 lakh. Up to 2.5 lakh, the tax rate is 0. Up to 2.5 lakh, the tax rate is what? You see, here I have given heading regular tax regime or normal tax regime. You can also add it as optional tax regime. Getting it? The tax rate is up to 2.5, 0. 2.5 to 5 lakh. 2.5. Next slab is taxable at 5%. 5 lakh to 10 lakh is taxable at 20%. Above 10 lakhs is taxable at 30%. We all know very well. Up to 10 lakh, the tax is fixed at 1,12,500. By the way, these tax are for normal incomes or special incomes? Normal incomes. Special incomes, these slab system will not apply. Correct? Then tax rates for resident senior citizen. Aged 60 years or more, but not exceeding 80. 60 years means if your 60th birthday is completed, if your 60th birthday is completed on 1st April, getting the point, means as on 31st March you completed 60 years of age. On 1st April you are entering into 61. Means you have completed on 31st March itself 60 years. Means in the previous year, 60 years of age should be completed by 31st March. That's enough. By 31st March, if you complete 8 years, that is more than enough. If you are a senior citizen, basic exemption is 3 lakh. 3 to 5 is 5%. 5 to 10 is 20%. Above 10 is 30%. If you are a super senior, straight away up to 5, 0. 5 to 10, 20. Above 10, 30%. Correct? These are the slab rates. But remember, these slab rates are not applicable. I mean, 3 lakhs and 5 lakh is not applicable for non-residents. And remember, under default tax regime, irrespective of age, Whether you are a normal citizen, senior, super senior, doesn't matter. By default, the basic exemption is 3 lakh only. Correct? Now remember, in tax, the most important thing is the computation format. Whenever you are computing tax, never deviate from this format. Always follow this format only. What is the tax computation format? Many students, they don't have tax computation format. They randomly compute in whatever the way they want. There are steps to compute tax. Getting it? First, what you should compute? Basic tax. Then you should add surcharge. Then you will get something called subtotal, both of it put together. Then from that, you have to reduce rebate and relief. Then you will get again subtotal. Then you need to add cess. Then you will get a grand total. Correct? Now we are discussing what actually basic tax concept we are discussing. We already discussed slab rates for individuals. HUF, AOP, BOI, artificial judicial person, we discussed the slab rates. Now let's look at special rates. Let's look at special rate. In exam, they will give you total income, or they will give you information to compute total income. Either they will give you total income details or information related to total income. Now, the moment you have total income, don't directly compute tax. First, divide this total income into 2 categories. Divide the total income into 2 categories. Getting it? Just a minute. Yeah. What are they? Normal. No. First you should always put special incomes. What are the special incomes? Yes. Long-term capital gain 112. Long-term capital gain 112A. Short-term capital gain 111A. Remember, short-term capital gain 111A only comes under special income. Normal short-term capital gain, then 115BB or BBJ. This is both are related to winnings. Black money is taxable at 60%. That's not a special income. That's a black money income, first of all. Okay, that's keep it aside. Now, suppose if the total income is, let us assume 50 lakh. If the total income is how much? 50 lakh. Okay, first, when you are computing tax, look at the problem. Allocate the 50 lakhs to various. Suppose lottery 10 lakhs is there. Lottery how much? 10 lakhs is there, allocate it here. Short-term capital gain 10 lakhs is there, 111, allocate. Long-term capital gain some 9,25,000 is there, allocate it here. Long-term capital gain 112, some 5 lakhs is there. How much it is? 5 lakhs is there, allocated. Now from 50 lakh, I allocated like this, correct? From 50 lakh, remove all this. Balancing figure is called as normal income. How much is that? 15 lakh 75,000. Now how to compute tax in this scenario? For example, in this case, on this 15 lakh 75,000, let us assume SS is going with default tax regime. We all know 1,40,000 rupees is fixed up to 15 lakh. Beyond 15 lakh, how much is there? 75,000 into 30%. What is the basic tax? No, 1,62,500, correct? This is the basic tax. And what is the long-term capital gain tax? Let us consider before amendment. Okay, before amendment for May 25. Means for January attempt and all, this is only applicable. Getting it? So, before amendment, what is the tax rate? 20%. Before amendment, what is the tax rate? 20. Short-term capital gain, what is the tax rate before amendment? 15%. Whereas 115 BBJ, all that, no, 30% is always. Now long-term capital gain, don't apply tax rate straight away. On 112A, you should not apply. 1,25,000 basic exemption is there for them. Yes or no? Balance 8 lakhs is applicable before amendment or after amendment only 12.5%. 23rd July before or after 23rd July doesn't matter. Straight away what rate? 12.5%. Correct? Suppose if the capital gains are coming after 23rd July 2024, then that is also 12%. Because 12.5%. Short-term capital gain 111A after 23rd July. 20%. So shall we do one thing? Shall we now write or shall we now revise it to our new rates? So long-term capital gain is taxable at 12.5. Short-term capital gain is taxable at 20%. These are all the rates applicable from 23rd July onwards. If the capital asset is sold on or after 23rd July, if the asset is sold on or after 23rd July 2024, if it is a short term capital gain 111A, 20% is a tax rate. If it is a long term capital gain under 112, 12.5%. If it is a long term capital gain under 112A, after reducing 1.25 lakh, balance gain is taxable at 12.5%. Correct? Now, how much is this? 5 lakh into 12.5%. 62,500. No, not 62,500. 62,500 only. Oh, then I'm very correct only. Sometimes, yeah. So 8 lakhs into 12.5, 12 ways are 120.5% is 20. 1 lakh 40, yeah. 12 weights are 96. Fine. 96,000 into 2.5. Yeah, correct. 1 lakh. 1 lakh only. Perfect. 12 and a half into 8. Correct. Yeah. 10 lakhs into 20, 2 lakhs. Then it is 3 lakh. Now, what is the total basic tax plus all put together? 1 lakh 62,500 plus 62,500. 1 lakh, 2 lakh 25,000. How much is the total? 8 lakh? 8 lakh? 8 lakh 25,000. Correct? Now, we need to substitute this in our book. So, 8 lakh 25,000. Now, in this case, surcharge is not applicable, 0, because the total income is only 50 lakh. If the total income is more than 50, surcharge is also applicable. Okay, shall we do a slight correction now? Shall we do a slight correction? Now, for example, no, total income is 51 lakh. Let us revise it. Total income is 51 lakh. Let us revise the total income to 51 lakh. Getting it? Or else we'll do one thing. We'll do one thing better. Why to confuse? Okay, let us compute the tax in a simple format. Then for surcharge and marginal relief, specifically we will compute. Okay. Now, so, yeah. So 50 lakh only. What is the basic tax actually? What is the basic tax? 8 lakh 25. Surcharge is not applicable in this scenario. What is the subtotal again? 8 lakh 25,000. Now, is there any rebate relief? Rebate is applicable only when the SSC total income is not exceeding 5 lakh or the SSC total income is not exceeding 7 lakhs in case of a default tax regime. Rebate we will discuss little while later. Okay, so in this case, rebate is not applicable. 8 lakh 25,000. Now add cess. Then you will get the gross tax liability. Gross tax liability. Sometimes in exam, they will ask you what is tax payable. Gross tax liability is different. Tax payable is different. From gross tax liability, you should remove TDS and advance tax paid. You should remove what? TDS and advance tax paid. That information will be given. TDS paid, TDS is this much, advance tax is this much, they will give you. If you reduce that, then the balance amount is called as what? Tax payable. Observe the MCQ carefully. Whether they have given TDS information, advance tax, look at that. What is the question they are asking? Are they asking tax liability before TDS advance tax, or are they asking final tax payable after TDS and advance tax? Look at that question carefully. Then select the MCQ option correctly. Correct? Easy or not? That's it. Now, so so we have completed a basic tax computation part. Tax computation format is fully done. Now let's begin rebate. Now rebate is different under optional tax regime, default tax regime. Correct? Under optional tax regime, what is the rebate maximum limit? 5 lakh. What is the maximum total income? Yes, 5 lakh. Under optional tax regime, the rebate limit is what? 5 lakh. You see, under optional tax regime, individual residents, remember, rebate is only for resident individuals. It's only for resident individuals. Individuals who are residents or resident individuals in India paying tax under optional tax regime. If total income does not exceed 5 lakh, then rebate is how much? Lower of basic tax, yes or no, or 12,500, whichever is lower. First compute basic tax. Most important condition is basic tax you compute. Add surcharge 0. Subtotal less. Rebate applicable or not. Look at the total income. Total income means what? Including dividend, including capital gains, everything. Look at the total income. If it is not exceeding 5 lakh, rebate amount is maximum how much? 12,500. Suppose my basic tax is only 5,000. Suppose my basic tax is 5,000. Tax, can it be negative? So maximum rebate can be 5,000. Either actual tax or 12,500, whichever is lower. Correct? So that's it. So rebate shall not exceed the amount of income tax. That's what the meaning. Now under optional tax regime, by the way, one more point. Rebate is not available for tax liability in respect of 112A gain. If at all basic tax includes 112A related tax amount also. So before you are calculating rebate, one more checkpoint. In the basic tax, how much is 112A tax portion? Keep it aside. Balance tax, how much? You keep it aside. It may be lottery related tax. It may be 111A related tax. It may be 112 related tax. Doesn't matter. 112A tax, keep it aside. Balance basic tax, how much? Check out. From that only you should reduce rebate. That's it. So 87A rebate is not available for 112A. Whether it is optional tax regime or default tax regime, doesn't matter. But under default tax regime, higher rebate is given. Rebate is given up to how much? 25,000. How much is the rebate given? 25,000. Rebate under default tax regime is 25,000 or basic tax, whichever is lower. Not only that, in default tax regime, there is something similar concept like marginal relief. So suppose if the total income is not exceeding 7 lakh, the rebate is how much? Lower of basic tax or 25, whichever is lower. Suppose if the total income is exceeding 7 lakh, then the rebate calculation is like this. First you should compute what is the total income minus 7 lakhs. This computation is applicable for calculation of rebate only if the total income crossed 7 lakh. First compute, suppose my total income is 7,10,000. Suppose my total income is 7,10,000. Is this step applicable? No. Which step is applicable? This step. So first compute total income minus 7 lakhs. In our example, 10,000. Compute tax on total income. Total income is what? 7,10,000. We know very well. Up to 3 lakhs, 0. 3 to 7 lakhs, 4 lakhs at 5% is equal to 20,000. Now beyond 7,10,000 is there. 7 to 10. 10,000 multiplied by 10% is equal to 1,000. So what is the step 2? 21,000. Is step 2 more than step A? Yes. Is step 2 more than step A? Yes. B is more than A. Then rebate is equal to B minus A. 21,000 minus A is how much? 10,000. So what is the rebate now? In this example, 11,000. What is the basic tax? Already we computed. Basic tax is how much? 21,000. What is the basic tax? 21. Plus surcharge? 0. Minus rebate how much? 11,000. Minus rebate how much? 11,000. What is the balance tax? 10,000. Plus 4% cess is equal to 10,400. MCQ might come. Are you getting it? Directly MCQ might come. Now what is the logic behind this? Very simple. You see here, generally if I have income less than or equal to 7 lakh, whatever basic tax comes, generally it is exempt, right? Indirect, because 25,000 rebate I will get. My income by bad luck, 10,000 extra I got. Just because 10,000 extra I got, department is asking you to pay how much? 21,000 rupees tax. Just because I got 10,000 extra income, department is asking me to pay how much? 21,000 rupees extra tax they are asking. How much extra income I got? 10. How much extra tax you are asking because of this? 21. If I don't have this 10,000, you would have given me 25,000 discount, right? If I don't have this 10,000 income, I would have got 25,000 discount, right? Because of this 10,000 income, I lost the discount. Yes or no? Moreover, you are asking me to pay 21,000 rupees tax, which is more than my 10,000. 11,000. The department said, okay, don't worry. The 10,000 you pay me, 11,000 discount you take. Clear? That logic is expressed as these steps. In exam, you should write only answer with the steps. If at all it is a descriptive questions, you should write this as a working note, clearly able to understand. And of course, maximum rebate cannot exceed tax amount. Obviously, tax if it is 10,000, rebate cannot be 15,000. That's it. Clear all of you? That's it. Now we discussed basic tax computation, rebate computation, yes or no, and special incomes, normal incomes, all that computation we completed. Now let's enter into the concept of surcharge. Surcharge for individuals, HUF, BOI, AOP, AJP, artificial judicial persons. Just 1 minute. Yes. Let's now continue discussion on what? Surcharge. Now let's now continue discussion on what? Surcharge. Just we'll open a table on surcharge. Yes, surcharge for individuals, HUF, AOP, BOI, artificial judicial persons. What is the rate of surcharge? First to know, there are totally 5 cases of surcharge. First 2 cases, you should consider total income, including dividend, including long-term capital gain 112A, including short-term capital gain 111A. Remember, and whereas in the third and fourth case, you should exclude dividend, capital gains, and all this. But you should not exclude lottery income and all. Here everything is included. Total income means literally everything. Lottery, everything. Whereas here you should exclude only which incomes? Dividend, capital gains, 11111A, 112, 112A. Only these capital gains you should exclude. Now, if at all your total income including everything, it is exceeding how much? 50 lakh. But not exceeding 1 crore. Then the surcharge rate is 10%. Surcharge is calculated on basic tax. First you compute basic tax as per what we discussed. On basic tax, surcharge will be computed at what rate? 10%. Suppose if the total income is exceeding 1 crore but not exceeding 2 crore, then surcharge is increased to 15. By the way, are there slab limits or threshold limits? Threshold limits. Threshold limit means what? Slab system will not work straight away. If at all total income is crossed 1 crore, then on the basic tax straight away will apply 15% surcharge. Suppose in the question, no, you computed total income crossed 2 crore. Total income crossed 2 crore. First case, second case do not apply. Now when the total income is crossing 2 crore, you should split the total income into multiple parts. Dividend how much? Long term capital gain 112A how much? Short term capital gain 111A how much? Keep it aside. Balance total income check out. Balance total income still it is more than 2 crore but not exceeding, then rate of surcharge 25. Suppose after eliminating dividend, long term capital gain, short term capital gain, balance total income is more than 5 crore. Then surcharge rate under default tax regime is maximum how much? 25. And for normal tax regime, surcharge rate is 37%. Are you clear? But remember, what about dividend, capital gains related? Capital gains, dividend on the tax portion is there, right? That we are excluding, no? Tax portion on dividend, all that you are excluding. On the normal incomes, you are computing basic tax. On that, you are levying 25%, 37% surcharge. What about tax? What about surcharge on tax component on dividend, long-term capital gain, short-term capital gain? What is the surcharge rate? Restricted to 15. Only in the first case, it is 10% everywhere. From second case onwards, dividend income related tax, long-term capital gain related tax, short-term 111A related tax, dividend rate of surcharge is 15% only. Correct? Yes or no? Now remember, when you are computing tax in exam, 99% they don't give like this such a complicated problem if at all dividend income is there. On the dividend related tax, what is the rate of surcharge? 15. Now how much is the dividend related tax? Average rate of tax on normal income. On normal income, average basic tax how much? You know already. Basic tax computation steps are there now. In that, normal income will be there. On that, tax will be there. Apply average. That percentage apply on the dividend income. Then you will get tax on dividend. On the tax on dividend, apply 15% surcharge. Over. Remaining basic tax will be there after dividend related tax. After dividend related tax, you remove it from remaining basic tax. On that, you should apply 25, 37 as the case may be. Remaining basic tax is there na? Lottery, winnings, on that 25, 37 as the case may be. 111 again, 112 again, on the tax is there na? On that surcharge rate is 15. That's it. We already solved this in our regular class. Correct? That's it. Okay, clear all of you? Suppose no, my total income is more than 2. More than 2. But if I eliminate dividend, if I eliminate short-term capital gain, if I eliminate 111A, 112A, my total income is less than 2. My total income is less than 2, which means 3 and 4 case do not apply. Correct? 3 and 4 case do not apply. Now 1 and 2 case, if I have to apply, I should include and then see. I should include everything and then see in 1 and 2. I should exclude everything and then see. I mean, dividend, long term, short term, I should exclude and then see. But I have total income which is more than 1 crore, but not exceeding 2 crore. Excluding this, 1, 2, 3, 4 cases do not apply. Then directly fifth case, in respect of tax on every income, the surcharge rate is easy. All of you, that's it, surcharge rate. Now whenever there is a surcharge, marginal relief will also be computed. One example of marginal relief I'll compute right now, getting it. So suppose SSC is having 1 crore 2 lakhs. SSC is having 1 crore, or else let us do one thing. SSC is having 5 crore 2 lakh. SSC is having how much? 5 crore 2 lakh is the total income. What is the tax computation? Remember, SSC is computing tax under default tax regime. Okay, I think many times we compute default only. Let us do normal tax regime. Let us do normal tax. In the revision already I did default example. Optional tax regime. How much is the tax? Basic exemption limit is 2.5 lakh. Normal citizen. Very simple. How much is the basic tax? Remember, entire 5 crore 2 lakh is normal income only, no special income. Total income itself is how much? 5 crore 2 lakh. 5 crore 2 lakh. Now on this basic tax how much? 1,12,500 plus 4 crore, sorry. Yeah, 4 crore 92 lakh, correct? Into 30%, correct? Yeah, how much it is? 4 crore 92 into 30% how much? 1 crore 46 lakh 4760, correct? 47 lakh 60. Now basic tax 112 plus 1.7 both put together how much? 1 crore 58 lakh, sorry, for 1 crore 48 lakh 72, right? 72,500. Now since total income is crossing 5 crore, moreover SS is going for optional tax regime, surcharge is levied at 37%. Everybody watch carefully, because we are doing marginal relief computation. That logic is very important. Now what is the surcharge rate? 37. How much is the surcharge amount? 55 lakh 2,825. What is the subtotal? 2 crore 75,325 minus marginal relief. Logic is very simple. Now you see, suppose SSC has 5 crore only income. Suppose SSC has only 5 crore income. SSC has only 5 crore income. How much would be the tax amount? Tell me. Basic tax is how much? 1 crore 1 crore 48 lakh 12,500 would have been the basic tax. That's wrong. That's wrong, because how come here if 5 crore 2 lakhs basic tax is 1 lakh 48, how come? Correct only. 2 lakh into 60,000. Yeah, 12,500. Yeah, correct only. 12,500 is correct only. Correct. Okay. Plus, if I have total income up to 5 crore only, surcharge is only, how much is the 25% value? 37 lakh 125. That's it. What is the subtotal? 1 crore 85 lakh 625, correct? Now earlier if I have total income 51 lakh, tax plus surcharge together, government is asking me how much? 2 crore 3 lakh 75,325, correct? 2 crore, one second I'll write, 2 crore 3 lakh 75,325. 51 lakh, sorry, 5 crore 1 lakh, 5 not 1 lakh, correct? If I have income 500 lakhs exactly, means 5 crore exactly, government is asking me to pay tax plus surcharge 1 crore 85. Just 1 lakh extra income I got. How much extra government is asking? 18 lakh 700, correct? 18 lakh 59 700. Actually I got extra income how much? 1 lakh. For that, how government is asking extra tax how much? 5 crore 2 lakhs. Oh, sorry ma. 5 crore 2 lakhs in our example. Yeah. Extra income how much I have? 2 lakhs. For that, government is asking me how much? 18 lakh 59,700. Here what I will tell government, take the 2 lakhs itself. You take 2 lakhs. Don't ask me 1859. Don't ask me 18. I am ready to pay 2 lakhs. How much is the relief? 16 lakh 59,700. Reduce this in the basic tax. 16 lakh 59,700. What is the balance tax? 1 crore 85 15,000. 1 crore 85 15,625. On this plus 4%, you will get the gross tax liability. That's it. What we applied here logic, the same is to be presented in exam. How? Here we have given the presentation. You see, We computed first tax on 5 crore 2 lakh at 37% surcharge. In step 2, what we did? We computed only tax on 5 crore, but 5 crores 25% surcharge is applicable, right? 25 plus extra 2 lakhs I am ready to pay. On 5 crore, I am ready to pay tax plus surcharge 25 plus extra 2 crore I got to, you take it. Step 1 minus step 2. If it is positive, relief is there. Suppose if the value become negative, no relief. Clear? Now, relief computation is always simple. In step 1, surcharge rate is at a higher rate. In step 2, surcharge rate is generally a lower rate. If it is 37, 25. In this case, 25, 15. In previous case, it is 15 and 10. Suppose if it is 10, lower surcharge rate is below 10. Is there any surcharge? 0. That's it. Easy or not? So, surcharge computation is easy. Clear? Now, surcharge logic is also completed. Clear? Tax computation is completely done. Now let us look at what is the tax rate for firms and all. Okay, what is the tax rate for firms? Flat 30%, 30, and for the firms surcharge rate is 12% straight away if the income is exceeding 1 crore. As usual, marginal relief is same logic like individual, just that basic tax computation alone is flat 30%. Correct? Societies, no slab limit. I mean, no basic exemption, right from first rupee to 10,000, 10%. Next 10,000 rupees, 20%. That next, after 20,000, any amount to corporate society is earning straight away taxable at 30%. But if a cooperative society is doing manufacturing activity, where the manufacturing happened between 23 and 24, they started straight away, tax rate is what? 15% on the manufacturing income, PGBP income. Other societies, if at all they want to pay lesser tax rate, 22% tax rate. Similar logic is there for companies also. Similar logic is there for companies. So what is the companies? By the way, for societies, no, what is the surcharge rate? If the total income is more than 1 crore but not exceeding 10 crore, surcharge rate is 7%. Correct? And relief is same. If the total income is exceeding 10 crore, surcharge is 12%. These rates are similar even for domestic companies. Correct? Next, by the way, if a cooperative society is declaring, if the cooperative society is paying tax at concessional tax rates under 115 BAD, BAE, BAA, BAB companies, BAC individual, BADAE societies, 10% is the surcharge rate and no relief. For them, no relief. Next, domestic company. What is the tax rate for domestic company? Normally 30%. But if the domestic company gross receipts and turnover is not exceeding 400 crores in previous year 23-24, when we see 24-25 previous year point of view, 2 years old, 20-23, if it is not exceeding 400 crore, what is the basic tax? 25. Suppose if the company manufacturing between 2019 to 2024, manufacturing company, that time companies were given boost, tax rate is 15. Suppose if a company want to pay concessional tax rate 22%. What is it? 22%. Getting it? Concessional tax regime for domestic companies. What is it? I think this is not that important. Similar to societies. It's okay. Let us not discuss about this. Not that important. What is the surcharge for domestic company? Same like cooperative societies. Do companies have marginal relief? Yes. How we calculate for individuals? The steps for computation of marginal relief is exactly same. Foreign companies, for royalty income and all, 15%, flat 50. For other income, flat 35. For foreign company, up to 10 crore worth of total income, surcharge rate is 2%. If the total income is crossing 10 crore, 5%. As usual, marginal relief is there even for foreign companies. Correct? But remember, special incomes, 112, 112A, 111A, winnings, everything, they are all same for companies, individuals. Remember, incomes are two types: normal incomes, special incomes. Normal income means that the tax rate is decided based on SSE type. If it is a company, 25%, 30%, 15%, 22%. If it is a partnership firm, 30%. If it is an individual, slab system. Special incomes are always tax rate, special rates, irrespective of type of SSE. Correct? That's it. Okay. So next, let's, now are you all clear until now? Almost we spent more than 40 minutes on revision, only basic concepts. Getting it? We still have agriculture income. We still have what? Agriculture income. Once we complete agriculture income, aggregation concept, basic concepts revision will be over. Okay. Then in the next session, we'll discuss residential status revision, which is hardly less than half an hour. Okay. Next. Are you clear, everyone? Yes or no? Yes. Now. Yes. There is one more point which is regarding unutilized basic exemption limit. Okay. What is unutilized basic exemption limit? The unutilized, see, whenever we are computing tax, no, total income is there, right? First divide the total income into two parts. One, normal income. Two, special income. So whatever total income is there, you should always divide the total income into two parts. One is normal income and special income. For example, my total income itself is 10 lakh. And in this 10 lakh, no, I have 112A gain, which is 3 lakh. And I have 112 capital gain, which is some 2 lakh. And I have 111A capital gain, which is 1 lakh. Almost approximately, let us assume 2 lakhs. So approximately 7 lakhs it is there. And let us assume this SSC is a super senior citizen. This SSC is a super senior citizen. By the way, 10 lakhs is his total income, right? 111A, 112, and 112A all put together 7 is there. Balance normal income is how much? 3 lakh. Now, this 3 lakh, now 3 lakh, right? By the way, what is the basic exemption limit applicable? 5 lakh. He is eligible for basic exemption of 5 lakhs, but his total of normal income is only 3. Now, after set off, still there is an unutilized basic exemption limit, which is 2 lakh. This unutilized basic exemption limit can be used to set off against a 111A capital gain, 112 capital gain, 112A capital gain. Now, if I have an option to set off, where I will set off? I will set off with 111A. Why? After amendment, before amendment it is 15% tax, after amendment it is 20. Before amendment, this is after amendment. 99% in exam they will give you after amendment provision only. Okay, whereas capital gain 112 is the right, before amendment 20%, after amendment it is 12.5. Now this 2 lakhs limit is there, no, I can set off against these 3 incomes and pay lesser tax. Where I will set off? Suppose if at all the question is about after amendment, I will set off first against 111A, because that is taxable at 20%. The 2 lakhs I will set off with 2 lakhs, balance is 0. On this 20% is 0. Then on this I will pay 12.5% some amount, and on this no, minus 1.25 lakh basic exemption, balance 1.75 lakh into 12.5%, which is after amendment tax rate. Before amendment 112A tax rate is 10%. After amendment 112A tax rate is 12.5. Simply speaking, unutilized basic exemption limit that can be set off against 111A capital gain, 112 capital gain, 112A capital gain. After set off, if you still have income, on that apply the tax rates. Now, this unutilized basic exemption limit can be set off, right? That is available only for residents. Resident individuals only it is available. Non-resident it is not available. That's it. This is one point which I want to clarify. That's it. Okay. Yeah. Yeah. Now let's revise on agriculture income related exemption. We all know that agriculture income is exempt from tax. 10 clause 1. Yes or no? But indirectly department is collecting tax on agriculture income through something called aggregation of tax. Correct? Through something called aggregation of tax, income tax department is collecting tax on agriculture. In our book it is there in the last page, aggregation of tax. That is called partial integration of agriculture income with non-agriculture income. That's nothing but aggregation. How they are collecting tax, what they're doing, you are having total income, right? Add agriculture income, compute basic tax on that. Whenever you are computing, most important checkpoint, when you are computing tax, no, in the question first see agriculture income there or not. If at all agriculture income is there, to the total income add agriculture income, now compute basic tax on it. Then step number 2, you have a basic exemption, right? To that add agriculture income, on that amount also compute basic tax. Step 1 minus step 2 is equal to final basic tax. Now we know after basic tax is computed, just now we discussed add surcharge, less relief, rebate, everything is common. Understood? Now this aggregation do not apply if agriculture income is not exceeding 5,000 rupees. If the net agriculture income is not exceeding 5, the aggregation do not apply. What do you mean by net agriculture income? Farmer sold vegetables, 1 lakh he got. For growing this vegetables, 20,000 he spent, remove that. Then 80,000 is the net agriculture income. That net agriculture income is not exceeding 5,000. So remember, don't get tempted immediately. Our agriculture income is 40,000. Expenses are given, cultivation expenses given, net off and then see, less than 5,000. Aggregation will not apply. Are you getting it? Suppose no, non-agriculture income is more than basic exemption, that time only it is applicable. If it is less than basic exemption, there is no logic at all, because tax itself will not come. Are you getting it? That's it. So aggregation provision do not apply to companies, LLP, societies, firms. Why? Because they are anyhow taxable at flat rate. They are always taxable at flat rate. Step 1, total income plus agriculture, flat rate. Step 2, basic exemption 0 plus agriculture, flat rate. What benefit is there for the department? Correct? That's it. Now what is agriculture income? What is agricultural income? So, agriculture income is defined under 2 clause 1A. Agriculture income is defined under 2 clause 1A. From agricultural land, you are getting rent or revenue. Only one condition: land must be situated in India and it must be used for agricultural purpose. On that agricultural purpose, agriculture activity means what? Basic operation, subsequent operations. Ultimately, whether you are doing basic operations, whether you are doing subsequent operations, the agriculture produce name is still same. A tomato is tomato only after doing those operations. Then those operations are called as agricultural operations. Anybody rendering those operations, that is also treated as agricultural income. Suppose if I am helping a farmer and charging some money from him, getting it? What help it is? It is a kind of basic operation. It is a kind of further operation. It is a kind of basic operation or further operation which do not change. Characteristic of the produce. Then it is called as what? Basic and subsequent operation, and it is still treated as agricultural income. Now for the farmer, agriculture income is exempted, right? Who has to do basic operation, subsequent operation? Anybody can do. Either he himself can do, somebody can do, anybody can do. At the end of the day, it should be from agriculture. Agriculture income is exempted, correct? So first, agriculture income, it will be arising in 3 ways. Agriculture income is in 3 types. Rent revenue from agriculture land. 2, income derived from agriculture activities. Rent means what? I have an agriculture land, I am renting it to some cultivator. That rental income is exempt. Agriculture activities, just now covered. Basic operations, remember, basic operations which are absolutely necessary. Subsequent operations, are you clear? Now we also know that dairy farming, poultry, rearing livestock for butter, all that is not considered as agriculture. Agriculture means activity must relate to land. Are you getting it? That's it. What about nursery? In nursery, plants and all will be sold by growing them in pots, not on the land. Still, nursery saplings and seedlings income is still treated as agriculture income. Sometimes in exam they will give you that the nursery is there outside India. Be careful. Everything should be in India. Growing must happen in India. Then only it is called as agriculture produce. What about forest produce? Forest produce is you are not doing any operation at all. First of all, that's a forest land that naturally grows. Correct? So either you are doing directly or through somebody you are doing operations and growing it through your effort. Then that's an agricultural income. Without effort, something is growing and that you are selling and making money. That is not an agricultural income. Correct? Then further, third type of income is what in agriculture? Income from farm building. Income from farm building. Only one condition. Farm building, owner of the land, owner of the building, both general will be same. Okay, if the farm building is rented to farmer is using it for residential purpose and storing agricultural produce purpose, then the rent is exempted. Yes or no? Now the land is there, right? The rent is generally exempted from farm building. It is generally exempted. Only one condition is there. Land must be assessed to land revenue. The building is standing on a land, right? The land must be subject to land revenue, or land should not be there in urban area. Land should not be there in urban area. Either land should be liable for land tax. Generally, if it is in urban area, land tax will be paid. If at all land tax is not paying, On that land farm building is there. From that you are getting some rental income. Is this agriculture or not is the question. Is this exempt or not is the question. If the land is in rural area, it is exempted. It is exempted. Even though land revenue, land tax is not paid. Getting it? What do you mean by rural area? In Act, no, they don't use the word rural area. They use the word specific, not in specified area. Specified area means urban. Other than specified area means rural. Correct? Now, suppose if at all on the land you are not paying tax, and the land is not in a municipality. Land is not in a area where population is more than or equal to 10,000. If at all land is in a municipality where population is 10,000 or more, that's a specified area. If it is a specified area, it's an urban land. If it's an urban land, land tax must be there. Only then farm building rent is exempted, but you are not paying land tax. But it is in urban area. Farm building related rent is agriculture income. Sorry, it is taxable income. It is taxable income. Easy or not? Farm building, I am getting rent. Is it taxable or exempted? On the land, are they paying land tax? Yes. Farm building is exempted because at the end of the land is used for agriculture purpose, building is used for farmer staying. Land is on the land, you are not paying land tax. Where the land is situated? Sir, it is in a municipality, sir, more than 10,000. Again, it's a land tax must be paid. If it is tax is not paid, it is not an agriculture income. Sir, land is in rural area, sir. It is not in municipality. Land is in rural area. What do you mean by rural area? Rural area means it is an area which is not situated in specified aerial distance. It is not situated in specified aerial distance. Aerial distance, if you see, it is not there anywhere nearby. What do you mean by specified aerial distance? Now very simple. Suppose this is the city. If the land is in this, in the city, this city, population is having more than 10,000. Land is in the city, in the municipality. Then that's a urban land. On urban land, if it is used for agriculture purpose, urban land used for agriculture purpose, and on that farm building is there, rental income is there, that is exempted only if the land tax is paid to the local authority. Easy. I think more than regular class. Now you got clarity. Correct? That's it. Now suppose sir, land is not in this area, sir. Land is outside. Is it within 2 kilometers? Yes. And you are not paying any land tax? It's okay. You don't pay land tax, fine. Is it within 2 kilometers? Yes. What is a city? What is a municipality related population? Sir, more than 10,000, sir. And it is within 2 kilometers. City municipality population is more than 10,000, but not more than 1 lakh. But not more than 1 lakh. But not more than in the municipality 1 lakh it is not there. 1 lakh population is not there. It is more than 10,000. Here, that's why you can interpret not more than 1 lakh. It is not more than 1 lakh, you can interpret like that. Getting it? Why I didn't give you? I specifically told in regular class. Because that will give you confusion. Suppose, land is in municipality. Within 2 kilometers, land is in so-and-so area. Land is in so-and-so, municipality is having some 2 lakh population. Municipality is having some 2 lakh population. Within 2 kilometers land is there. Urban land only. Yes or no? More than limit, you should not generally check. If at all, your land is situated within 2 kilometers from municipality. If at all, your land is situated within 2 kilometers from municipality, and the municipality has a population of minimum 10,000, that's an urban land. Otherwise, that is a rural land. Sir, my land is not within 2, sir. It is within 6. Is it urban or not? Check the municipality population. How much is the municipality? More than 1 lakh? Then it's an urban land. Sir, my land is situated after 6 kilometers, but within 8 kilometers. Now check the municipality population. If it is more than 10 lakh, up to 8 kilometers is not a matter at all. Distance. It is still urban land. This is the logic you should. That's why upper limit never interpret. Are you getting? Sir, my land is after 8 kilometers, sir. My land is after 8 kilometers. Municipality population is 1 crore, sir. It doesn't matter. It doesn't matter. Land is situated beyond city. City outskirts it is there. How come you call it as urban? It's a rural land. For that example is given. And we already discussed in our regular class also. Clear or not? Easy. Now you got clarity? That's it. Indirect connection with land. What do you mean by indirect connection with land? For example, ours is a company which is involving, our company is producing vegetables, using the vegetables and also making sauce, whatever. Simple. Our company is producing vegetables. In our company, we appointed one director who is an agriculture scientist. Okay. This director we are paying salary. And in the ground and all, we have employees who are doing agriculture activities, all that. Now director is getting salary, right? Salary is getting from company which is involved in agriculture. Whether director salary is also treated as agriculture income? No, that's it. Very simple. Next, Whether sale of milk, agriculture income? No. Suppose if the farmer is having 1 or 2 cows for his self purpose, and if at all balance milk is left, that alone he is selling to his neighbors nearby, marginal income only he is getting, that may not be treated as that may be treated as agriculture income. But if a farmer is doing a commercially farming, milk farming, everything, then it is a dairy farming, then it is not a agriculture income, it is fully taxable. Next. What are the examples of non-agriculture? Livestock, poultry, fishery, dairy. These are all non-agriculture incomes. They are all taxable. Sapling seedlings, growing flowers, land used for grazing of cattle, growing of bamboo, provided all these in India, then only it is agriculture income, then only it is exempted. If I am getting agriculture income from a land situated outside India, that is not treated as agriculture income and it is fully taxable. Easy. We revised agriculture concept in just 12 minutes. Every part we covered, yes or no? All of you? Then we have something called previous year assessment year. In income tax, the year is always based on previous year assessment year. For May 25 exam, September 25, Jan 26, in the question, which previous year will be there? Always 24-25 based problem. Assessment year will be 25-26. For us, which Finance Act is applicable? Finance Act 2024, number 2. Correct. Finance Act will have first schedule. First schedule will have 3 parts. Part 1, Part 2, Part 3, Part 4. Part 1 talks about assessment year 24-25. Part 2 talks about previous year 24-25. Part 3 talks about TDS rates, all that. Easy. Part 4 agriculture income related stuff. Easy or not? Next. This non-resident shipping business related, we will keep it pending, which we will be discussing in PGBP or other sources related revision. Then undisclosed income also we will keep it pending for revision class itself. In PGBP revision class or other sources revision class, we will be discussing it. Okay, that's it. Predominantly, I hope I have completed everything. By the way, coming to the introduction, Income Tax Act, okay, 265 article says you cannot levy tax without a law. So accordingly, there is an article called 246 which has a 7th schedule, which has 3 types of list: union, state, concurrent. Inside union list, entry number 82, it gave a power to levy tax on income other than agriculture income. Accordingly, under income tax 10 clause 1, agriculture income is exempted, and Income Tax Act is having totally 298 sections numerically, but actual number of sections are more than 400. Getting it? 14 schedules were there. So section means what? Section means it contains subsections or clauses. If at all in the section various points are interrelated, we call it as subsection. If they are not interrelated, we call it as clause. Yes or no? Theory questions, MCQs might be possible. Proviso means what? Proviso means it's a condition or exception. In Act, how it looks like? Provided that, further provided that, also provided that, also further provided also that, provided further that, any way it can be there in the Act. I showed you in the regular class how proviso looks like. Explanation means what? In a section, in a subsection, in a provision, if any term they want to define, then they will give the definition through explanation. Correct? That's it. Finance Act. Circulars are binding only on the department. Notifications will be binding on both SSC and department. Correct? Supreme Court judgments apply nationwide. State level judgments apply statewide. Correct? Charging section not required. That's it. First topic, basics is completed. Company definitions and all not required. At your interest, you can study on your own later. What is an Indian company? What is a domestic company? What is a foreign company? What is a widely held company? What is a closely held company? Like this, company definitions were given that you study on your own. HUF is there. In HUF, there are 2 types of schools: Mitakshara, Dayabhaga. Okay. Theory question might come, don't neglect it. Okay, in Mitakshara, anybody born in the family by birth have a right. Dayabhaga, if eldest member died, then the next eldest member will get the assets. Are you getting it? In a Mitakshara, even female family members will have a right in the property by birth. Getting it? That's it. With this, entire basic tax is completely done. We discussed every concept. That's it. In the next session, we will do residential status revision, which is again, I'm telling you, less than 20 minutes, crystal clear clarity. Yeah, let's continue. With respect to agriculture income, when the farmer is getting agriculture income, right, I already told basic operations, subsequent operations, all that. Sometimes farmers go beyond, the cultivator go beyond, the producer go beyond, where he will do some further processing and sell a different product. For example, as I already told, potatoes. Suppose a farmer who is manufacturing, who is actually producing, who is actually cultivating potatoes. Now what these potatoes can be done? He can do a further processing, cut pieces he can make, and then pack it into a ready-made, packets of 500 grams, 250 grams, 1 kg, and directly sell in retail to various houses and all. Correct? Or he can sell it as a potato chips, whatever. Now if the vegetables, if the agricultural produce is sold as a packaged commodity, if the nature of the commodity changed, cut pieces is different, chips are different from potatoes. Getting it? If the commodity nature changes, then there it is said to be composite income is involved. There it is said to be composite income. Means it is not only agriculture income, but also business income would have been involved. Now for that we have some 4 rules. Rule 7, Rule 7A, 7B, 8. These 4 rules are dealing with the taxation of composite income. Composite income means when you are selling something, the proceeds that you are getting, it is having both non-agriculture and agriculture. Now rule number 7, generally what this rule says, as per rule number 7, generally other than rubber, other than coffee, other than tea. Rule number 7 is applicable for other than rubber, coffee and tea. Because rubber, coffee and tea, they have given a dedicated percentages, deemed percentages they give. But for any other product, for example, income from growing and manufacturing products, you are growing the products. Not only that, you are also performing some activity called manufacturing. Then the market value of the agricultural produce used as raw material is deducted from total income. For this, there is one problem in the ICS study material illustration. For example, in the illustration, there is a problem where the farmer is producing sugar cane. Correct? Yes or no? The sugar cane, approximately, he has produced some sugar cane. He has produced a lot. For example, total sugar cane produced is approximately 14 lakh. Let us have some random numbers. Total sugar cane market value is how much? 14 lakh. Out of this, 50% of the sugar cane, whose market value is 7 lakh, he transferred it to his factory, where the factory produces sugar, where the factory is producing sugar. Now on this sugar cane, he spent some 2 lakh rupee extra money. He spent some 2 lakh money extra money and brought sugar, and that sugar is sold for what price? Approximately 11 lakhs he sold it for. Approximately at what price he sold? 11 lakh. Now tell me, sugar, sale of sugar, how much amount the farmer has got? 11 lakh. Getting it? Is this agricultural product, industrial? Manufacturing, industrial product. So minus. Now how to calculate business income? Here what we get is called as business income. Whatever we are getting here is called as business income, means taxable income. How to calculate this? First, sale of what? That sugar, whatever is there, that you consider. How much is the sale price? 11 lakh. Minus, what is the value of the sugar we used? Sorry, what is the value of the sugar cane we used? 7 lakh. In exam they'll give you, like sugar cane market value is how much? 14 lakh. To produce this sugar, the farmer would have spent how much? 6 lakh rupee he would have spent. He would have spent how much? 6 lakh rupee to produce 14 lakhs worth of sugar. Are you getting it? Now, so sugar cane market value we should reduce. We should not reduce the cost. Generally, what we might think is cost is only 6 lakh now. 50% means only 3 lakhs is the cost of the sugar cane. No. If at all the 6 lakhs is sold directly as an agricultural commodity, the farmer would have got exemption, right? To that extent, we should not tax, right? If we should not tax means cost should be claimed as proportionately. Yes or no, market value we should claim. Then further, how much further processing he spent? 2 lakh. So 11 minus 7 plus 2, business income is how much? 2 lakh. Now the sugar cane which he used in the manufacturing, in that agriculture income component also there. Now what is the market value of the sugar we used in manufacturing? 7 lakhs. What is the cost of producing it? 6 lakhs is for entire sugar cane, but for 50%, 3 lakh. So what is agriculture income of the sugar cane which is used in manufacturing process? 4 lakh. Further, the farmer has 50% more sugar cane left. 50% more sugar cane left. This was sold after some few days where market price is increased to 8 lakhs. Balance 50% is sold at what price? 8 lakhs. Getting it? At the time of sale of that sugar cane, market value is how much? 8 lakhs. By the way, to produce this 8 lakhs worth, to get this 8 lakhs worth of consideration on sale of sugar cane, how much farmer has spent? It's actually 6 lakhs, but it is only 50%, 3 lakh, correct? How much is agriculture income here again? 5 lakh. 50% of the sugar cane he produced directly sold in the market. That is at what price he sold? 8 lakhs. What is the cost of producing that 50% of the sugar cane? 3 lakh. What is the net agriculture income? 5 lakh. Then before the sale, 50% of the sugar cane he directly used it in his sugar production. At that time market value is what? 7 lakhs, that sugar cane value, 50%, yes or no? Whatever the market value of the agricultural produce used in manufacturing process will be taken as an expenditure, business expenditure in the computation of business income, correct? That's it. Now, what is the total income of the farmer? 2 lakhs only. Agriculture income is not a total income. Agriculture income is not liable to tax. But when we are computing tax on it, as I already told, aggregation, integration concept, that time total income plus agriculture income also you should take into account and compute tax on it. Step 1. Step 2, basic exemption plus agriculture income and compute tax on it. Yes or no? For that reason, these values are very, very important. So if the agricultural produce is used in business, it has two types of incomes. One, agriculture income is there, which is nothing but market value of the agricultural produce used in business minus cultivation expenses is equal to net agriculture income. Then coming to business income, value of the, sale of commercial commodity minus value of the agricultural produce used minus further cost if anything is given, then business income you will get. What about the balance, agricultural produce, if in the question given, that also you have to compute like this, easy or not. That's it. With this, entire basic concepts topic is completed. We'll be discussing remaining company rates, all that. Okay, company rates of tax, society rate of tax, all that. So everything almost we covered in basic term, especially tax computation, agriculture income, everything we covered. Clear? Yeah, coming to this one, rubber, coffee and tea. Here, the rules have given direct computation. The rules have given direct percentages. You need not worry about how much is cultivation expense, how much is market value of the coffee grown, nothing. If at all you are growing rubber products, if at all you are growing and selling rubber, directly income tax says 65% of the sale value is agricultural produce, business income is 35. Actually, the percentages is not applied on sale value, the percentage is applied on the net income. The percentage is applied on the net income. Very simple. What is net income? Sale of rubber value you take. Sale value of rubber minus depreciation of the machinery used minus cultivation expenses minus marketing expenses. All that you reduce. You will get net income, right? On the net income, you apply 65%, 35%. Clear? Same way. Suppose if it is coffee grown and cured, 75% is agriculture, 25% is business. Suppose if the coffee is roasted and grounded also, extra process we did, then business income will increase 40%, agriculture income is 60. If at all it is tea related one, then 60 and 40. Always thumb rule is high percentages means agriculture, low percentages means business income. That's it. Clear? Let's start revision of residential status. Very simple. It's a very small chapter, 10 pages chapter. Okay. Residential status. Residential status is different from citizenship. If you talk about individual, a person may be citizen in multiple countries, but he can only be resident in few countries. It depends upon the residential rules of the in tax laws of each country. Getting it? For determining whether a person is liable to pay tax or not, residential status is the most important factor. Now, see, in any country you take, the taxation is based upon source principle, receipt principle. For that, they have given something called source of income, section 5. There is a section called source of income, scope of total income, section 5. What is scope of total income says? Now, first of all, how many types of residential status are there? For individual and HUF, there are 3 types of residential status: ROR, RNOR, NR. Whereas for companies, LLPs, others and all, no, RNOR, middle category will not apply. The middle category is only for whom? Individual and HUF. How to decide this ROR, RNOR, non-resident will discuss little while later. Now, Like, what is the taxability based upon residential status? What is the taxability based upon residential? We already seen in our regular class that for ROR, global income is taxable. Whereas for non-resident and resident but not ordinary resident, R and OR and non-resident, incomes are taxable only two types. One, either source is in India or receipt is in India. But for R and OR, even if source and receipt are outside, but if it is from a business controlled from India, profession set up in India, that is also taxable. And the same thing is given here. If the income is received or deemed to be received, the first point you should check is what in the problem when they give you, is it received in India? Check it out. Received in India means what? First time the amount is getting in your control. Suppose if you are getting control on the amount at the foreign itself, in the abroad itself, then you received it abroad. Are you getting it? Just because you received in abroad, you received in abroad and transferring that money to India, you cannot call it as received in India. First time where you are getting that income, where are you receiving that income, where are you collecting that income, correct? If you are receiving it in India, straight away, whether you are a non-resident or a resident, doesn't matter, it is always taxable. Suppose if the income is accrue in India, suppose no receipt information is not there, or received is not in India, then see where it is accrued. Where it is accrued. Accrue or deemed to accrue, section 9. Received or deemed to be received, section 7. We have already seen that. But anyhow, we'll revise once again carefully. So, income accruing or deemed to accrue or arise in India. If receipt is not in India, accrual I will see. Then also it is fully taxable. Suppose income is accruing both outside India. For R and OR it is not taxable. And for non-resident also it is not taxable. For remember, for ROR it is a global income. Now coming to income is both outside India, receipt also outside, but it is from a business or controlled or profession set up in India, even though accrual is outside. Not only accrual, receipt is also outside, but if it is from a business controlled in India, for R and OR also it is taxable. That's it. This is scope of total income. Now, why the scope of total income? The scope of total income, having understood this, now let us understand how to decide residential status. First, residential status of individuals will come back at last. Very simple. What is the residential status of other than individuals and HUF? Other than individual HUF, we can easily classify them into company and others. Correct? We can easily classify them into other than individuals itself. We can classify them into two types. Coming to company, Indian companies are always resident. Indian companies are always residents. Just a minute. We have seen it. Yes or no? Company residential status. Is it an Indian company? Check it out. Yes. Then a company is said to be resident. Suppose if it is not an Indian company, is POEM in India? Place of effective management, is it in India? Check out. If POEM is in India, then it's a resident. If place of effective management is not in India, then it is not a resident. Simple. For companies, the answer is simple. What about partnership firms, LLPs, all that? What about them? Just a minute. Yeah, you see residential status of firms, AOP, BOI, and below here residential status of local authority, AJP. For all of them, what is the criteria? Control and management. Even if 100% of the control is in India or part of a control is in India, either 100% in India or part of the control and management is in India, then all these entities are said to be resident. When they will become non-resident, 100% control must be outside India. Then only they are non-resident. Now coming to HUF. What is a residential state? What is how to decide residential status for HUF? Same, control and management, check out. Is control and management is situated in India, even part, whole, 100% or part of it? Yes, then HUF is a resident. Suppose no, then HUF is a non-resident. But I told you, for HUF, ordinarily residential status is also to be seen. Ordinarily residential status also we should see for HUF. How to check ordinary residential status of HUF? Look at Karta. Karta's what stay? Current year stay. What past years are? Past years. Getting it? Look at Karta's past 7 years record. In the past 7 years, Karta stayed in India for 730 days or more. And in the past 10 years, Karta became resident for any 2 years. For out of 10 years, minimum 2. He may be 5 years, 7 years, 10 years, 10 out of 10 also he can be resident. Out of last 10 years, exclude current year always. Whatever the year for which we are calculating residential status, ignore that year. Ignoring that year, past 7 years, 730 days or more Karta stayed. Out of 10, for any 2 years Karta is a resident, then the HUF will become what? Resident and ordinarily resident. For HUF, basic residential status criteria is control and management. For ordinarily residents, no, for ordinarily resident, not ordinarily resident, the criteria is what? Karta's past track record. In the past 730 days or more, he is in India. And 2 out of 10, he is a resident. Then HUF is said to be ROR. Remember, Karta can be a non-resident. HUF can be an ROR. Both is possible. Yes or no? What if Karta in the current year have not stayed even single day? In the current year, he is not in India at all. But past 10 years is fully in India. Past 7 years is fully in India. For the purpose of HUF, past only we will consider of Karta. In the current year, whether he is a resident or non-resident, doesn't matter. Same way, Karta can be resident, HUF can also be non-resident. Anyway, it is permitted, possible. Getting it? Again, in case of firms, companies, AOP, BOI, directors, partners, their residential status can be absolutely different from the company, firm, LLP. Correct? Remember, HUF is a different entity. Karta and individuals, the members of the HUF are different entities, different people, different SSCs. Correct? That's it. This is residential status of HUF. Very simple. Correct? Now, residential status of individual. This is where actual crux lies. Individual residential status, many confuse. Many will have a confusion. Now, see, again, just like HUF, individuals also have. Individuals are also 3 classifications. Correct? Resident and ordinarily resident. Resident, not ordinarily resident. Non-resident. Resident means what? Current year. Ordinarily resident means what? Previous years. Suppose in current year you are a resident. Then we will check previous year's data. In previous years or also you are satisfying some criteria given. You are not only resident in current year. Ordinarily also you are a resident in past. Ordinarily also you are resident. That's what the meaning of resident and ordinarily. Suppose you are a resident in current year only. But you are ordinarily you are not a resident. Ordinarily you are not a resident of India. In this year you are a resident. Then you are said to be what? Resident and not ordinarily resident. That's what the meaning of ordinarily, not ordinarily means. How to decide ordinarily, not ordinarily? They have given some criteria. So just like HUF, for individuals also they have given, we need to calculate residential status in 2 steps. First, decide basic residential status. Then you decide ordinarily residential status. Now, individuals, how to decide basic residential status of individuals? How to decide basic residential status of individual? I have given. I have already told. Individual residential status is, you see, 1 minute. Individual residential status is basic residential status of individual. If an individual is coming under following 3 categories. If the individual is coming under following 3 categories. What are the categories? One is basic conditions category. Under basic conditions category, 2 criteria have given. Any 1 criteria satisfied by the individual. Any 1 criteria satisfied by the individual. He is deemed to be what? Basic resident. Suppose basic conditions he didn't satisfy. Let us assume. Immediately we cannot say he is a non-resident. We need to check second criteria. We need to check what? Second category. What is the second category? Special resident. Is he a special resident because of high Indian income? High Indian source of income? Check out. No, he is not coming here also. Then go to the third category, deemed resident concept. Whether he can be a deemed resident or not, check it out. If these 3 categories does not apply, if these 3 categories the individual does not come under, then only he is said to be what? Non-resident. Whether an individual is a resident or non-resident, you can't easily decide. Basic residential status will be tested in 3 categories. Test number 1, basic conditions test. Test number 2, special residential status with income test, high income test. So, test number 3, deemed residential status test. These 3 tests. First, what is the basic conditions test? Basic conditions test under first category, they have given how many criteria? 2 criteria they have given. An individual is treated as resident when, if they satisfy any one of the following. What are they? He stayed in India for how many days? 182 or more during which year? Relevant year. For what year we are calculating residential status? In the exam, you will get question for previous year 24-25 only. In 24-25 year, how many days he stayed? Check it out. Is it 182 or more? If it is so, then he is a resident. Basic criteria 1 satisfied. So he is straight away resident. 182 days they are saying, right? Should he stay only continuously 182 days? No need. In the entire 365 days, any 182 days he must be in India. On the date on which he arrived in India, the date on which he is leaving India, both these days are considered as stayed in India. Stayed in India means within territory of the land or territorial waters, airspace, staying in ship, everything is counted. Easy or not? Suppose no, 182 days logic he didn't satisfy. He didn't satisfy 182 days logic. Then you should check the second logic. Whether is he in India for 60 days or more in the current year? Check out. Is he in India for 60 days or more? Check out. And you should also check what? 365 days or more in the past 4 years, ignoring current year. Ignoring current year, preceding current year, past 4 years. Is he in India for 365 days or more? Check out. If so, 60 or more in the current year, 365 or more in the past, 4 years, then also he is said to be satisfying basic conditions. Since category 1 is satisfied, he will become a resident. Once he become a resident as per category 1, do I have to check category 2, special residential with high income 15 lakhs category? No. Should I check again deemed resident concept? No. Category 1 once is over, we need to go for ordinarily residential status. We need to go for ordinarily residential status. As per ordinarily residential status, what is the criteria? Suppose in the past 7 years, this individual is in India for 730 days or more, and past 10 years, any 2 years, he is a resident. Basic resident enough. Basic resident is enough. Out of past 10 years, for any 2 years, minimum 2 years, if at all he is satisfying either category 1, category 2, any category, he became a basic resident. The point is, he became a basic resident. In the past 10 years, for any 2 years, 730 days or more he is there. Out of past 2 years he is a resident. Not only in current year he is a resident, in the past also he is a resident only. Resident and ordinarily resident. What is he? Resident and ordinarily resident. Suppose in the current year he is a resident. As per this, either criteria 1, 182 criteria or 60 days logic, any one is satisfied. But in the past 730 days or more plus 2 out of 10 he must be resident, right? Any one is failed. Suppose any one is failed, automatically he will become a resident, but not ordinarily resident. Correct? Now suppose individual does not satisfy any of this. Before that 60 days or more logic is there, right? The 60 days or more logic do not apply for the following categories. You see, non-applicability of B2 condition. What are they? An Indian citizen who is living India for the purpose of employment outside India. If you recollect, we have solved one question where one individual in India got married and then went abroad. Yes or no? Generally, since she got married and went abroad, we may apply that. We may wrongly apply that 60 days logic does not apply. That's wrong. When 60 days logic will not apply, you are an Indian citizen, you are leaving India. For what purpose? Employment purpose you are leaving India. If employment is the purpose why you are leaving India, then only 60 days logic we will not apply. Suppose if the individual is leaving India for marriage, after marriage she is going to settle abroad, so he or she is going to settle, that time this relaxation will not apply. Correct? Further, a member of crew, for him also 60 days logic we will not apply. Not only that, an Indian citizen or a person of Indian origin who is visiting India, for him also we will not apply 60 days logic. For them, when they will become resident, only if they were in India for 182 days or more than 182 days, only then they will become resident. Who are they? Indian citizen leaving India for employment, Indian citizen working as a crew member, Indian citizen or a person of Indian origin visiting. Remember, for visitors, we have two criteria. Either he must be Indian citizen or he must be Indian origin. Indian origin means he may not be citizen. He is not an Indian citizen, but his parents and grandparents were Indian citizens. Nothing but they were born in India. They are called as what? Person of Indian origin. Now, then suppose this is what we learned, right? 60 days logic does not apply for him. 182 days logic only applicable. Suppose there is a visitor who is an Indian citizen or who is a person of Indian origin. For him, suppose if the person is Indian citizen or a person of Indian origin, he is visiting India. For him, you should check special residential status. Special residential status is a word which I used. It is not there in the act. It is not there in the IC study material. This is a name which I gave, special residential status. How to check special residential status? Easy, a special resident checkout. Very simple. See, if at all 182 days or more is there, obviously he is a resident, no doubt about it. But he didn't stay 182 days. That is the reason why we came to category 2. As per category 2, what you should check mainly? Is he in India for 120 days at least? At least means what? 120 or more than 120, and 365 or more in the past 4 years. Check out. In the current year 120 or more you see. In the past 4 years 365 or more you see. Yes sir, he stayed. Then don't decide residential status. Look at his total income excluding foreign sources. Look at his total income excluding foreign sources. If total income excluding foreign source, which means total income from Indian source, if it is exceeding 15 lakh, total income from Indian source is exceeding how much? 15 lakh. Then the person is said to be again what? Resident. The person is said to be resident. And we know very well, if a person is treated as a special resident, he is always RNOR. He is always RNOR. Easy or not? Now, what do you mean by Indian source of income? Indian source means, what do you mean by foreign source of income? Foreign source means what? Income accrue or deemed to accrue outside India and not deemed to accrue in India. However, for the purpose of foreign source, Indian source purpose alone, business controlled from India, profession set up in India is treated as what? Indian source income. So, in problem they will give you business control details, source of income in India, source of income outside, all that they will give you. Now, when you are calculating 15 lakhs, business control will be taken into account. And see whether it is more than 15 lakh. It is more than 15 lakh. 120 days or more he is satisfied. For example, getting the point, then he is an RNOR. For example, you considered business control from India, source of income in India, totaled it. It is less than 15 lakh. It is less than 15 lakh. But he stayed more than 120 days in current year, more than 365 days in the past 4 years. Getting it? But 15 lakhs logic he failed, no. That's why he will be a non-resident. He will be a non-resident. But before we even decide non-resident, we should apply category 3 also. That is second 3. So he is not a resident. As per special residential status, he is not a resident. Suppose if the answer is non-resident. Suppose if the answer is non-resident. If the answer is non-resident, which incomes are taxable? If the answer is non-resident, only if the source in India is taxable, only if the receipt is India is taxable. Income from business control from India, income from profession set up in India, where the business is happening outside, where the receiving is outside, will it be taxable for non-resident? No. In exam you should know, you should consider for computing total income for applying 15 lakhs logic, business control you will take into account. Whereas when you are calculating actual total income for the answer purpose, you will not include it for non-resident. Correct? That's it. Suppose special residential status also he has not satisfied. You cannot straight away say he is a non-resident. Check third criteria. Is he a deemed resident? Check out. Is he a deemed resident? Check out. What do you mean by a deemed resident? Very simple. An deemed resident, only Indian citizens can be deemed resident. Only Indian citizens can be deemed resident. Are they visiting India, leaving India? That and all doesn't matter. They are Indian citizens. One day also they didn't come India. That doesn't matter. They are Indian citizens. Remember, this section does not apply for Indian origins. Only special residential status talks about Indian citizen and Indian origin who are visiting India. Visiting is also most important condition there. Getting the point? Now, an Indian citizen whose total income other than foreign sources, same logic, exceeding what? 15 lakh. His Indian source of income is more than 15 lakh. And you know what? Wherever he is staying at abroad, in that country he is exempted from tax. In that country he is exempted from tax. He is not liable for tax, or liable but maybe exempted subsequently. these people are also treated as residents in India. These people are also treated as residents in India. That is what deemed residents. A deemed resident is also always RNOR. A special resident is always RNOR. A deemed resident is always RNOR. And now, what is the consequence of RNOR? Source of income in India, taxable. Received in India, taxable. Business controlled from India, profession set up in India, taxable. That's it. Residential status is over. Easy. Majorly it is over. Now we just have to cover what do you mean by deemed to be received in India, what is meant by deemed to accrue or arise in India. Deemed to be received means what? Contribution to provident fund. Contribution to provident fund in excess of 12% of salary, in excess of 9.5% interest. That is deemed to be deemed to receive in India. What is excess of 12%? What is excess of 9.5? Don't worry, we will be revising it in salaries revision. Getting it? Amount transfer from URPF, unrecognized provident fund, to recognized provident fund, deemed to be received in India. Contribution to pension scheme, it is deemed to be received in India. Are you clear? Then what do you mean by deemed to accrue? Because as per scope of total income, income accrue or arise, or deemed to accrue or arise in India, that is deemed to be source of income is in India, that is taxable for everybody. What do you mean? Which incomes are deemed to be accrue in India? Suppose if a income is received abroad, business is happening abroad, but they have a connection in India, a property in India, or a source in India, or a capital asset is in India. Any income that has a business connection, property, source, capital asset in India, that is deemed to be accrue or arise in India. If it is a deemed to accrue or arise in India, it is fully taxable. Correct? However, 5 items are not deemed to be business connection. They are not treated as what? Business connection in India. They are not treated as business connection means they are not accrued in India. If they are not accrued in India, if they are not deemed to be accrued in India, they are not taxable. What are they? Business operations partly outside India, purchase of goods in India for exports. Remember I told you JLR business operations partly outside India, Jaguar, Land Rover, Range Rover. Suppose if the Jaguar is having 2 factories, one at Germany where they are manufacturing cars and selling the cars at Germany itself, and they are also having Jaguar, Land Rover factory in India also. Just because both are connected names, just because they both are having business connection, that doesn't mean Jaguar factory which is there in India, since both are having connection, you cannot say German factory is also deemed to be accrue in India. Purchase of goods in India, some foreigner coming to India, purchasing goods and then exporting and selling abroad, yes or no, that is not deemed to be accrue in India. Collection of news and views in India, foreign news channels and all, collecting news and publishing there. For that, whatever income they are getting in abroad, that is not deemed to accrue in India. Shooting of films, so many shootings will happen in India of foreign films, getting it, and they are exhibiting it outside India, right? That income is not deemed to be accrued in India. And diamonds in notified zones by foreign companies. If foreign company is displaying diamonds in notified zones, special notified zones for diamonds purpose, getting it, that income is not deemed to be accrued in India. Easy. Next, only key points I will talk. Salary paid by government to Indian citizen for services rendered outside India. Indian citizen is there, he was transferred outside India in embassy. Okay, some embassy is working, external affairs ministry, getting it, in that ministry department is working, outside India is working on behalf of government of India. Salary paid by government of India to Indian citizen for working outside India, that salary is deemed to accrue or arise in India and it is fully taxable. However, any allowances, perquisites paid to them outside India is exempt under 10 clause 7. Easy or not? All of you? Suppose if dividend is paid outside India, but the dividend is paid by Indian company, source of income is in India. Now coming to interest, royalty and fees for technical services. What is it? Fees for technical, interest on borrowed loan, royalty for patents, computer software, all that, fees for technical services. These are the three incomes. Now suppose summary of interest, I have given a small diagram here. Who is paying this amount? Paying means the person is incurring expenditure. Who is receiving it? Receiving may be either residents or non-resident. Why are they receiving? They are receiving interest for giving loan. They are receiving royalty for allowing to use patents or software. They are receiving fees for providing technical. So for technical services it is called as fee. For patents and software it is called as royalty. For giving loans it is called as interest. Suppose if I am a lender, I am getting interest. Or I am having a patent, I gave you a patent, I am getting royalty. I am rendering some service for which I am getting some FTS, fees for technical services. Now, the fees which I am getting, the interest which I am getting, the royalty which I am getting, is it deemed to be accrue in India and taxable? This is a question. Now, for this, what is the criteria? Who paid you? Check out. Who paid it? Suppose no, the interest is paid by government. The interest is paid by whom? Government on loan borrowed. Getting government borrowed the loan, they are paying interest, and I am getting interest. Always it is taxable. It is treated as accrue in India. Suppose resident is paying, not government. Some resident is paying. Are Indian resident is paying means I am getting interest from him only. I am getting royalty from him. Obviously the service is used by him. So taxable, taxable, taxable. However, if that resident is using it, if the resident is using that particular loan, that particular interest means what? Automatically loan. Royalty means what? Patent and software. FTS means what? Some technical services. If at all the resident is using the loan, patents and software and technical services outside India for business, he is using it outside India. I am already outside, for example. Not taxable, not taxable, not taxable. Are you getting it? Any other source, he is using this interest, he is using this loan, he is using this patent, he is using the services outside for some other purpose, then also not taxable. Suppose no, if the interest is paid by, suppose if the amounts are paid by non-resident, if the amounts are paid by non-resident, I am, for example, I am a non-resident, I gave a loan to another non-resident, that non-resident is paying me, why the hell it is related to India? Obviously outside India he would have been there. So straight away general provision is what? Not taxable. But non-resident is paying me interest on loan, right? Non-resident is paying me royalty, right? Non-resident is paying me fees, right? For what? The amount is invested in India. The service is used in India. The patent is used in India. For what purpose? Business or profession? Then again taxable. Suppose if the loan is used in India for some other purpose, then not taxable. But royalty and FTS is taxable. Actually, not taxable point in the Act, it is not there. Act is silent on this. Many will interpret this as not taxable. Act is actually silent. Whereas these 2 points, Act specifically told that it is deemed to accrue or arise in India. T means what? Taxable. Indirectly T means what? Deemed to accrue or arise in India. Not taxable means what? Not deemed to accrue or arise in India. That's it. With this, residential status is completely done. Hardly 28 minutes it took. Easy or not? So let's begin. Income from salaries revision for May 25 attempt related onwards. We are going to discuss completely from the amended book. So specifically no discussion for amendments is required. When I am discussing rent-free accommodation perquisite valuation here, I will discuss what amendment happened. And there is 115 BAC standard deduction related amendment. Those who are following default tax regime, for them standard deduction is 75,000. Those who are not following default tax regime, the standard deduction is 50,000. Means optional tax regime 50,000 standard deduction, default tax regime 75,000. This is the major amendment. RFA is one amendment. This is one more amendment. That's it. There is no other amendment in salary. First, let us revise the salaries in a particular order where I will avoid 99% of the confusion that you have. Remember, this is a revision class. This is not a regular class. Getting it? But I will give you 99%. Entire vagueness will be removed. Those who have done a preparation of salaries already, you watch this revision, you get complete clarity on the salary. Now, you see, what are the various types of salaries? First of all, salary chapter, what are the various incomes covered for us? Now, we have something called 17 subsection 1. Salary means what? In this, the observation points are salary includes contribution to recognized provident fund. Salary includes interest on recognized provident fund. Salary includes allowances. Getting it? Salary includes perquisites. Salary includes profit in lieu of salary. Now, perquisite means what? Again, it is defined under 17 subsection 2. Perquisites includes two types of perquisites. One is monetary perquisites. Most of the students don't understand the salary overview. Lack of overview on the salary is what making them confusion on the salary. Perquisite, monetary perquisite. This is nothing but reimbursements. This is nothing but what? Reimbursements. Reimbursements are different. Allowances are different. Reimbursement is different, allowance is different. The basic difference is very simple. Allowance is given to you. The money will be given. Medical allowance is given. Whether you will use it for medical purpose or not, we don't know. That's irrelevant for us. Whereas reimbursement, first you will go spend money and give me the bill, company will reimburse, or direct payment by company, employer. The employer is directly paying the third party. Are you getting the point? Both are treated as monetary perquisites. They are not treated as allowances. Allowance means what? Cash is given to you. Whether you will spend it or not, I will not ask. Are you getting it? Reimbursement means what? I will reimburse based on the bill, or I will directly pay to the third party. That is reimbursement. Then perquisite can be another variety, that is non-monetary perquisite. What is a non-monetary perquisite? Best example, rent-free accommodation, motor car, use of movable assets. Like there are plenty of non-monetary benefits were there, which we will be discussing. So how to tax this non-monetary perquisites? There is a perquisite valuation rule called rule number 3. Accordingly, we need to value those perquisites. Okay, don't worry, we will discuss it from the book itself. Just I'm giving you overview. Then we have another section called 17 subsection 3, profit in lieu of salary. Nothing but compensation received by employee on termination, that and all taxable under profit in lieu of salary. But still, since the amount is received from employer, because of employer and employee relationship, that profit in lieu of salary, the amount that you are getting instead of salary, that is also taxable under salary, because you are having employer-employee relationship. Remember, any income that is taxable under salary only if the recipient and payer, they have employee-employer relationship and the amount is received because of this relationship, then only that is covered under salary. Clear or not? Next, for example, no, employee has a own house. This house is rented to employer. This house is rented to employer. I am getting rental income from the company for the house which I rented. Though we are employer and employee, the transaction is not because of employment. The rent amount which I am getting, no, from the employer for the renting of house, that is still taxable under house property only. Are you getting the point? Then so look at what are the points that are there in the salaries. So first thing is employer-employee relationship is must. The next one is what? Charging section. What is the basis for salary? We all know salary is taxable on due basis or receipt basis, whichever is earlier. Due, suppose no, April month salary, suppose we are doing financial year 1st April 2024 to 31st March 2025. This is the year for which the problems will be coming for us. Okay, 1st April month salary is due to me on 1st May. May month salary is due to me on 1st June. March month salary is due to me on next year. In the 24-25 year, how many due dates will come? 12 due dates. In 24-25 year, how many due dates will come? 12. First due date will be 1st April 2024. But 1st April 2024, the amount I receive, no, that is last year March month. Still, since it is due on 1st April, the due date comes under 24-25 year. Even though it is last year March month salary, still it is taxable in the current year. Remember, under income from salary, the income is taxed on due basis or receipt basis, whichever is earlier. Suppose I am at the last month, March. I am in certain urgent need of funds. I requested my employer, dear employer, next year April and May I have salary, right? I will receive, right? Can you pay me now itself? I asked. Before due date I am asking. Company paid it. This is called as advance salary. Advance salary, you received it before it became due. Since you received before it became due, it is taxable. So salary is taxable on due basis, if at all not yet received. Or if you already received before it become due, then receipt basis, whichever is earlier. That's how the charging section. Then sometimes you will also receive arrears of salary information in the exam. Suppose in the question, arrears of salary received point they gave, don't tax it. We assume that this amount is already taxed on due basis in the earlier years. We assume that this amount is already taxed on due basis in the earlier years. Suppose in the question in the exam they told arrears of salary bracket not taxed earlier. Now it is taxable for you. Suppose if the question is silent, arrears of salary, no point is mentioned. Earlier we assume that it is already taxed. Now already once again you are receiving, it is not taxable. The point is very simple. If an income is already taxed on due basis, subsequently when you receive it, once again it is not taxable. Or if salary is already taxed on receipt basis, subsequently when it becomes due, actually it is once again not taxable. Clear or not? Yes or no? Advance against salary and loan, both are different from advance salary. Advance against salary, loan, these both are treated as loan taken from company. Getting it? On that, perquisite valuation is there. They are not liable for taxation. Clear or not? Next, what is a salary? Salary includes wages, pension, gratuity, fees, commission, perquisite, PLU, advance salary, leave salary, provident fund. And remember, salary is an inclusive definition. Allowances and all will come under salary definition. Now, what are various types of allowances? Also, one more point I want to tell you. Provident fund contribution, that is also salary. Contribution by government or contribution by private employer, some other employer, to the employee account in the pension scheme ATCCD. For the employee, first it should be taxed. Then employee, when he is computing total income under optional tax regime, getting it, he can claim deduction for employer contribution. Getting it? That anyhow, we will once again touch it in the chapter 6A deduction. Same way, if Agniveer, central government is contributing in the name of Agniveer employee to Agniveer Corpus Fund, for him it is a benefit, therefore it is treated as salary. So pension amount paid to pension fund, amount paid to provident fund, amount paid to Agniveer Corpus Fund by employer is taxed as salary. However, provident fund, no, it is exempted up to 12% of salary. Amount contributed to recognized provident fund is exempt up to 12% of salary. I will discuss under provident fund taxation little while later. Clear until now? Salary definition, basics. No much thing in this. There is no major thing in this to remember. Allowances. There are allowances. Now coming to, when you come to allowances, there is a huge amount of confusion. Which allowances are taxable to employee under optional tax regime? Which allowances are exempt under optional tax regime? Which allowances are taxable under default tax regime? So confusion. Ignore all that. I will give you one simple diagram. Look at the allowances. Allowances are given for very simple official purpose, or allowances are given for personal purpose. Allowances are given for what purpose? Either official or allowances are given for personal purpose. Official allowances are, they are exempted. They are exempted. Whether it is optional tax regime or default tax regime, doesn't matter. Expenses given for official purpose. Don't worry, I will tell you what is official purpose allowance. I will give you example also. Allowances given for official purpose are straightway exempted. Whether it is optional tax regime or default tax regime. How much is exempted? How much is spent, that much is exempt. Sir, I got 10,000 allowance official, sir, but I spent 8,000 rupees only, sir. 2,000 rupees is taxable. Whether it is default tax or optional tax, doesn't matter. Sir, I got 10,000 allowance. Sir, I spent full 10,000 for official purpose, sir. Nothing is there. No benefit is there. Fully exempted. Now, what do you mean by official allowances? Official allowances are, example, conveyance allowance, traveling allowance, daily allowance, uniform allowance, helper allowance, research allowance. These are the allowances which are actually called as official allowances. These are allowances which are called as official, or any other allowance given exclusively for official purpose or business purpose of the employer. Now these allowances, how much exempted? Whatever you spend, that much is exempted. No difference between optional tax regime, no difference between default tax regime. Remember, I am talking about allowance. Immediately some students might think, sir, meals is exempt up to 50 rupees. No, meal is not allowance, it's a perquisite. I will come to perquisite valuation. That time I will tell you. Many think that meal. Remember, food allowance. Suppose if a company is giving food allowance, that is fully taxable. Food voucher they are giving. Food facility they are giving. Up to 50 per meal is exempted. That too under default tax regime only. That I will discuss in perquisite valuation rules, because food, meals and all is a, this thing, what? A perquisite. Now these are the tax treatment for official allowances. Remaining allowances all are called as what? Personal. Only one personal allowance is exempt. Whether optional tax regime or default tax regime, there is only one allowance which is personal in nature. Transportation allowance. What is it? transportation allowance given to blind, dumb, deaf, disabled person. Getting it? Any allowance given to blind, dumb, deaf, disabled person, that to which allowance it is? Transportation allowance. Immediately you might get it out. Sir, what is the difference between conveyance allowance, traveling allowance, transport allowance? That also will tell you. Getting it? Traveling allowance, if the word is given, that is official purpose. Conveyance, official purpose. Transport, personal purpose. Transportation allowance given to an employee, whether optional tax regime or default tax regime, fully taxable. However, a dumb, blind, deaf, disabled employee can claim exemption up to 3,200 per month. Can claim exemption up to 3,200 rupees per month. So an employee who is covered under blind, dumb, deaf category, disabled category, they can claim exemption up to 3,200 per month. Which allowance? Transportation. Suppose I am not coming under blind, dumb, deaf, disabled category. I will not have any exemption. Fully taxable. Sir, I got some other personal allowance. I got some other personal. What allowance? Leave it. I got some other personal allowance, sir. Always taxable fully under default tax regime. Always taxable fully under default tax regime. Any allowance except transport allowance. Any allowance except transport allowance. Transport allowance also for whom? That too disabled employee. For him only 3,200. If transport allowance is received by any other employee, it is fully taxable. Able to recollect everybody. Yes or no? Now there is another allowance which is fully exempt under both the regimes. There is only one allowance which is always exempt in the both the regimes. Fully exempt. That's personal actually, but fully exempt. Perquisites or allowances granted to Indian citizen by Government of India. Perquisites or allowances granted to Indian citizen by Government of India for services rendered outside India. 10 subsection 7. This allowance is always exempt. This allowance is always exempt. So allowances given to outside India to Indian citizen by Government of India for services rendered outside India, fully exempt. Remember, this exemption is available only if the government is paying perquisite or allowance to Indian citizen. That is only exempt. Salary is not exempted. Remember, salary is not exempted. Only perquisite is exempted. Allowance is exempted. Salary is not exempted. Able to understand? Salary is deemed to be received in India. It is fully taxable. Deemed to accrue from India. It is fully taxable. This is 10 subsection 7. Are you confident until now? Now, sir, still little bit of confusion. This element is taxable here, that element is taxable here, all that. So for that I gave you at the end of this salaries chapter one simple table. I gave you at the end of this chapter a simple table. Just a minute. So coming to the end of the salaries chapter, very simple. Summary of deductions. Summary of deductions or exemptions not allowed under default tax. If you are going for default tax regime, these benefits are not allowed. What are they? All, exemptions for free food voucher up to 50 per meal, no deduction. Entertainment allowance and profession tax, no deduction. Special allowances for personal use are always taxable. However, transport allowance for differently abled people, 3,200 is exempt. HRA, no deduction under default tax. Leave travel, no exemption. Rent-free residence to judges of Supreme Court, High Court, no benefit under default tax. Allowances for judges' salaries and pensions paid by UN board, no benefit under default tax. These benefits, no, under optional tax regime have some exemptions. That exemptions is what we are now going to discuss. Clear? So what is there in default tax regime? What is there in optional tax regime? And the salaries, nothing to worry. No need to even remember like whatever I told just 5 minutes before. You can directly say allowances for judges and Supreme Courts, all that. Is it allowable? Default tax regime not allowed. Optional tax regime allowed. Rent-free official residence to judge. Optional tax regime exempt. Default tax regime taxable. Leave travel concession, optional tax regime, some exemption is there. Default tax regime fully taxable. HRA, optional tax regime, some exemption is there. Default tax regime fully taxable. Special allowances for personal purpose, always taxable. Yes or no? Under default tax regime. Whereas an optional tax regime, education allowance 100 per month, hostel allowance 300 per month, like that some exemptions and all were there. Whereas transportation for differently abled people, whether it is optional tax regime or default tax regime, up to 3,200 rupees per month is exempted. Entertainment and profession tax deductions under section 16, you can claim only under optional tax regime, no deduction for default tax regime. Exemption for free food voucher up to 50 per meal, no deduction in default tax regime, only under optional up to 50 per meal is exempted. That's it. Under salaries, a single screenshot like this is enough. That's it. If you remember this, you remember what is default tax regime, what is optional tax regime, and the income from salaries. Clear, all of you? Now let's look at some important allowances and memory part of it. Important allowances. I told, right, allowances are two types: official and personal purpose. Okay, official purpose allowance means what? Helper, research allowance, uniform allowance, all that, traveling allowance, daily allowance, conveyance. Conveyance allowance means what? On office purpose, you are roaming within the city. Okay, cab charges, auto charges, all that is conveyance. On office purpose, you want to travel to another city or another country, that is traveling allowance. Transport allowance means what? That's a personal allowance. That is for traveling between office to home. That is always taxable. For differently abled person, up to 3,200 exempt under both default tax regime and optional tax regime. That's it. Clear or not? Next, now personal allowances, they are always taxable, right? In the tribal area allowance, 200 per month exempted. Remember that. Transport allowance given to transport sector employee. How much allowance you received? Check out. Flat 70% exempt. Flat, how much is exempted? 70%. However, maximum exemption per month cannot exceed 10,000. The same is expressed in the book as what? Lower of 70% of the allowance received or maximum 10,000 per month, whichever is lower, that is exempted. Nothing but transport allowance, employee given in transport sector, they will give you 10,000 monthly received. Many students will straight away claim 10,000 exemption. No, 70% only exempted, or 10,000 per month, whichever is lower. Then education allowance 100 per month per child up to 2 children. Hostel allowance per children 300 per month per child up to 2 children. This much only exempted. Are you clear? Next, any other allowance in this? No need to remember. No need to remember. Sir, allowances were given to disabled, differently abled people, sir. Under both the regimes, 3,200 per month is exempted. But remember, under optional, transport allowance received by some other employee who is not a disabled person, always taxable. Now, High Court, Supreme Court judges, allowances fully exempt under default tax regime. Allowances to United Nations Organization employees fully exempt under optional tax regime. These are the allowances which are exempt only under OTR, but not in DTR. That's what I already told. Yes or no? Next. Allowances payable outside India to Indian citizen, exempt under both the regime, irrespective of tax regime, it is exempted. Now let's come to some discussions on pension. Pension is categorized into two types. One is uncommuted, which is actually called as monthly pension. Remember, pension received on retirement only I am discussing. If pension is received before retirement, fully taxable, always taxable, except disability pension. Except disability pension received by armed force employee. Disability pension received by armed forces employee is fully exempt. But any other pension received during service, fully taxable. On retirement I am receiving, on or after retirement I am receiving, then the pension is divided into two categories. Are you receiving on a monthly basis? Yes, fully taxable. Sir, I am receiving lump sum, sir. Commuted pension I am getting. Commuted pension means what? Very simple. Suppose originally company offered you 10,000 rupees per month monthly pension, or 5,000 monthly pension, 5 lakhs lump sum cash. You chosen this option, not this option. Indirectly, monthly how much you sacrificed? 50% you sacrificed. Originally they offered how much? 10,000. But you asked the company how much? 5,000 you pay me monthly enough. Instead of 5,000 which you are sacrificing, no, which is nothing but in the monthly, how much percentage you are sacrificing? 50% you are sacrificing in the monthly pension. For 50% sacrifice of the monthly pension, you are receiving lump sum how much? 5 lakh. Tell me, full pension value is how much? Full value is how much? 50% is equal to 5 lakh. 100% is full value is equal to 10 lakh. That's it. So first compute full pension value. In exam they will give you commutation percentage, how much commuted pension you receive they will tell you. Sometimes they will tell you uncommuted pension before commutation amount they will give you, uncommuted pension after commutation they will give you. Percentage you calculate, lump sum amount they will give you, that lump sum amount is equal to this percentage, 100% is equal to how much you should calculate. Are you getting it? Clear or not? No, sir, commuted, sir, lump sum amount I received, sir. Government employee, fully exempted. Non-government employee, check whether they are receiving gratuity or not. Sir, non-government employee, sir, he is receiving gratuity also, sir. He is receiving gratuity. See, I am not talking about are they covered under gratuity act or not. I am not talking about act coverage. I am talking about are they received or not. Yes, sir, they are received, which means they are claiming exemption for gratuity also, which means under commuted pension exemption is lower. How much is exempted? Commuted pension received, how much you calculate? Based upon this full pension value you calculate. What is full pension value? Commuted pension received how much? What is commuted percentage? Check it out. You will get full pension value. In our example, commuted pension received 5 lakh. 50%. Full pension value how much? 10 lakh. So how much are received here? 5 lakhs are received. Minus 1/3 of full value. 1/3 means what? For full value, 10 lakhs into 1/3 means what? 3.33. So how much is exempt? How much is taxable? 1.66 lakh is taxable. Next, sir, I am not receiving gratuity, sir. Then half of full pension value. Half of full pension value is equal to how much? 5 lakh. How much are received? 5 lakh. Minus how much is exempted? 5 lakh. Taxable is 0. You should always compute. First, commuted pension received how much? Put in the amount column. Less exemption. 1/3 of full pension value, not 1/3 of received. 1/3 of full value. Full value you should compute. Sometimes if you're lucky enough in the exam, they'll give you that full value also. Clear? That's it. Pension is over. And I told you, disability pension granted to disabled person of armed forces, they are always exempted. Getting it? Okay, persons who retired normally is not exempt. Persons who are received because of disability during the service also it is exempted. That's it. Correct? Sometimes no pension may be received by family members. If family members are receiving the pension, that is taxable under income from other sources. Okay, that's it. Anyhow, that's it. Pension point is majorly over. Now let's look at gratuity. Now let's look at what? Gratuity. Gratuity again. If you receive gratuity on service, means you didn't retire yet, fully taxable. Gratuity received before service is fully taxable. Just 1 minute. Yes, let's continue. Gratuity. Gratuity received before retirement is always taxable. It is treated at par with allowance. Remember, gratuity received before retirement, pension received before retirement, uncommuted pension received before retirement, they are all treated at par with allowance. When I say at par with allowance, you should consider that in RFA salary computation purpose. RFA salary computation. For example, in September 24 exams, leave encashment is received during service. Before retirement, it is treated as allowance and it is considered in RFA salary computation purpose. Remember? Fine. Sir, I received gratuity on retirement, sir. Very simple. You are a government employee. You are a government employee, fully exempt. Non-government, you received during service, fully taxable. Government employee received on retirement or death, fully exempt. Remember, if it is received during the service, whether it is government or non-government, are fully taxable. Sir, if the gratuity is received by other employee, if the gratuity is received by other employee, check whether that employee is covered under the Payment of Gratuity Act or not. An employee drawing a salary so and so amount, some limit is there, only they are covered under Gratuity Act. Check whether the employee is covered under Gratuity Act or not. Yes, sir, he is covered under Gratuity Act. Then calculate, first identify how much amount received. Sir, he received some 15 lakh rupees, sir. First identify how much amount he received. Okay. From that, exemption is as below. How much is exempted? Least of the following. Statutory limit under income tax is 20 lakh. Maximum exemption cannot exceed 20. Maximum amount cannot exceed even 15 lakhs, right? How much amount you received? 15. That cannot exceed, right? Gratuity limit under Gratuity Act. How much is the limit? 15 by 26 into completed years of service or part thereof in excess of 6 months. What does it mean? Suppose employee retired after 26 years, 8 months, it is treated as 27. Sir, employee retired after 26 years, 2 months, sir. Then it is treated as 26. Sir, employee retired after 26 years, 11 months, 9 days. It is still treated as 27. Suppose if act is not applicable, there you see only completed years of service is used. They didn't use part thereof in excess of 6 months. So, sir, I am an employee, completed 26 years, sir. 11 months, sir. 20 days I worked, sir. Still it is treated as 26. If act is applicable, 27. If act is not applicable, completed years means 26. Are you clear? Now, how much is exempted? 15 by 26 into completed years or part thereof in excess of 6 months multiplied by last drawn salary. Last drawn salary means what? At the time of retirement, what is your salary? Salary means what? Salary means what? Here we have given. Salary means what? Where Gratuity Act is applicable, salary definition is different. If Gratuity Act is not applicable, salary definition is different. If Act is applicable, for that employee, 15 by 26 into completed years or part thereof in excess of 6 months into last on salary is there, right? Their salary means what? Basic plus any DA. Whether for retirement or not for retirement, irrelevant. In exam, if they mention the DA, they didn't mention anything. We assume that it is not for retirement. Specifically, they mentioned something is for retirement. Then only we will consider. Clear? So, 15 by 26 into, in our example, 27 years into last run salary, you will get some amount, compute it. So, this amount you know, whichever is lower, that amount will be reduced from this. Balance amount is taxable. This is to be added to gross salary computation. Easy or not? Yes, next. Sir, employee, he is not covered under the Gratuity Act, sir. Every criteria is same. Exemption provision is same. Least of the following only exempted. One criteria is different. It's not 15 by 26. Here it is 15 by 30. Actually, in the ICA book, 1 by 2 they will use. Half only they will use. But in order for you to get a clear-cut distinction, I told 15 by 30 multiplied by completed years multiplied by average salary. Not last drawn salary. Average salary means what? Average of last 10 months salary preceding month of retirement. Okay. Now, last 10 months average you should take. What you should take in averaging? You should take 3 components. You should take basic of last 10 months, total it. DA for retirement purpose in the last 10 months, total it. Commission percentage of total last 10 months proportionately how much it is calculated. Remember, fixed commission should not be considered. Only commission percentage of turnover should be considered. Total it. 10 months you total it. Divided by 10 is equal to, you will get average salary. That's it. And remember, the lifetime exemption limit is restricted to 20 lakh. Suppose in the question they might give you gratuity received. Earlier employee got exemption for 5 lakhs. Now here statutory limit is there, not 20. That should be adjusted by 5 lakh. Means 15 lakh only you should consider lifetime. Whether you are receiving from one employer or multiple employer, whether you are receiving in 1 year or multiple years, you are receiving on retirement. Exemption is maximum 20 lakhs throughout the lifetime of the SSC. Clear or not? All of you. Next, when I am discussing RFA, that time I will discuss HRA. Okay, HRA I didn't discuss. I will discuss at the time of RFA. Next, leave encashment. Leave encashment again. Remember, leave encashment received during service is fully taxable. On retirement, I am receiving, sir. That time, government employee fully exempted. Yes or no? Sir, non-government employee. Then 4 criterias were given. 4 criterias were given. So, 25 lakh. Leave salary actually received. Remember, gratuity it is 20. Leave encashment it is 25 lakh. 10 months into average salary, 1 criteria. 4th criteria, cash equivalent of unavailed leave to the credit at the time of retirement. Earned leave entitlement cannot exceed 30 days every year. This is the point where every student will do wrong. For this, best way to understand this 4th point is what? Let us convert this 4th point into a formula. What is the formula? Look in the problem, they will give you completed years of service. Take that. Part thereof in excess of 6 months. Don't consider. Only completed years you take. Multiplied by per annum how many leaves employee eligible? Look at. Per annum company policy, what is it? Check out. Or 30 days. Whichever is lower. Yes or no? This is one bracket. Correct? Minus leaves utilized how much? Leaves utilized by employee throughout that number of years in service, how much calculate? Divided by 30 multiplied by average salary. So first numerator you should compute. What we are computing in numerator? We are simply computing, we are simply computing unavailed leave. Unavailed leave means what? Unutilized leave. How to calculate unutilized leave? Total leave how much minus utilized leave how much is equal to unutilized. Total leave is how to calculate? Per annum total leave cannot exceed 30 days. Eligible leaves per annum should not exceed 30. That's what they're saying. Earned leave entitlement cannot exceed 30 days for every year of service. So per annum, how many maximum leaves? 30. Suppose company policy 45 days, but you can only take 30. Sir, I completed 20 years, sir. Company policy 45 days, sir. No, that is not considered. 30 only considered. So total leaves eligible how much? 600 days. Correct? Sir, in those 20 years, no, I already used 450 days leave, sir. Leaves utilized, actual information you take. In the question, they will give you mostly. So unutilized leave is how much? 150. Now, what is the fourth criteria? 150 by 30 into average salary. That's it. If you understand this point, leave encashment, you can never do mistake. This is how you should understand leave encashment. Are you clear? Suppose, no, sir, if the company policy itself is 20, sir, then 20 or 30, whichever is lower, 20. 20 into 20, 40. Already you took 450 leaves, sir. No leave encashment exemption, zero exemption. Clear or not? Everybody got communicated clearly whatever we discussed in depth without any confusion? Yes. Yes. Next, now here also average salary used. Average salary means what? Last 10 months salary preceding the date of retirement. Here they used date of retirement. In gratuity, where gratuity act is not applicable, month of retirement they used. Now salary means what? Same, basic plus DA for retirement plus commission percentage of turnover. Now immediately you might get, sir, somewhere at gratuity, where gratuity act is applicable, basic salary means basic plus any DA. At this one, leave encashment, gratuity where act is not applicable, HRA, there are various other. There again salary is different. Different places, different salary definition is there. How to remember that? Very simple. At the end of this chapter, we gave one schedule. We gave one simple table. At the end of this chapter, we gave one table. Key observations under salaries. Meaning of salary for various purpose. You see, for gratuity, where act is applicable, basic plus any DA. For RPF contribution, VRS, gratuity, leave encashment, which gratuity, by the way, act is not applicable, HRA. In all these cases, if the word salary comes, salary means what? Basic, DA for retirement plus commission percentage of turnover. Sir, suppose if it is a rent-free accommodation, what is salary? Basic plus DA for retirement plus any commission, any bonus, taxable portion of allowances, only allowances, not reimbursements. Perk visit should not be considered in this. In salary definition, for RFA purpose, perk visit should not be considered. Only salary, basic plus DA for retirement plus all types of allowances. Only taxable portion shall be considered. Under default tax regime, taxable portions will be mainly whole. Under optional tax regime, taxable portion will be proportionate. Able to understand? All of you. That's it. That's it. With this, leave encashment is also over. Leave encashment is over. Clear? Just a minute. Then coming to provident fund. Provident fund is one of the toughest thing in the entire salaries topic. Very simple, I will tell you. Okay, contributions by central government to their employees is SPF. Employer contribution fully exempt. Employee contribution we are collecting and paying. What is the tax treatment for him? He will claim 80C deduction. Chapter 6 here, that too under optional tax regime. Employers, interest will be given on the contribution, fully exempt for government employee. Later he withdrawn lump sum amount, fully exempted. Correct? Then recognized provident fund. Next one is RPF. This is for private sector, not government companies, private sector. For them, no, employer contribution is taxable in the hands of employee in excess of 12% of salary. Up to 12% of salary exempted. Salary means what? Basic plus DA for retirement plus commission percentage of turnover. 12% of salary is exempted. Beyond 12% it is taxable. Beyond 12% of salary it is taxable. That too. Employee contribution also will be there, right? RPF, that he can claim it as deduction under 80C in optional tax regime. Sir, interest is paid by employer, sir. Up to 9.5% per annum. Interest rate up to 9.5% per annum is exempted. However, from 2021 onwards, if at all employee contribution in a year is more than 2.5 lakh, Beyond 2.5 lakh, beyond 2.5 lakh, very simple. Look at this, employer contribution, employee contribution. Employer contribution is exempt up to how much? Principal 12% of salary. Employee contribution 80C deduction under optional tax regime. Now we are paying interest. Interest is exempted how much? 9.5% per annum. Extra interest is fully taxable. Employee contribution is also exempt up to how much? 9.5. But employee contribution, we should split. How much is employee contribution? First identify, sir. Employee contribution is 5 lakhs, sir, per annum. This year came. Then on first 2.5 lakh, 9.5% is exempt. Beyond that is taxable. On the balance 2.5 lakh, in the 5 lakh, no, balance 2.5 lakh, entire interest is taxable. Entire interest is taxable. Suppose no RPF is there. Inside that, employer is not giving any contribution, but employee voluntarily contributing. Then the limit is treated as 5 lakhs. Are you clear? Everybody. So that's why what they will do for the purpose of RPF, separate accounts will be maintained for taxable portion and non-taxable portion. So taxable portion means up to 2.5 lakh, sorry, beyond 2.5 lakh, any contribution is there from employee, that amount will be credited to taxable portion account. On that, whatever interest is credited, fully taxable. Non-taxable portion will be there. On that, interest credited up to 9.5% is exempt. Beyond that is not taxable. But from exam point of view, this is not that important. Clear? That's it. Provident fund is over. Now, suppose RPF is there. Employee is withdrawing from RPF. Employee is withdrawing. Did he withdraw after 5 years of service? 5 years of service means what? With the same employer 5 years? Huh? No. After joining job, till now how many years you completed? More than 5 years. Now you are withdrawing from RPF. Fully exempt. Sir, I am withdrawing before 5 years. Is there a valid purpose? Valid purpose means what? Ill health, contraction or discontinuation of the employer business, or any reason which is not in the control of my employee. Somehow I got the money without a valid, for a valid purpose, for a valid purpose, if I got the money, exempted. Not a valid purpose. Suppose there is no valid purpose, then see, is the amount you withdrawn? No. Have you transferred to another RPF account with another employer? No, sir. Then no, I didn't transfer. Taxable. Or you transferred to pension account? Yes, sir. Exempted. Suppose you didn't transfer. Taxable. Simple. Easy or not? That is withdrawal from RPF. If you withdraw after 5 years, no, it is always exempt. The question comes only before withdrawal. Withdrawal before 5 years. For this 192A TDS section is also there, which we will discuss in TDS revision. Clear? Next. Suppose no, if withdrawal from provident fund is taxable, how to tax it? Employer contribution, interest on employer contribution is taxable under salaries. Employee contribution, no tax treatment. Interest on employee contribution is taxable under other sources. That's it. Simple. Contribution to pension fund, that and all easy. Profit in lieu of salary, nothing is there in this. Retrenchment compensation, not that important from exam point of view. Then VRS. VRS is what? Exemption only. Exemption only if employee has completed 10 years of service or 40 years of age. Remember, this requirement does not apply to PSU employees. Public sector companies will be there for their employees 40 years age, 10 years, that and logic is not applicable. If they receive VRS, no, least of the following is exempted. How much is exempted? Maximum 5 lakh, maximum actual amount, or 3 months salary multiplied by completed years of service. Yes or no? 3 months salary multiplied by completed years of service, how much? Or salary at the time of retirement, how much you take? Into remaining months of service. If at all this retirement does not happen, how many months of service is that? Check out. That amount you compute. 3 months into completed years into last drawn salary. How much amount you check out? In all these 4, lowest amount is exempted from the amount received. Clear? All of you. Now remember, exemption for VRS is available only one time during the lifetime. It is not multiple times, only one time. If you claim one time exemption, sir, I claimed only 2 lakhs exemption, sir, one time, but statutory 5 lakhs is there, that is irrelevant. Clear or not? Now what is salary here? Last on salary is there, all that. Basic DA for retirement plus commission percentage of turnover. For 5 purposes, the salary definition is same. HRA, RPF, gratuity where act is not applicable, leave encashment, VRS. For all these 5 purposes, salary definition is same. Correct or not? Easy or not? Next. Then perquisites. There are various types of perquisite in this. No, this one complex taxable perquisite calculation is there, which we discussed in regular class. It is not required in revision purpose, not that important in exam point of view. Even this comes, it will come only for 4 to 5 marks weightage. Getting it? Which is very difficult to solve. We already seen it. Able to understand? Next, exemption from superannuation fund. This is also not that required. Tax free perquisites. These perquisite means what? It may be monetary or it may be non-monetary. Monetary means what? Reimbursement or your expenditure employer paid directly, obligation paid to you on behalf of you. Or perquisite can be non-monetary. Facility. Facilities are taxable only for specified employees. Reimbursements, your amount I paid, employer paid, your amount liability. These and all is taxable for all employees. Whereas facility is taxable only for specified employee. Who is a specified employee? Specified employee is a person, we have given somewhere definition. Yeah, you see specified employee definition. Who is a director, or an employee who is having substantial interest in the entity, or employee who is drawing per annum more than 50,000 monetary benefits. Obviously, this definition is very outdated. Today, practical, if you see, everybody is a specified employee. In the problem that you are going to get, 99% everybody is a specified. Sometimes to test this, a 2 marks question might be given as a two descriptive questions they might give, 1 mark each. Like that they will test this provision. Apart from that, there is no testing of this provision practically with the numbers. Clear? All of you. We are about to finish the salaries chapter. Another hardly 10 minutes. Okay. Now look at this. There are some benefits which are fully exempt. What are they? Telephone facilities fully exempt. Transport facility provided by an employer to a transport sector employee is exempted. Remember, transport allowance is different, transport facility is different. Transport allowance given to transport sector employee, allowance, optional tax regime, 70% of the amount received or 10,000, whichever is lower. Transportation facility fully exempt. Yes or no? Whether it is default tax or optional tax, it doesn't matter. Clear? Next, all perquisites know if any exemption is there, they are exempt under default tax regime. Also, optional default tax regime, no differential treatment here. Only per meal coupon alone, 50 rupees up to limit. That is not there in default tax regime exemption. Yes or no? Yes. Remember, all these points will come at later. We will discuss all these points. We'll discuss now. Exemption for LTC, leave travel concession. Very simple. Exemption is given only for travel expenses for the employee on a tour. Travel expenses for the employee on a tour, only travel expenses. For example, company paid, employee tour related one, some 10 lakhs he paid, company paid. Tour must be within India. The travel must be within India. Exemption is available only for travel expenses of individual employee, spouse, 2 children, parents or brother or sister, family members, correct? You see here, family members means what? Here we have given somewhere. Yeah, you see, the exemption is available only for whom? Employee and his family. Family means what? Spouse, children, dependent parents, dependent brother or sister. In entire perquisites, no, family members means brother and sister included, parents is included, provided they must be dependent. Children and spouse can be dependent on me, maybe independent also, doesn't matter. Dependent means income they don't have, they are depending on me for livelihood. Okay, not dependent means what? Non-dependent means they have their own incomes. That's what the meaning. Are you clear? Next, LTC. What is exempted? Only travel cost is exempted. That too for how many? Spouse, children, dependent parents, dependent brother or sister. Children for how many? 2. Yes or no? That's it. Limit for exemption. How much is exempted? 2 journeys it is exempted. In a block of 4 years. Employer has given you travel expense related tour for how many? 2 tours. 2 types of tours it is exempted in a block of 4 years. Right now 2022 to 2025 calendar year is running on. Getting it? So up to March 2025 for you problem will be given on 24-25 and they will give you information how many tours were already completed. Suppose this is 3rd tour, leave travel allowance is fully taxable. Suppose this is 2nd tour. Getting it? Travel cost reimbursement alone is exempted for self, spouse, children, 2 children, all that. 2 children means what? Who were born on or after 1998 only will be counted. If their children were born before 1998, they may not be counted. They will not be counted. Again, children born after 1998, twins, first time, they are considered as 2. First time single, second time twins, they are considered as 2 children only as a whole. Yes or no? That's it. Then how much is exempted? Economy fare in air travel. Rail fare, first class air condition, that's it. This is only exempted. Clear or not? Then, sir, company provided medical facility. Next perquisite is what? Medical facility. Medical facility, how much is taxable, how much is exempted? All medical facilities are taxable except following four. Except following four. Medical facilities given to whom, by the way? Employee or family members. Family means what? Spouse, children, dependent parents, dependent brother or sister. What medical facilities are exempted? Only the following are exempted. How many were there? 1, 2, 3, 4. Only 4 medical facilities are exempt. Rest all other taxable. Medical reimbursements, everything is taxable. Following, what are they? Reimbursement. Remember, a medical treatment provided to their family in employer hospital. Straight away treatment in employer hospital, fully exempt. Sir, employer hospital, it's not employer hospital, sir, but outside hospital, company bear the expenditure or company is reimbursing the expenditure. Then it is exempted only if the treatment is in government hospital or a local authority hospital, or if the treatment is for specified disease in any hospital approved by Commissioner of Income Tax, or it is for COVID-19 treatment, provided COVID-19 positive report is required, treatment related bills and all is required. Okay, one. If at all company is reimbursing you the money or company paying directly to the hospital, the amount paid is exempted only if it is a government hospital or for specified diseases or for COVID, yes or no, or medical treatment abroad. Abroad medical treatment means what? For abroad, no. Employee or family member, somebody suffering from some problem, company is bearing the entire expenditure. That expenditure is exempted for medical treatment up to the limit permitted by RBI. Travel and stay also up to the limit permitted by RBI is exempted, provided travel and boarding expenses and traveling and boarding expenses are restricted to only the patient and one attendant. Yes or no? That too, traveling related reimbursement is there, right? Medical treatment outside in traveling reimbursement, that is exempted only if the gross total income does not exceed 2 lakh. Typically speaking, for all employees it is taxable. But sometimes in exam only medical facility they will give you, where this point may be tested specifically on that. Clear or not? Yes or no? Now sometimes companies might take premiums, okay, for health insurance of the employee. Company might pay premium, okay, or they will reimburse you for the health insurance policy you purchased. That is fully exempted. Remember, if a company is giving you medical allowance, fully taxable. Medical allowance is fully taxable, no exemption at all. Medical reimbursement, these 4 types of reimbursements are exempted. Apart from this, company might take personal accident insurance, where maturity amount will not be there, exempted. Suppose company is paying life insurance premium where maturity amount will be there. Life insurance premium company is paying on your name, fully taxable. If on the employee name, company is paying life insurance premium where maturity amount will be there, that is fully taxable. Personal accident insurance, only if the employee day he will get, family members get, so it is fully exempted. You see, that's what, if an employer takes personal accident insurance and pays the premium, no benefit is provided, therefore insurance is exempted. However, if employee LIC policy, life insurance policy is taken on his name, which is not an accident insurance policy type, where some benefit he will get tomorrow if at all he is alive also, that is fully taxable. In one of the test your knowledge problem, it is there. Clear or not? Yes or no? Then perquisites which are taxable only for specified employees. Specified employee, what? Facility is only taxable. Yes or no? Now let's cover RFA. Let's understand RFA discussion and HRA discussion both. HRA what? HRA, suppose I am receiving HRA received 10 subsection 13A only under optional tax regime, it is exempted. How much is exempted? Actual amount, how much checkout, okay, rent paid minus 10% of salary checkout, 50% of salary in case of Delhi, Mumbai, Kolkata, Chennai, 40% of salary if the house is taken on rent in another city, other cities, correct? One condition, in that city he should not have a own house. He should not be claiming SOP benefit. Correct or not? That's it. So salary means what? Basic plus TA for retirement plus commission percentage of turnover. Easy or not? Now this is HRA. By the way, here salary is there, right? Suppose I am receiving HRA from April month to September month. For these 6 months HRA I am receiving. Salary should also be considered only for these 6 months. Sir, April month salary is paid in May, sir. May month salary is paid in June, sir. June month salary is paid in August, sir. Like that it is there, sir. What about that? That is irrelevant. When the salary is paid, salary of this month is paid in which month? That is irrelevant. April month salary, how much? That only you should take. September month salary, how much you should take? Only that only. Are you getting the point? In ICI book, test your knowledge question. First question is the important question, very best question that you solve it. Clear? That's it. RFA is, HRA is over. Now RFA. Everybody, I'm telling you, 99% of the students, they do mistakes in RFA computation. For RFA computation, there is a simple decoding. First to know, furnished, unfurnished, leave all that. Leave all that. First calculate, look at the question. Identify what employee is getting. He is getting furniture, sir. He is getting house also, sir. Then look at who is the employer. Who is the boss? Government is the boss, sir. Government is giving the benefit. Now look at, is the property owned or rented by the government? Check it out. Is it a hotel or not a hotel? Check it out. Sir, it's not a hotel, sir. It's an accommodation given by government. Then straight away license fee determined will be value of the house given to you. Is the value of the house given to you. Okay. Compute. Answer came. Suppose value of the house, license fee, some 10,000 per month. 12 months the government gave you. You stayed 12 months. Then 12 months you should compute 1,20,000. Sir, I stayed only for 4 months, sir. Then 4 months only it should be computed. Able to understand? Then suppose, sir, government gave me a hotel, sir, accommodation. Then 24% of salary or actual rent for the hotel, whichever is lower, that much is the outer column. Fine. This is accommodation perquisite value. Sir, along with this, I was given furniture also, sir. I was given furniture appliance. If it is given, compute the value. If it is not given, 0. Sir, furniture is given, sir. Then look at whether the furniture is purchased by the government and then gave you. Purchased by employer and then gave you. Yes, sir, he purchased and then gave me, sir. Then 10% per annum of the original cost of the movable asset. Remember, laptop facility is always exempt. Remaining any other furniture is taxable at 10% per annum of the original cost. That is treated as perquisite value. Sir, company hired on rent, sir. Then they are giving me. Rental expenditure is a benefit given to you because you are getting a benefit. Now, total accommodation 1,20,000, furniture whatever value, you will get the gross perquisite. Remember, this is not taxable value. This is value of the perquisite I got. How much is taxable? First, you should solve like this in the exam. First, compute gross perquisite. Just now we computed. Minus amount recovered, reduce it. Then you will get what? Taxable amount. Are you getting it? Suppose if the employer is a private sector employer, not a government employer, but other than government, then more than 40, suppose employer owned, so or else we'll take here 3 categories were there: rented, hotel, owner. Rented 10% of salary or actual rent, whichever is lower. 10% of salary or actual rent. Before amendment, no, it was 15% of salary up to 31st August 2023. But for 24-25 year exams purpose, this percentage is enough. No need to remember. ICA book itself does not talk about before amendment. Students are unnecessarily looking at old amendment and new amendment and confusing. Not required at all. Getting it? Suppose if it is hotel, same as government. So compute that value. Sir, employer owns, sir. Then look at the population in that city where you got the accommodation. More than 40 lakhs, 10% of salary. 15 to 40 lakhs, 7.5. Any other area, 5% of salary. By the way, salary means for which means how many months? Accommodation is occupied by SSC for 3 months. Then for 3 months only salary should take. Which 3 months? Jan, Feb, March, employee taken, sir, accommodation. Only those 3 months related salary only you should take. Salary means what? Basic plus DA for retirement plus every allowance only taxable portion. Correct? Under default tax regime, taxable portion generally will be full. Under optional tax regime, taxable portion can be some amount because exemptions were there. Yes or no? That's it. So now you compute like that. Suppose, sir, furniture is also given, sir. Furniture valuation rule is same. Government employee, non-government, no variation at all. Same valuation rule. Look at here, same. Then you will get total benefit value. What is the total benefit value? Minus, did employee recover? Did employee paid company any amount? Did company recover any amount? Recover. Then balance is taxable. Now here, there is most important point. Subsequent year valuation rule. What is this? Subsequent year. Sir, in 23-24, I got accommodation, sir. Perquisite valuation is done, sir. In 25-26, I am continuing the same house, sir. Employer has given me, allowed me. I am staying in the same house. Then there is a maximum limit on perquisite valuation. Generally, many interpret it as second year we should compute perquisite like this. Wrong. You should compute in second year also the same way. Second year also you should compute the same logic. But one checkpoint you should do. Checkpoint is what? Value of perquisite in the 23-24, how much checkout? Previous year, how much is the perquisite checkout? Index numbers they will give you. Cost inflation index numbers they will give you. Of the 24-25 amount, how much checkout? Number. First year you got perquisite, no? Or 23-24, whichever is later is there, right? That number you take. How much value you are getting? How much value? Sir, I am getting some 2 lakhs at this value. Sir, this perquisite value is 1.8 lakh only. As per the rule, it is 1.8. Since it is less than 2 lakhs, no need to apply that provision. 1.8 lakh only perquisite. Yes or no? Sir, as per 10% of salary, 7.5% of salary, hotel accommodation, all that, no? I saw it is coming somewhere around 2.5 lakhs, sir. In the second year. First year it is 2 lakhs only. In second year, how much it is coming? 2.5. Because in second year, my salary increased, sir. That's why RFA value also increased. But perquisite value shall not exceed indexed value. Perquisite value shall not exceed indexed. As per the indexed value, how much it cannot exceed 2? How much as per the main rule? 2.5. But since it is less than 2, I will restrict the valuation to 2 lakhs. This is a benefit. In subsequent years, remember first year your salary will be low. But subsequent year, as you grow further, your salary will be increased. Automatically, RFA valuation also will increase. No, same house I am saying, but you are increasing value of the house. It should not be done. It should be increased only to the extent of inflation. That is the logic. It shall not exceed. Getting it? So this is only a checkpoint. If at all the value you, by the way, this checkpoint is applicable only for non-government employer. Yes or no? So first compute 10% of salary, 7.5%, 5% of salary, or 10% or actual rent, whichever is lower. In case of rented, all that you compute. Remember only accommodation value. Furniture value should not be considered. Furniture value should not check here. Accommodation value you check. In the second year. First year, how much is accommodation value? Check out. Second year value increased. Then immediately you should apply this logic. If the second year value, first year value both are same, no need to. If second year value increased, then you should apply this logic. First year value multiplied by second year index number divided by first year index number. How much that value? Your perquisite cannot exceed that. Already computed value is less than this, no problem. Computed value will be the perquisite value. Correct? Once again, listen to this if at all you don't understand. Clearly told. Getting it? That's it. Now, first year means what? First year means what? In which year you got accommodation? Check out. Sir, I got in 9-10 years, sir. 23-24 year or 9-10 year, whichever is later. Nothing but if accommodation is given long ago, now you are staying. 23-24 accommodation value, how much you check out? Multiply by index number. Sir, accommodation itself I took first time in 24-25, sir. Then first year means 24-25. Clear? Now first year 24-25 means 25-26 onwards will be second year. Second year onwards you should apply this logic. Correct or not? Then finally, if accommodation is given to a judge of a high court or supreme court, they are fully exempted under optional tax regime. Under default tax regime, it is fully taxable. Then car. Can I proceed? Easy. Just another 5 minutes, it will be over. Almost 1 hour. We are finishing within 1 hour. You see, day before exam, many students will have a worry how to finish. Very simple. 1 hour and finishing salaries chapter. PGBP will be another 1 hour. Capital gains will be another 1 hour. 3 hours. Remaining all other chapters will be put together 4 hours. 8 hours. 7 to 8 hours. I'm revising entire book without leaving one point. I'm in fact explaining, not revising. I'm explaining. Yes or no? Next. Car perquisite. What is car benefit? Very simple. You see here in the book I have given you. If everything is employer, orange color. If employees, then purple color. Getting it? Car. Very simple. Company gave a car. They are only bearing expenses. Simple logic. They are only bearing expenses. Car is given for you for official, fully exempted. Fully personal. Then car comes under use of movable asset. 10% per annum of the original cost in case of it is a own car. If it is a rented car, rental expenses plus actual expenses for petrol, diesel, all that. Yes or no? That's it. They are official and personal. Then deemed perquisite value. What is deemed perquisite value? Office and personal. Company owned car, company is only bearing up to 1.6 cc. 1800 per month or part of a month is the deemed perquisite value. Remember, 1800 per month. Per month means calendar month. Sir, I received car on 16th July, sir. 15th August only I used. 15th August I returned to company. It is considered as 2 months. July you got, August you got. 2 months it is considered as. Able to understand? Not day to date, month to month. Getting it? Now, Driver is also given 900 extra. Sir, more than 1.6 is the car engine capacity, 2400, 900 in case driver is provided. Sir, suppose no company is owning the car, sir. Employee is bearing expenses, means only for car benefit should be taxed, right? Both official 600, 900, that's the only difference. Sir, company, yeah, car owned by employee, sir. Employer is only bearing expenses, sir. You can see here, expenses are met by whom? Employer, sir. Fully official, sir. Fully exempt. Fully personal. All whatever expenses incurred, sir, both official and personal. Look at what is the actual expenses minus what is the deemed value for official purpose. Actual expenses, look at minus deemed value for official. Official purpose deemed value, how much we assume? 1800 per month or 2400 and 900 in case of driver. Suppose no, this deduction you felt the more than I spent more, then you need to prove records. You need to maintain records. That's it. For all official purpose, if you are saying you have to maintain records, that's it. Car is over. Easy or not? One more point is there in the car. Suppose if the employee was given 2 cars or more than 2 cars, for 1 car only you will do valuation like that. Remaining all other cars are treated as personal purpose. Same way, accommodation also we have 1 point, more than up to 90 days, more than. Suppose if an employee was given accommodation at another place because of transfer, up to 90 days, both accommodations will value. Any lowest value we will tax it. After 90 days, both will be taxed. That's it. Easy or not? Domestic servant, easy point, not a big deal. Whatever employer facility taxable for specified employee, reimbursement fully taxable for all employees. Gas, yes or no, pay, I mean supplied from company own, then equal to, sorry, supplier from own resources, manufacturing cost. Employer is buying from somebody and giving, amount equal to amount paid by employer. Valuation of education facility, reimbursement is fully taxable for everybody. Facility, employer school or employer related school, getting it. If cost of similar education is less than 1000 rupees per month, no per visit at all. If cost of education in similar school is exceeding 1000, fully taxable. Correct? Remember, education allowance is fully taxable under default tax regime. Under optional tax regime, 100 rupees per month exemption is there. Correct? That's it. Next, other benefits, interest free or loan. Suppose no company is giving you loan. Company is giving you loan. Now, at a concessional rate of interest, the year you got loan, right? First date, 1st April, SBI rate is how much you get, rate of interest. For that similar kind of loan, SBI rate of interest how much? That rate minus employer is charging from you only 4%. SBI rate is 10%. Employer is charging only 4% for the loan. 6% is taxable. Suppose you are repaying principal every month. Then every month end outstanding amount you compute. Maximum outstanding monthly balance. What is that outstanding balance at the end of each month? First compute it every month. At the end of the month, outstanding balance compute. Multiplied by 1/12 multiplied by benefit interest. Benefit means what? SBI rate minus employer how much is charging interest. Like that 12 months you compute total values per visit. Over. However, if the loan is not exceeding 20,000, no per visit. If the loan is given for medical treatment of specific diseases, no per visit. Yes or no? Next, food and beverages. Food, non-alcoholic beverages provided to employer fully, I mean, they are typically taxable. However, meals up to 50 per meal is exempted under optional tax regime. Default tax regime, it is fully taxable. However, if the food is served at remote work site, fully exempted. Yes or no? And employee was given any refreshments, tea, coffee and all in the office, that is fully exempted. Gift voucher. Gift is exempted if the value is below 5,000. In the institute book it is wrong. They use the word does not exceed 5, means equal to 5. That's wrong. As per the perquisite rule, you go income tax portal, income tax rule, rule number 3 you open, 3 sub rule 7 you open. Inside that you will find gift. Gift value below 5,000 is fully exempt. Beyond 5,000 is fully taxable. But in ICA book also, up to 5,000 they can claim exemption. Beyond 5,000 they are taxing. Accept ICA practice. Able to understand? But remember, this is about gift in kind. Suppose if the gift is in cash, fully taxable. It is treated as allowance and it should be considered for salary definition for RFA purpose. Yes or no? Then credit card, club and all, remove it. Movable asset. Suppose employee was given any asset for usage. Laptop, fully exempt. Any other asset, own asset, 10% per annum original cost for the number of months used by the employee. Rent, rent expenses per month paid by employer for the number of months used by employee. That's it, perquisite value. Yes or no? Suppose employee purchased asset of the company. Company own asset, employee purchased it. Company purchased it 10 lakhs. Employee bought it from the company at some 2 or 3 lakhs. Directly you cannot calculate 7 lakhs as benefit. No. Notional depreciation you should reduce. For computer and electronics, remember TV, bike, everything comes under other assets. Just because electronics word is used, don't think electronic means every electronic. Computer and electronic means what? Computer related items. Then deemed value of depreciation, notional depreciation is what? 50% for every completed year of usage. Yes or no? 50 WDV method. Car 20% WDV. Any other asset 10% SL. How to compute? Original cost to the employer, how much? Less notional depreciation at rate specified for every year, reduce. Then WDV value will get on the date of transfer to employee minus how much amount employee paid, check it out. Then balance is taxable. Easy or not? Next, other benefits, very simple. Telephone allowance is fully taxable. Telephone facility is fully exempted. Then coming to valuation of specified security, being equity share. Equity share, very simple. If the employee was given ESOP, equity share, other than equity share, whatever it is, doesn't matter. ESOP, you exercise it. On the date of exercising, fair market value is there. That much is perquisite. But year of taxability will be different. Generally, whenever you exercise the option, that time you got allotment of shares, market value is taxable. But in case if eligible startup you are getting ESOP, then taxation is deferred. Taxation is deferred to when? After 48 months it will be taxed. For which year you got? Assessment year, check out. End of the assessment year, check out. After 48 months, that previous year will come, right? Exactly that year it is taxable. Are you clear? Suppose no, before 48 months you left the company. Then year in which you leave the company, taxable. Before this you sold the shares also, then sale year it is taxable, whichever is earlier. After 48 months from the end of the relevant assessment year or date of leaving the company or sale of those securities, whichever is earlier, in that year it is taxable, not in the year of exercising option. Remember, this kind of facility is there only for eligible startup employees. Normal employees, which year you exercised the option, that year it is taxable. How much is taxable? Market value of the share is taxable. Minus, you would have paid some amount to the company, that you will reduce anyhow. Yes or no? Then what are the deductions from salary? 3 deductions. Standard deduction. Under optional tax regime, 50,000. Under default tax regime, 75,000. Entertainment elements. Deduction only for government employees. Remember, entertainment elements is fully taxable for everybody. But for government employee, under optional tax regime only, he will get a deduction 1/5 of basic salary, 5,000 actual amount, whichever is lower. Profession tax, if company is paying it, first it is taxed as salary minus under optional tax regime, whatever amount is paid ultimately is allowed as deduction. Relief not that required from exam point of view. Observations completed. Predominant salary topic is completed in 1 hour 10 minutes. Yes or no? All of you confident? Yes. Intense preparation is required. Okay, it's all about intensity. Everybody will sit 12 hours. It's not how much time you sit, it's with what intensity you sit. That's important. Clear? I think I didn't miss any point. Almost every point I covered, right? That's it. Okay, yeah, take care. The next session will discuss house property. House road is something 20 minutes or half an hour only. Okay, that's it. Yes, let's revise the income from house property, which is the second head of income. And the charging section is 22 directly. So what the charging section says, annual value of any property which is building or land attached to building, nothing but land and building. Okay, provided SS is the owner, then only the annual value is chargeable to tax. Remember, in house property, it's not the rent which is taxable mainly, it's the annual value. So whatever rent you are getting, we should not straight away tax it. What is taxable is annual value is taxable. Now, what is annual value? How to figure out annual value? All that. Now, first of all, before I go into that, okay, suppose no, sir, I am holding some house as a stock in trade, sir. I'm a real estate person, sir. I'm also having house properties. Getting it? I'm owner. You see, in the house property charging section, they didn't mention anything specifically for business. And you see, one exception is there. So, however, certain properties are not taxed when if the SSC uses the property or part of it for their own business or profession, then that portion is excluded from chargeability. So if at all I am having a house property, nothing but building, if I'm using it for my own business or my own profession, then that part is not treated as house property. That part is treated as building in PGBP. You can claim depreciation on that. Repairs and maintenance, municipal taxes, everything you can claim under section 30. We already covered in PGBP revision that point. Yes or no? Which you will get it. Okay, next. Now, Suppose, sir, I'm a real estate person. I'm having stock in trade all the buildings, sir. What is my position? Because I'm not using them for my business. I kept it to sell it, not using for my business. What about them? For 2 years, the annual value will be treated as nil for 2 years from the end of the year in which completion certificate is obtained, provided the property is not rented during the 2 years. A real estate person who is having buildings and flats as stock in trade for 2 years, we will not apply house property head of income, but after 2 years we will apply house property head of income. That's it. Getting it? So now composite rent means what? Suppose, sir, I'm having a house, sir, I'm renting house along with furniture. Either the tenant can take both together or they can take only one. Like the letting is inseparable. Inseparable means what? Either he has to take both or he can't take it. Sir, my building along with furniture on rent. Building rent is 20,000. Furniture rent is 5,000. Total 25,000. Breakup is available. Don't think that 20 is taxable under house property, 5 is taxable under other sources. No, you should not tax like this straight away. See whether this can be rented separately. Means if the tenant don't want furniture, he want only house, can he take like that? He can't. Such a kind of option is not there. Tenant has to take both compulsorily. If that is the kind, then we call it as composite renting. We call it as composite letting, and the rent is called as composite rent. Straight away it is taxable as PGBP income or other sources. Suppose if letting is separable means what? Tenant said, sir, I don't want this furniture, sir, I have my own furniture. Owner also agreed, okay, furniture I will take back, I'll give only house. That contract is called a separable contract, divisible contract. If divisible contract is there, then only building, I mean that building rent alone, whatever you are getting, you tax it under house property. Here also furniture is taken on rent. That furniture will be taxed under other sources. Nature is what? You can take whichever you want. Only house you want, you can take. With the furniture also you want, you can take both. You don't want furniture, I will give you that option. If such a kind of flexibility is there for the tenant, then each component rent is taxable under respective head. Such flexibility is not there. Both components rents are straight away taxable under other sources or PGBP. That's it. Okay. Next. Now, how to calculate income from house property? By default, everyone has to follow this format. By default, everybody has to follow this format. In exam, you follow only this format. How to compute? You know, in exam, you should put heading, computation of income from house property for the assessment year 25-26. Nothing but previous year 24-25. First, you should compute what? Gross annual value. What is gross annual value? We have discussed below. How to compute gross annual value I have given here. Getting it? Gross annual value. Outer column. How to compute? We will see later. From that, only one deduction. Gross annual value, only one deduction. Remember, house property charging section, annual value is taxable. That is what? Nothing but gross annual value. That is nothing but generally what? Gross annual value. From that, reduce municipal taxes paid. Here, paid means actually paid. Cash base is only allowed. Whatever municipal taxes and property taxes and water taxes and chivalrous taxes that you pay between 1st April to 31st March of that year, whatever you actually pay, that you claim it as deduction. Then what you will get is net annual value, some amount you will get. Now in house property, for house, no, buildings, no, you will incur so many expenses, repairs, maintenance, insurance, all that. No, you won't get any deduction. You will get only two deductions. Standard deduction, which is 30% of the NAV. On this, apply 30% value, that amount you will get. Then another deduction is interest on borrowed loan. How to calculate interest on borrowed loan? That I will explain it now. In house property, if you are able to understand gross annual value discussion, if you are able to understand interest on borrowed loan, these two computations, if you understood, I am telling you house property you mastered. Pakka 4 marks question. Pakka 4 marks question on house property minimum. If you understand these two elements, you can do house property any kind of problem. Now, before I start this, suppose if the house property is self-occupied by SSE, means I am not renting it at all. See, there is a concept called straight away NAV, you can take it as 0. There is a concept. Actually, we have a section called 23. Inside that, we have 23 subsection which talks about GAV computation. 23 subsection 2 which talks about NAV directly 0. Subsection 2 and subsection 3, both of this collectively says what? NAV you can straight away take it as 0. When you know, when NAV can be straight away taken as 0, you know, two conditions has to be satisfied. One, Either the property is self-occupied or property should be vacant. 12 months is there. Okay. For 6 months it is self-occupied, 6 months it is vacant, or 9 months it is self-occupied, 3 months it is vacant. Either 12 months are vacant or 12 months self-occupied. Only one point. Should not be rented. Should not be rented even for 1 day. Should not be rented for even for 1 day. Should not be rented for even 1 day. You should not get any benefit there. You should not get any benefit from that property. You should stay or it should be unoccupied. If these two conditions are satisfied for that house, you can straight away start computing income from NAV. No need to compute GAV. Straight away you compute NAV is equal to 0. Now, this kind of facility is there for 2 such properties. This kind of facility is there for how many properties? 2 properties which satisfy both these conditions. SSE can straight away start the problem with NAV is equal to 0 for a particular property. 2 conditions. That should be either self-occupied or unoccupied, and you should not at all rent. Even for 1 day you should not be rented. You should not get any benefit. You should not get any benefit. No, best example I'll give you. Suppose I'm working in a company. The company as part of employment, no, they told me they will give me housing facility, housing accommodation. I told the company, sir, why do you take it on rent at somewhere else and give me? I have my own house in the same city. Take my house as rent. Put a rental agreement. Pay me monthly 20,000. Give me the same house as an accommodation. See, now SSE might say, I am only staying in this house, no, entire 12 months, my own house. But you are getting some benefit from this property. Since you are getting a benefit from this property, you cannot call it as SOP. Since you cannot call it as SOP, NAV is equal to 0 cannot be claimed. If NAV is equal to 0 cannot be claimed, you should compute GAV. If NAV is equal to 0, logic do not apply. You should compute what? GAV. Are you getting the point? Now, by the way, for how many properties SSE can claim NAV is equal to 0? 2 properties. Both the properties must satisfy 2 conditions. 1, it should be self-occupied or unoccupied and not rented at all throughout the year. 2, no benefit you should get from that. Then NAV is equal to 0 can be claimed for 2 kind of properties. Sir, SSE is having 5 houses, sir. In 5 states and 5 metropolitan cities, is having 5 houses. He's a movie actor. Okay, or he's a politician. He's having 5 houses, sir. All the 5 for his own purpose only he's staying, sir. He is not renting at all. Can he claim for all the 5 houses NAV is equal to 0? No, only for 2 houses. Out of 5, any 2 houses you can claim NAV. NAV is equal to 0. Remaining 3, you must treat them as deemed let out property. You must treat them as deemed let out property. And for them, you have to compute GAV. And we already know, for a deemed let out property, gross annual value is expected rent only. Gross annual value is expected rent. Don't conclude anything by this time. How to calculate expected rent? 12 months, how many months you should calculate? Ownership period, all that we are going to discuss. Able to understand? So for GAV, for DLOP, GAV you should calculate straight away expected rent. In house property ICA book, test your knowledge and some illustration. You have fantastic questions. Getting it? 3 houses information will be given. You know, you can't apply any shortcut also. Getting it? You have to consider 2 houses as SOP, 1 as DLOP, or the 2-3 options you need to compute and see which option is best for you. Remember, which option is best for you? Fine. I'll come back to it better. Let me discuss interest on housing loan, all that. Once I cover the entire head of income, how to do solving of house property provision also we will discuss. Remember, interest claiming deduction. In house property, interest deduction is there, right? That is subject to default tax regime or optional tax regime. Okay, that I will cover that point. Even in the PGBP, in salaries, everywhere we discuss default tax provisions at respective places. Here also we will discuss default tax provision at respective place. Are you clear until now? Now, so now when we can claim NAV is equal to 0, we know. If those 2 conditions are not satisfied, you cannot claim NAV is equal to 0. That time what you should do? You should compute GAV. Now, how should we compute gross annual value? Very simple. Gross annual value is computed in 3 steps. First step, no, calculate expected rent. Remember, charging section says annual value is taxable, not how much you are charging. See, you are charging rent which is more than the value, then rent is taxable. You are charging rent less than the value, then value is taxable. So cleverly drafted the section. Getting it? First, calculate expected rent, value of the renter, value, how much the property can give you rent. Step 2, calculate actual rent received. Step 3, gross annual value. Step 1 or step 2, whichever is higher, straight away higher of step 1 or step 2, whichever is higher. However, there is one scenario where gross annual value, we will take it as step 2 only, where gross annual value will be actual rent received, which is computed under step number 2 straight away. Okay, so gross annual value is computed in 3 steps, right? First you compute step 1, expected rent, then compute step 2, actual rent received. Don't worry, I'll explain detailedly. Step 3, by default generally what you can go for, step 1 or step 2, whichever is higher. But in some scenarios, gross annual value is equal to step 2 only. When? Up rule. See, I am telling you how to solve the problem directly. More than logic in the revision, solving ability is what most important for you to learn. You know, suppose you calculated step 2 answer. Suppose you calculated step 2 answer. This is the step 2 answer. And you also calculated step 1 already. Suppose if step 2 answer is lesser than step 1. Step 2 answer is lower than step 1. And one more condition. Property remained vacant during the relevant year. In the relevant previous year, getting it, that property was empty for certain months. Then just do a cross verification. Just to do one small checkpoint. Already you calculated step 2 value rent received, right? Put that amount here. For that, vacancy period rent. Vacancy period means what? Some 2-3 months property was idle, no? If at all it is not idle. If at all it is not idle, for these 3 months, if at all rented, how much rent you will get? Add that. Now, how much would be the actual rent if at all there is no vacancy? Calculate. Suppose if you add back vacancy period rent, step 2 value is becoming greater than step 1. If you do not add vacancy period rent, step 2 value is less than step 1. If you add vacancy period, it is higher than step 1. If you do not consider vacancy period rent, it is lower than step 1, which means because of vacancy, our actual step 2 answer is lower than step 1. If vacancy, step 2 is lesser than step 1, sir, I am not renting cheaply, I am renting super. I'm charging very good amount, but my rent amount received is lesser this year because of vacancy. If you are able to prove vacancy is the reason why your actual rent received is lesser than step 1 expected rent, then gross annual value will be actual rent received. Actual rent received means what? Step 2 value, whatever step 2 value is there, right? That itself is gross annual value. Got the clarity? Easy or not? You're able to recollect? Now, for this in ICA book, we have given in the question bank, we have given illustration also, just to go and solve it immediately after this. Whenever you're solving, if you're not getting the answer, once again get back. But wait, still it is there. Now, sir, how to calculate step 1? How to calculate step 2? Step 3 relatively we understood better. Once again I will cover step 3 once we cover step 1, step 2 understanding. Now, how to calculate step 1? Step 1 means what? Expected rent you should calculate. Expected rent. Tell me, if I am owner for 12 months in this year for a house, 12 months I can expect rent, no? Basically, suppose I purchased the house only on 1st October. Up to 31st March I am owner only for 6 months. Then how many months I can expect the rent? 6 months only. Able to understand? Sometimes in exam they'll give you a combination provision. SSC purchased a house at 1 crore whose stamp duty value is at so and so, and the expected rent information also they'll give you. Getting it? What are the tax implications? Stamp duty value information they gave, purchase price they gave, gift provision you apply, other sources, plus 1st October you purchased it, right? From 1st October to 31st March. Getting the point? 6 months if at all your owner, you should also apply GAV computation. Here house property income is computed in this year for how many months? 6 months. Sometimes the problem will be a combination of capital gains and house property. Like SSC is having house from long ago, but he sold the house on 30th September. He sold the house on 1st October or 30th September, he sold it. Now sale consideration is there. Stamp duty value information might be given. Full value of consideration, 50 you apply, compute capital gains. 2. House property income has to be computed for 6 months only. Such a combination also they can ask. Able to understand. Now, what is expected rent? Simple, fair rent, municipal value, whichever is higher, but it should not exceed Rent Control Act limit, because it legally you are prohibited. So expected rent cannot exceed standard rent. So simple equation, higher of fair rent or municipal value restricted to standard rent. Now expected rent generally will be computed for 12 months. However, if the property is purchased or constructed or sold during the year, then it is computed only for the period of existence and ownership in the relevant year. Getting it? Completion certificate is the criteria for number of months property is in existence. If at all this year only you constructed. Able to understand? Then what is fair rent? Fair rent is the rent similar property in the same locality would fetch. Getting it? Municipal value means the value as per the municipal records. That's it. Be able to understand. Sometimes in problem they will give you municipal value for full year, standard rent for full year, fair rent for full year, but SS is owner only for 6 months for the house. Don't consider full values, you should consider proportionate values. Able to understand. Sometimes in problems, they will give you this house is partly for house personal purpose, partly for self-occupied, partly for renting. Then NAV is equal to 0 for that portion. NAV is equal to 0 for that portion of the house which is used for self-occupation. Remaining portion, only that portion related, fair rent, municipal value, municipal taxes paid, loan amount, everything should be considered. Able to understand? Okay. Then now step number 2. First actual expected rent, everybody understood? Now step number 2, actual rent received. What is actual rent received? Actual rent receivable first you compute. What is actual rent receivable, sir? Tenant stayed for 10 months, sir. I should also receive rent for 10 months. So number of months rented into actual rent per month minus, sir, tenant stayed 10 months, sir, but paid only 9 months rent, sir. 1 month rent he didn't pay, he left. That amount is called as unrealized rent. Unrealized rent, no, here you should reduce. You can reduce unrealized rent from the receivable rent only if 4 conditions are satisfied as per rule number 4. What are they? Tenancy must be a genuine. Defaulting tenant should have vacated. He should not occupy other property of you, and you have taken steps to recover like legal proceedings. Only then you can reduce the unrealized rent here. Once you reduce unrealized rent, what you will get is called as what? Actual rent received. Now step 1 we computed, step 2 we computed. Now see step 1, step 2, suppose if the step 2 value is higher than step 1, straight away GAV is equal to step 1 or step 2, whichever is higher. Suppose if this step 2 value is less than step 1 value and the property vacant for part of a year, property was vacant for part of a year, then add vacancy period rent for step 2. See now actual rent how much after adding vacancy period. Sir, it is more than step 1, sir. Oh, if vacancy period is considered, step 2 is more than step 1. If vacancy is not considered, actual step 2 value is less than step 1, which means your actual rent received is less than step 1 because of vacancy, and therefore gross annual value is equal to actual step 2. Able to understand? Easy or not? You see, you read this actual rent received. That one, put it. Add vacancy period rent. Many students will have, sir, vacancy period rent we should add. No, we should add this before unrealized rent reduction, after reducing unrealized rent. After reducing unrealized rent. That's why you follow this format. I'm telling you, you will never do mistake in the house property. Easy or not? That's it. House property GAV computation we understood. Now there are some circumstances. Okay, fine. GAV computation understood, right? Let us discuss remaining also. Then at the last, we will discuss how problems has to be solved, how different ways of problems will come, how it has to be solved. Conceptually, let us understand. Okay, now, okay, sir, GAV understood, sir. What is the computation format? What is the computation, sir? First, you should compute GAV. We know how to compute. When we should not compute also, we know. When GAV should not be computed, straight away NAV is equal to 0 we will take if the house is self-occupied, unoccupied, not rented at all throughout the year, and no benefit is you are getting, NAV is equal to 0. Like this, for how many properties you can claim? 2. By the way, house property means a portion of full property. Full property. Suppose I have an independent house. I have 4 portions in that. All the 4 portions I am only stake. It is treated as one property only. How do I identify how many properties SSC has? How many registration deeds are there? Check out. Suppose in a big apartment, I have a flat. I will have a separate registration for it. In an independent house, I have four houses inside that. Four portions are there. For four portions put together, one property it is treated as, because one registration only there for the entire house. Generally, able to understand. Next, now how to calculate NAV? Reduce municipal taxes paid. Then what you will get? Net annual value. Municipal taxes paid allowed as deduction only if it is actually incurred by owner. Suppose if the tenant is bearing, no deduction for the owner. Suppose if the property is outside India and I'm an ROR, if you are computing income under income house from house property in India, even taxes paid in foreign country can be claimed as deduction. Able to understand. Now GAV computation is over. Now once NAV computation is also NAV over, GAV computation both are over. Now once NAV is computed, you should calculate what is income from house property. If you have to calculate income from house property, you can reduce only two deductions. One, flat 30% of NAV. Flat 30% of NAV. Another one you can claim it as what? Interest on borrowed capital. One you can claim flat 30%. Another one interest on borrowed loan. NAV flat 30%. How much you are spending actually, that and all doesn't matter. Straight away flat 30% you can claim. Here I have given one important note point which was asked in September 24 exam, which is actually fundamental. If a part of a property is used for business or profession, this point I even covered in PGBP revision, yes or no, then the attributable expenses can be claimed as deduction under PGBP. Suppose municipal taxes paid, repairs and maintenance, insurance and all taken for the house, and the house is 50% used for residential, our residential own SOP, 50% is used for business, or 50% I'm renting it to somebody and 50% I'm using it for my own business. Whatever I'm using it for my own business, that portion, that percentage of the property is not covered under house property. That time municipal taxes, repairs and maintenance, insurance, proportionate to that 50% of the property, you will claim deduction under PGBP. Whereas in house property, these expenses you will ignore. Municipal taxes you will consider. Remaining repairs and maintenance, insurance you will ignore under house property. Straight away you will claim 30% of NAV. Able to understand? Next. Now another deduction is what? Interest on borrowed capital. Interest on borrowed capital. Generally for purchasing houses and constructing houses, we go for loan and we will be paying interest on that. That interest can be claimed as deduction. Now this interest deduction is subject to this interest under house property. The interest expenditure is classified into two types: pre-construction period interest, current year interest. Pre-construction period interest means interest expenditure during pre-construction period. Pre-construction period means what? Year of completion of construction will be there. The year in which construction gets complete, no, that year ignore. Preceding all years for which loan is outstanding, that entire period is called as what? Pre-construction period. Able to understand? Remember, if I am borrowing the loan and construction of the property or purchase of the property is completed in the same financial year I borrowed loan, same financial year purchase is over, construction is over, pre-construction period logic will not apply. Pre-construction period logic will not apply. What is pre-construction period? In problem they will give you date of construction or date of purchase before 31st March. Exactly before 31st March. Date of completion 29th March sir, 2025 sir. Before 31st March means 31st March 2024. Sir, problem 30th March 2025 is the construction completion date sir. Pre-construction period means before 31st March. Sir, 10th April 2024 construction completed sir. Before 31st March means 31st March 2024. Pre-construction period end date shall be computed like this, end date. Now pre-construction period means what? End date we know. Beginning date is what? When you borrowed the loan. When you borrowed the loan. Sir, in the problem they gave, I borrowed the loan on 1st October 2022 sir, and here 31st March 2024 is the end date in the pre-construction period sir. Based on construction date I computed sir. For this period, calculate interest expenditure incurred how much? Total interest how much you calculate here. That interest is called as what? Pre-construction period interest. That interest is called as what? Pre-construction period interest. Wait, then we understood now pre-construction period interest. Now what is current period interest? Current year interest, current relevant previous year interest, nothing but. What is current year interest? Sir, in the problem they said construction is completed on 30th March 2025 sir. Pre-construction period means what? Up to 31st March 2024. This is PCPA. Then what about 24-25 interest? That interest is called as current year. Once construction is completed, purchase is completed in a particular financial year, that year is called as current year. From that year, every year you will incur interest again. Every year, whatever interest is there, right, in that respective years, that is called as current year interest. Remember, current year interest will be changing every year. Current year will change, whereas pre-construction period will be same. Yes or no? Current year might be 25-26, current year might be 26-27, current year might be 28-29, but pre-construction period is 31st March 2024 only. In our example, able to understand. Now, so suppose SSE borrowed a loan on 1st April 2022, okay, or 1st September 2022, best example, and for construction or purchase, but for some reasons finally the property construction is completed on 2025, 30th June 2025, the property construction is completed. Sorry, 2024 we will take, because in our exam mostly problems will be 24-25 based. Okay, 24. Now yeah, correct, 2024. Now what is pre-construction? This is date of purchase or date of completion of construction. Before 31st March means what? 31st March 2024. So 1st September to 31st March 2024, approximately 7 plus 12, 19 months, approximately 19 months. In exam they will give you loan amount, they will give you rate of interest multiplied by 19 by 12 is equal to, this amount is called as what? Pre-construction period interest. Now remember, you not only spent interest here, loan is outstanding loan is outstanding. You computed only up to 23-24 in this problem. You loan is outstanding even in 24-25. 24-25 also you will incur interest expenditure on loan, right? That is called as current year interest. Now total interest is how much? This is called total interest. This amount you can claim it as deduction. Wrong. PCPA straight away you can't claim. PCPA you have to claim in 5 installments. PCPA you have to claim in 5 installments. Okay sir, from which year I will claim sir deduction? Until now what we computed is interest expenditure is how much. Now when I will claim deduction, from which year I will claim deduction? Array, you will show this house only in the year of purchase, right? To the income tax department, from when you will start showing this house? Only after construction is completed, only after purchase is completed. In this question, when the construction is completed 30th June means for the first time you will show to the income tax department for which financial year? 24-25. In this year I will show. For this year I will compute GAV, municipal taxes paid, NAV. Now in this example, GAV is computed only for 9 months. Because the property's construction is completed only on 30th June. Only from 1st July I can expect rent. 9 months. Now minus municipal taxes paid, then you will get net annual value, then minus 30% of NAV, interest on loan. Here you need to reduce. Now how much you will reduce? Already you computed PCPA and you computed current year interest. Now PCPA 1/5 amount you take, current year full amount you take, total amount you take. So that amount you can claim it as deduction. From which year? From the year of first year in which you are computing house property income for that house. From the year of completion of construction onwards, from that financial year onwards, you will claim PCPA interest, not fully at a time, 5 installments you will claim. Current year interest every year you will claim, both total it and then claim deduction. How much you can claim? Whatever amount you incur, because GAV you computed. If GAV is computed, interest expenditure no limit at all. If GAV is computed, interest expenditure no limit at all. Sir, I am default tax regime or I am optional tax regime. It doesn't matter. When you computed GAV, if the property is a let out property or a deemed let out property where GAV is computed, then interest expenditure no limit at all. Now you see, interest expenditure logic is same everywhere. Suppose the property is SOP or UOP, sir. I claimed NAV is equal to 0, sir. That time also interest expenditure is there, right? PCPI multiplied by 1/5, current year interest, PCPI into 1/5 in current year. Both put together some amount came, sir. Okay, can I straight away reduce it here? No. In case of default tax regime, if at all NAV is equal to 0, suppose you are going to declare income under default tax regime. You are going to declare income under default tax regime. And this property is SOP or UOP where NAV is equal to 0, benefit is claimed. No deduction for interest, straight away 0. In case of default tax regime, for self-occupied and unoccupied property where NAV is equal to 0 benefit is claimed, NAV is equal to 0 benefit must be claimed, then only no interest deduction, straight away income is 0. Are you getting it? Sir, I am going with optional tax regime. Now what is the situation? Very simple. Interest expenditure you calculated, right? PCPI into 1/5 plus current year. Total interest expenditure you calculated, right? To be claimed, it cannot exceed 2 lakh. It cannot exceed 2 lakh. Actually, original limit is 30,000 only. However, if you satisfy 3 conditions, 2 lakhs limit is applicable. If you satisfy 3 conditions, loan must be borrowed on or after 1999. Okay, loan must be borrowed for purchase or construction purpose, not repairs, not renovation, all that. And this purchase or construction is completed within 5 years from the date of borrower of loan. Actually, from the end of the financial year in which loan is borrowed, that and all is there. Within 5 years, logic, you remember, 99.99% of the cases within 5 years only they will buy or they will construct the property. You able to understand? If these 3 conditions are satisfied, then for a self-occupied property, unoccupied property where NAV is equal to 0 benefit is claimed, interest expenditure can be claimed as deduction up to 2 lakh. Remember, interest expenditure means what? Full PCPA plus current year, 1/5 of PCPA plus current year. 1/5 of PCPA plus current year is equal to total interest. That cannot exceed 2 lakh. If these 3 conditions, sir, some condition is failed, sir, then maximum limit applicable is 30,000. By the way, this 2 lakhs limited, 30,000 limit are there, right? Is it applicable per property or per SSE? Per SSE. This is applicable per SSE. Sir, suppose I have 2 loans, sir. 2 houses are there. 2 houses are there. Both are self-occupied, sir. NAV is equal to 0, sir. But one house, no, interest amount I borrowed for repair. Loan amount I borrowed for repair. Another house, 2 lakhs limit is applicable, sir. Which limit I should take? 2 lakh limit you take. If for the SSE, 30,000 limit is applicable for one property, 2 lakhs limit is applicable for another property. If both the limits are applicable, then higher limit you take, 2 lakhs limit. Able to understand? Easy or not? Okay, now look at this theory. Loan can be borrowed from any person. Interest is allowed on accrual basis. Remember, interest on late payment of interest is not deductible. Yes or no? The total interest is computed in 2 parts. Pre-construction period interest, current year interest. Pre-construction period interest means what? From the date of borrow till the end of the previous year, preceding the year of completion of construction. Very simple. Date of completion of construction find out before 31st March. That is the end date. Original borrow from date is what? Borrowable date. Easy. Yes or no? Suppose, sir, construction is completed on 30th March, sir. 30th March. I borrowed loan on 1st April 2024, sir. Construction is completed on 30 March 2025, sir. Before 31st March means 31st March 2024, sir. I borrowed loan on 1st April 2024. How can I go backward? That's why if date of borrowal and construction date and purchase date are in the same year, pre-construction period logic will not apply. Now, what about that year interest? That year interest is called as current year interest only. Able to understand? Now, so interest incurred during pre-construction period can be deductible for a period of 5 years. The deduction commences from which year? The deduction commences from the, one student asked me, sir, previous year. Previous year means income tax means that relevant financial year. The previous year, sir, it is claimed in year of construction onwards. No, you said previous year, last year, how can we claim? Array, previous year means not last year. Previous year in income tax means the year in which, previous year in which construction is completed. Suppose you are doing 24-25 previous year problem, then 24-25 is the previous year. Yes or no? Yes. Suppose if date of borrow and date of completion are in the same financial year, PCPI is nil. That's it. Current year. Interest expenditure incurred from year in which construction is completed. That interest is called as current year interest. The same can be fully claimed irrespective of the previous year. In respective previous year. Total interest is equal to PCPI plus current year. By the way, PCPI means what? Only 1/5. So here you take 1/5 of PCPI, better for better. Okay. Now, how much reduction I will get? How much reduction I will get? Sir, how much reduction I will get in case of let out property? Let out and let out, no limit at all. Whatever total interest is there, you can straight away claim. Sir, suppose mine is a self-occupied or unoccupied where NAV is equal to 0 benefit is claimed, sir. Then under default tax regime, no deduction will be given at all. No deduction at all. Under optional tax regime, and it's an SOP or UOP, NAV is equal to 0 benefit is claimed, sir. And in such a case, maximum deduction is 30,000. However, if the loan is borrowed for construction or acquisition and loan borrowable construction or acquisition is completed within 5 years and loan is borrowed on or after 1/4/1999, then the limit is maximum 2 lakhs. And remember, this limit is per SSE, not per property. If the SSE is having two limits applicable, then higher limit we should take. Able to understand? Able to recollect everything? Now. So to get interest deduction, no, some formalities and all were there. Set off and carry forward we will discuss later. In set off and carry forward chapter, I will discuss set off and carry forward of losses. That's it. Then again, no, interest on loan. There is another link in 80EE. Okay, like that there is a section. Okay, 80EE section is there. There I will once again cover, and then when I'm revising chapter 6 deductions, so that time I will cover this point once again. Able to understand. Next. Sometimes no, we receive arrears of rent. Means I am not the owner of the house. It's long 3-4 years back I have a house. That time tenant used to stay. That time he defaulted me. Unrealized rent or some amount he has to pay. Finally this year he paid me. This year whatever amount you recovered is fully taxable. In the problem they might give you additional information. That time no, you didn't offer income tax. That time you already paid tax on that and all irrelevant. This year have you got any arrears? Yes. Have you realized any amount in the name of unrealized rent? Yes. How much you received? That is fully taxable. Minus 30% flat deduction. That's it. You're able to understand. Suppose, sir, there is a house, sir, co-owned. Means two people are there as owners. 2 or more than 2 people are their owners. Then forget about number of owners. Compute GAV. NAV is equal to 0 if the entire house is self-occupied by both of them. Yes or no? Suppose it is not self-occupied by both of them. Rented. First compute GAV for rented portion. For self-occupied portion, NAV is equal to 0. Claim municipal taxes deduction. Minus 30%. Minus interest. You will get the net result, right? That net result distribute in the share. Distribute to the each owner. Able to understand. Now when you are claiming interest deduction, no. How many owners are there? That much limit is applicable. Limits on interest we will see only in case of self-occupied and unoccupied property. Where NAV is equal to 0 is claimed. That too under optional tax regime only. Correct? Everybody? Now when you're doing problems, no, how the problems will be given. For example, no, SSE will be having house property. What they will do, you know, this house property for some 5 months he rented it. Tenant vacated. Remaining 7 months he is staying it. Entire 12 months it is occupied either by you or by tenant. No vacancy at all. Okay, like this they will give you. Now see, NAV is equal to 0 can I claim? For 5 months can I calculate NAV separately? For 7 months can I calculate NAV separately for the same property? Never. NAV is equal to 0 can be claimed when entire 12 months you stayed or it is empty. No benefit is there. But here 5 months you rented. So NAV is equal to 0 cannot be claimed. You must compute GAV. For 12 months you are owner, right? Expected rent must be computed for 12 months. You remember this problem solving method, what I'm telling you, just apply that logic, you will get it. Getting it. So 12 months. Step 2. Actual rent received, you rented for 5 months, so step 2 will be computed for 5 months. Step 3, sir, step 2 is lower than step 1, sir, but there is no vacancy. Straight away, whichever is higher, over. Are you getting it? Sir, I have a house property, sir. It has 2 portions, sir. One portion is self-occupied, another portion is let out property, sir. For this portion, NAV is equal to 0. For this portion, you will compute GAV. Now when you are computing GAV for one portion, whereas in the problem, fair rent, similar property rent, municipal value, standard rent, they are all given for annual. Sorry, they are all given for full house. You should take only LOP portion. Suppose it is half or 2/3, whatever, some proportionate they will give you in the exam. Only that proportionate you should take. Minus municipal taxes paid, only proportionate you should take. Then you will get NAV minus 30% minus interest. Before you claim interest, no, here also interest you will get. Suppose if the SS is following optional tax regime, you will calculate interest. Suppose if the SS is following default tax regime, first calculate interest. How to calculate interest? PCPI, current year, total interest you calculate. Split into 50-50. In case SOP is 50%, LOP is 50%. Or split into 1/3, 2/3. Or 1/4 to 3/4. Whatever proportion they'll give. Split the interest into 2 parts. Now, here whatever interest is there, claim as it is. No problem at all. Here you will interest amount you allocate, right? Look at what regime. Default tax regime, 0. Optional tax regime. See how much you allocated. Maximum you cannot allocate more than 2 lakhs. If it is for repairs purpose, you cannot allocate more than 30,000. That's it. Over. house property head of income is over. Now sir, suppose NAV is equal to 0 cannot be claimed, sir. It's an SOP, sir, UOP, sir. I didn't rent to anybody, sir. 1 rupee rent also not there, but I have more than 2 houses. Like this. Any two at your option. Any two at your option. Take it as, SOP or UOP, show NAV 0 minus interest, everything you compute properly, depending upon the regime. Remaining houses, compute it as DLOP. 3 houses were given. 3 houses were given. House number 1, house number 2, house number 3. Getting it? Suppose house number 1, SOP, house number 2, SOP. This is called DLOP. Compute income from house property. Don't decide based on annual value. Income in each case you compute. Okay. Then second option. Okay. This is DLOP remaining to SOP. Compute income from house property. Another third option. Okay. This is SOP. One is DLOP. Like that you compute 3 options. Under optional tax regime, under default tax regime. Under optional tax regime, house 1, house 2 might be best option. Whereas in default tax regime, house 2, house 3 might be best option. So which 2 houses you can claim it as SOP? Under optional tax regime, decision might change. Under default tax regime, decision might change. Ultimately, all the 3 houses put together, how much is the net income you are getting from house property? Lowest in which option you are getting, that is best option in that regime. Are you clear? All of you, that's it. Income from house property is over. Confident? Yes. Let's revise profits and gains from business or profession. Okay. And for the May 25, September 25, and Jan 26, there is only one major amendment in PGBP. Actually, there is only one amendment. It's not even major, I can say. There is only one amendment in PGBP. That is section 40B, assessment of firms. Inside that, earlier remuneration to working partner. Earlier, remuneration to working partner is restricted to 1,50,000 or 90% of book profit up to 3 lakhs worth of book profit, whichever is higher, or on the balance book profit 60%. Now this limit is increased. This limit is doubled. 1,50,000 instead of that 3 lakh. Now up to 3 lakhs book profit is there, right? That is increased to 6 lakhs. Anyhow, when I am discussing that concept of 40B, there I will cover that point. Okay. Fine. Let's revise the entire PGBP revision with a crystal clear understanding with illustrations also. Certain illustrations. Illustrations means not the IC illustrations or like something. I will give customized illustrations here. If you understand that illustrations and the concept which I'm revising, that is enough, more than enough. You can solve any kind of problem in the exam. That's it. And we all know charging section is what? 28. In PGBP, the most important thing is, 1 minute. So in the PGBP, the most important thing is having an idea on the structure. PGBP is structured into 4 parts. Okay, 28 and 41. These 2 sections are talking about what incomes are taxable under PGBP. 29. Okay, let me not cover this. Okay, 28 and 41 talks about incomes. Then we have sections from 30 to 38. 30 to 38. These are the sections which are talking about deductions. Then we have sections called 40 to 43B. These sections are talking about disallowances, they call it as. People generally call it as disallowances. You know what I call it as? Conditions for these deductions. What are they? Conditions for these deductions. Conditions for these deductions. Indirectly, if at all you do not comply with this condition, this deduction you will not get. That's why it is called as what? Disallowance. Then finally, we have some administrative provision called 44AA, 44AB, 44ADA, 44AE, 44AD, presumptive taxation, books of accounts, and audit. And you know what? There is a section called 29, which says that entire income under PGBP shall be computed. Entire income under PGBP shall be computed by taking reference from 28 to 43B. By using all these sections, you should compute PGBP. This is the structure of the PGBP. Getting it? In the PGBP, many students do wrong problems, like in the sense they do wrong answers. The only reason they do not understand how to apply the disallowance logic. And 15 marks compulsory question will be there. That is generally based on PGBP. 99% of the cases, the question, 15 marks question will be based on this PGBP. So PGBP is such an important topic, and it is easy also. It's not complicated. It's very logical. Just if you understand this logic, if a P&L account is given, how to do the problem. If receipts and payment account is given, how to do the problem. If you understand that decoding, if you understand that logic, that's more than enough. Getting it? You know, now let me straight away proceed with that. Now, what is the charging section in PGBP 28? In charging section, nothing much is there. In charging section, there is only one important element according to me, that is conversion of inventory into stock in trade. What is it? Conversion of inventory into capital asset. Conversion of inventory into capital asset. This ninth clause you see, ninth point, conversion of inventory into capital. Remember, it's not vice versa. Conversion of capital asset into stock in trade comes under capital gains. Conversion of inventory into capital asset is PGBP. Yes or no? Now, so if at all inventory is converted into capital asset, suppose I'm a jewelry shop owner. I have a jewelry which is actually inventory, but suddenly my wife likes one model. She want to take it and use it for personal use. She took it. Now what happened? My inventory became my personal property right now. Capital asset. It is treated as sale. It is treated as sale. In PGBP, that conversion is treated as income. How much income you should show it under PGBP? Fair market value of inventory on the date of conversion. So that much you should show it as income. And this jewelry item you might have purchased at some price earlier. Fair market value minus purchase price is equal to business profit or business loss. That's it. Able to understand? Same way, sometimes our capital asset will be there. That is converted into PGBP. See, when you are converting this into capital asset, you are calling it as selling price, right? When that is converted, when capital asset is converted into PGBP, you are bringing into business. Means it should be recorded as purchase. It should be recorded as purchase. At what value? Same fair market value on the date of conversion. If capital asset is converted into PGBP, that item becomes inventory. What is the purchase price for the inventory? Market value on the date of conversion. In the capital gains chapter, the same market value is treated as full value of consideration for the purpose of computation of capital gains under 45 subsection 2. If you recollect, under capital gains 45 subsection 2, the capital asset transfer into stock in trade conversion is not taxable in the year of conversion, but it is taxable in the year ultimately when I sell the stock in trade in the business. Now in PGBP, what is the business profit on this converted capital asset into stock in trade? What is the business profit? Sale price plus or minus, sale price minus market value of the conversion. Market value on the date of conversion from capital asset to stock in trade. That is equal to again business profit or loss. Able to understand? Able to understand? That's it. So that is one important point in entire charging section. Rest of the points in charging section, no, whenever it is necessary in the revision, wherever it is necessary, I'll come back to it. Now, what is the method of accounting in PGBP? Remember, for other sources and business or profession, you should maintain accounting records. There is a section called 44AA, which we will discuss little while later. That section says if you satisfy certain parameters, getting it, you must maintain. Simple. In that section, 4 categories of SSS has to maintain accounts. 44AA section says 4 categories of SSS has to maintain accounts. So what are the 4 categories of SSS? We will come back to that later. Getting it? Now what is the method of accounting? Very simple. How are you maintaining books of accounts? Accrual. In PGBP also, computation shall be based on accrual. Suppose if you are maintaining books of accounts on cash, then in PGBP also, books of accounts shall be maintained on cash. Just 1 minute. Yes, sorry for the interruption. Yeah. So, if the books of accounts are maintained on accrual, PGBP income is also calculated on accrual. If the books of accounts are maintained on cash, PGBP income is also calculated on cash basis. That's it. Okay. Now, remember in PGBP, no, when we are discussing incomes and expenses, no, sometimes they will use the word paid, or sometimes they will use the word payable. Paid or payable shall be interpreted in context of method of accounting. Suppose if the word used is paid, don't think that it is actually paid. Okay. If it is accrual basis, in PGBP, income is taxable on accrual, expenses are also, deductions are also given on accrual, except 43B. Except 43B payments. In 43B, 7 types of payments are there. 7 or 8 types of payments are there. Those deductions you will get only if you actually pay. And remember, 43B section is applicable only for the SSC following mercantile basis of accounting. Okay, fine. I'll come back to it. So this is the PGBP related method of accounting. And in 145B, in 145B, if at all you are getting any subsidy, grant, any other from government for your business or profession, that is taxable only when you receive it, irrespective of your method of accounting. Your method of accounting, accrual or cash, doesn't matter. Government grant, when the government declared the grant, that time not taxable. Only when you receive it, taxable. Same way, if you are getting any interest on compensation or interest on enhanced compensation related to transfer of some capital asset, generally that interest amount is taxable under other sources. Getting the point? Straight away the interest is taxable under other sources. 145B is addressing two issues. One is interest on compensation. Interest on compensation is directly taxable under other sources. And if you recollect, we discussed in our class, flat 50% deduction is available. What is it? Flat 50% deduction is available. That's it. And suppose, if the SS is having multiple businesses, if the SS is doing some cotton trading, some rice trading, some manufacturing, some iron and ore, getting it, and he's also having a software company, like that, some 5 to 6 kinds of businesses SS is doing. For each business, you should compute income separately. At the end of the computation of all the business incomes, combine it, you will get total income under PGBP. Getting it? That's it. Now, there is something called income computation disclosure standard, which is not relevant at CA Into. ICDS standards are applicable for an SSE who is liable for, who is following mercantile basis. Who is following mercantile basis. Remember, individuals and HUFs who are having business but not liable for audit under 44AB, they are exempted from ICDS. MCQ, this is important. Getting it? They might test this under MCQ. That's it. This is introduction to the PGBP, which is more than sufficient. Directly, we have something called speculation related discussion. This entirely we will be covering in set off and carry forward revision. Okay. Now, what are the various deductions? First deduction is what I told you, right? Entire PGBP, incomes are covered under 28 and 41. What are all incomes taxable under PGBP? Very simple. If you are getting any amount related to business, it is taxable under PGBP. Able to understand? So, incomes, there is no need to learn specifically what incomes are taxable. Very simple. You are doing manufacturing, sale of goods. You are providing services, sale of services. You are providing any other additional warranty, all that. Whatever income you are getting from that and all is taxable under PGBP. Now, what expenses you can claim under PGBP? What expenses you will get? What deductions you will get? Deductions are covered under section 30 to 38. Actually, 37 only. 38 section says, if at all any deduction, if at all any expenditure you spent that is used for both business and personal purpose, only business related portion you should claim. Personal related portion you should not claim. That is where it is said 38 section says. So 38 section is not a deduction section. 38 section is a clarification section. Now, 30 first deduction section. What is this first deduction section is saying? This deduction section is saying deduction for building expenses. Remember, building expenses, building related expenses. Now, what are the deductions? Suppose, sir, I am a tenant, sir. So what expenses will be there for building? Rent I will pay, sir. That is allowed. Sir, here the word used is paid. No, which means cash basis. No. Getting it? If at all SS is following accrual basis, paid means payable. Getting it? Remember, all the deductions under PGBP, you will claim deduction on accrual basis if at all you are declaring income under accrual. If your books of accounts are accrual, in PGBP, each and every expenditure, each and every deduction is only on accrual. Accrual means what? You incur, that is enough. However, there is a section called 43B where 7 types of payments are covered. These 7 types of payments you will get deduction only on cash basis. Rest all other expenses on accrual, and inside that 43B, rent is not covered. Therefore, rent, the word paid means what? Rent incurred. That's what the meaning. Able to understand? Suppose if the SS is following cash method of accounting, if the SS is following cash basis, then the rent must be paid by 31st March. Only then the expenditure will be given as deduction. Cash method of accounting means what? From 1st April to 31st March. See, for you, the problems will be based on 1st April 2024 to 31st March 2025. May exams, September exams, all that. Getting it? January 26 also. The financial year which will be tested in exam is 24-25. In that year, if you receive any money, that is taxable. In that year, if you pay money, that is deductible. That is cash method of accounting. Yes or no? Now, then another expenditure, repairs. Repairs expenditure is allowed as deduction. Remember, it must be borne by the tenant. Further, tenant might sometimes pay what? Property taxes. He might also pay what? Insurance. He might incur some other expenses. They can also be claimed as deduction. And remember, repairs. They said repairs, right? Which kind of repairs are allowed as deduction? Capital nature. Sorry, revenue nature is allowed. Repairs of capital nature, they are not deductible. Repairs of capital nature. Suppose, I am a tenant, sir. I have taken a building on rent, sir. I incurred some capital expenditure on some renovation, sir. What should I do? I cannot claim deduction. You can't claim. You should create a block to it. You should create a buildings block. Getting it? And then add that into the buildings block. Suppose if it is interior work. Suppose you took a building on lease. You took interior work. Interior is generally coming under furniture meaning. Getting it? You add it to the block of asset under section 32, you claim depreciation on that. So if repairs of capital nature is incurred, they are not deductible, they are added to block, and depreciation can be claimed by the SSE. Next, premises partly used for business and partly used for others. Very simple. Sir, the building which I am using for business, no, that is also used for other purpose, sir. What should I do with regard to this? Very simple. Claim proportionately. Getting it? Business purpose only you should claim expenditure. If at all some expenditure is being enjoyed in other purpose also, being enjoyed by personal purpose also, don't claim deduction for that. Yes or no? Sometimes in problem, no, they'll give you like, okay, let me cover this point also. Sir, SSE is the owner of the building. Rent alone will not be there. Rent expenditure alone will not be there. Rest all other expenses, repairs will be there. Municipal taxes he might be paying. Insurance expenditure is there. Everything else is there. But remember, property taxes, they are subject to 43B. Able to understand. Now, there is one more expenditure. With respect to building, no, you might have borrowed some loan also, right, from the bank. Interest on loan related to building, right? That interest on loan is covered under section 36. The interest on loan is covered under section 36. It is not covered under section 30. Able to understand? That is also building related loan only. Remember, any interest expenditure paid on or after the building is put to use. On or after the building is put to use. The interest expenditure related to that period on or after building is put to use is a revenue expenditure. You should not add it to the asset value. You can claim deduction under section 36. Interest on loans borrowed from banks and FIs is subject to 43B. 43B means what? That expenditure you will not get deduction just on accrual. You should have actually paid by due date for filing IT return under 139 subsection 1. Yes or no? That's it. Now in problem they'll give you sometimes. For example, in September 24 they have given one problem like SSE has a house property. In the house property, 50% is used for business, 50% is used for 50% used for residential purpose, personal purpose. Municipal taxes, repairs expenditure, they all give you. In house property, repairs, insurance, all that you ignore. In house property, for the 50% portion, you directly claim 30% of the NAV, correct? Whereas in PGBP, you should consider that repairs, you should consider the insurance, actual expenditure, how much proportion, whatever is used for business, that much actual only you should consider. Whereas in house property, we ignore actuals, we straight away claim standard deduction. Remember this point. Getting it? Same way, municipal taxes paid, 50% is for house property, 50% is for business. In house property, you will get deduction only if it is paid in the 31st March before. Whereas in PGBP, municipal taxes paid on or before due date for filing IT return under 139 subsection 143B, up to that you can click. Able to understand. That's it. Next, coming to next one is what? Machinery, plant, furniture. Very simple. Any repairs and maintenance incurred on this. Any repairs and maintenance expenditure incurred on this plant and machinery, furniture, you can claim deduction. Sir, I leased this plant and machinery, sir. What about the lease amount? What about the rent amount? You can claim deduction under section 37. You can claim deduction under section 37. Because section 31 is silent on rental amount of plant and machinery, all that. Suppose for my business purpose, I took plant and machinery on rent. What should I do? You can claim deduction under section 37. Able to understand. Next. So repairs and maintenance, assets must be used for business. Usage includes passive usage. Passive usage means what? Sir, I purchased machinery, sir. I just kept it idle. It's installed. Just to switch on, it will start working. It is ready to switch on and start working. Is it ready to use? That's enough. You need not actually use it. Getting it? That's it. Remember, repairs, that too. Which kind of repairs are allowed as deduction? Only current repairs, only revenue repairs. Capital nature are not deductible. They are added to block. Then, now for insurance and for plant and machinery, furniture and all, no, you will be incurring some insurance expenditure also. Deduction is allowed for insurance premium paid. Deduction is allowed for insurance premium. Incurred is enough. Getting it? That's it. Then this point is not required. Okay, majorly it is done. 31 is over. 2 deductions we completed. Now the next major deduction in PGBP is 32, depreciation. Major deduction is what? Depreciation. Remember, depreciation is mandatory to reduce from the block of asset. Compulsorily you should reduce. Well, you should claim compulsorily depreciation. You should also reduce the depreciation in the block. Under PGBP, very important, most important, depreciation is the most confusing point where 90% of the students do wrong answers when they are computing depreciation. Very simple. In PGBP, depreciation is calculated based on block of asset approach. Depreciation is calculated based on block of asset approach. However, for power sector, who is engaged in generation or distribution of power, getting it? Any entity which is engaged in power generation or power generation and distribution, whatever they have in the first year of business, for them in the first year of business, they can either choose SLM, asset wise, or They can use WDV method, block of asset approach. This option is given to them only in the first year. Only in the first year. First time they are claiming depreciation under income tax. They can claim on SLM basis if they want. Once they choose this, forever that power sector has to go with SLM method only. For that, depreciation is given under, depreciation rates are given separately. For power sector SLM basis, depreciation rates are given separately. There is something called appendix 1, appendix 1A, depreciation rates. Okay, so one appendix is applicable for block of asset approach, another appendix is applicable for SLM method. That's it. Now suppose the power sector decided, no sir, we don't want SLM, sir, we will go with the block of asset approach. Then if they choose block of asset approach in the first year, the same they should follow forever, lifetime of the electricity company. You able to understand? Now remember, electricity companies, there is something called additional depreciation. Remember, there is something called in PGBP additional depreciation. Additional depreciation is eligible for whom? Manufacturing entities, power sector. Power sector additional depreciation they will get only when they follow block of asset approach. If they follow SLM, they don't get additional depreciation benefit. Yes or no? That's it. Now, sir, what do you mean by block of asset? Very simple. In income, block of asset means one or more assets, sorry, two or more assets falling under same category and carrying same rate of depreciation, same percentage of depreciation, same category. In income tax, thumb rule, the categories are only 4: intangibles, buildings, furniture, plant and machinery. Any asset you buy, suppose I bought a computer, suppose I bought books, suppose I bought air conditioner, I bought a mobile phone, I bought a car. All these items are not intangibles, they are not buildings, they are not furniture. So books comes under plant and machinery, computer comes under plant and machinery, motor car comes under plant and machinery. So they are all plant and machinery. And see what is the rate applicable. See what is the rate applicable. For that, don't remember all the rates. I will tell you what rates to be remembered. Most important rates. This entirely is PGBP only. You see, for example, what is the rate of depreciation for intangibles? Straight away 25% block. Rate of depreciation is what? Straight away 25. Buildings. Suppose if the building is used for residential purpose like staff quarters, residential premises, 5% is the rate. Suppose if the building is not used for residential, factory, official purpose, office purpose, 10%. Suppose if the building is a wooden structure, then 40% is the rate of depreciation. Suppose it is a furniture, then rate of depreciation is 10%. Remember, furniture, all furniture should come under one block. Buildings, 5% buildings, all that should come under one block. 10% building should come under another block. 40% building should come under another block. So within buildings you have 3 blocks. Then coming to plant and machinery, in plant and machinery, entire totally 5 blocks only possible. Plant and machinery 30% block, plant and machinery 45%, plant and machinery 40, plant and machinery 20. Many students confuse here. They will think it is a computer block, books block. No, it's a plant and machinery 40% block. What are all the assets eligible for 40% depreciation? Assets eligible, renewable energy devices 40%. Computers, including computer software, even computer printers. Printers are also eligible for 40%. Books, whether annual or professional, doesn't matter. You are purchasing books, which is 40%. Pollution control equipment, aeroplanes and engines, life-saving medical equipment, they all come under 40% block. You should call them as only plant and machinery. Getting it? So if they, in the problem they'll give you SSC purchased so and so, computer, books, aeroplanes, all that. You should include them in one block. Like how to compute depreciation block wise, we'll come back to it later. Just 2 minutes, we'll come back to it. Then remember, if energy devices, if at all they are installed before April 2014, then it is 50%. 99% they won't test it. Getting it? Then cars, motor cars. What is the depreciation rate for cars? Motor cars, generally what is the rate of depreciation? 15%. Suppose if the car is purchased between 23rd August, if the car is purchased between 23rd August to 31st March 2020, which is actually generally not required. Mostly they won't give this point, 30%. Generally, if the car is used for taxi purpose, hiring purpose, renting purpose, depreciation is 30. Sir, I bought a car not for renting, sir. I bought a car for my director's purpose, sir. My office business purpose, sir. Then rate of depreciation is 15%. Suppose in this list, mobiles is not covered, air conditioner not covered. They all come under what category? Any other plant and machinery. They all come under what? 15% block. You able to understand? That's it. Now, so this is block. So block of asset. Now, what are they saying here? Block of asset. So what do you mean by block of asset? Asset falling under same category, carrying same rate. You should divide them into block, a single block. Now, how to compute depreciation on the block of asset? This is the question. This condition I will tell you. Then I will open depreciation format. You in income tax under section 32, when you should calculate depreciation? 31st March of the relevant previous year. The year begins on 1st April 2024. Year ends on 31st March 2025. You should calculate depreciation on 31st March. You should calculate on 31st March. On 31st March, you will calculate depreciation if two conditions are satisfied. One, block exists. One condition is what? Block exists. Another condition is what? WDV exists. What is it? WDV exists. Written down value also exists. Block must exist. Inside the block, WDV must also exist as on 31st March. Sir, what do you mean by WDV? Many students thinks that WDV means after reducing depreciation, closing. No. Closing WDV after reducing depreciation is different. WDV of the block is different. WDV of the block means what? I will show you right now. This is the format. Suppose you see this is a depreciation computation format. You should follow. See, I have given you how you should present in the exam also. I have given you how you should calculate normal depreciation, how you should calculate additional depreciation. If you follow this format, you 99.99%, no, 100 out of 100%, you will get the right answer only. You will get the right answer only. You follow this format. Now, what is the WDV of the block? First, opening WDV you take of the block on 1st April. Sometimes when you are solving the problem, they will tell you WDV as on 31st March. Many students, what they do, they take it as opening. No, wrong. WDV as on 31st March. If at all the problem says WDV as on 31st March, simply, they did not mention before depreciation, after depreciation, they did not mention. By default, it means before depreciation. By default, it means before depreciation. WDV as on 31st March 2024, they said. It's nothing but 31st March WDV of 2024 before calculating depreciation for 23-24. Suppose in problem they said very clearly WDV as on 31st March after allowing depreciation. Then that is opening WDV for this year. Remember this point. Suppose in the question they said WDV. In our ICA illustrations, these problems were there. Same namings were used. You go and check. WDV as on 31st March means it's not after reducing depreciation, it is before reducing. If the question clearly says after reducing depreciation, then only you take it as after reducing. Suppose in the question they gave WDV as on 31st March simply. Now they are asking you to find out current year depreciation how much. What many students do, they will take it as opening and they start calculating depreciation. Wrong. First give last year depreciation reduction. Then you will get closing WDV after depreciation of last year. That you take it as opening WDV. Then in the current year, how you should calculate depreciation in the current year. First identify what is the opening block value. What is the opening block value? Identify. For that you should add 4 items. You should add 4 items. Many things only 3 items, but there are 4 items to be added. 1. Assets. You should add what? Actual cost of. You should add what? Actual cost of assets acquired during the previous year. Actual cost of assets acquired. Immediately some students say, is there assets acquired and installed also? No. Acquired enough. If you acquire, you add it in the block. See, for claiming depreciation, installation condition is required. For adding in the block, installation condition is not required. Many don't know this. For claiming depreciation, only installation condition is required. For adding in the block, installation condition not required. Now you see here. How you should? Assets put to use for less than, more than or equal to 180 days. How much? Assets put to use for more than or equal to 180 days. The cutoff date is 4th October of the previous year, relevant year. Suppose right now your problem will be based on 24-25. If the asset is purchased and used, if the asset is purchased and installed before 4th October, straight away it is used for more than or equal to 180 days. Straight away is used for more than or equal to 180. If the asset is installed, see, I'm not using the word purchase. If the asset is installed on or after 4th October 2024, number of days from 4th October to 31st March is 179, which means the asset is used for less than 180 days. So in the problem they'll give you additions. Look at the date of installation. Sometimes in questions they don't give you date of installation, they only give you date of purchase. If date of installation is not specifically given, we assume that on the purchase date itself asset is also installed. Able to understand? Yes, sir. So assets purchased and installation date, you see, accordingly you categorize the assets into more than 180 or less than 180 you categorize. Apart from that, you should also add 2 more. Sir, I also acquired some assets, sir, but not at all installed, sir. Not at all installed as on 31st March. It is not ready for use. No passive usage also. That amount you separately add. Suppose if the SSE has incurred any capital repairs. If the SSE has incurred any capital repairs, we just discussed under 30 and 31 section. That also you add. Then opening value, add actual cost of assets acquired and capital repairs incurred during the year, added. Then what you will get, value of the block, which we call it as gross value of the block, opening plus additions. Remember, here I am going to discuss capital gains point also, section 50. Getting it? Now, less. From this, what you should raise? See, first you are calculating closing WDV of the block before depreciation. Remember, in exam they don't use the word before and all, they simply use the word WDV of the block as on 31st March 2025, 31st March 2024. If they simply mention WDV as on 31st March, you should consider that as before depreciation. Unless they specifically tell you, you should not consider it as after depreciation. Yes or no? That's it, WDV. So how do I get WDV of the block? Remember, 2 conditions are there. WDV shall exist, block shall exist. This condition I'm discussing now. WDV means what? This value must be there. This value must exist. This value must be positive. Only then I can claim depreciation. Only then I can claim depreciation. This value must be positive. Asset also must be there in the block. Means block should be there. Block is there, value is there. Then I will calculate depreciation. If value is turning negative, if the value is turning negative, for example, why? Like, you understood gross block, right? From that, what you should reduce, what you should reduce, block is there, right? Inside that, some part of a block. Please, you see the word I used is part of a block, not full block. If at all full block is transferred. Transfer means sale, demolition, destruction, compulsory acquisition, any reason. My depreciable assets, government compulsorily acquired, or they were destroyed, I received insurance compensation, or I sold them, I received sale consideration. Simply speaking, with respect to assets belonging to this block, right? In this block some assets are there, right? Have you received any money regarding them? Yes. That money received, reduce it. That money received, reduce it. That too, you will reduce here. You will follow this format, whatever I am telling, only if it is a part of a block transfer. Suppose, very simple. Look at this question. Already in the capital gains also I told this point. Getting it in the capital gains revision also I am covering this point. Very simple. Sir, opening WDV they gave, sir, in exam, which is 10 lakhs, sir. Additions during the year, sir, which is 8 lakhs, sir. Getting it? Now, in this year, part of a block only sold, sir. Part of a block only sold. Okay, sir, part of a block is sold for some 9 lakhs, sir. Now, tell me, is depreciation applicable? Yes. Opening plus additions is equal to 18 lakhs minus money received on part of a block, 9. Balance is 9. So value is there as on 31st March. WDV is there. Block is also there. I will straight away go and calculate depreciation. Suppose, sir, I sold this part of a block for not 9, sir, but 19 lakhs. Part only I sold, but 19 lakhs money I got. Sir, opening plus additions is 18, sir. If I reduce 19, minus negative is coming, sir, WDV. WDV block value can never be negative. It can only be 0. Then what about that extra one? You will straight away tax it as short-term capital gain. You will straight away tax it as short-term capital gain. If part of a block is sold, either short-term capital gain you will get or depreciation you will get. Sir, suppose, sir, opening is 10 lakhs, sir. Additions during the year 8 lakhs, sir. But you know what? Full block is sold, sir. Full block is acquired compulsorily. Full block is destroyed, sir. I got insurance compensation 9 lakhs, sir. I got insurance compensation 9 lakhs, sir. Now what is the tax treatment? Very simple. Full block is sold. As on 31st March, 2 conditions shall be satisfied. Block must exist. Value must be there. WDV value must be there. Yes or no? Written down value must be there. Now, written down value 10 plus 8 minus 9. WDV value is there. But the block is not there. But the block is not there. When the block is not there, straight away section 50 you should apply. Straight away section 50. When section 50 is applicable, opening plus WDV 18. This much value of the block I sold for 9 lakhs. Short-term capital loss. If amount received is less than gross block value, short term capital loss. If the amount received is more than gross block value, then the amount is called as short term capital gain under section 50 in case of full block, part of a block. If amount received on part of a block is more than the gross block value, straight away the extra amount is capital gain. If the amount received on part of a block is less than gross block value, then WDV value is there, you can still claim depreciation. Able to understand? So here, so for money received on part of a block, reduce this. Here there is something point regarding slump sale is there. This is not that required. It's okay, no problem. Okay, so this I think I already covered in slump sale revision also. In capital gain slump sale revision I already covered. Getting it? So reduce it. Then what you will get? Closing WDV of the block. Now you should calculate. By the way, this is before depreciation. Now on this value you should calculate depreciation. On this value you should calculate depreciation. For example, I will give dummy numbers. Suppose I purchased for 10 lakhs, sir. Assets I purchased which are used for more than 180, 5 lakhs I purchased. I purchased for what price? 5 lakh. Assets I purchased, sir, but installed and used for less than 180, 6 lakhs, sir. And I also purchased assets, sir, which I have not yet installed, sir, 8 lakhs, sir. And you know what? Some part of a block is sold, sir. Some machineries relating to this block, no, I sold. By the way, this is a 15% block, sir. For our computation purpose, let us assume this is a 15% block, sir. You know what? I sold approximately almost, this is a gross block value is how much it is? 18 plus 11, 29, correct? Almost 29 is the gross block value. You know what? I sold approximately 14 lakhs worth of blocks, sir. 14 lakhs worth of block. You know, this is case number 1. 14 lakhs worth of block I sold, sir. Part only I sold. What is the balance block value? 15 lakh. Now calculate depreciation. In exam you should follow the same steps. Working note 1. What is working note 1? WDV of the block before depreciation, how much? Just now we computed how much it is? 15 lakhs. How much it is? 15 lakh. Now look at the answers here. Look at the point. First, allocate the value to assets bought but not used. How much in our example assets bought but not used? Assets bought 8 lakhs is there. Okay, out of this 15 lakh, no, 8 lakh I will allocate here. How much it is? 8 lakh. Then still how much is there? 7 lakh. Then second you should allocate the value to assets used for less than 180 days. How much is the value of the asset less than 180? Oh, 6 lakhs is there. Okay, 6 lakhs I will allocate. This is how you should do allocation. Then balancing figure 1 lakh. Now what is the rate of depreciation? Here no, nil depreciation, because asset you purchased only but not installed. In the year in which you purchase the asset and not installed, normal depreciation you can't claim, but second year onwards you can claim depreciation on this, because second year onwards it will belong to opening value. You can't find out this kind of breakup in the second year. That is why they say normal depreciation is not allowed in the year of purchase if the asset is not installed. Suppose if the asset is not installed in the year of purchase, normal depreciation is not allowed only in the first year. Second year onwards can I claim? Yes. Why you can claim in second year onwards? You don't claim separately. It is forming part of opening value. That's why you can claim. It is forming part of, in the second year it will come under balancing figure if at all there. Able to understand? Now 0. Now in current year 6 lakhs is there, right? 6 lakh. Now what are they saying? Apply half rate on this value. Half rate means what? 6 lakhs into 15% into half only. How much is it? 45,000 is the depreciation. Then 1 lakh is there. Apply full rate into 15%. 1 lakh 50,000. Sorry, 15,000. What is it? 15,000. So total normal depreciation is how much? 60,000. Able to understand? Total normal depreciation is 60. Now if the SSC is engaged in manufacturing, he is also eligible to claim additional depreciation. In that case, working note 2 will be there. Part number 2, depreciation is computed. See, this is working note 1. In this working note 1, part 1 computation is normal. We understood right now normal. Now, okay, now we will understand part 2. Don't worry, I will take one more illustration here itself. Part 2, additional depreciation. How to calculate? You know, additional depreciation. For example, in the problems they gave some machineries and all. You know, machinery purchased during the year but not installed. Additional depreciation is 0. Sir, second year also it is not installed. Same 0. Third year it is installed, sir. That year you will get additional depreciation. Additional depreciation you will get in the year of installation. Sir, I installed, sir, in this year. Machinery I installed, sir, but used for more than or equal to 180 days, sir. Then look at actual cost. Remember, for computing additional depreciation, WDV value is irrelevant. What is important? Actual cost multiplied by 20%. You will get some amount. Suppose if the machinery is used for less than 180 days, you will get 10%. Balance 10% you can claim in the next year. When you are solving the problem, see whether in the before year, any additional depreciation is there, balance 10% is there or not, check out in the before year. Getting it? Machinery A brought last year, balance additional depreciation to be claimed how much? Actual into 10%, that value. Remember, if at all any balance additional depreciation is there coming which is belonging to the last year, getting it? Balance additional depreciation, can you claim in the current year if at all you are following default tax regime? No. If at all the SS is following default tax regime, getting it? You cannot claim additional depreciation. Remember that point. Okay, that's it. You calculate additional. Now, what is the total depreciation? Part 1 plus part 2. This value you should include here. Then you will get what? Closing WDV as on 31st March after depreciation. Are you getting it? Suppose, sir, in this question, for example, this is not 14 lakhs, sir. For example, this is 20 lakhs, sir, sale value. How the answer will change? Very simple. If it is 20 lakh, WDV before depreciation is how much? 9 lakh. So here how much value is there? How much value is there here? Just a minute. So how much value is there? 9 lakh, correct? So how much value is there here? 9 lakh. Now anyhow, first I should allocate for what? Assets bought but not used. How much is the asset bought? 8 lakhs. 8 lakhs into 0% depreciation 0. Then yes, second allocate, balance only 1 lakh is there. Here we have how much value? 6, but I have only value how much here? 1 only there. So 1 only I will allocate. Able to understand? So 1 lakh multiplied by 15% into 1 by 2 is equal to so and so amount. Balancing figure 0. Entire 9 lakhs is allocated, 8 here, 1 here. That's how allocation should be done. Able to understand? That's it. This is how you should calculate depreciation. Easy. All of you. Now, additional depreciation. Who will get additional depreciation? SSC not following default tax regime. First point. 2. SSC not following default tax regime. Second condition. SSC must engage in manufacturing or generation of power or generation and distribution of power. Power sector is eligible provided only when they follow block of asset approach. How much is the rate of additional depreciation? 20% of actual cost you will get as a deduction. Further, additional depreciation is eligible only for new plant and machinery. Remember, we have given here itself. Additional depreciation is eligible only for new machinery or plant acquired and installed in the factory. Getting the point? If it is installed in office premises or residential premises, no additional depreciation. You will not get additional depreciation on any type of vehicle, roads, ships, aircraft, transport vehicles, nothing. You will not get additional depreciation. If at all, you are claiming 100% deduction on it. If at all you purchase any asset for scientific research, you cannot claim additional. Forget about it. You can't even claim normal depreciation. If you purchase any asset for scientific research, that will not come under block. If you purchase any asset for specified business, capital expenditure, that will also not come under block. Yes or no? And second hand machinery, getting it, you will not get additional depreciation. What is additional depreciation? 20% of the actual cost. If the asset is put to use for less than 180 days, you will get only 10%. Balance 10% will be claimed in the subsequent year. Easy or not? 32 is over. 32 is over. So entire matter is given here. Getting it? Remember, here I not only covered depreciation computation, I also covered section 50 capital gains computation also I covered. Yes or no? Now there are few points. You will not get depreciation on land and goodwill at all. Getting it? Okay, depreciation is allowed on spare parts and components also if at all they qualify for capital expenditure criteria. Plant and machinery definition includes ships, books, vehicles, scientific apparatus, surgical equipment. I told right. And tea bushes, livestock, building, furniture, they are all not plant and machinery. Remember, tea bushes and livestock, they are not at all eligible for depreciation. Getting it? Then that's it. Remaining points are not that important. This is enough. This understanding is enough from exam point of view. Clear? Yes. Next. Now coming to power sector. Power sector, they are eligible to claim, deduction. They are eligible to claim terminal depreciation and balancing charge. Power sector, if at all following WDV method. For them, no, depreciation will be calculated on what basis? For them, depreciation is calculated on what basis? Depreciation is calculated on SLM. Even for power sector also, we will calculate depreciation only on 31st March. If the asset is still existing, then only we will calculate depreciation on 31st March. Suppose as on 31st March, asset is sold. Opening date, asset is there. 31st March, asset is sold. See, I am using the word asset, not block. Power sector, SLM basis. Asset is there. Opening value 10 lakhs, sir. 31st March, it is sold, sir. At what price? 5 lakhs. 5 lakhs is loss, no? Don't call it as loss. Call it as terminal depreciation. Sir, 10 lakhs is the opening value, sir. Asset is sold for 15 lakhs, sir. Original cost is 20 lakhs, sir. Original cost is 20. Okay, 10 lakhs worth of asset you sold for 15, no? 5 lakhs profit is there, right? You call it as balancing charge. 41 subsection 2, balancing charge. It is treated as income under PGBP. Sir, same opening value 10 lakhs, sir. I sold for 25 lakhs, sir. You know, original cost is 20 only, sir. Which means you have a profit of 15 lakh. Profit up to original cost 10 lakh is taxable as balancing charge under 41 subsection 2 PGBP. Extra 5 lakhs is there, right? You profit over and above original cost. That 5 lakhs is treated as short-term capital gain under section 50A. You will straight away treat it as what? Short-term capital gain under section 50A. Clear? Hey, what happened? Yes or no? That's it. That's it. Next. With this, depreciation computation is completed. Next, we will straight away proceed with the actual cost. What do you mean by actual cost? Remember, in depreciation block, no, you should add actual cost of additions. No, in the recent January exam, this was asked for 3 or 4 marks question. Getting it? What is the actual cost? Sir, I purchased, some asset is there, sir. I purchased it for scientific research, sir, first. But after using there, no, I directly brought into my normal business, sir. Means I added into my normal block, sir. At what value you should add? Actual cost minus deduction allowed. Generally, it is nil. Getting it? Then, sir, my inventory, no, sir, I am converting into capital assets, sir. My inventory is there, right? Nothing but, sir, actually I have a furniture shop, sir. I have a furniture, which is actually inventory, sir. This furniture, no, I converted into my office appliance, office furniture, which means I am converting from inventory to fixed asset. Now, how much value you should add in the furniture block? Market value on the date of conversion. Remember, if this point is given in the question, no, you should add in the block, as well as you should also show it under sale. You should show it as sale value, 10 lakhs market value. The 10 lakhs will be added in the block also. Remember, what is the tax consequence? MCQ might come, or they might ask you a 2 or 3 marks question. SSE has furniture, or SSE has some machinery which is inventory for him. He converted into so and so a depreciable asset. Now, what is the tax treatment? You should treat it as sale, plus you should also add it in the block. What value? Market value on the date of conversion into capital asset. Remember, capital asset means what? In case of business, depreciable asset is also a capital asset. Yes. Sir, I got the asset as a gift or inheritance. I got the asset under gift or inheritance, sir. How much? How much is the cost to previous owner? Check it out. Minus notional depreciation, reduce it. Plus installation expenses you might have incurred. No, when you purchased after installation, that and all you should add it. No, cost to the previous owner. Previous owner purchased 10 lakhs, sir. He gifted me now. Getting it? Now 10 lakhs, don't take it as cost. Don't add directly 10 lakhs in the block. When he purchased, how many 31st Marches were there? You see, how many 31st March were there? He purchased, I got it, no? Between how many 31st March is there? You see, for each 31st March, on WDV basis, reduce notional depreciation. Whatever the rate applicable to that asset. If it is computer, 40%. If it is other plant and machinery, car and all, 15%. So, for every 31st March on WDV basis, that rate you apply, you will get WDV value. That value you should add in the block of your assets. Able to understand? Easy. Next, then suppose SSE transferred asset used for business. I am using for my business one asset. I sold. Again I repurchased. Very simple. What is the price on reacquisition? How much price you paid at the time of reacquisition? Check that. You have actual cost, no? You purchased, no? Minus depreciation till the date of sale. You sold now, right? Yes or no? Later you acquired it. Up to the sale date, how much is the depreciation? Check out. Original cost minus depreciation up to the sale date, check out. WDV value, check out. WDV value on the date of sale. Simple. WDV value on the date of sale. Getting it? Check out. Compare with the cost at which you acquired, whichever is lower. That is treated as actual cost of addition to the block. Able to understand? Next, we already discussed this enough in the in-depth in the class. Again, logics and all I can't discuss in the revision class. Okay. Then, sir, second hand asset is there, sir, given on lease. Okay, hire or otherwise to previous owner. Previous owner himself I gave. What is it? I purchased an asset from him. Actually my friend is owning an asset. I purchased it from him. Again I gave him lease. I purchased it from him. I gave him back as lease. Some tax related fraud they are doing. Now what is the block? WDV to the previous owner will be treated as the block value. Getting it? What price you paid for purchasing from him, don't add, because no, you purchased and give it as a lease to him only, which means there is some tax manipulation. So don't record it purchase price. WDV to him in his books of accounts, how much? The same value will be treated as purchase price for you. Simple. Able to understand. Next, sir, I have a building, sir. I have a building. I brought into business. My personal asset I brought into business, sir. If it is building, original cost how much? Identify. Minus notional depreciation for every 31st March from the date of purchase of building till the date I'm bringing into business. Suppose I purchased the building in 2019 April. 2019 June I purchased the building. You know, I am bringing into business on 20th June 2024. In the problem, 2020 31st March, 2021 31st March, 2022 31st March, 2023 31st March, 4 31st March is there before I bring into business. For 4 31st March, reduce notional depreciation. Now, moreover, if it is a personal building, no, you might have used it for residential purpose. You might have used it for residential purpose. Then 5% depreciation. Suppose if you are told that building earlier you are renting it for commercial purposes and all, then reduce 10% notional depreciation. You able to understand. Then you add it as a block. Suppose no, in the last January exam, this question was asked. Suppose, sir, other personal asset brought into business, sir. I have a personal car, sir. Now I am bringing into my business, sir. What price? Directly actual cost. You see, don't reduce notional depreciation. Symbolically, how I gave minus notional and I wrote stroke off, because you should not reduce notional. Directly actual cost. You able to understand. Then, sir, I borrowed loan, sir, relating to asset purchase, sir. Interest expenditure is there, right? Up to date of put to use, that should be capitalized. From the date of put to use, interest amount will be the rate on the loan outstanding. Claim it as deduction under section 36. Remember that, sir, when I'm purchasing the asset, no, GST amount and all is there, sir. I'm a registered person under GST law, sir. Input tax credit is available, sir. To the extent of input tax credit, don't add it in the block. Over. Yes or no? Sir, grant I got, sir. Central government or state government or somebody else, sir. Actual asset price is 10 lakhs, sir. But I incurred only 2 lakhs, sir. I incurred only 2 lakhs. 8 lakhs somebody else incurred. Then you should add in the block only 2 lakhs. Able to understand? Then this specified business point and all is not that important for us at CA interlevel. It's not required. But in regular class, we discuss this very in-depth logically. Yes or no? How this point will come, all that. But briefly, once again, I'll cover this point. Once I'm covering 35 AD. Able to understand. All of you, that's it. Rest of the points are not required. Carry forward and set off of depreciation, nothing but unabsorbed depreciation loss. All that we will straight away discuss in set off and carry forward revision. Now it is not required. We will discuss in set off and carry forward revision. Yes or no? That's it. Depreciation is completely done. Able to understand. Then section 35. Section 35. Deductions for scientific research expenditure. Deduction for scientific research expenditure. Remember, under section 35, you will get two types of deduction. You know, deduction where you are directly incurring the expenditure. Deduction for SSC where he is directly incurring the expenditure. Deduction where you are giving as a donation to other entities. Deduction towards donations, contributions to others. You know, if you are giving deductions or donation, if you are giving contributions or donations to Scientific Research Association, approved. Indian Company for Scientific Research, approved. Social Research, approved. National Laboratory, University, IIT and all, approved. If you are giving donations to these 4 categories of persons, you will get 100% deduction only under optional tax regime. You will not get deduction under default tax regime. However, sir, scientific research expenditure, I am only directly spending, sir. Many students confuse. If you are directly spending, you will get deduction. Many students interpret section 35 is not eligible for default tax regime. Wrong. 35 subsection 1, 4, 1A eligible. 35 subsection 1, clause 2, clause 2A, clause 3, 2AA. This is only not eligible under default tax regime. Directly expenditure is incurred by the SSC. You can claim. You know what you can claim? You know, revenue expenditure anyhow you can claim. Not a big deal. Capital expenditure also you can claim. What you can claim? Capital expenditure also you can claim. You see here. Capital, just a minute. Capital expenditure also you can claim on scientific research. Whatever research expenditure you allowed, no, you spend, no, fully you can claim deduction, except land cost. What you will not get deduction? You will not get deduction for land. Getting it? Sir, no deduction for cost of land. However, building cost is also deductible. Now remember, if at all any asset you purchase it for scientific research, it is not eligible for depreciation. No block of asset. It should not be added in the block. When this asset will be added in the block from scientific research, I directly took into normal business purpose. Then I will add in the block. At what value will add in the block? Explanation 1 to 43 subsection 1. Actual cost. Actual cost minus deduction claimed under 35. Deduction claimed is equal to full 100%. So nil. At nil price you will add. Able to understand. Now, so capital expenditure. Sometimes I will incur expenditure on scientific research before starting the business. Before starting the business, I might incur. What about the previous? Before starting the business, if I spend some money, that year business is not there, no. So I spent money, but I didn't claim deduction anywhere. In the year in which you started business, no. Whatever last 3 years, remember, last 3 years revenue expenditure, last 3 years capital expenditure, whatever is there, claim it as deduction in the first year in which you started the business. When you are claiming deduction for revenue expenditure, for past 3 years before commencement, only salary and material cost is allowed as deduction. Once you started the business, again you are incurring scientific research. No type of expenditure, no limit on type. Any expenditure you incur, scientific research allowed. Revenue, capital, both are allowed. Able to understand? All of you. Now, sir, scientific research purpose I purchased asset, no, I removed it now. Removed it means what? Either you might have sold to somebody or you might have transferred it to your normal business. Suppose, sir, I sold directly to somebody, sir. I purchased an asset for scientific research purpose, sir. I sold it to somebody directly, sir. Without using it for some other purpose, I sold it directly, sir. How much amount you got? How much amount you got? First check out. Sale proceeds, how much you got? Or how much deduction you claimed under 35 you see. Sir, I purchased scientific research asset for 10 lakhs, sir. Earlier I claimed deduction 10 lakhs, sir. Now I sold it directly, sir. Directly I sold. Remember the word is directly. Directly sold means what? I didn't take into normal business. Directly from my research and development department itself, I sold it, sir. How much you got? 5 lakhs you got, sir. Whichever is lower. How much is taxable? 5 lakh. Where it is taxable? 41 subsection 3. It is treated as a deemed profit. Oh, sir, I didn't sell it, sir. I transferred it into block. I used it for normal purpose, sir, directly. Then in the block, I will add it at 0. That asset I sold from the block, sir, at 5 lakhs. No tax treatment on that here. You will reduce that 5 lakhs from the block value, because once an asset is forming part of the block, it will lose the identification of scientific research asset. Once you transfer scientific research asset into block, it will lose the identification of scientific research. It is now part of the block. When asset is sold in the part of the block treatment you will apply. 30 to 50, all that logics will apply. Yes or no. That's it. So that is what I have given. Suppose if the asset is brought into normal business, the same will be added to the block at nil, which is explanation 1 to 43.1. Indirectly, there is no retaxation. Yes or no? That's it. With this, 35 is also over. Then we have 35 AD. 35 AD. You know 35 AD talks about what? Capital expenditure for specified business. Sir, I am doing specified business, sir. What about revenue expenditure? Revenue expenditure, anyhow you can claim 30, 31, 32, 36, 37. Revenue expenditure you can claim as usual. 35 AD is specifically drafted for which deduction? Capital expenditure deduction. Suppose, sir, I am following default tax regime, sir. I will not get 35 AD deduction. Yes or no? If the SS is following default tax regime, will he get 35 AD deduction? No. 35 AD deduction he will not get means which deduction he will not get? Revenue expenditure, capital expenditure? Capital expenditure. Yes or no? Because 35 AD talks only about capital. Sir, if 35 AD section is not there, sir, what is the consequence? Every capital expenditure, it is eligible only for depreciation. Revenue expenditure as usual, 30, 31, 35, 36, 37 as usual. 35 AD specifically talking about what? Capital expenditure. Now, if at all you are starting any of these 14 businesses, if at all you are starting any of these 14 businesses, I am not repeating this list, okay, you take care of it later. If at all SSC is doing any of these 14 specified businesses, in these businesses, he is incurring some capital expenditure other than land, other than goodwill, other than financial instruments. You are incurring some capital expenditure. Don't claim depreciation. Claim 100% deduction for capital expenditure. That is what 35 AD benefit is. Getting it? To encourage investments. So if at all I have to encourage investment means I should give deductions investment linked. This section is also called as what? Investment linked deduction. This investment linked deduction, capital expenditure related deduction section is not applicable when the SS is following which regime? Default tax regime. Yes or no? Until now, DTR, additional depreciation you can't claim. 35 AD, contributions, donations, 35 you can't claim. Contributions and donations. 35 AD, capital expenditure you can't claim. Sir, what about revenue expenditure for specific business? That you can claim. That's a normal business expenditure. Yes or no? Next, what is the amount of deduction? 100% deduction on capital expenditure incurred. Sir, not only current year, sir. Before I started this business itself, I started constructing hotel. Getting it? Past 3-4 years, I'm constructing hotel, sir. What about that? That expenditure incurred before commencing the business. No, that time you incurred expenditure. You didn't claim deduction anywhere. By the way, which expenditure I'm talking about? By the way, capital only. Under 35 AD, we are only discussing about capital. Revenue expenditure, no problem at all. You can claim under respective sections. Yes or no? Now, before commencement of specified business, I incurred some expenditures. So what about that? You can claim deduction in the first year in which you started the business, provided only one condition. Whatever expenditure you incurred, no, please capitalize it in your books of accounts as on the beginning, 1st April or beginning date of the business. Capitalize it. Then you claim deduction in the current year while filing IT return. You able to understand. Now, again, when you're incurring any capital expenditure, no, if at all you're making any payment exceeding 10,000 in other than cash, cross check, bearer draft, you will not get deduction for that capital expenditure. Same point is there in depreciation also. In depreciation, 43 subsection, what is actual cost? Actual cost is purchase price. However, if the amount paid is more than 10,000 by other than cash, nothing but, if the amount paid is by other than prescribed modes, other than prescribed mode means what? Cash, cross check, bearer draft, then you will not get any depreciation on that. You will not add in the block. Actual cost is treated as nil. Same way here also in 35 AD, if at all you're incurring any capital expenditure in a day to a single person more than 10,000 by other than prescribed mode. What is other than prescribed mode? Cash, bearer check, cross check, bearer draft. Then it will, you no deduction for that capital expenditure at all. Yes or no? Now, conditions. Conditions, it should not be splitting. It is not, the business should be started as completely afresh. It should not be like a demerger from existing business. And in that business, no, you should not use second hand machinery. Up to 20% only second hand machinery can be used. Able to understand? You will get deduction. Second hand machinery, new machinery, everything you will get deduction. But second hand machinery should be only maximum 20% of the total machinery installed in the business. What is not a second hand machinery? If it is not used in India and no depreciation is claimed in India by anybody on that asset till date, getting it? Then it is treated as a new machinery. Yes or no? It is imported into India for the first time, and on that mission, no, nobody claimed depreciation till date. Then only it is treated as what? New machinery. Otherwise, that machinery is treated as second hand. Second hand can be there up to how much? 20%. Then, there are some conditions. Most important conditions in 35 AD. Very simple. Now, you are incurring capital expenditure. You can claim 100% deduction, right? There is one condition. That asset, no, whatever you are claiming deduction, that asset must be used for that asset must be used only for specified business for 8 years. Only for specified business for 8 years you must use it. Sir, I'm not using it, sir. Within 8 years, no, I transferred it to my some other business, sir. See, I'm not talking about sale. I am not talking about transfer. I'm talking about usage condition. 8 years you must use it for the same specified business. Sir, I'm not using it for 8 years, sir. Some 4th or 5th year, no, I transferred that machinery to my normal business, sir. What is the consequence? Very simple. Earlier given deduction. What is it? Earlier given deduction. Deduction claimed earlier how much? Minus the asset purchased. That year 100% you claim deduction. No? After that, how many 31st March came? You see. For number of 31st March, you claim notional depreciation. The balance is treated as income under 35 AD subsection 7B. The balance is treated as what? Income under 35 AD subsection 7B. This is treated as income. This income is there, right? This income under PGBP 28. Sorry, 35 AD 7B, not 28. 35 AD 7B, it is treated as income. Now this income, what is treated? What is taxed as income, right? This amount. The same amount will be added in the block also. Because now you are moving the asset from specified business to block. This is what there in the explanation 13. In the 43.1. This income, what is deemed as income? By the way, we are treating it as income. Why? We are selling it. No. We are using it from specified business to other purpose within 8 years. Sir, I am using it for other purpose after 8 years, sir. In the block, 0. Value added in the block is 0. Retaxability under 35 AD subsection 7B, 0. Within 8 years, I am using it for some other purpose. Actual cost, deduction claimed how much? Minus notional depreciation for every 31st March. Reduce it. And You calculate total notional depreciation, you calculate. So WDV value you will get. That amount is treated as income under 35 AD subsection 7B. Able to understand. Now the same value will be added to the block also in the normal business. Able to understand. Sir, it's not about usage, sir. I sold it, sir. When you are selling, suppose I purchased an asset for specific business, 100% reduction claimed. Now I sold it, sir. Whether you are selling within 8 years, after 8 years, that 8 years logic is not applicable for sale. Amount you got, whatever amount you got is straight away taxable under charging section PGBP. That's it. Suppose, sir, asset I bought for specific business, sir. Within 8 years, I used it for some other purpose. Then income will be taxed. How much income? Deduction allowed earlier minus notional depreciation, that is treated as income under 3587B, and the same value will be added to the block. After adding in the block, I sold, sir. What should I do? Reduce it from the block, because once an asset is forming part of block, any subsequent transfer of that particular block, only block of asset treatment will be applicable. That's it. Able to understand? Everybody? Yes. Next. Amortization of preliminary expenditure, 35D. 35D is not a big deal. Okay, you can handle on your own. Okay, like very simple. Total preliminary expenditure, find out. Find out total preliminary expenditure. How much is allowed? Sir, I am a company, sir. I am a company, sir. Mine is a company, sir. 5% of COP, cost of the project, 5% of capital employed, whichever is higher. Suppose, sir, I spent 10 lakhs money, sir, but cost of the project is only 100 lakhs. You know, capital employed is 105 lakhs. So 5% of it and 5% of it is equal to whichever is higher, means some 5.2 lakh is coming, sir. For example, you spend 10 lakhs. Deduction is only for 5.2 lakh. Maximum preliminary expenditure under 35D cannot exceed 5% of COP, 5% of capital employed, whichever is higher. By the way, you can't claim deduction at a time, that amount also. 5 lakhs also you can't claim at a time. You have to claim in 5 installments. Able to understand? What are all preliminary expenditure? I have given meaning here. You can look at it. Okay. Now, for claiming preliminary expenditure, one most important condition is within 1 month before the due date for filing IT return. By 30th September, nothing but accountant report, chartered accountant report has to be submitted. Even for 35 AD, capital expenditure reduction, you should give chartered accountant report. Able to understand? You're able to recollect everything? Productive? Yes. Next. 35 DDA, sir. SSC, he is incurring VRS expenditure, sir. Voluntary return. Whatever amount paid under VRS, you can claim deduction in 5 installments. That's it. Other deductions. Sir, I took insurance policy for inventory, sir. You can claim deduction. Sir, I took insurance policy for my employee health benefits, sir. Employee health insurance. You can claim deduction only if it is paid in other than cash. Yes or no? Sir, I took insurance on plant and machinery, sir. What about that? It is not covered in 36. It is not covered in 31 also. It is allowed under 37. Because 37 talks about one expenditure. It is related to business. Expenditure must be related to PGBP, business or profession. And it is exclusively used for that. And it must be revenue in nature. It is not a personal nature. Business expenditure, not a personal nature. Revenue in nature, not covered in the above sections. You can claim it under 37. Suppose salary paid by company to the employee. Salary is not covered anywhere in the section. 37 you can claim. Electricity expenditure, 37 you can claim. Telephone expenditure, 37. Internet charges, 37. Repairs and maintenance, 37. Repairs and maintenance of plant and machinery furniture, 31. Repairs and maintenance of building, 30. So repairs and maintenance are covered under 30 and 31 only. So 37 will not apply. 37 will not apply. You able to understand? That's it. If any of you are feeling speed, my revision, reduce the speed, playback speed. That's it. Watch speed you can reduce in the YouTube. Okay, that's it. I think you're able to understand. I hope I'm not fast. Okay, that's it. Next. Suppose I paid bonus or commission to employees, sir. Yes, allowed as deduction subject to 43B. Bonus or commission is covered under 43B. Sir, interest on loan borrowed, sir. Used for business or profession. Getting it? Allowed as deduction subject to 43B. Which interest on loan? Banks and FIs and NBFCs. You borrowed loan from banks, FIs and NBFC for business purpose. Interest incurred. You can claim deduction only subject to 43B. Moreover, suppose if the loan is borrowed for purchasing asset, up to the date of put to use the asset, as per explanation 8 to 43 subsection 1, up to the date of put to use the asset, you should add it to the block. That's it. Then zero coupon bonds. Getting it? Zero coupon bonds means what? Zero coupon bonds, what you can claim? Discount amount you can claim deduction on pro rata basis. Discount amount you can claim deduction on pro rata basis. What is discount amount? Maturity amount, how much you have to pay. Now how much, at what price you issued the bond? Sir, maturity amount, no sir, approximately 12 lakhs I have to pay, sir. 12 lakhs I have to pay, sir. Right now I have issued the bond at 10 lakhs, sir. So 2 lakhs, sir. 2 lakhs is the per bond discount, sir. 2 lakhs per bond. How much is the discount? 2 lakhs. You know, this bond duration is 200 months. This bond duration is how many months? 200 months. Per month reduction is how much? 1000 rupees. In the current year, the bond is issued on 1st October 2024. Then for 6 months into 1000, 6000 you can claim deduction. Next year, 12 months, 12,000 you can claim deduction. That next year, 12,000. Again in the last year of the bond, 6 months only is there in the financial year. 6 months into 1000, simple, per month 1000. In this year, bond is in existence in this year, how many months? That many months into that much. Able to understand? So discount divided by number of months you should identify. So you will get a pro rata basis. Able to understand? Next. Then you remember contribution to welfare funds. Employer, he is contributing to RPF, superannuation fund. Employer is contributing to RPF and superannuation fund within prescribed limits. That amount is allowed as deduction. How much ever employer contributed, that much amount is allowed as deduction, subject to 43B. Contribution towards national pension scheme, sir, is also allowed as deduction. How much maximum deduction here? Limit is there, 14% of salary. Salary means what? Basic plus DA for retirement benefits. Able to understand? Then, sir, employer, he is contributing to gratuity fund, sir. Approved gratuity fund, sir, is contributing, subject to 43B. Sir, 5A. What is this 5A? I collected from employee contribution, sir. Not mine, employee. First treated as income. First treated as income under 2 subsection 24. You paid to the respective statutory authority within due date under that law, claim it as deduction under 36 subsection 1 clause 5A. Getting it? So deduction is allowed under this section if employee contribution is remitted to respective fund within the due dates prescribed under the respective law. Remember, employee contribution collected by employer shall be first treated as income. 43B will not apply on this because this is not your contribution, this is employee contribution. Again in 43B, I gave a comparison table for this. Again in 43B, I gave a comparison table for this. Bad debts. Very simple. You sold goods on credit. You showed it as income on the you showed income in the PGBP on accrual basis. You pay tax also. Subsequent year, amount is not recoverable. You wrote off in the books. Or the amount became irrecoverable. Either you wrote off or it became irrecoverable, as the case may be. That amount you showed as income in the PGBP, right? You can claim it as deduction in the subsequent year. Able to understand? Sometimes sir, I claim a deduction, sir. 10 lakhs I claim a deduction in PGBP, sir. But the assessing officer opened my case. He allowed only 5 lakhs deduction, sir. 5 lakhs only he allowed deduction, sir. How much he disallowed? 5 lakh. Getting it? Which means, sir, my bad debt is 10 lakh. I sold goods for 10 lakhs. My bad debt is 10 lakhs. Many faculties, I am telling you, many books are having wrong provision on this. Many books are containing wrong way. Getting it? See, suppose bad debt amount is 10 lakhs. Bad debts claimed is 5 lakhs. What? That question itself is wrong. If bad debt is 10 lakh, you will also claim how much? 10 lakh. If assessing officer does not allow entire 10 lakh, that is what the provision is about. There is a section in the bad debt 36 subsection 2. Inside that there is a clause number 3. This talks about assessing officer involvement. Even ICA book does not have this point. Getting it? This is the actual meaning. Suppose, sir, I sold goods on credit for 10 lakhs, sir. The customer is not paying. Not paying at all. That entire 10 lakhs I showed it as bad debt, sir. In my books I showed it as bad debt. In income tax also I claim it's a 10 lakhs. But you know what? Assessing officer did not allow. Assessing officer did not allow full 10 lakh. He allowed only 5 lakhs, sir. Okay, 5 lakhs only I claim it, sir, ultimately. Actually, 10 lakhs is the sale value I showed. But 5 lakhs reduction I claim. Net amount is still how much income I showed to the department? 5. Subsequently, I collected luckily 5 lakhs, sir. I already showed originally 10 minus 5. 5 only I showed. Finally, I collected 5 only. Nothing is taxable. Suppose I collected 7 lakhs, sir. Till now, original I showed 10. Second year, I claimed bad debts 10. But assessing officer only 5, right? So net amount to claim it is how much? Only 5. Now I recovered 7. 2 lakhs is treated as business income. Sir, I recovered 10, sir. 5 lakhs is treated as income. Suppose I recovered 11 lakhs, sir, including interest, sir. Then 6 lakhs. Sir, suppose you know what? Ultimately, I recovered only 4 lakhs, sir. Original I showed 10 lakhs income, sir. Entire 10 lakh is bad debt, sir. Second year I claimed 10 lakhs bad debt, sir. But the assessing officer permitted only 5 lakhs, sir. Indirectly, 10 minus 5, 5 lakhs income I showed, sir. But ultimately I collected only 4 lakhs. Now the customer is insolvent. I don't even get 1 rupee extra. I showed 5 lakhs income in net effect already, sir. But I recovered only 4 lakhs now, sir. that 1 lakh which you showed extra income, no, is allowed as additional deduction. This illustration, if you understand bad debts, you understood it. Here indirectly what am I covering? 41 subsection 4, recovery of bad debt also I'm covering. Recovery. So how much is taxable? Recovery of bad debt is taxable. Recovery of bad debt is taxable to the extent deduction allowed earlier. Deduction allowed earlier means what? Sir, bad debt claimed. Bad debt claimed how much? 10 lakhs, sir. Deduction allowed by AO is how much? 5 lakhs, sir. How much is not allowed, sir? 5 lakhs, sir. To this extent only recovery is taxable. Able to understand? Yes or no? That's it. Then family planning expenditure, only company SSE can claim deduction. Only company SSE can claim deduction. This family planning expenditure is again broadly classified into 2 types: revenue, capital. Capital expenditure is also eligible for 100%. Revenue is also eligible for 100%. If you purchase any asset for family planning, that asset will not form part of the block of asset. Remember. Now, what is capital expenditure in family planning? You constructed some small hospital, you constructed some, you recruited some medical equipment, all that. A company, normal manufacturing company, recruited some medical equipment and all. That is capital expenditure. Revenue expenditure means treatment cost. That's revenue expenditure. Revenue expenditure 100% you can claim. Capital expenditure also you can claim 100%. But capital expenditure is subject to unabsorbed depreciation rules and all. Scientific research capital expenditure is there, right? That is also subject to unabsorbed depreciation rules. Specified business 35 AD capital expenditure is there, right? That is also something subject to the unabsorbed depreciation rules. These are all similar to unabsorbed depreciation rules. What is unabsorbed depreciation rule? All that we will discuss in set off and carry forward chapter. Able to understand. Next. Suppose I'm doing stock market or commodity market. STT paid, CTT paid. Remember, if it is a capital gains chapter, STT paid is not deduction. No deduction at all in capital gains if it's a capital asset. But in PGBP, it is not like that. If it is a stock in trade for you, STT paid is allowed as deduction. Finally, sir, there are so many other expenses which I incur in business, sir, like salary, salary expenditure, office maintenance, telephone expenses, fiber net, like internet charges, so many, paper cost, printing and stationery, so many expenses I incur, sir. Fuel. Where I can claim deduction? You can claim deduction under section 37. Only one condition: it must be incurred after the business is set up. It must not be related to personal, or it should not be capital. Expenditure is exclusively for the business. It is not covered under 32, 37. Remember, in PGBP, no deduction for provisions and reserves. You will get deduction in PGBP for an expenditure only if it is a real expenditure. You create provision, you don't get deduction. You create reserve, you don't get deduction. Then further, CSR expenditure, company will spend CSR activity expenditure, right? That's your personal obligation. That is not related to business. You will not get any deduction. Further, there is a section called 35 subsection 2B. Sir, I am incurring an expenditure, sir, which is actually advertisement cost in a newspaper, sir. That newspaper, pamphlet, brochure, no, it is published by political parties, sir. It is not treated as a business expenditure. It is treated as a donation. No deduction under PGBP. For companies under 80 GGB, the same amount is given as donation. The same amount can be claimed as deduction towards donation. Able to understand? That's it. All the deductions are over. All the deductions are over. Hardly 1 hour 15 minutes. We completed all the deductions. Getting it? Yes. 2 minutes gap will take, and we'll immediately start disallowances. Confident until now? Disallowance until another 45 minutes to 1 hour. Over. Okay. Now let's begin disallowance sections. Let's continue disallowance sections revision. Okay. See, we have very many disallowances. For example, what are the sections that we have? We have section 40A subsection 1. 40A subsection 1A, and we have 40 subsection B, which is actually applicable for firms or LLPs. Then we have something called 40A subsection 2, 40A subsection 3, 40A subsection 3A, 40A subsection 5, 40A subsection 7, 40A subsection 9. Actually 5 we don't have, we only have 7 and 9. Just a minute. We only have 7 and 9. Okay, that's it. Then we have 43B. We have something called 43B. Now, if you observe these sections, these two sections, getting it? 40A1, 40A1A, 43B. In these, the deduction of expenditure is linked with 139 subsection 1 due date predominantly. If at all you do not pay, suppose in 43B there is clause H, MSME, that is linked with the due date under MSMED Act. Okay, by the way, in these two sections, in these three sections, if an expenditure is disallowed, it is not permanently disallowed. In this year, it is disallowed. Later, when you once again comply with the section, you will get once again a deduction. Whatever is disallowed now, you will once again get a deduction later. So it is like a temporary disallowance. Whereas disallowance under 40B, disallowance under entire 40A series, this is a permanent disallowance. Permanent means what? For example, there is a section called 40A2. Any amount paid as expenditure to related person. If the unreasonable portion is there, that is fully disallowed. Will it be given as deduction later on again? No. 40A3, it is talking about revenue expenditure claimed to be deduction on, if at all, amount paid in other than prescribed mode. Other than prescribed mode means cash, all that, more than 10,000. So that one is 40A3. 40A3 is talking about treating as income, deeming as income. We'll come back to it. 40A7 is saying provision for gratuity, all that. You will not get deduction for provision. You will get deduction only if it is a funded gratuity, only if you really pay it. Or if the gratuity actually becomes payable in the current year. 40A9, this is talking about contribution to unrecognized funds. Suppose if the employer is contributing to unrecognized funds in the name of employee, no deduction at all. Actually, this deduction is over. This deduction is over. Simple. 40A7 is talking about contribution to, provision for gratuity, no deduction. If you contribute to gratuity fund really the amount, subject to 43B, you will get a deduction. Gratuity becomes payable in the current year, you have to pay. Accrual basis you recognized, you will get deduction. Provision for gratuity which will be paid somewhere later, no deduction. 40A9, any contribution to unrecognized funds, no deduction at all. 40A2, payment to, what is this 40A2 is about? Payment to related persons, any revenue expenditure, obviously capital expenditure you can't claim deduction, that's the reason. Revenue expenditures which are covered under section 30 to 37, any payment made to related person, deduction will be allowed only for the reasonable portion. If the amount is unreasonable, no deduction at all. Who is a related person? Who is a related person? I have given a simplest way the definition. Who is a related person? You see, for individual, relative. Relative means what? Spouse, brother, sister, any ascendant or descendant. In January exam, no, amount is paid to aunt. Some point is given, which is not covered under relative definition in the Jan 25 exam. Now, will the section be applied or not is the question. Intention of the section you understand. It's to related person. Yes or no? Maybe the examiner might consider two options. They may absolutely interpret this definition of relative and say, since it is not covered under relative, no disallowance. Or they may apply the intention of the section. We don't know what this adjusted answer looks like. Getting it? Fine. Suppose expenditure is paid to entity, sir, not to the individual, sir. Not to the individual, paid to entity, sir. You know, I am a business person, individual. I am paying expenditure to another individual who is my relative. Unreasonable portion disallowed. I am paying money to some enterprise, sir, in which myself or my relative has substantial interest. That is also covered under related person. For companies and HFs and firms, very simple. Directors for companies, and partners for the firms, members for HUF, members for AOP, and their relatives. They are all covered under related persons. So for a company, directors and relatives. For a firm, partners and their relatives. For AOP, members and their relatives. For HUF, members and their relatives. They are all related persons. Not only them. Entities in which these directors, partners and their relatives has substantial interest, they are also related persons. Very simple. 40A subsection 2. If you are paying to related person, yes sir. Unreasonable portion is there, yes sir. Assessing officer can disallow. Able to understand. Over. 40A2 is over. Substantial interest means what? Minimum 20% voting power in case of companies. Other entities, minimum 20% profit sharing ratio. Then only we call it as what? Substantial interest. That is 40A2. Able to understand. Now, permanent disallowance I am discussing first, then final I'll come to temporary disallowance. 40A subsection 1, 40A subsection 1, a payment to non-resident, payment to non-resident without deduction of TDS, that and all I will discuss at last, just now. Okay. Now, payments made in cash. Sir, there is an expenditure, sir, which is actually eligible to be claimed under 30 to 37. By the way, I will also talk about how the disallowance mechanism works, how to compute the problem when P&L account is given, how to compute the problem when receipts and payments account is given. I will give you one technique. If you follow the technique, I'm telling you, you will get fantastic clarity. Okay, fine. So 40A3. Sir, I'm incurring some expenditure, sir, revenue expenditure. I can claim it under 30 to 37, sir. But that amount is paid exceeding 10,000 in a day to a person, in a single day to a single person. If at all you are paying any expenditure more than 10,000 by other than prescribed modes. Prescribed modes are what? Account pay check, account pay draft, electronic purpose. Getting it? Account pay check. Remember, crossed check is not covered. Bearer check is not covered. Bearer draft is not covered. Cash is not covered. Suppose if at all you are paying any expenditure for more than 10,000 in a day to a single person by cash, by bearer check, by crossed check, or by bearer draft, more than 10,000 you paid, fully disallowed, no deduction at all. That expenditure is not considered under PGBP. If it is already debited to P&L account, to the net profit you will add back. Suppose if this information is not debited in P&L at all, it is not recorded in books of accounts, it is given as an additional information. Some expenditure is missed to be recorded in business. Some expenditures they forgot to record in the PGBP, but that expenditure is paid in cash more than 10,000. You don't claim deduction. It's already not recorded, and you don't get deduction. You ignore. Able to understand? Yes. Then there is another section called 40A 3A. In the recent September 2024 exam, this fantastic adjustment was asked. Suppose we all know expenditure can be claimed as deduction on accrual basis, right? April to March, I incurred expenditure. I can claim. Only 43B items I must pay within 139 subsection 1 due date. Remaining expenses I can claim on accrual. By 31st March, whatever expenditure I incurred, I can claim on accrual. But in the next year, April or May or June, some amount, some month, later on, that amount was paid by me in cash. That amount was paid by me in cash. Very simple. I incurred in previous year 24-25 some expenditure which is 20,000 on accrual basis I claim. But in 25-26 or some other year, whatever year, this entire 20,000 I paid in cash. What is the tax treatment? For 24-25, no problem. You claim deduction on accrual. No disallowance for that. Whereas in 25-26, 26-27, 28-28, whenever that amount is paid in cash, that year it is treated as income because you violated payment in other than prescribed modes. Getting it? So you violated that provision. So it is treated as income. So any expenditure which is allowed as deduction under accrual basis in the past year and the same is paid in the subsequent year in other than prescribed mode, then it will be treated as income. Now this amount is 10,000 limit, right? Suppose if you are making payment to a transporter, then the limit is increased to 35,000. In case it's payment to transporter, the limit is increased to 35,000. That's it. Now this disallowance will not attract on repayment of loan. This disallowance will not attract on between transactions between principal and agent, because transactions between principal and agent, there is no expenditure involved. Simple logic. Now if there are some exemptions from 40A3 applicability, suppose if you are making payment to cultivator or producer, getting it, not a trader in fish, getting it, payment to cultivator or producer, no disallowance. You are making payment for purchase of products, where they are not where they are manufacturing without aid of power, to them you made payment more than 10,000, no problem at all, in cash. Payments to government not covered. Payments of book adjustments not covered. Payment made on a bank holiday, exempted. Able to understand? That's it. Okay, 40A3 is over. That's enough. 40A3 section is over. 40A3 is over. 40A3A is also over. Now you see, I completed 40A2, 40A3, 40A3A, 40A7, 40A9. We are only left with what? 3 more sections. 40A1, 40A1A, 43B and 40B. That's it. So hardly another half an hour. This particular deductions will be over. Can I proceed? Now there is a section called 43B. There is a section called 43B. What 43B section says, certain expenses, you see, specific deductions. Some expenses, you will get deduction only on payment basis. Only on payment basis means cash method. No, not cash method of accounting. Payment basis by some due date is there. Of course, actually cash only. I can say cash only. This section is applicable only for the SSC following accrual basis of accounting. This section is applicable only for the SSC following accrual. See, SSC who is following accrual basis, for him, he can claim any expenditure on accrual. But these 7 payments, totally 7 payments, clause H and up to above 6 total 7 payments. These 7 payments, in some books they may write it as 8, in some books they may write it as 6 also. It depends upon, some points, they will merge into 1 point. That's it. That's why in my book I wrote it as 7 points, which is logically correct. Getting it? These 7 payments, you will not get deduction purely on accrual. If you incur is not sufficient, you must have actually paid to the other party. By when? This is the question. These 6 payments, April to March you incurred. By 139 subsection 1 due date. For the business, what is the due date for filing IT return checkout? 31st July. Normally for every SSC. 31st October in case of the SSC is subject to audit. Yes or no? Within this due date, you must have repaid this money. You must have paid this money. Not only accruing, but you should also pay. Then only you will get a deduction. Suppose in the question, in the exam, some amount is debited in P&L account. Some amount is debited in P&L account. That amount comes under these 6 items. In the additional information or somewhere they gave this point. These amount is paid before 139 subsection 1 due date. No problem. No adjustment is required. Suppose some amount is debited in P&L, 1 lakh. In the below additional information, they said only 50,000 rupees is paid on so and so date. Another 50,000 paid down after due date, they said. Then what you should do for 24-25 year, that 50,000 which is paid after due date, for this year no deduction. Next year it is paid, no, that year you will get deduction. Able to understand? Very simple. These 6 payments you will not get a deduction. You will not get deduction if you do not pay by IT due date. 31st March before you incurred, by 31st July due date for filing IT return, or 31st October as the case may be, you must have paid it. Suppose you didn't pay it, for 31st March P&L is there, right? Net profit, for that it will be added back. Disallowed. Not allowed as deduction. It is not allowed as deduction. Sir, later on again I paid, sir. When you paid, check out. That date comes under which year you check out. For that year you will compute PGBP income, right? You can claim specifically deduction for that. Able to understand? For example, sir, in 24-25, in 24-25, I incurred some expenditure, sir. I paid my, I incurred bonus. I declared bonus to my employees, sir. What are the 6 expenses? I will cover the list now. Okay. I declared bonus to my employees, sir. Bonus. How much I declared, you know, sir? 10 lakhs I declared, sir. I accrued. But, you know, 31st March in my books of accounts, 10 lakhs provision is also created. You know, for me, the due date applicable is 31st October, sir. Mine is a company, sir. Audit is applicable, sir. 31st October is the due date, sir. Within this due date, is this 10 lakhs paid a checkout? Not paid, sir. Then for 24-25 PGBP income you are computing, right? In assessment year 25-26, for previous year 24-25 you are computing PGBP income, right? This 10 lakhs you will not get deduction. Suppose you already debited to P&L, right? From net profit, what you should do? Add back. Sir, suppose within 31st March I paid 5 lakhs, sir. Another 5 lakhs I did not pay before 31st October. Before 31st October I paid only 5 lakhs, sir. Remaining 5 lakhs is pending. Then 5 lakhs only disallowed. Sir, ultimately, you know, sir, this actually 31st October 25 due date, sir. You know what? I paid it on 4th November 2026. Ultimately, the balance 5 lakhs, sir. 4th November 2026 comes under which year? 26-27. For this year, you will compute PGBP income, right? Previous year, for this previous year. In this year, this 5 lakh, you claim it as special deduction. That's it. That is 43B. And very simple. You incurred any expenditure which is covered under above 6 payments. Incurred on or before 31st March. You claimed in P&L account. You debited in P&L. You claimed in PGBP also. But on or before 31st, on or before the due date under 139 subsection 1, it is not paid actually to the other party. Then the amount which you debited in P&L, which you already claimed as reduction from net profit. Later I paid, sir, after due date. When paid, check out. Date you check out. That date comes under which April to March of which year you check out, which previous year. For that previous year, once again you will compute PGBP income, right? For that year you will claim deduction. That's it. Able to understand? Now this is for 6 payments. There is another type of payment which is 7th payment, which is payment. Suppose no, I incurred some expenditure, sir. I purchased goods. I purchased some service, sir, from micro and small enterprise. Medium enterprise is not covered, my dear. Only micro and small is covered. Getting it? I incurred some expenditure payable to micro and small. You must pay them within 15 days from the transaction date. You must pay them within 15 days from the transaction date. Suppose agreement is there, maximum 45 days credit period. Sir, as per agreement he gave 60 days, sir. That doesn't matter. Maximum allowed is 45 days. Suppose there is no written agreement and credit period terms and all not there, then 15 days is the maximum period. Suppose, very simple, sir, I purchased goods from MSME on 31st March 2025, sir. Means previous year 24-25 is the expenditure I incurred, sir. I incurred the 24-25 related expenditure, sir. Repairs and maintenance, sir, to MSME, sir. Okay, 25th March. Agreement is there. We have an agreement also. 45 days agreement is there. Plus 45 days means logic is what? Approximately 10th May 2025, sir, approximately. Sir, within 10th May 2025, you paid approximately 10 lakhs is the amount, sir. You paid within 10th May? Yes, sir, I paid, sir. Then no problem. For this 24-25, you can claim deduction. Sir, I paid on 11th May, sir. After the 45 days, what is the consequence? For 24-25, you will not get deduction. You will not get deduction. Again, you can claim deduction. Yes, sir. When you paid 11th May, you paid, no? 11th May 2025 comes under which year? 25-26 year. For this year, you will get deduction. Now, one more twist. Sir, I incurred this expenditure on 10th January 2024. Look at this example and that example. Compare both again later. Okay. Replay the video once again. Okay. 10th January 2024, I incurred, sir. How much incurred? 10 lakh. You know the due date, sir? It's actually 45 days, sir. Let us assume a 45 days comes under 28 plus 21 approximately. Okay. You know, 24th, approximately 23rd February is coming, sir. 23rd February 2024 is coming, sir. 25 we will put, because for us problems are 24-25. Okay. What is the due date for MSME? February 23rd, 2025 is the due date. Within this due date, no, sir, I did not pay. I have not paid. 10 lakhs deduction on this date, you will not get deduction. But you know what, SSC, no, this 10 lakhs, no, 30th March 2025, he paid, sir, fully. But remember, within 45 days, he didn't pay. 43B subsection H attracted, it is disallowed. But same section, what it says, you know, ultimately again it is allowed as deduction in the year of actual payment. I paid on 30th March, sir. This comes under 24-25, sir. Indirectly, the section says 24-25 originally is allowed. For the same year, again they are saying allowed. Indirectly, what is it? If at all actual payment date to MSME is on or before 31st March, no need to apply this section. Suppose if the actual payment is after 31st March, transaction is before 31st March, actual payment is after 31st March, then you should check, is it within 45 days, within 15 days, logic. If it is after 15 days and after 45 days paid, and the payment date is in the next financial year, and it is after 15 days from transaction days, after 45 days from transaction date, then for this year it is disallowed. For that year you will get a deduction. Yes or no? If at all you did not get this, repeat once again, you will understand. Able to understand. Okay, now I hope you got clarity. That's it. Now, so look at this. What are the 6 expenses? Taxes, cess, duty, interest, taxes, property taxes, interest on taxes. That's what. Penalty is not allowed. Remember, penalty is not allowed. They are violation. They are not allowed. Employer contribution to welfare fund. Employers contributions. We said already, subject to 43B. Gratuity fund, superannuation fund, everything. Payment of bonus commission to employees. Leave encashment to employees. Interest on loans and borrowings from banks, NBFCs, you know, public financial institutions, state financial corporations, state industrial investment corporations, all that, excluding primary agricultural loans, primary agricultural banks. Getting it? So suppose if I borrow any loan from my friend and relative, that is not covered under 43B. I can claim deduction on accrual basis. Interest. Suppose I borrow loan from bank, FIs, all that, I can claim deduction of interest amount only if it is paid before 139 subsection 1 due date. But so if the payment is made after the due date, then deduction will be allowed in the year of actual payment, in the previous year of actual payment. However, deductions where MSMED Act is involved, you know, any expenditure payable beyond the time limit is disallowed. If it is not paid or credited to the MSME within 15 days or within 45 days, as the case may be, you know, this is actually called as appointed day. This period is called as what? Appointed day. Getting a due date is called as appointed day in MSME. If you pay within appointed day, you will get for the respective year. If you do not pay within appointed day, then in which year you paid actually, for that year you will get. If the date of payment is also same year of transaction, you will get deduction for that year itself. Yes or no? Next, further, if the amount is paid subsequently after the credit period, then deduction will be allowed for the actual year of payment. In September 24 attempt 43B, 40A3, 40A3, one adjustment is given. What is that adjustment? You know what? SSC, you know, very fantastic adjustment. SSC, you know, 10 lakhs. 10 lakhs expenditure is there. Okay. 10 lakhs expenditure is incurred in financial year 24-25. That too, date of transaction is 20th March. What is the date of transaction? 20th March 2025. 20th March 2025. This amount is payable to MSME within 45 days. 45 days due date is what, you know? 5th May. What is the due date? 5th May 2025. What happened? This 10 lakhs is entirely paid within 5th May. What is it? It is paid in within 5th May he paid. When he paid, you know, 1st May he paid. For example, 1st May he paid. How much he paid? 10 lakhs he paid. Within 45 days, within 45 days he paid. Allowed. But this 10 lakhs is paid in cash. This 10 lakhs is paid in cash he paid. Now under 43B, any expenditure paid in cash for more than 10,000 rupees is fully disallowed. But remember, this is incurred in 24-25 but paid in next year on cash. 40A3 subsection will not apply, but subsection 3A is applicable. As per that, for previous year 24-25, no treatment. Whereas in 25-26, this 10 lakhs is treated as income. In September exam this year, where every student added to P&L account, added to net profit. Entire answer is wrong. For that year, no treatment. Why? It is not a case of disallowance. It is a case of treating income in the respective year in which it is paid in cash. 48(3)(a) is applicable. Once again, watch this if you do not get it. Okay, that's it. I hope you got it. Already I explained in regular class also in depth on this point. We discussed almost more than 15 minutes time. Yes or no? That's it. Next. Now, sir, interest on loan, no, converted into principal, sir. Conversion is not treated as payment. Only if that amount is paid subsequently, it is given as deduction. Contribution to welfare funds. Employer 43B section apply. Employee 43B do not apply. Employer contribution disallowed if it is not paid within 139. Subsequently, if it is paid, you will get deduction. Whereas employee contribution, no, you must pay within respective due date under the law. If you do not pay, you collected and not paid within the respective statutory law, straight away treated as income. Even though later you remitted with interest and all, no deduction. It's a severe punishment. Then what is meaning of micro and small enterprises? Recent January 25 exam, they asked this question for 3 marks. What is a micro enterprise? Investment in plant and machinery shall not exceed 1 crore. Turnover shall not exceed 5 crore. Small 10 crore, 50 crore. That's it. Able to understand. That's it. With this 43B section is completed. Now let's understand 40A1, 40A1A. Finally, I will explain you 40 subsection B. Now let's understand 40 subsection A clause 1, 40 subsection A clause 1A. Okay, you see the book. I fantastically wrote in 1 page. In single page, this entire provision is given. You will get a clarity on this section like anything. Again, this is also something similar to 43B logic only. You see what is the heading I used? Disallowance. Disallowance. Just a minute, it's loading. It's okay, fine. Disallowance on account of non-compliance with TDS provision. Disallowance on account of non-compliance with TDS. Suppose you did not comply with TDS. Very simple. Every expenditure you are paying, right, it is liable for generally TDS. What you have to do as per TDS provisions, when you are making the payment, you should deduct amount TDS. The TDS which you deducted, you should remit to the department in the name of the payee. You should remit. If you deduct in the current year and remit within 139 subsection 1 due date, no problem at all. Suppose you did not deduct. You did not deduct in the current year, or you deducted but not remitted in 139 subsection 1 due date. Whatever expenditure is there, right? If that expenditure is paid to, a non-resident, or if the expenditure is paid outside India, 100% of the expenditure, what is it? 100% of the payment is not allowed as deduction. When it is not allowed as deduction, when disallowance will apply? If you do not comply with the TDS provision. If you do not comply with the TDS provision. What do you mean by non-compliance with the TDS provision? You did not deduct the TDS in the respective year in which you incur the expenditure, or you deducted but not remitted within 139 subsection 1 due date. That is treated as non-compliance. When there is a non-compliance of TDS provision and the amount is paid to non-resident, or the amount is paid outside India, 100% of the amount is disallowed. Suppose if the amount is paid to resident payee, 30% is only disallowed. Now what expenditures are covered? For non-resident, interest, royalty, fees for technical services, any other sum, literally every amount is covered. For residents also, every amount paid is covered. Remember, TDS provision should be applied and you failed to comply, then only this section. Sir, TDS provision itself is not applicable, sir. TDS provision itself is not applicable. For example, there are sections called 194A, 194C, 194H, 194I, 194J, 194R. These 6 sections are there. These 6 sections, they are not applicable for individual and HUF. Whose previous year, whose preceding financial year, turnover is less than or equal to 1 crore. Business less than or equal to 1 crore. Profession less than or equal to 50 lakhs. For them, these sections will not apply. Now, I am an individual, I am not covered under TDS provisions, and I am paying some amount without deducting TDS. It's not a non-compliance. TDS itself is not applicable to me. When TDS provision itself is not applicable to me and I paid full amount without deducting TDS, what mistake I did? Nothing. This section will not apply. When 40 subsection A clause 1, 40 subsection A clause 1A will apply to me, I am liable for TDS. When I'm making payment, I should deduct TDS as per TDS provision, but I didn't deduct. But I did not deduct. Or I deducted but not remitted within due date. Then only I have not complied. Then only that is called as a non-compliance with the TDS provision. Only this section attracts only when there is a non-compliance with the TDS provision. Now what is the consequence? You will not get deduction. So for the relevant year in which expenditure is incurred, in that year you didn't deduct or deducted but not remitted. You see, if TDS is deductible, means first TDS is applicable and you have not deducted in that year, or you deducted in that year but not remitted within 139 subsection 1 due date, then no deduction. For non-resident 100%, for resident 30%. However, this is temporary disallowance, I told you. Subsequently, you ultimately realized your mistake and remitted to the department, like TDS deducted in RPY but not remitted within the due date. Then disallowed for RPY. For the relevant year, it is disallowed. Ultimately allowed as expenditure in the actual year of remittance. Whatever you disallowed earlier, no, the same you can claim it as a special deduction in the subsequent year when you actually remit the TDS. 139 due date is irrelevant subsequently when you are remitting. Suppose TDS itself is not deducted, sir, earlier. That is why they disallowed. Ultimately allowed as expenditure. Ultimately allowed as expenditure in the year of actual deduction and remittance. Original year I didn't deduct, sir. Straight away disallowed. Later you deducted and remitted, sir. When you remitted, check that date. That date comes under which year? Check that. For that year PGBP income you are computing, specially claim that deduction. Whatever you disallowed earlier, you claim it as deduction. You able to understand? You know, sometimes no, we don't apply this entire section itself. When you know, suppose I paid amount, sir. I am liable for TDS. I am liable for TDS and I paid amount, sir. I am liable for TDS. I paid amount to the person, sir. No TDS I deducted, sir. I didn't deduct, or I deducted, I did not remit, sir. Actually, if I do not deduct and if I deducted but not remitted within due date, disallowance will apply, no. But actually what happened, you know, to whom I paid, no, that fellow filed IT return, sir. That fellow filed IT return. In that return, no, the amount which I paid is also included, sir, and he paid tax also, sir, and my CA is giving a certificate on that. It is treated as deduction. It is treated as deduction. In which year? It is treated as, it is assumed that TDS is deducted and TDS is remitted in the year in which payee furnishes return of income. Sir, in 24-25 expenditure I paid, sir, 10 lakhs I paid, sir. TDS I deducted or not deducted and not remitted, whatever reason, non-compliant, sir. But my recipient, no, by 31st July, his due date is 31st July, sir. Okay, his due date is 31st July, or maybe he filed the return of income in some date, sir. He filed return of income on 31st July, yeah, 30th July, yeah. When he filed doesn't matter. When he filed, in this example, 31st July he filed, sir. He filed on 31st July 2025, he filed, sir. In this return, no, my amount is there, right? That is included. He paid tax also, sir. Now the section says I complied with the TDS provision on this date. The section says I complied with the TDS provision on this date, which means I complied for which year? 25-26. Indirectly the section says I have not complied for 24-25. For 24-25, 100% or 30% is disallowed. In 25-26 again I compute PGBP income, right? For that year, that 30%, that 100% which is disallowed for 24-25 PGBP computation, no, that is once again allowed. That's it. 40A subsection 1, sorry, 40 subsection A clause 1, 40 subsection A clause 1A is completed. Easy or not? Now 40B, once that 40B is over, entire PGBP is over except 44 series. Getting it? Are you easy? Feeling easy or not? PGBP. Now 40B, remember, whenever you are doing problem, if at all the problem gives partnership firm PGBP computation, you should always compute as per this format. Many students in 40B have a confusion on book profit. What is book profit? Everybody will do wrong this problem. Even in CA final they do wrong. Many students. You follow the method which I am telling, you will never do wrong. Getting it? Fine. If at all you have to compute PGBP, if at all you have to compute for partnership firm income from business or profession. For partnership firm, no, they will get additional 2 deductions. Whatever we covered in 30 to 37, right? Apart from that, you will get two more deductions. Interest on capital borrowed from partners, remuneration paid to working partner. These two the firm can claim as an extra deduction. Actually, as per Partnership Act, partnership firm and partners both are one and same. But under PGBP, they are treated as different. So if firm is paying any interest to partner, if the firm is paying remuneration to partner, it is allowed as deduction. Suppose if a sole proprietor firm is paying interest to sole proprietor, remuneration to sole proprietor, no deduction. It is payment to self. Yes or no? Now, sir, if firm problem is given, what I should do? How? First to know, look at the P&L account, apply 30 to 37 sections, apply 40 series everything, apply full, compute profit under PGBP before reducing interest amount, and remuneration amount paid to any partner, doesn't matter. Sir, firm paid some amounts to partners, sir, interest on capital, sir, interest on loan, sir, firm paid remuneration to working partner, non-working partner, all that, sir. Except these, reduce all other deductions. You see, after considering all deductions, depreciation, additional depreciation, capital expenditure, scientific research, disallowance under 40, 40, 43B, whatever we discuss now, disallowance you apply, deductions you reduce, compute income of the firm just before interest paid to partners, remuneration paid to any partner. Don't reduce payments to partners alone, don't reduce. Compute firm income before reducing interest to partner, remunerations to partners, compute. This is income of the firm under PGBP before reducing interest to partner, before reducing remuneration to any partner. Deduction you will claim only for remuneration to working partner. First, I should compute profit before reducing any type of remuneration. Reduce, compute it. Now, first. Now, firm is paying interest on capital. Yes, sir. Partner gave a capital, sir, out of his own funds. Partner gave a loan, sir, out of his own funds. Interest on capital, interest on loan of the partner own funds. Maximum interest allowed is up to 12% per annum on the capital or loan amount, which is given out of personal funds of the partner. Personal means whether he out of his pocket, whether he borrowed loan and then gave, doesn't matter. Sir, actually in our firm, no, a company is a partner, sir. Company is the partner, sir. On behalf of company, director is attending the meeting, sir. We want some amount, sir. Director out of his personal pocket giving me loan, sir. Remember, director is not partner. Company is the partner. Representative is giving loan in personal capacity. Representative partner is giving loan in personal capacity. Is it treated as loan taken from partner? No. When it is not a loan taken from partner, interest ceiling limit 12% will not apply. That's the logic. That's what we have given here, table. Now, very simple. So, interest deduction up to 12% on capital, 12% of loan is allowed as deduction. Getting it? So, that's it. How much is the maximum deduction? 12% of capital. Reduce that first. First, compute income of the firm under PGBP. After reducing all deductions, apply all disallowances, but don't reduce interest paid to partner. Don't reduce remuneration paid to partner. If at all in the P&L, interest and remuneration is debited, some remuneration, working partner or non-working, or leave it, add back. First reduce what? Interest on capital, interest on loan. Then what you will get, the balance profit, that is called as book profit. If you know book profit computation, I'm telling you, you're mastered in this 40B. This is how you should compute book profit. Now book profit is computed. Now look at, did the firm pay remuneration to partners? Yes. Remuneration is paid to working partner, remuneration paid to non-working partner. Both are already added back. Consider only remuneration paid to working partner. How to calculate that deduction? First, look at actual remuneration paid to only working partner. Actual amount, look at. Now, book profit you already computed, right? Book profit. Suppose this book profit is, remuneration paid to working partner is 10 lakhs. Total is 10 lakh. Actually, two working partners are there. Both the partners, we are paying 1 lakh each. Total remuneration paid is how much, 24 lakh we paid. And the book profit of the firm is 30 lakh. What is the book profit of the firm? 30 lakh. How much is eligible? This is the question. First 6 lakhs of book profit. First 6 lakhs at 90%, or this is amendment. Remember earlier, this limit is 3 lakh. This limit is 1.5 lakh. Up to January 25 exams, here 3 lakhs limit, here is 1 lakh, 1 lakh 50. But from May 25, September 25, Jan 26, these limits are applicable. So first 6 lakhs book profit at 90% or 3 lakh, whichever is higher, is equal to 5.4 lakh. Then balance book profit is 24 lakh. On balance book profit is 24. On that 60%, what is it? What is 60%? 24 lakh into 60%? Huh? 14 lakh 40,000. Okay, both put together 19 lakh 80,000. How much is eligible remuneration? 19 lakh 80. 14 plus 5, 19 lakh 80,000. Array firm paid 24, but eligible is 1980. Deduction allowed is how much for the firm? 1980. Lower of A and B. This is how you should solve in the exam also. This should be your working note. Getting it? 19 lakh 80. Now firm income is there, right? Here you reduce what? 19 lakh 80. Then whatever balance is there, right? That is income of the firm. On this, the firm will apply set off and carry forward provision. Brought forward business loss and all. Now they will set off. Then if balance profit is there, that will be claimed as deduction. That will be, if at all unabsorbed depreciation is there, right? That also you should allow here itself. When you are computing income itself, unabsorbed depreciation you will allow. Sir, how to allow unabsorbed depreciation, all that we will discuss in set up and carry forward. On this, firm will pay 30% tax. Still after tax some amount is there. Firm will distribute to partners. That is share of profit. Share of profit received by partners from the partnership firm is exempted. 10 subsection 2A over. Able to understand? Now remember, here we have given some conditions. The above deductions will apply only if it is explicitly authorized by partnership deed. That too prospectively only, not retrospective. Further, with effect from 1st April 2025, TDS under 194(2) is attracting. This might be asked as an MCQ. Many students will ignore. This is also a new amendment, 194T, new amendment, new section is added in TDS provision. But in TDS chapter, this section is not there. Only here it is discussed. Suppose if the firm is paying any remuneration, any interest, remuneration, firm is paying to partner. If it is exceeding 20,000 in that year, directly TDS rate is 10%. TDS rate is what? 10% they need to deduct. TDS. That's it. Able to understand. Okay. Further. Now, sir, partners are getting some interest from the firm. Partners are getting some remuneration from the firm. No. What about that? That is taxable under PGBP. How much is taxable? How? No, they don't see firm paid. Whatever firm paid, did the firm get deduction? No. Firm got deduction only 12%. Remuneration to working partner. Same way, partner is receiving some amount, right? Whatever they receive is taxable for partner? No. How much deduction firm got? That much only in the hands of partner it is taxable. For firm, deduction is 19 lakh in our example. Partner received 24. Firm paid 24, but firm got deduction only 19 lakh 80. For partner also 19 lakh 80 only taxable. That's it. Entire 40 subsection B is also over. That's it. Okay. 44AA, 44AB, 44AD, 44ADA, 44AE. Once these 5 sections are completed, PGBP is over. Literally I covered everything. 1 hour 40 minutes, approximately 1 hour 50 minutes. Another 15-20 minutes, PGBP will be over. Able to understand? That's it. We'll continue after a break. Okay. That's it. So let's continue the discussion on the PGBP. Final, we are at the conclusion stage of the revision. Yeah, right? We completed all the sections like incomes. Basically, we discussed incomes. We need not discuss any, but already some elements of it we already covered. Then 30 to 38 covered. 40 series, conditions for dissolvences completed. Now we need to look at the other provisions, 41 and 44 series. 41 is very simple. Inside 41, balancing charge is over. Sale of assets directly from the scientific research over. Recovery of bad debt is also over. Then there is another one, expired business losses. This you need to cover as part of set off and carry forward. This revision you need to cover as part of set off and carry forward revision. Now this revision, what is this? Remission or cessation of trading liability. Very simple. We all know that we can claim deduction on accrual basis, right? Suppose I purchased goods from some some person, third party. I claim a deduction on accrual basis. Later on, the third party waived me. In the sense, I don't have to pay the amount. Ultimately, the amount which I claimed as deduction earlier towards purchase cost, now I don't have to pay it. Means it's not an expenditure for me. Now it is treated as income. So in the year of waiver, in the year of remission, in the year of cessation of liability, cessation means seizure of liability. Liability is cancelled. If your liability is cancelled, trading liability, the two. If a trading liability is cancelled, it is treated as what? Income. Getting it? Remission, waiver, cessation of trading liability. Getting it? So, if a deduction was claimed in earlier, and later such liabilities remitted or seized or recovered in cash, then the amount of benefit is taxable as income irrespective of whether business is an operation or not. It doesn't matter. Generally, PGBP income is applicable only when the business is run, only when the business or profession is, active during the year. Here, the remission of liability is taxable irrespective of whether you are active or not. And here, even if the successor is receiving the remission, even then it is taxable. Actually, there is a bad debts provision, bad debts is recovered. If bad debts is recovered by successor, the section is silent. Therefore, we don't tax it. Able to understand? Yes. Next. Now, foreign currency exchange, 43A section. This is very simple section. If at all you borrowed, see, you acquired an asset. You acquired an asset from a foreign country. And for that, no, you have taken a loan. You have taken a loan. Getting it? Increase or decrease in liability due to change in foreign exchange at the time of settlement of liability or repayment of loan. Suppose you purchased an asset, later you need to settle the amount, or you purchased an asset by using a bank loan, foreign loan. Foreign country, you acquired an asset using foreign country loan. Getting it? Now, at every 31st March, your loan liability amount not only, your loan liability amount increases or decreases because of the foreign currency fluctuation. That foreign currency fluctuation, so no, it shall be added to the block or reduced from the block. Able to understand? That's it. Simple. There's no much complication in that. Then we have something called 43A, stamp duty value of immovable property. This point we will be covering anyhow as part of 50C. Capital gains revision is there. Inside that anyhow 50C it is covered. Getting it? There we will discuss. In capital gains, the same provision as it is there, but in the capital gains chapter, the immovable property is a capital asset for the assessee. Here, it's a stock in trade. Very simple. You are selling immovable property at certain price, right? Sale price alone is not considered. We will also compare it with stamp duty value. Stamp duty value means what? Stamp duty value? Date of registration will be there. Date of agreement will be there. Date of registration we should take normally. However, if agreement is there, on or before date of agreement, if advance is paid by any other mode other than cash, if advance is received by the seller, getting it? If we receive, because in PGBP we are selling this land and building, we received advance, getting it by other than cash, then stamp duty value on the date of agreement will be applicable. Now, freeze the stamp duty value. Now, check that stamp duty value with the consideration you received on sale of building, which is a inventory, which is a stock in trade. This section is applicable for real estate people. Okay, so now stamp duty value, is it more than 110% of the actual consideration? Is it more than 110% of the actual consideration? Yes, then stamp duty value will be the revenue under PGBP. Sir, it is not exceeding 110%, sir. Then whatever the price at which you sold immovable property, no, that itself is the revenue under PGBP. Remember, it's not profit, it's revenue, turnover. Able to understand? That's it. The provision is over. 43CA is over. Then finally, we are left with 5 more sections: 44AA, 44AB, 44AD, ADA, AE. Okay, 44AA and 44AB, these two are talking about accounts and audit, whereas 44AD, ADA, AE, these three are talking about presumptive taxation. Okay, so you see this section 44AA is one confusing section for many. I made it in a simplest way. Now 44AA, what this section says: 5 categories of assessees has to maintain books, or else better I'll come back to this later. First let me finish presumptive taxation, because in 44AA, 44AB, presumptive taxation link is also there. So first I will cover presumptive taxation and then we'll then discuss this one. Okay, now what is presumptive taxation? See, we have something called presumptive taxation. Presumptive taxation. So we have totally 3 sections on this: 44AD, 44ADA, 44AE. 44A is applicable for the assessee who is engaged in a business of plying, hiring, leasing of goods carriage vehicles. 44AE is applicable for an assessee who is engaged in the business of plying, hiring, leasing of goods carriage. 44ADA, this is applicable for the assessee who is carrying notified professions, correct? And this is applicable for any other business assessees only. Any other business assessees only. Getting it? Now, what is the presumptive taxation means? Presumptive taxation means, see, until now what we covered in PGBP, how to calculate PGBP income. Add all the revenues minus all the deductions, disallowances, all that. Whereas in presumptive taxation, forget about disallowances, deductions, all that. You know turnover, you know gross receipt, on that some percentage you declare it as profit directly. Some percentage, you declare it as directly profit under PGBP. Like what is that? 44 ADA, this section says, if at all your turnover is less than or equal to 50 lakh, suppose if 95% of receipts are other than cash, then the limit is 75 lakh. 95% or more than 95% of the receipts, payments condition is not there here. Whereas in tax audit section, both receipts and payments logic is there. So your cash receipts are not exceeding 5%, or your other than cash receipts are minimum 95 or more than 95. Then the turnover limit is what? 75 lakh. Otherwise, your turnover limit is what? 50 lakh. So up to this turnover, whatever is there, you straight away declare 50% of turnover. Actually, in case of profession, we don't call it as turnover, we call it as gross receipts. We call it as what? Gross receipts. Straight away declare 50%. What is this? This is directly profit and gain, directly income from business or profession, directly, that's income. No more depreciation, no more additional depreciation, no more scientific research expenditure, no more deduction. 32, 38, what are all deductions we covered, right? We assume that we claimed. We assume that we claim. Remember, this is income, not turnover. On turnover, we apply this percentage, the resulting number, that resulting whatever is there, right? This is straight away treated as what? Income. This is straight away treated as income from business or profession. Understood? Now, similarly, 44 AD is there, another section. This section talks about business assessees. This section talks about business assessees. However, 44 AD do not apply. 44 AD do not apply. 44 AD, you see, do not apply to person earning commission or brokerage income, persons involved in agency businesses, persons who are claiming benefit under 10 AA chapter 6A. Sir, what is 10 AA chapter 6A? We will discuss. By the way, not full chapter 6A, only heading C. Income based chapter 6A deductions. See, we are going to learn, we are going to revise in chapter 6A topic. Chapter 6A deductions are two types: investments and payments based deduction, income based deductions. Generally heading C will come, generally income based deductions will be there under heading C. Getting it? In our syllabus, heading C related 3 sections only there: 80 QQB, 80 RRB, 80 JJAA. Only these 3 sections are there in our syllabus. Getting it? Heading C related. See, if you see chapter 6, you know, there are so many sections, but in our syllabus, heading C related, only these 3 were there. Able to understand? So, if an SSC claiming heading C related, which are forming part of CA inter syllabus, these 3, and claiming 10 AA, he cannot go for presumptive taxation. And of course, obviously, an SSC who is covered under 44 AA, separate section, plying, hiring, leasing of goods carriage vehicle, or a person who is covered in notified professions under ADA, they are also not covered under 44 AD. Clear? Okay, now, so who is covered? Only residents are covered. Even in ADA also, 44 ADA also, resident individual or resident firm only covered. HUF is not covered. Here, in 44 ADA, who are covered? Individual and firm, other than LLP. Other than LLP. HUF is not covered here because HUF cannot engage in profession. Whereas in AD, business, individual, HUF, or firm other than LLP. Same here also, other than LLP. Provided here also residents, here also residents. Presumptive taxation is available only for residents in India. Getting it? Now, so if at all you are a resident, getting it, and your turnover from business, what is the turnover? Shall not exceed 2 crore. In ADA professions, just now we covered, turnover shall not exceed 50 lakh. In ADA, if 95% of the receipts minimum are other than cash, then turnover limit is increased to 75 lakh. Here it is increased to 3 crore. The limit is 3 crore. If cash receipts are less than or equal to 5, means other than cash is more than or equal to 95. That's it. Now, presumptive income. How much is the presumptive income? How much we will straight away declare it as income? If at all turnover is in cash mode, 8% of the turnover. Suppose if the turnover is received in prescribed modes under 40A3. Prescribed modes means what? Other than cash, other than bearer draft, bearer check, crosser check. Okay, then on the turnover, 6% we can apply, provided. Generally turnover means what? You might have sold it on cash sale or credit sale. You must have recovered it within due date under 139(1). If at all you sold on credit, any amount of sale, that amount must be recovered within 139 subsection 1 due date. If you recover in 40A3 specified modes, then 6% logic you can apply. If at all the turnover is not realized by due date, then the department assumes the turnover is received in cash. On that balance turnover 8%. Very simple. I sold goods on credit, sir. 1 crore is there, sir. As on due date for filing IT return, I have not yet recovered this 1 crore, sir. What should I do? Treat it as cash turnover, apply 8%. Sir, 1 crore I recovered, sir. See, bank statement, bank proof is there. On recovered portion, apply 6%. Simple logic. Okay. For this detailed logic, I already told in the regular class. Okay. Now here in 44 AD, some conditions are there. Once an SSE chooses 44 AD, what is it? They must continue declaring profit for the next 5 years. Means for 1 year if you choose it, that year plus next 5 years, means total is 6 years at stretch you must declare. And if the SSE stops declaring in any of these 5 years, getting it, they lose the benefit of the section for the next 5 years after non-declaration. For example, if you declare this year, next 5 years, totally 6 years at a time you should declare continuously, consecutively. Suppose in 4th year I stopped. 4th year as well as that next 5 years, means 6 years you will not eligible totally for presumptive taxation. Able to understand? See, once you choose, next 5 years also eligible. Once you stop, for that year plus next 5 years also you are not eligible. Able to understand? For that I have given a clear cut example here. Okay, that's it. So with assessment year numbers and all I clearly gave. That's it. 44 AD section is over. Now there are some common conditions which are there for all the presumptive taxation sections. I'll come back to it later. 44 AD, it is also applicable for only resident, only individual and partnership firm. Remember, HUF is not covered because HUF cannot carry on profession. HUF can carry on business, family business, but family cannot carry on doctor profession, right? For example, yes or no? That's it. So gross receipts 50 lakh. However, the limit is 75 lakh if the cash receipts are less than or equal to 5%. How much is the presumptive income? Straight away 50% of the receipts. Straight away 50%. Now finally, sir, I am an SSE who is engaged in business of plying, hiring, leasing of goods carriage vehicle. Either goods carriage vehicle I will rent, I will lease, or I myself run hiring, I myself ply. Getting it? I will take contract of goods shipping and I myself do plying. Getting it? So if the SSE is engaged in this, and most important conditions, and owning not more than 10 vehicles, owning not more than 10 vehicles, 365 days you see, on any day, you should not have ownership for more than 10. 1st April, 2nd April, 3rd April, 4th April, 5th April, 6th up to 31st March, on any time also, at a time. Suppose morning I am owner for 10, evening, afternoon I sold 1 vehicle, evening again I purchased another vehicle. At that time you see it's not there more than 10. That is again permitted. Able to understand? So that is not an issue. At that time, on any time in the entire 365 days into 24 hours, on any 1 hour or any 1 minute you see, SSE shall not be owner for more than 10. How many vehicles you can be owner for goods carriage vehicles? Ownership I'm talking about. You may have taken on rent 100 vehicles. How many vehicles you have taken on rent doesn't matter. How many vehicles your owner? 10. It should not be more than 10. Then only 44 AE section is applicable. Okay, sir, I'm not more than 10 vehicles. I don't have more than 10 vehicles. You have 2 options. One, you might have renting it, no? You might have got rental income, all that, right? Lease income, plying income, all that, right? Minus all expenses under 30 to 37 claim. You will get profit. You declare that. Or presumptive income. How much presumptive income? It depends upon the type of vehicle. Sir, I am having heavy goods vehicles. I'm having heavy good vehicle. What is a heavy good vehicle? Heavy good vehicle is a vehicle where gross vehicle weight is exceeding 12 tons. Exceeding, remember, up to 12 tons it is not a heavy good vehicle. Only if the gross capacity of the vehicle is crossing 12 tons, that only. See, generally gross vehicle weight is different, unladen weight is different. In exam they should give you only gross vehicle weight. Sometimes they don't give you gross vehicle, they'll give you unladen weight. Then you should take unladen weight. Gross vehicle weight means vehicle weight plus load permitted on the vehicle put together is called as gross vehicle weight. Unladen weight means what? Without a load, what is the weight of the vehicle? It depends upon the state to state. Some states no, actually it is uniform now. Right now it is uniformed. Getting it? Every dealer has to mention only gross vehicle weight. Unladen weight it should not be mentioned on the registration certificate. Getting it? On the registration certificate of the vehicle you will find what is the gross vehicle weight. Very simple. If the gross vehicle weight is more than 12 tons, straight away, getting it? I mean, if the gross vehicle weight is more than 12 tons, then that vehicle is straight away called as what? Heavy good vehicle. Now for heavy good vehicle, how to calculate presumptive income? You know, suppose I have a 13-ton capacity vehicle, sir. Then 13 tons into 1000 rupees per month into per ton. How many? 13 tons. So 13 tons multiplied by 1000 rupees per month per ton. This is your presumptive income. This is your presumptive income. Remember, many students in 44A, they do wrong answers because suppose, no, in April I have 10 vehicles. Okay, we have a problem on this. May 2nd, no, I sold one vehicle. Again, May 6th, no, I purchased one vehicle. Okay, then again up to 31st March, no changes at all. Now, what many students will do, you know, entire May month, no, only one vehicle is there. No, they will think it as 1 month. No, getting it for this vehicle. Remember, presumptive income is there, right? 1000 per month per ton. Yes or no? Per vehicle. Per vehicle. In case of heavy goods vehicle. In case of other goods vehicle, 7500 per month or part of a month. Here also per ton or part of a ton. I mean per month or part of a month, per ton per vehicle. Okay, per month or part of a month per vehicle. Able to understand? So you have a problem in the ICA book illustrations or test your knowledge. It's fantastic question. You please solve it. Getting it? So now you see, suppose April he is having 10 vehicles. May 2nd he sold one vehicle. He sold one vehicle. May 6th again he purchased one. So May 2nd he is having 9. May 6th again he is having 10. On any time you see there is no more than 10. How you should calculate presumptive income? First, no, April month 10 vehicles multiplied by, let us assume all are other goods vehicle, 7500 is equal to 75,000. May month one vehicle we sold, right? Only for that vehicle you calculate. Only for that vehicle you calculate 7500, which is sold actually, but still income will be computed. In again May month I purchased one more vehicle. I purchased one more vehicle, 7500, again 7500. Now you see, in May month I computed presumptive income only for the one vehicle sold and one vehicle purchased. What about remaining 9 vehicles which are as it is there? For that also I should calculate 9 vehicles into 7500. How much it is? 67,500. Then June to March, how many months? 10 months. In all these 10 months, 10 vehicles are there. Per vehicle 7500 is equal to how much? 7,50,000. That's how you should calculate. Able to understand? Sir, in May month, no, it is like a double calculation. No, yes, it has to be, no problem at all. Getting it? Because here in May month, one vehicle you owned even for 2 days, right? That is enough. Even if you are owner for 2 days, it is considered for full month. Able to understand? That's it. This is how you should compute presumptive income. Are you confident? Yes. Next. So now, what are the common conditions for presumptive taxation? What are the common conditions? Very simple. All deductions under 30 to 38, they are deemed to have been claimed, allowed. No set off for depreciation, unabsorbed depreciation, nothing. You get presumptive income, right? On that income, no, you can apply losses, set off and carry forward provisions you can apply. What is set off and carry forward? I'll discuss in set off and carry forward revision. Okay. Now, in case of 44AE alone, in case of 44AE, and remember one more point, 44AE is applicable to any SSE, whether resident or non-resident. So here there is no specification, either resident or non-resident. It is even applicable to LLP, even applicable to company. Anybody can do this, 44AE. Yes or no? Now, in case of 44AE, plying hiring business of lease goods carriage vehicle, for that section alone, interest and remuneration paid to partner is allowed as deduction additionally after calculating presumptive income is there, right? 7,500, 1,000 per month. After calculating, you get the total amount, right? From that, you can still claim it as, you can still claim deduction for interest and remuneration. Nothing but in 44AE, suppose if it is a partnership firm, in 44AE, whatever income we are calculating, no, presumptive income 75,000, all that logic, that is stated as income of the firm before giving deduction for interest and remuneration. First you reduce interest, then you will get what? Book profit, then minus as usual 40B provision. Able to understand? Whereas in 44ADA, suppose if the SSE is a partnership firm, you computed 50% of the gross receipt, right? And you computed 8% or 6% in AD, right? That is straight away treated as income of the firm. Straight away that is treated as income of the firm after giving deductions for remuneration to partner, after giving deduction for interest. Whereas in 44AE, we will treat it as before giving deduction. And I told you in the regular class, this is a mistake happened in the law. This is actually a mistake. Getting it? This is not supposed to be. This mistake they have not rectified. They rectified this in 44 AD and 44 ADA, but in 44 AE they missed to rectify. I told you this is a loophole in the law. Getting it? Next. Then that's it mainly. Okay. Now generally no need to maintain books. If at all you're declaring income under 44 ADA, 44 AD, 44 A, everywhere you don't have to maintain books. However, see, audit also do not apply. Even if your gross receipts are more than 50 lakh, audit do not apply. However, under ADA and AE, if lower income is declared, nothing but very simple. Suppose I'm doing that business or notified profession. As per presumptive income, I'm getting so much, but I'm actually having a loss, or I'm actually having a very minor income. Real income is minor. If you want to declare a lower income, then books of accounts are mandatory. Audit is mandatory, provided income is more than basic exemption limit. That's it. And advance tax. Suppose an SSE claiming 44 AD and ADA presumptive taxation, they don't have to pay 4 installments of advance tax. They just have to pay 1 installment, that to last installment, March. Whereas AE SSE, advance tax has to be paid in 4 installments, 15th June, 15th September, 15th December, 15th March. All 4 installments will equally as it is apply. Able to understand? What is advance tax? We will discuss in the TDS TCS advance tax revision. Easy. Everyone. Now, in 44 AD, what is the point here? Suppose if the SSE stops declaring, then they lose benefit of 44 AD on non-declaration. After non-declaration, what is the consequence if they are not declaring? 44 AB section will apply. 44 AB clause number E, tax audit clause number E. An SSE for whom 44 AD subsection 4 is attracted should maintain books of accounts, should get them audited, provided their income is more than basic exemption limit. Yes or no? By the way, presumptive taxation is over. Now we will go back to 44 AA, 44 AB. First I will finish tax audit. You see, very simple. Simplest way presented. Tax audit is compulsory for 5 categories of SSS. Very simple. The following 5 categories of SSS, they require to get their books of accounts audited by a chartered accountant by specified date. What is a specified date? Remember, the word due date is different, specified date is different. Due date means, if I am under 139 subsection 1, if audit is applicable, the due date for filing IT return is 31st October. But audit report has to be given 1 month prior, means 30th September. That's it. Okay, that is what specified date. Now, who has to get their books of accounts audited? Sir, persons carrying on business, sir, not a profession. They should get their books of accounts audited if turnover exceeds 1 crore. However, the turnover limit is 10 crore if aggregate cash receipts are less than or equal to 5%. Aggregate cash payments are also less than or equal to 5. Means 95% of the receipts, 95% of the payments are carried in other than cash. In such a case, business SSE's turnover limit is 10 crore for getting audited. Same way, sir, suppose the SSE carrying on profession, sir. That which profession? Notified profession. Getting it? And gross receipts are exceeding, any profession. But ADA, presumptive taxation, is applicable only for notified profession. Suppose the SSE carrying on profession, sir, then tax audit is compulsory if gross receipts are exceeding 50 lakh. Yes or no? But remember, in ADA, presumptive taxation limit is also 50 lakh. Up to 50 lakh turnover only you can declare presumptive. The moment you cross 50 lakh, it is not applicable. However, if 95% of the receipts are in other than cash, 75 lakhs limit is applicable. If at all you are declaring under presumptive taxation because your turnover is less than 75, audit do not apply. Able to understand? Next. And SSE who is declaring income lower than presumptive, just now I told. Suppose, sir, I am engaged in 44 AE, sir, flying, hiring, goods carriage vehicle. I'm actually having loss. But how? Under income tax, presumptive income is 10 lakhs, 12 lakhs, it is coming. Actually, I'm having 1 lakh only profit. Suppose you want to show real income, not that income, which is lesser. Then maintain books, get them audited. Same way, sir, 44 area, I am in a notified profession, sir. Income tax department is asking me to show 50% flat profit. My turnover, for example, 50 lakhs turnover, sir. Flat 50 means 25 lakhs, they're asking me to show profit. But really I have 10 lakhs only profit. You want to show 10 lakhs, sir? No problem, show it. But get them audited. Sir, for me, 44 AD subsection 4 is applicable. What is subsection 4? Sir, I'm engaged in business, sir. I declared in presumptive basis one time, sir. Actually, next 5 years I need to go for presumptive, sir. But I breached. I break that logic. Then in that year, You should maintain books of accounts and get them audited, and in the next 5 years you are not eligible for presumptive taxation section at all. By the way, audit is required if income is exceeding basic exemption limit. That's it. 44AB is also over. Easy or not? Now, what is the penalty for failure to get audit? If at all audit is applicable, 0.5% of the turnover or 1,50,000, whichever is lower, which means maximum penalty is 1,50,000. That's it. Next, suppose if at all SSC is declaring income under 44AD, 6%, 8%, or ADA, getting it, whatever that 50%, all that, then audit under AB do not apply. Not only that, AE also. Even if the SSC is declaring income under 44AE, then audit is not applicable. Actually, this is what earlier also we have the same provision. But now department explicitly told this. Able to understand. All of you. Next, now maintenance of books of accounts. This is where many students will have confusion in entire 44 series. Maintenance, 4 categories have to compulsorily maintain books of accounts. What are they? Sir, I am carrying on notified profession, sir, I should maintain books of accounts. I am carrying on business or profession, sir, but not notified profession, sir, I should also maintain books of accounts. When should I maintain books of accounts? Sir, notified profession has to maintain books of accounts. See note number 1, if these conditions are satisfied. Sir, I am not a notified, sir, I am carrying on some business or profession, I am covered in second point, sir, then these limits you should apply. Or third category, sir, I am declaring income lower than presumptive income, sir, 44AE, then also I should maintain books of accounts. Sir, for me 44AD subsection 4 is applicable, then also I should maintain books of accounts. Able to understand? Now, sir, note number 1, notified profession I am. When should I maintain books of accounts? 2 circumstances. Now, suppose in all the 3 last years, my receipts are exceeding 1,50,000. In all the last 3 years, my receipts are exceeding 1,50,000. Every year 1,50,000 crossed my receipts. Then I must maintain books of accounts as per rule number 6F. Notified profession has to maintain books of accounts as per rule number 6F. Rule number 6F books will apply if in the last 3 years your gross receipts are exceeding 1,50,000. Yes or no? Or, sir, I newly started the profession, sir, notified profession, sir, then my turnover is likely to exceed 1,50,000. Likely to exceed 1,50,000. Now, sir, what do you mean by rule number 6F books, sir? Cash book, journals, ledgers, copies of bills. Xerox copies is enough. If at all bill value is just exceeding 25, original bills are required if the bill value is exceeding 50. Moreover, voucher has to be maintained for all the bills less than or equal to 50. Next, doctors, daily case and inventory register has to be additionally maintained. Suppose, sir, I am not covered under this category, but I am notified profession. I am a notified professional, but I am not coming under this A category. Then I will come under other. At that time, rule number 6F do not apply. Rule number 6F books does not apply. But you should maintain reasonable records so that assessing officer can compute your total income. Easy. Finally, suppose, sir, I am not coming under notified profession. I am carrying on some business or other professions, sir, not notified profession. Then the SS is divided into 2 types. Are you individual or HUF or others? Suppose if you are another partnership firm, AOP, BOI, company, all that, they must maintain books of accounts if income is more than 1,20,000 or turnover is more than 10 lakh. In any of the 3 years, last 3 years you take, any 1 year if this criteria, these 2 criteria, any 1 criteria satisfied, you must maintain books. Or, sir, you are newly started business, sir, likely to exceed. That's enough in the current year. Sir, I am an individual and HUF, sir. Then I have a higher amount. Income is 2,50,000, turnover criteria 25 lakhs. Current year, likely to exceed 2,50,000 income, turnover is likely to exceed 25 lakh. Then only I should maintain books of accounts. Able to understand? Easy. That numbers are easy. Now, sir, what is the penalty if I fail you to maintain books of accounts? 25,000 rupees penalty, 271A. Now, who is a notified profession? Because you see here, what is a notified profession? Here I have given a star mark. Who is a notified profession? Every person carrying on legal, medical, engineering, architecture, accountancy, technical consultants, interior designer, all that. Further, notified by the CBDT. The CBDT notified, authorized representative, film artist, company secretary, IT professionals are as notified professionals. Able to understand? All of you. Now, sir, how much period I should maintain books of accounts? 6 years you must retain from the end of the relevant assessment year. You should retain for 6 assessment years from the end of the relevant assessment year, where you should maintain. If single place only is there your business, then principal place, that place itself. If multiple places are there, at respect to place itself, you can maintain books. Easy. entire income tax revision is over. Confident or not? Yes. Let's discuss the revision of capital gains, which is again applicable for May 25 and September 25 and January 26. This is the chapter where major amendments happened. Predominant amendments happened in capital gains. Generally, capital gains itself is a one complex chapter because of so many dates, so many provisions, so many conditions, so many situations they will cover. Now it became even more complicated. But anyhow, let's break down the entire capital gains. Like many students in this capital gains, they ask me, sir, what are the amendments in capital gains? Only amendments they want to read. No, never read amendments part in capital gains directly. You will not understand. Read the entire chapter as per amended provision. And that is what right now we are doing. Capital gains, right now we are discussing straight away the amended provision. And you listen to this particular revision of capital gains, I'm telling you, you generally get complete clarity. Everywhere, wherever amendment is there, I will specifically point out. Okay, now in capital gains, the major thing is there are 4 dates that you should remember in this chapter. And there are 4 rates that you should remember in this chapter. These rates are applicable for long-term capital gains. These rates are applicable for short-term capital gains, 111A section. There is another short-term capital gain which is taxable at normal rates. There is another short-term, there is another capital gain, another short-term capital gain which is applicable at normal rate. But don't worry, let's not discuss immediately into this. 4 dates, 4 rates, this point I will come back. Okay, this point I will come back. What are the 4 rates that are there in the capital gains? What are the 4 dates that are available in capital gains? I'll come back. Now, most important, in capital gains, how do we compute capital gains? This is the first question. Normally, when you're learning capital gains, in what order you learn, that's different. But when you're revising the capital gain, there is a particular order in which you should revise. Therefore, you get ultimate command on the subject. Now, how to what is the let's begin the actual capital gains revision discussion. Capital gains will be computed in 2 parts. Capital gains can be computed in 2 different ways. One, for non-depreciable assets. Capital gains is computed for what? Non-depreciable assets and depreciable assets. What is it? Depreciable assets. Non-depreciable assets, capital gain computation is available under 48. Depreciable assets, capital gain computation is given under 50 and 50A. Apart from this, there are few more sections which talk about computation of capital gain. There are few more sections which talk about computation of capital gains, that is 46, liquidation, on account of liquidation. Then 46A, computation of capital gain on buyback. Computation of capital gains on buyback. There is another section which is also talking about capital gains for market linked debentures, units of specified mutual fund, unlisted debentures, unlisted bonds with effect from 23rd July. This section has an amendment. Getting it? And there is another section which also talks about computation of capital gain is slump sale. There is another section which is also talking about computation of capital gain is slump sale. Now, so this is the capital gain computation format. This is the situations under which you should compute capital gains. Remember, don't deviate. There is an order which I am discussing. If you listen to this order, if you listen through this order, every point I will connect. Now, how to compute capital gains for depreciable assets? First, let us look at this. Already, this point we will discuss in PGBP revision. We would have already discussed this in PGBP revision, but briefly once again I will tell you. How to compute capital gains on depreciable assets? Very simple. In depreciable assets, you sold full block. You sold full block. Full block is transferred. Full block is transferred. As on 31st March of the relevant previous year, a particular block is not at all there. 1st April the block is there, but 31st March the block is not there, which means the block itself is ceased to exist. Now, how to compute capital gains? First, identify gross block value. First, identify gross block value. What do you mean by gross block value? Opening WDV plus additions during the year plus transfer expenses during that year. Transfer expenses incurred on transfer of the block. See, this point is what I already given you in the book also. In the book also I've clearly given you this point. This point I've given, just a minute, it's loading. Yeah. You see here, section 50. Section 50, how to compute capital gains on depreciable assets which are forming part of block of asset. Very simple. Sir, full block is transferred. Yes. Short term amount is, look at the amount received. Sir, how much amount you received? Check out. Amount received is more than gross block value. Then amount received minus gross block value is treated as short term capital gain. Sir, full block is transferred. Sir, amount received is less than gross block value. Then it is a short term capital loss. Sir, I transferred part of a block. I transferred part of a block. And the amount received is more than value of the block itself. Then the excess amount received is short term capital gain. Suppose part of a block is transferred, sir. The amount received is less than gross block value, sir. 32 section will apply. Opening value plus additions minus amount received on transfer of a block, part of a block. Still some value is there, WDV. It's called WDV. Written down value is there. Asset is also there. Block is also there as on 31st March. You will not compute capital gains at all. Correct? So now, how to compute capital gains? Amount received, gross block value you should compare. Correct? You should compare amount received. Amount received minus gross block value. If the net result is positive, it's a short-term capital gain. If the net result is negative, it's a short-term capital loss. Correct? Amount received minus gross block value. Now, amount received means what? Value of consideration received on transfer. Transfer means what? The block, no, either it would have been sold or the block is demolished or block is compulsorily acquired by somebody. Some transfer happened. You received some amount. Block itself is not there. Compare that amount received with the gross block value. What is gross block value? Opening value of the block. Add actual cost of asset acquired in the block during the year. Add, very important, expenses in connection with the transfer. For computation of capital gains, expenses incurred in connection with regard to transfer shall also be treated as gross block value. So very simple, sale value, full value minus transfer expenses is equal to net value minus gross block value. That's how you can compute. But instead of that, you compare these three. Simple. Full block itself is sold, sir. Some amount you got. Full block itself is sold. Some amount you got. Compare it with the gross block value. Difference amount is either short-term capital gain or short-term capital loss. That's it. Very simple example I'll give you here. Suppose, sir, opening value of plant and machinery 15% block. Open value of plant and machinery 15% block. This is 100 crores, sir. Current year, no, more than 180 days, less than 180 days. So I purchased so many assets, sir, which is 20 crore. Total gross block value is what? 120 crore. Now, this entire block, no, sir, entire block we sold for 150 crores, sir. Short-term capital gain is 30 crore. Don't compute like this. If you see the question, you understood that full block is sold. You saw the question, you understood that full block is sold. Immediately your mind should think about how to present it in such a way. Very simple. Amount received on transfer of full block, correct? How much it is? 150 minus transfer expenses, some 1 crore was there, 149 net consideration, correct? Minus gross block value, opening plus additions during the year. Opening 100 crore, additions 20, so 120. Therefore balance is short-term capital gain. Balance is to be treated as short-term capital gain. You should think about the process. First you should think capital gains applicable or not applicable. Then you should immediately come to this format when you are doing. Are you getting it? Sir, part of a block sold. Here instead of using the word part, you will use. In a part of a block sale, you will only have gain or you will have depreciation. Sir, part full block sold, sir, but lesser price, sir. If it is negative, it's a short-term capital loss. If it is negative, it's a short-term capital loss. Able to understand. You should present like this. Sale you should present, transfer expenses should reduce, then gross block value should reduce, and the final result will be either short-term capital gain or short-term capital loss when full block is transferred. Sir, part of a block only transferred, sir. Part of a block is transferred, sir. But you know that capital gains apply in that. Why? When part of a block is sold for higher than block value, automatically what is applicable? Capital gains is applicable. Depreciation will not apply. Since capital gains is applicable, same format you will follow. Amount received on part of a block 150 crores, sir. Gross block value 120 only. Obviously, capital gains provision will apply. Therefore, my format will be like this. Suppose no, sir, amount received on part of a block is 100, sir. Full block value is 120, sir. Capital gain section will not apply. Section 50 will not apply. Directly I will go for 32. Depreciation format will follow. Opening WDV 100. Additions 20. Gross block value 120 minus part of a block sold. Net amount you reduce after reducing transfer expenses. Net amount after reducing transfer expenses, reduce that amount received. Amount received 20 crores, sir. Minus transfer expenses 1 crore is there, sir. 19 crore you reduce. Still balance is there. Block is there. Compute depreciation as we discussed in PGBP. First allocate that amount for assets not used, purchased but not used. Second, allocate the value for assets purchased during the year but used for less than 180. Balancing figure. Second amount is there, right? Half rate. Balancing figure, full rate. This we already covered in PGBP. Clear? That's it. Depreciation as a depreciable assets logic is over. And on depreciable assets, the capital gain is always long term. Sorry, the capital gain is always short term. Loss is short term. That's it. 50 is over. Now, sir, I am an electricity company, sir. 50A. I am an electricity company which is following SLM basis of accounting. Sorry, which is where I am following SLM basis of depreciation, sir. How to compute capital gains? You will have WDV on opening date, right? On 1st April of the previous year, you will have opening date, right? As on 31st March, you will compute depreciation. But as on 31st March, that asset is sold. For that year, you don't get depreciation at all. For that year, you don't get depreciation at all. If an electricity company purchased a machine, SLM method, they are depreciating. As on 1st April, opening value find out. That asset is sold during the year. No depreciation for this year. Are you getting it? Sir, opening value of this is 50 crores, sir. I purchased this asset for 100 crores, sir. Now I sold it for 150 crore. I sold it now for what price? 150 crore. Now, remember opening value as on 1st April is 1st April 2024 is 50 crore. You know, I purchased originally for 100. Now I sold it for what price? 150. Now how to compute? Very simple. Total profit is what? 150 crore is the sale price. 50 crore is the, you know, WDV. Total profit is 100 crore. Total profit is 100. But this 100 will be split into two parts. Profit up to original cost. WDV is 50 only. But I sold for 150. 100 crore profit is there. How much of the profit is up to original cost? 50. This 50 crore is treated as balancing charge. This 50 crore is treated as balancing charge under 43 subsection 2. What is that? 43 subsection 2. Sir, balance 50 crore is there, right? Beyond original cost profit. That is treated as short-term capital gain under 50A. That is treated as short-term capital gain under 50A. That's it. Sir, actually WDV 50, sir. I sold this asset for 10 crore only, sir. Then 50 minus 10, what is the loss? 40 crore. This is straight away treated as terminal depreciation under section 32. It is straight away treated as terminal depreciation under section 32. This we already covered once in PGBP. That's it. Section 50, depreciable asset. How to compute capital gains we completed. 50A, how to compute capital gains we completed. And that entire points were given in this. This entire point, transfer of depreciable assets, all that we have given here. Clear? Next. Then 50AA, most important amendment is there. 50AA amendment is there, which is applicable for May 25 exams for the first time. And I'm thinking there is a possibility of MCQ on this. What is this? 50AA is what? This 50AA section, no? This 50AA section. Okay. I am talking about before amendment and after amendment. Both. I am talking about before amendment, after amendment. Before amendment means what? Before 23rd July 2024 on or after 23rd July 2024. 23rd July is most important date in capital gains, remember. Now, one date is what? Before 23rd July, on or after 23rd July. How this section is modified? That is the question. Before 23rd July, only two types of assets are covered under 50AA. Only two types of assets. Specified mutual fund. What is it? Specified mutual fund. Market linked debenture. Whereas after amendment, three assets are covered. Specified mutual fund as it is there, market linked debenture as it is there, unlisted debenture, unlisted bonds were also added with effect from 23rd July 2024. With effect from 23rd July 2024, unlisted debentures and unlisted bonds are also added. Unlisted debentures and unlisted bonds are also added within the purview of 50AA. Sir, what is 50AA? 50AA is very simple. 50AA says the capital gain on the section, on the assets covered under the section, the capital gain, the capital loss, whatever it is. If at all the asset comes under 50AA section, the gain or loss is always short-term capital gain or short-term capital loss. This is what the section says. The section says whatever assets covered under that section, the gain or loss is always treated as short-term, irrespective of holding period. Irrespective of holding period. Now, sir, I purchased specified mutual funds, market linked debentures, which I purchased and sold before 23rd July, or I purchased before 23rd July, sir, but sold after 23rd July. Here, what I am doing, transferred on or after 23rd July. Here, what am I doing? Transferred. What you transferred? Sir, before 23rd July, mutual funds. Before 23rd July, I transferred mutual funds, specified mutual funds. Specified mutual funds is generally debt-oriented mutual funds. Generally, what are they? Debt-oriented. Debt-oriented means what? Where investment in equity shares of domestic companies less than 65%. Investment in equity shares, investment in equity shares is not more than 35%. Not more than 35%. Predominantly 65% or more than 65% is invested in debt or bonds. Then that is called as what? Specified mutual fund. It is given here. What is a specified mutual fund? A mutual fund where not more than 35 is invested in equity shares. Means equity share investment portion is how much? Less than or equal to 35. Indirectly 65% is invested in preference shares, debentures, bonds, something debt oriented. Getting it? Now, if at all I am selling these two items, whether I am selling before 23rd July or after 23rd July, doesn't matter. The gain or loss is always short term. However, latest amendment, unlisted debentures, unlisted bonds, unlisted debentures and unlisted bonds. Sir, I am selling unlisted debentures, sir. Right now I am selling unlisted debenture or I am selling unlisted bonds, sir. When are you selling? I am selling after 23rd July. I am selling them well after 23rd July. Before 23rd July, I purchased it, sir. When you purchase it, not matter. When you sold, sir, I sold after 23rd July. On 23rd July 2024 or after 23rd July 2024, I transfer. For May 25 exam, September 25, Jan 25, problems will be asked based on financial year 24-25, previous year 24-25. This is very important. So, unlisted debentures, unlisted bonds, I sold after, on or after 23rd July. Very simple. On this, sir, this asset is a long term for me, sir. It doesn't matter. The gain is always short term. The gain is always short term. The asset may be long term. Asset may be long term. By the way, whether an asset is a long term or short term, whether an asset is a long term or short term, it depends upon what? Period of holding. Whether an asset is a long term asset or short term asset, it depends upon what? Period of holding. Now let's discuss that point first. Okay, we have a section called 2 subsection 42A and 2 subsection 29A. 242A talks about short term capital asset. 229A talks about long term capital asset. 229A section says what is a long term other than short term. What is a short term capital asset? Now the section gave two parts. Now, what is a short-term capital asset? Again, it is divided into two parts. Very simple. I'll open to that directly, so you will get a view. You will get a holistic view. You see, types of capital asset. types of, you see capital gains chapter here, it starts here, and types of capital asset. Capital gains are broadly classified into long term and short term based on period of holding of the capital asset. Based on period of holding, capital assets are two types. What are they? Short term capital asset, long term capital asset. Sir, when an asset is treated as short term, when an asset is treated as long term? This is the question. It depends upon what? Period of holding. Now, this classification of capital asset into long term, short term, the provision is different if at all asset is sold before 23rd July. Suppose you sold asset before 23rd July. Tell me, capital gains set off income is applicable only when there is a transfer of capital asset. Transfer is the taxable event. When the transfer happened, check out. Sir, transfer happened after 23rd July, sir. On or after 23rd July. From 23rd July, there are only two criteria. For highly volatile assets. I am naming it. This name is given by me. Highly volatile assets. What are the assets? Nothing but listed securities. Listed securities means what? It may be listed equity shares, listed preference shares, listed bonds, listed debentures, all that other than units. Mutual funds is not covered here. In that first point, mutual fund is not covered. Listed securities. What is the criteria? 12 months. 12 months. If at all holding period is up to 12 months, it's a short term. If the holding period is beyond 12 months, it's a long term. If the holding period is up to 12 months, it's a short term. If the holding period is more than 12 months, it's a long term. You see, before amendment also the same. For highly volatile assets. Highly volatile assets means what? Listed securities, units of equity oriented, units of Unit Trust of India, zero coupon bonds. Remember, what are highly volatile assets? Listed securities. Units of only equity oriented fund. Debt oriented funds are not covered in 12 months category. Debt oriented mutual funds are not covered under 12 months category. Only equity oriented mutual funds are covered under 12 months category. Yes or no? So listed securities, units of equity fund, Unit Trust of India, zero coupon bonds. If these assets are sold after 23rd July, 12 months is the criteria. Even if you sell before 23rd July, same as above. 12 months is the criteria. Understood? Now, after amendment, from 23rd July, you are selling some capital asset other than volatile assets. Straight away, the criteria is what? 24 months. What are they? Unlisted securities. What are they? Unlisted securities. Debt-oriented mutual funds. Immovable property. Jewelry. Yes or no? All these items. Urban agricultural land. Industrial land and building. All these items. Straight away the criteria is what? 24 months. Before amendment, we have two classifications for these assets. Unlisted shares, land and building or both. Remaining assets. Before amendment, we have 12 months logic, 24 months logic, 36 months logic. Whereas after amendment, we have only two logics, 12 months, 24 months. Before amendment, suppose, sir, I am selling an asset, sir. Before 23rd July, I am selling. You are selling before 23rd July. Okay, I am selling before 23rd July, sir. What is the consequence? Which asset you sold? Highly volatile asset. 12 months is the logic. Or I sold unlisted shares. Remember, it's not unlisted security, unlisted share. Unlisted share means what? Either equity share is covered, preference share is covered, debenture is not covered, bond is not covered there. Understood? Debenture is not covered, unlisted debenture, unlisted bonds not covered. Zero coupon bond is covered under highly volatile asset. Zero coupon bond is covered under highly volatile. Highly volatile means what? Listed securities. Equity oriented mutual fund, Unit Trust of India, zero coupon bonds. For them it is always 12 months. Before amendment, after amendment, no change. Whereas unlisted shares, only preference and equity, only they are eligible for 24 months criteria. Remaining unlisted securities, unlisted debentures, unlisted bonds, they still come under 36 months criteria if at all you are selling those debentures and bonds before 23rd July. Suppose I am selling a debenture and bond after 23rd July. 24 months is enough. 24 months is enough. See here, very important. Why long term and short term classification is important? Why it is important? Because tax rate is decided accordingly. You should decide an asset is a long term or short term because tax rate is important. Now very simple. Unlisted shares, land, building or both. For them, what is the criteria? 24. Remaining assets means what? Remaining assets means what? Unlisted debenture, unlisted bond, jewelry. Yes or no? For all jewelry, archaeological collection, painting, drawing, for all this straight away 36. Whereas after amendment, what happened? These items are also classified under 24 months. These items are also classified under 24 months category. Earlier, unlisted debentures, earlier, unlisted shares, immovable property. Only these two assets come under 24 months logic. Remaining all other comes under 36 months logic. After amendment from 23rd July, every asset other than highly volatile asset comes under 24 months logic. Highly volatile assets are 4. Remember this. Listed securities, units of equity oriented mutual funds, zero coupon bonds, units of unit trust of India. Remember there is a point, units of business trust. For that, before amendment, 36 months criteria is applicable. After amendment, 24 months criteria is applicable. Until now clear? All of you. This is short-term capital asset, long-term capital asset definition. Over. Now you see here 50A, right? Sir, I am selling unlisted debentures, unlisted bonds, sir. When you are selling, before 23rd July I am selling, sir. 50A section do not apply. I am selling unlisted debenture, unlisted bonds before 23rd July. That time 50A section is not applicable. If it is a long term, gain is long term capital gain. If it is a short term, gain is short term capital gain. Before 23rd July you are selling means holding period is 36 months criteria. Before 23rd July if you are selling, holding period criteria is 36 months. If it is a long term capital gain. If it is a short term capital gain. Simple. But if you are selling after, on or after 23rd July, then 24 months criteria. It may be a long term or it may be a short term. But the profit or loss is always short. With effect from 23rd July, unlisted debentures, unlisted bonds is also covered within the scope of section 50AA. That's it. Understood? All of you? That's it. Now we also completed long-term capital asset means what? Short-term capital asset means what? Now, what are the capital gains tax rates? Let's now look at the capital gains tax rate. So that is given in our book at the last. At the last of this chapter, we have given what is the tax rates. Just a minute. Yes. What are the tax rates? There are, at the beginning I told, right, four rates concept that I am thinking now. Okay. Now, see, there are three types of assets. There are three types of assets. What are they? Listed equity share. Listed equity share. Listed equity oriented mutual fund. Units of business trust. Units of business trust. Business trust taxation is not there in CA Inter. That's why we will not get anywhere business trust related cost of acquisition, business trust related market value. If you don't get that, business trust is a different entity where the taxation is available at CA final only. Okay. Now, sir, I am having three assets, sir. Listed equity shares, listed equity oriented mutual funds, units of business trust. Okay. Okay. You are selling these assets. Yes, sir, I am selling these assets. By the way, for this, holding period criteria is what just now we covered. Listed equity shares comes under highly volatile. Listed securities logic. 12 months logic. Equity oriented mutual funds comes under 12 months logic. Units of business trust. If at all you are selling before 23rd July 2024, 36 months logic. If at all you are selling after 23rd July 2024, then 24 months logic will apply. By the way, up to 12 months, up to 24, up to 36, as the case may be, is a short term. Beyond 12 months, beyond 24, exceeding 12, exceeding 24, exceeding 36 only, it's a long term. That beyond up to exceeding point I didn't cover, that's why I'm touching it now. Now understood, everyone? Yes. So now we understood these three assets, when they will become long term, when they will become when they will become a long term asset, when they will become a short term, we understood. Exceeding 12 months is a long term. Exceeding 12 months is a long term. Suppose units of business trust before amendment I sold. I sold before amendment. That time holding period is what? More than 36. After amendment I sold. Then holding period must be more than 24 months. Sir, what is holding period? From which date you got the asset? On which date you are selling it? If the gap is more than 12, more than 24, more than 36, then it's a long term. If the gap is less than or equal to 12, less than or equal to 24, less than or equal to 36, then it is a short term. Correct? Now look at these three assets. What is these three assets? These three assets are covered under two sections, 112A, 111A. These three sections are covered under two different sections called 112A, 111A. Sir, these three assets I sold, sir. Any of these three. Suppose if it is a long-term capital asset. If it is a long-term capital asset. Sir, I sold, which is a long-term capital asset, sir. These three assets I sold, sir. Long-term capital assets, sir. Moreover, more than 12 months. After holding them for more than 12 months, I sold it. Now, what is the tax rate applicable to me? This is the question. When you sold, I want. You sold before 23rd July? You sold before 23rd July? Or you sold on or after 23rd July? I want. You sold on or after 23rd July? Yeah, before 23rd July? I want. Sir, I sold before 23rd July, sir. Straight away tax rate is what? 10%. You all know this. Exceeding 1 lakh. No, it's not 1 lakh, it's 1.25 lakh. For financial year 24-25, up to how much of 112A gain is exempted when computing tax amount? 1.25 lakh is exempted. Whether you transferred before 23rd or after 23rd, doesn't matter. Many students thinking up before 23rd 1 lakh limit, after 23rd 1.25 lakh. This is not a separate limit. For full year put together, only 1.25 lakh limit. Are you getting it? No. Sir, I sold before 23rd July, sir. Or I sold on or after 23rd July, sir. On or after 23rd July you sold, huh? Which one you sold, by the way? Sir, I sold these three, sir. Either listed equity share, listed equity oriented mutual fund, units of business trust, STT paid, sir. STT paid. What do you mean by STT paid? I'll discuss little while later. STT paid, sir. At the time of sale, STT paid, sir. Then, if the asset is a long term, before 23rd July, if at all you sell, you have a long term capital gains, it is taxable at 10%. Suppose if at all you are selling it after on or after 23rd July, the tax amount is 12.5. Whether it is before or after a total capital gain, you compute first. Total capital gain you compute. On that 1.25 lakh give exemption. On that give exemption 1.25 lakh. Getting it? Balance capital gain is taxable. For example, sir, before 23rd July I sold, sir, I got 5 lakhs capital gain. Okay? And after 23rd July, I sold another listed equity share, sir. That is also long term, sir. Here also I got 5 lakhs capital gain. Now, how to compute tax, sir? Very simple. From this 5 lakhs, 1.25 lakh reduce. First in, first out. FIFO order we will reduce. 1.25 lakh we will reduce in which order? FIFO. 1.25 I reduced it, sir. Balance 3.75 lakh. This entire gain is came before 23rd July. Taxable at 10%. You know, here 1.25 already claimed exemption. 5 lakh is taxable at what rate? 12.5% is equal to that amount is the tax. 112A, how to compute tax? Crystal clear, I told. Many students are thinking before amendment 1 lakh, after amendment 1.25 lakh, they are reducing both. Wrong. It's absolutely wrong. 1.25 lakh is the limit for the entire capital gain taxable in that year. Now that 1.25 lakh is exempted, first capital gain, first 1.25 lakh of capital gain is exempted. Balance capital gain is taxable. That is what the provision. First 1.25 lakh is exempt. Beyond 1.25 lakh is taxable. First capital gain means, before 23rd July I got a capital gain. That is first capital gain for me in this year. So that's why I will give exemption here. How much I will give exemption? 1.25 lakh. Now here some student, sir, before amendment 1 lakh only, no limit. Now how come you say 1.25? This 1 lakh limit. See, in 112A section, 2 amendments happened. One is threshold limit. 1 lakh is increased to 1.25. That's a different amendment. Tax rate is increased from 10 to 12.5. Threshold limit for the entire year is 1.25 lakh. Remember this. Sir, this is 112A. Sir, suppose same dates, sir. Transfer dates are same, but the asset is not long term. The asset is a short term. Then no threshold limit, no exemption. Straight away, we already know 112A gain is taxable at what rate? 15% before amendment. Now the tax rate is increased to 20%. Same assets, same three assets. Listed equity shares, listed equity oriented mutual funds, units of business trust. These three I am selling. Before 23rd July you are selling. Yes sir. Short term, yes, 15% tax rate, flat 15. On or after 23rd July you are selling. Yes sir. Flat 20%. Sir, I am getting a short term capital gain on some other asset. Not these three. Some unlisted debenture I am getting 50 AA. Sir, I am getting some unlisted bonds 50 AA. Market linked debentures I am selling. Short term capital gain. Depreciable assets block I am selling. Short term capital gain. Land I am selling. Short term capital gain. All other short term capital gains are taxable at SSE specific rates. Normal rates of tax. Normal rates of tax means what? For individual, HUF, AOP, BOI, AJP, slab rates. Company, firm, society, all them, company, firm, flat rates. Are you clear? That's it. 111A completed, 112A completed. Are you getting it? That's it. In 111A and 112A, you have even little more complications. Sir, shares if you are selling, no? STT must be paid both at the time of transfer and sale. At the time of purchase, at the time of sale, both the times. Equity oriented, at the time of sale, STT paid, that's enough. 112A section apply. Short term capital asset, no. STT paid at the time of sale of that asset, that's enough. The sale might be happened before 23rd July, on or after 23rd July. You see, I have given tax rates clearly. Before 23rd July, 10% tax rate. On or after 23rd July, 12.5. Provided capital gain exceeding 1.25 lakh only taxable. And remember, this 1.25 lakh limit is for the full year together. That's it. Tax rates. Sir, if it's a short term, 15% of the transfer is before 23rd July, 20% of the transfer is on or after 23rd July. That's it. 112A is completed, 111A is completed. Whether an asset is a long term or short term, that is also completed. Are you clear? Yes or no? No. Now, there is another tax rate. Another tax rate which is 112, section 112 tax rate. Sir, I am selling some assets, sir, but not listed equity share, not listed equity oriented fund, not units of business trust. Some other asset I am selling. If it is a short term capital gain, straight away normal rate. What if it is a long term capital gain? What if it is a long term capital gain? Then that section, then that gain comes under 112. Then that gain comes under 112. Sir, I sold it before amendment, sir. Straight away the tax rate is what? 20% off on capital gain, computed after reducing indexed cost of acquisition. After reducing indexed cost of acquisition, I will get a capital gain rate. Straight away the tax rate is what? 20%. When? If the asset is transferred before 23rd July, before amendment. And the biggest amendment is, if at all I am transferring on or after 23rd July, straight away the tax rate is 12.5% without indexation. Straight away the tax rate is 12.5%. Indexation benefit is removed with effect from 23rd July 2024. If you are selling any asset, no indexation benefit at all. No indexation benefit at all. Straight away indexation is removed. However, if I am selling land and building, when I am selling on or after 23rd July, I am selling land and building on or after 23rd July. But I purchased them before 23rd July. But selling after 23rd July. The period of holding is more than 24 months. It's a long term. I got a capital gain. What should I do? What I should do? Very simple. You should compute capital gains. Remember, this is very sensitive provision. You should compute capital gains for land and building. Look at this. Suppose, sir, I am doing land and building. Pakka question will come on this. This is what I'm predicting. Pakka question will come on land and building. Computation problem. Suppose I am selling a land and building, sir. When are you selling this land and building? Some, 20th August, or else let us do this point. Sir, I am selling this land and building after 23rd July 2024. I am selling this after 23rd July 2024. But when this is purchased in 2019 or 20, I purchased it, sir. Now, this is a long term, right? because more than 24 months. By the way, for land and building, before amendment, after amendment, holding period logic is same 24 months. More than 24 months, it's a long term. Yes. How you should do computation, full value of consideration, how much you calculate. Minus transfer expenses you reduce. Then you will get what? Net consideration minus indexed cost. Never. Because you sold it on or after 23rd July. So cost of acquisition without indexation, cost of improvement without indexation, balance is capital gain. It may be long term or short term. Now you need to pay tax on this, right? Now when you are computing tax amount on capital gain, individual and HUF, the two resident individual, resident HUF, they were given one option. Resident individual or resident HUF, they both were given one option. What option they were given? Sir, I was a resident individual. These people purchased this land before 23rd July, but are selling this after 23rd July. Indexation is lost. This is a very big negative thing for them. So what the government did? The government told them, you compute capital gains without indexation only. Always computation of capital gain for total income purpose must be without indexation. You should not consider indexation at all. But when you are computing tax amount, no. Computation of tax amount to time, once again compute long-term capital gain with indexation facility. Once again compute long-term capital gain with indexation facility. By the way, I need to compute long-term capital gain with indexation at what time? Tax computation time. On this, apply 20% tax rate, and how much is the tax? Identify. Already you computed long-term capital gain without indexation, correct? Already you computed, right? This amount copy paste here. On the 12.5% you apply. How much is the tax amount you are getting? Where the tax amount is low, that option you will choose. This will be applicable for whom? Only resident individual, only resident HUF, selling land or building or both on or after 23rd July, which they purchased before 23rd July, which is a long term. See, if it is a short term, I don't have any problem. Straight away taxable at normal rates. Since it's a long term, I have a question. Getting it? So first compute capital gains. In the answer, problem computation, compute capital gains. In ICI book, there is a test your knowledge question number 6 or 7. Fantastic question. Same. Whatever I told as it is, you apply, you will get the answer. Are you clear? All of you. This is for land and building. Okay. Suppose, sir, this land and building is sold by some other person, sir. Land and building is sold by some other person. Any other SSE is selling this land and building. When it is sold before 23rd July, straight away take indexation, compute capital gain, tax at 20%. Even resident individual, resident HUF, if at all they are selling before 23rd July, take indexation benefit, compute capital gain, compute tax at 20%. Suppose we are selling after 23rd July, then individual and HUF, compute capital gain without indexation. At the time of tax computation, you should apply this logic. And any other person, they are selling land and building or both. A company is selling, a partnership firm is selling, a partnership firm is selling, a non-resident is selling, which is situated in India. Land is situated in India. He is selling it. After 23rd July, straight away compute capital gains. Straight away compute capital gains without indexation. Capital gain multiplied by 12.5% is the tax. So no option scheme, no options like this. Option scheme is available only for resident individual and HUF. Remember, that's it. In regular class, I told you here also with indexation, without indexation, some logic also I told. 54 logic I told. More than 2 crore capital gain, here less than 2 crore capital gain. Without indexation, if you compute capital gain, maybe more than 2. That time investment in only one house is considered. What if SSE purchases 2 houses? And okay, we computed more than 2 crore logic. We did that logic. Remember the one logic I told? Yes or no? Yeah, that is enough in regular class. Here it is not possible to discuss. That takes a lot of time. Okay, but anyhow, if at all I'm covering, if at all, when I'm discussing 54 series, that time I'll tell you this. Until now, clear. Easy or not? You're able to reconnect everything? You're able to recollect everything? Yes or no? Fine. So this is regarding land and building. Suppose, sir, I am selling some other capital asset, sir. Not land and building. Some other capital asset I am selling. Some other capital asset I am selling. Not covered in 112A. But long term. Not land and building. If you are selling them before 23rd July. 20% tax rate with indexation. If you are selling on or after 23rd July, 12.5% tax rate without indexation. And remember, you need to compute capital gains as per 48 format for all non-depreciable assets. As per 48 format as for all non-depreciable assets. So what is the 48 format is all about? You see here. How to compute capital gains for non-depreciable assets. Computation of capital gains under section 48, non-depreciable assets. Other than depreciable assets, nothing but. Okay, for them, how to compute? First, you should always follow this format in the exam. You should always follow this format. Okay, so full value of consideration, how much? Identify. Full value of consideration, how much? Identify. What is full value of consideration? Full value of consideration can be actual amount or deemed consideration, which may be as per 50C, 50CA, 50D. Actual consideration or deemed consideration as per these sections, whichever is applicable. Whichever is applicable. We'll discuss that later. Okay. Full value of consideration, find out. Reduce transfer expenses. Remember, transfer expenses generally will be calculated as a percentage of actual consideration, or they'll give you straight away the amount. Reduce that. What you will get is called as net consideration. Then from that you have two deductions. One, cost of acquisition, cost of improvement. Suppose if this computation you are doing, if at all you're doing this computation before 23rd July and the computation is for a long-term asset, then indexed cost of acquisition, indexed cost of improvement. Remember, if at all you are computing on or after 23rd July sale, indexation benefit itself will not come. Sir, but you told no individual HUF, resident HUF, land and building. That is a tax computation time you do. Original long-term capital gain computation indexation will not be there at all. With effect from 23rd July, if you are selling, it's a long term. On or after 23rd July you sold, indexation itself is not available. Straight away cost, actual cost you reduce. Then what you will get? Gross long-term capital gain. Then from that, reduce exemptions under 54. What is 54(6) exemption? Will come back. Then balance taxable capital gain you will get. Now, what is full value of consideration is the question. What is full value of consideration is the question. Okay, we will discuss now one by one here. Full value of consideration is what? Cost of acquisition means what? Cost of improvement means what? Indexation benefit, how to claim. Before amendment, how to claim indexation. After amendment, how to claim indexation. All that we will be discussing one by one. So now I will cover full value of consideration. Okay, now I will cover full value of consideration. What is full value of consideration? There is a section called 50C. Remember what is full value? Remember, many students, they will write sale consideration word. When they are computing capital gains, actual sale consideration they will write. You will lose half mark there. You should never use actual sale value like that. You should always use full value of consideration. What is full value of consideration? Very simple. Suppose, sir, I am computing capital gains because I am transferring immovable property. I am computing capital gains on transfer of immovable property. Okay, you are transferring immovable. So what is consideration? Consideration is, this logic should be applied. Stamp duty value, identify. In the problem, they will give you stamp duty value. They will give you two stamp duty values in the problem. Stamp duty value on agreement, stamp duty value on registration of this land and building which you sold. Both the dates they'll give you. Which date we should consider? We'll come back. Stamp duty value first to see. Is it more than 110% of actual consideration? Identify. Suppose actual consideration 810 lakhs. 810 crore. Actual consideration is what? 810 crore. Stamp duty value is 890 crore. Stamp duty value is what? 890 crore. C is 890 more than 110% of 810. Check out. 110% of 810 is equal to 891, sir. No. Stamp duty value is not more than 110% of actual. Since stamp duty value is not more than, does not exceed 110% of actual, full value of consideration is actual, which means 810 only we will take. In the computation, we will take only 810. Sir, suppose stamp duty value is not 890, sir, but 900, sir. Stamp duty value is not 890, but 900. Okay, apply the same logic. Is 900 more than 110% of 810? Yes. If that is the case, then stamp duty value itself is full value. Then 900 I will take. Understood or not? No. Sir, stamp duty value I understand. If stamp duty value is more than 110%, stamp duty value. If stamp duty value is not exceeding 110% of actual, then actual. This is the consideration I should take. I understood. Stamp duty value means what? On which date we should consider? Stamp duty value can be either date of agreement or registration. Which is applicable we should see. Suppose to sell this land and building, is there any agreement entered into by you? Yes, agreement is entered, sir. On the date of agreement or before the date of agreement, have you received advance? Yes, sir, I received, sir. How will you receive the advance? Other than cash. In 40A3, some modes are given. Remember 40A subsection 3 PGBP, more than 10,000 in cash, that PGBP. Beam, UPI, credit card, debit card, check, account pay check, account pay draft. In 40A3 modes I received, sir. Advance I received in 40A3 mode. Other than cash I received, sir. Not bearer check, not crossed check, not bearer draft. Remaining all other electronic modes, banking modes, I received. When I received advance, agreement date, then stamp duty value on agreement date shall be taken. Suppose, sir, I don't have any advance, sir. Agreement itself is not there, sir. Then stamp duty value on the date of registration value you should compare. Sir, advance is there, but in cash. Stamp duty value on the date of registration. You see, advance received from buyer on or before date of agreement by other than cash, agreement date. Sir, advance received in cash, sir. Date of transfer STV. No advance at all, sir. Date of transfer STV. Are you clear? Yes or no? Full value of consideration you should decide like this for removable property. Sir, suppose I am selling. Here I have given an example. You see this example later. You download this PDF and then see that later. You can order this book also on the website. Okay, fine. So full value of consideration in other situations. What is full value? Sir, unlisted shares I am selling, sir. Suppose unlisted shares I am selling. In the problem, the moment they give you unlisted shares, see what is the market value. Actual consideration is, let us assume, sir, 10 crores, sir. Market value 12 crores, sir. Market value shall be taken. Sir, any other asset I am selling, sir. Not unlisted share, not land and buildings, sir. Some other asset I am selling, sir. And you, some other asset, what is the consideration? Always actual. However, if consideration cannot be ascertained, if consideration cannot be, somehow we are unable to ascertain consideration, sir. It's a case of exchange, sir. We are unable to identify how to determine what consideration. Then market value of the asset transferred you take. What you transferred, it has a market value, take that as a consideration. You got in return some non-monetary benefit you got. You don't know how to value that. What you gave has a market value, consider that. That's it. Full value of consideration is over. Clear all of you? So once full value of consideration is computed minus transfer expenses, you will get net consideration. Then from that you should reduce what? Cost of acquisition. Now you see again. Now full value, we understood how to compute full value. Land and building, stamp duty value more than 110% of actual is equal to stamp duty value. Otherwise actual. Unquoted shares, market value more than consideration, then market value. Any other assets, actual consideration which will be given in the question, that only you will take. If actual consideration is not determinable, market value of the asset transfer. Minus transfer. Transfer expenses means what? Expenses which are exclusively related to sale of that capital asset, like brokerage, stamp duty, registration fee, legal expenses, all that. STT paid will never be treated as transfer expenditure. STT paid. Suppose you are selling shares, you are selling listed shares. STT payment information is given. Never consider that. Never consider that. Understood? Then once you reduce from FVC, transfer expenditure, what you will get is net consideration. From net consideration, what deductions are there? Cost of acquisition, cost of improvement. That's it. Once we cover cost of acquisition, how to decide the cost of acquisition, there once again I will discuss period of holding, cost to the previous owner, 49 subsection 1 modes, like that. So much discussion is there. Once we complete that, I'm telling you predominantly capital gains chapter is over. Revision. Now you see you are able to reconnect everything. Yes or no? That's the power of holistic revision. Getting it? When you see independently, you will feel so much is there. Your confusion. No. There is a structure in which you should revise. You understood until now? That's it. That's it. Okay. We'll continue in the next session, the remaining part of the revision. Okay. That's it. Yes. Let's continue the revision of capital gains. So we started discussing the capital gain computation for non-depreciable assets, and we already completed what? Full value of consideration, transfer expenses. Now let's look at the cost of acquisition and cost of improvement. Now what is cost of acquisition? Cost of acquisition means generally actual cost or deemed cost of acquisition which will be determined as per section 49 and 55, which is as applicable. See, here in this book, I gave a format in such a way that you have to present like this only in exam. So you should present like this. So full value of conditions, you should write in exam note number 1. If 50C, 50D, 50CA, something is applicable. Then transfer expenses point, you should write it as a note number 2. If at all you are computing any transfer expenses, or if you are ignoring STT paid, that and all. 3. Cost of acquisition. Whatever point provision is applicable, you should write it as a note number 3. This is how you should present in exam as it is. Getting it? Now, what is a cost of acquisition? Deemed cost or actual cost, as the case may be determined as per 49 and 55. Correct? As per 49 and 55. No deduction will be given towards interest on housing loan under 24B, 80EE, 80EA. Nothing but interest on housing loan is not a cost of acquisition or cost of improvement. No deduction for that. Indexation is available if at all capital asset is transferred before 23rd July. Remember, transfer date must be before 23rd July. Then only indexation facility will be available, which is what? Prior to amendment. Whereas if at all transfer is on or after 23rd July, straight away when you are computing capital gains, no indexation at all. However, if at all you are selling a land or building or both by an individual or HUF who is a resident in India, getting it? There also capital gain computation will be done without indexation. But for him, at the time of tax computation working, that time we should consider once again capital gain with indexation and apply 20% tax rate, without indexation and apply 12% tax rate. That's it. Now, earlier up to 23rd, if it is a long-term capital gain, tax rate is 20%. Now, long-term capital gain is tax rate is 12.5%. Getting it? Now, without indexation, on or after 23rd July 2024, no indexation at all. Now, sir, what do you mean by indexation? What do you mean by cost of acquisition, deemed cost of acquisition? All that we'll discuss. Look at this. Now, cost of acquisition means what? Cost of acquisition means what? The cost at which asset is acquired by the SSE or even previous owner. Previous owner cost means what? If the asset is received by SSE under the modes specified under section 49.1. I clearly discussed in the later topics. Okay, fine. What is cost to previous owner discussion? We'll come back to it little while later. Now, whatever cost of acquisition is there, right? If at all you are transferring, before amendment, before 23rd July, if at all the asset you transferred is a long-term capital asset based on period of holding, then that asset cost of acquisition can be indexed. That asset cost of acquisition shall be indexed. Indexation is nothing but inflation benefit. So cost is given an inflation benefit. To the extent of inflation in the acquisition cost, income tax department don't want to tax you. That's the logic. Now, what is the, how to calculate indexation? Indexed cost of acquisition is equal to, look at the cost. What is cost? Cost may be actual cost or deemed cost as per 49 or section 55, as the case may be. As the case may be. We will come to this cost of acquisition discussion little while later. Cost of acquisition multiplied by index number of year of transfer. Index number of year of transfer. Remember, here you must use year of transfer. For example, you know, as per the charging section, like I have not yet covered charging section till now. Getting it? As per the charging section, capital gains will be computed in the year in which transfer takes place. However, there are 3 sections. 45 subsection 2, conversion of capital asset into stock in trade. 45 subsection 1A, destruction, demolition of capital asset and insurance compensation received. 45 subsection 5, compulsory acquisition of capital asset by the government. In these cases, computation of capital gain will be done not in the year of transfer, but in the year in which consideration is received. In the year in which actual consideration is realized. Getting it? That is when computation of capital gains will be done. For example, an asset is destroyed, or an asset is converted into stock in trade, or an asset is compulsorily acquired by compulsory acquisition. All this happened in 24-25. All this happened in 24-25 or 23-24 or 22-23. Look at the date on which it happened. Before 23rd July. Yes, if it is before 23rd July, the conversion happened before 23rd July. 23rd July 2024. Before 23rd July, destruction happened. Before 23rd July, compulsory acquisition happened. But amount is received in 25-26 or 26-27 some other time. Computation of capital gains, taxability of capital gains will be in these years. Taxability of capital gains will be in the year of realizing the money. But numerator, when you are computing indexation, for the purpose of numerator index number, by default many students accidentally take whatever the year in which they are receiving compensation, right, that year index number they will put. That's wrong. You should put the index number of the conversion year. You should put the index number of the destruction year. You should put the index number of the compulsory acquisition year. Once again I will repeat that when I'm revising 45 series. Getting it? So year of transfer means what? Year of sale, year of exchange, year of relinquishment, year of exchange, year of extinguishment, year of conversion into stock in trade, year of destruction, year of compulsory acquisition. That's what year of transfer. So that number you should put always denominator. Denominator. Very simple. When you got the asset into your hand, you are an SSC, right? When you got this asset into your hand, sir, I got asset into my hand somewhere, on or after 2001 or 2002, sir. Getting it? Simple. When the asset came into your hand, that year index number you should put, or for us indexation facility comes only from the 1-2 financial year, 2001 2002 financial year. So that is a base year. So index number cannot be before 2001-2. Suppose you purchased the asset in 98-99, you purchased the asset in 95-98, you purchased it in 90-70-90-71. It doesn't matter. Index number of 2001-2 we will use. Suppose you purchased the asset in 3-4, you purchased asset in 10-11, you purchased asset in 2-3, 2002-3, nothing but after 1-2. After 2001-2 year you purchased, then that respective year number we will put. So 2001-2 onwards, whenever you purchase the asset, that year number will be given. If at all you purchased the asset before 2001-2, then 2001-2 number will be given. Very simple. So CII index number for the year first held by the SSC. First when you are holding this asset. So what do you mean by first held by the SSC? There is a contrary Bombay High Court judgment in Manjula Jesha case, which we will discuss a little while later. Getting it? Index number of the first held by the SSC. First time you are computing capital gains for some SSC, right? In the problem they'll be given. This asset is sold by so and so. Who sold it? In his hand, when the capital asset was received, when the capital asset was acquired, that date you should see. Accordingly, that year index number only you should put. First held by the SSC means the year in which the asset came into the SSC control. And you remember, you are computing capital gain for that SSC only. Getting it? That's it. Then, same way, see, once you get an asset, you might have done some improvements to it. For example, you purchased a land. That's acquisition cost. Later you constructed a building, that's an improvement cost. Later that land and building together is sold. The land and building together is sold in 2024-2025. What you sold, land and building, but actually what you acquired originally, land. What you constructed later, building. Land cost is treated as acquisition, building cost is treated as improvement. Now improvement is also eligible for indexation. Remember, indexation will come only for long-term capital assets. That too if the transfer is before 23rd July 2024. Now how to calculate indexed cost of improvement? Simple. What is the cost of improvement? Identify. What is the index number of year of transfer? Same numerator. Denominator. When in which year index CII of the improvement year. Add the word CII of the improvement year. In which year improvement has been incurred? Which financial year? That financial year index number you should put. That's it. Clear? Next. So now remember, indexation facility is not available even before 23rd July. Even if the transfer throughout the entire income tax life cycle, if you see, indexation is not at all available on these assets. What are they? Bonds and debentures. They are not at all eligible for indexation. They don't eligible for indexation. And however, capital indexed bonds and sovereign gold bonds, even electronic gold receipts, these are all eligible for indexation. Remember, I actually used the word highly volatile assets, but let us not use the word highly volatile assets. Better use the word assets covered under 112A. Let us use the word assets covered under 112A, where 112A taxation you are doing. Suppose if you are computing tax under 112A or 111A, listed equity shares, listed equity oriented mutual fund, units of business trust, for them you know indexation at all. And already remember, if you see 50AA just to be covered, you transfer of specified mutual funds, market linked debentures, depreciable assets. In all these cases, computation itself is in a different way. There the short term, the gain is always treated as short term. Yes or no? Depreciable assets 50-50A, units of specified linked mutual funds 50AA. Under them, if at all you are computing capital gains as per 50 series computations, entire 50 series computation, no indexation at all. If you are computing capital gains under 48 series or 46 or 46A, indexation is available. 50 series, if at all you are computing capital gains as per 50, 50A, 50AA, 50B, slump sale, no indexation facility at all. Able to understand? Thumb rule you can remember like this easily. Then sovereign gold bonds and SGBs, yes, obviously that's what I told here, eligible for indexation. Any other long-term capital asset like jewelry, land and building, archaeological collection, paintings, drawings, sculpture, all other types of land and all other types of capital assets which are not depreciable assets, where the computation is not as per section 50 series, which is not a debenture, which is not a bond, they are eligible for indexation. For example, listed preference shares, unlisted preference shares, unlisted equity shares, getting it, whether you call bonus shares, whether you call right shares, whether it is land and building, whether it is jewelry, they are all eligible for indexation. Don't remember what is eligible for indexation, remember what is not eligible. Simple. Bonds, debentures not eligible. Computing capital gains under 50, 50A, 50AA not eligible. Getting it? And 112A assets not eligible for indexation, because their capital gains computation will be done as per 112A special rate. 1.25 lakh is up to basic exemption is available, so no indexation at all. Are you clear? Tell me, the concept of indexation itself comes when, if the transfer is before 23rd July. What if the transfer is on or after 23rd July? What if the transfer is on or after 23rd July? Straight away, no indexation at all. If the transfer is on or after 23rd July, not at all eligible for indexation. Any asset, jewelry, land and building, preference shares, equity shares, doesn't matter. No indexation at all. If the transfer is on or after 23rd July. However, for an individual and HUF who is a resident in India, for him also indexation is not available. He sold land and building, which he purchased long ago, but sold after 23rd July. Sold on or after 23rd July. Still, when you are computing capital gains, you don't consider indexation. Compute without indexation capital gain. We have in our test your knowledge question, ICA book, question number 6. Wonderful question. Okay, so compute capital gain without indexation. Then finally, when you are computing tax rate, if at all the SS is a resident individual, resident HUF, he purchased this land and building long ago, before 23rd July, but sold on or after 23rd July, then we will give him an option to pay tax as per these two. 1. Compute tax liability at 20% on the long-term capital gain, where the gain amount has to be computed after considering indexation. Or on or after 23rd July, what is the long-term capital gain tax rate? 12.5%. Compute capital gain without indexation, which is what we did already. In the main problem solving, we always do without indexation. On that, apply 12.5% and see the SAT tax. Whichever is lower tax, that option you will decide and pay tax accordingly. Remember, this is only tax computation step. This is not to be done in the problem computation. Are you getting it? That's it. So that is what we have given here. So only for income computation purpose, capital gain shall be computed without indexation. However, for tax computation purpose, indexation option will be checked to pay tax in a beneficial manner. That's it. Okay, indexation, without indexation, all that is completed. Now remember, cost of acquisition. What is it? Cost of acquisition. Look at this format. What is this cost of acquisition, right? This cost of acquisition, sometimes this cost of acquisition has to be adjusted by. Sometimes this cost of acquisition has to be adjusted by forfeited amount. Sometimes the cost of acquisition has to be adjusted by forfeited amount. Very simple. See, generally, how do we compute capital gain, sir? Suppose I sold an asset for 10 crores, sir, minus cost of acquisition 5 crores, sir. From this cost, I should reduce forfeited amount. For example, forfeited amount 50 lakh. Balance cost is 4.5 crore. If at all this transfer is before 23rd July, this has to be indexed. Many students will do mistake if forfeiture point is given. What they do, they index on this. They do apply indexation on this and they reduce this from the indexed cost. No. If at all forfeiture of advance is there, you should reduce first that from actual cost or deemed cost, as the case may be. Then balance cost, see whether indexation available. When indexation is available on the balanced cost, if the transfer is before 23rd July, indexation is available. If the transfer is on or after 23rd July, no indexation is available. That's how you should compute. If at all indexation has to be computed, indexation has to be applied on balance cost of acquisition available after removing forfeiture. Sometimes from cost of acquisition, forfeited amount if you reduce, cost might become negative. That time you should make it 0. That time you should make it 0. Able to understand. That's it. Very rare, very extreme rare cases. Now, sir, what is forfeiture of advance? Forfeiture of advance is very simple. Forfeiture of advance. Suppose I decided to sell some property and I entered into agreement with other person. He paid me advance. As per the terms, no, within 1 month or 2 months, he need to get registration. After paying the balance money, he didn't pay. He violated the contract terms and conditions and he is not interested to buy anymore. Whatever advance he paid me, I will forfeit either in full or in part. Okay, I will forfeit. Forfeit means what? I made a profit. Forfeit means what? I received an advance to sell the asset, but I didn't sell the asset. Nothing happened to my asset, but I made a profit because of the forfeiture. Because of the forfeiture, I made some profit. Now, what should I do with this profit? This is a question. Forfeiture of advance is a profit to the SSE. What should we do? It depends upon when you forfeited. That's what I told at the beginning of the class. 4 dates. In that, one of the date is 1st April 2014. One of the date is 1st April 2014. When you forfeited, I forfeited before 1st April 2014. If so, that amount shall be reduced from cost of acquisition like this. That amount shall be reduced from cost of acquisition like this. When you are computing capital gains ultimately on the transfer of the said capital asset. Same capital asset subsequently some other time you will sell, right? That time when you are computing capital gain, cost of acquisition, don't immediately reduce it. See whether any forfeiture is there in the question. See the date of forfeiture. If it is before 1st April 2014, reduce that from the cost of acquisition. Balance cost, reduce it from the consideration to arrive capital gain computation. Indirectly, the forfeited amount is not taxed in the year of forfeiture. Forfeiture amount is taxed ultimately in the year in which the asset is actually sold. This is the tax treatment if the forfeiture amount is before 1st April 2014. What if the SSE forfeited on or after 1st April 2014? On or after 1st April 2014, if at all you forfeited, it should be straight away taxed as income from other sources. It is straight away taxable under income from other sources. Which year? In the year of forfeiture, which is what a right way of taxing it. Getting it? So, if the forfeiture is, if the amount is forfeited on or after 1st April 2014, it will be straight away taxable in other sources. That's it. This is about section 51. Forfeiture before 1/4/2014, 51 section apply. Forfeiture on or after 1/4/2014, 56 section apply. That's it. Clear? Then, so we understood what is cost of acquisition. We understood what is indexed cost of acquisition. All that. Then, what is a cost of improvement? Let us look at cost of improvement aspect also, and then we'll finish. What is cost of improvement? Remember, I purchased some land. I already told. Then I constructed a building. Then I constructed additional floor. Then I constructed additional floor. Any capital expenditure you spent. Remember, any capital expenditure you spent on the asset after purchase, that capital expenditure is called as what? Cost of improvement. Able to understand. And remember, cost of improvement before 1st April 2001, nil. Don't take it. If cost of improvement is before 1st April 2001, don't take it. Remember, at the introduction I told 4 dates. One of the date is 1st April 2001. What is 1st April 2001 significance? I will tell you now. So, cost of improvement incurred before 1st April 2001, nil. Sir, improvement cost is incurred by previous owner, sir. Improvement cost is incurred by previous owner. I didn't spend it. I got this asset from the previous owner as per 49 subsection 1 modes. Then cost of improvement in my hands will be same cost how much my previous owner spent. Cost of improvement. Suppose, sir, I incurred improvement cost on or after 2001, sir. Previous owner incurred or I incurred. Any of us would have incurred on or after 1st April 2001. Whenever you incur, whatever the cost, that itself is the cost of improvement. 2001, 1st April 2001. And if any cost of improvement is given in the question that is spent before 1st April 2001, you straight away ignore it. Remember? Same way, one point I need to clarify. Section 51, forfeiture of advance is there, right? Advance forfeited by previous owner, ignore. Advance forfeited by previous owner. Sometimes in the problem, previous owner information might be given. Advance forfeited, that is not taxable in the hands of the SSE. In the hands of the SSE, no tax treatment on that. That's it. Clear? So, then, what is the cost of improvement for goodwill intangible? Straight away, nil. What is cost of improvement? Cost of improvement does not include routine repairs and maintenance. Any expenditure which is deductible under other heads of income. Any expenditure where you are claiming deduction under other heads of income, whenever you incur that. That is not treated as cost of improvement. Cost of improvements means something that is capital expenditure where you have not claimed a deduction till date. Now you can claim that expenditure as a deduction at the time of computation of capital gains. That's it. That's about cost of improvement. Clear? Next, now let's discuss the actual main theme of the provision. Cost of acquisition. Remember, period of holding, cost of acquisition, 49.1. This modes we kept pending. If at all we discuss this and we discuss 46 and 46 here, and if we discuss 54 series and 50B, over. The chapter is over. Able to understand? Now, what is cost of acquisition? What is cost of acquisition? You know, there are some circumstances where cost of acquisition has to be determined. What are the circumstances? What is the cost of acquisition? 49 subsection 1. If the capital asset became the property of the SSE under, if the capital asset became property of the SSE under the following modes. If, you know, I didn't buy the capital asset, I didn't buy the asset. See, I am selling the asset now, right? In the problem, they'll give you some asset you sold. That asset, no, not purchased by me. That asset was given to me as gift. That asset was given to me under will. You know, by an individual or HUF. By the way, here you remove this 31st March. Okay, this 31st March not required. This actually, this 31st March is relevant for ESOP point. For this, it is not relevant. Okay, leave it. Getting it? Gift or will by whom? Individual or HUF. Remember, now I need to even cover 47 section also. Now I need to simultaneously cover 47 section also. You know, 45 subsection 1 is there, which is actually charging section. As per charging section, profits and gains arising on transfer of capital asset will be taxable in the year of transfer. So if you transfer any capital asset, when are you receiving money? Doesn't matter. Is there a profit on the transfer? Yes, that is taxable. In which year? Year of transfer. Now, what do you mean by transfer? There is a transfer definition which is given inclusive definition. That's not a big deal. What is capital asset? We will discuss. What is a capital asset? We will discuss. Now, you know what? Section 47 is there. There is a section called 47. Remember, 2 subsection 47 is transfer definition. 47 is exemptions from transfer. There is a logic between them. Getting it? There is a link. 2 subsection 47 is a transfer definition. 47 says which are not treated as transfer. What is not treated as transfer? There some list is given. Majority of that is copy pasted here also in 49 subsection 1. Getting it? Suppose, sir, I received a capital asset by gift or will from an individual or HUF, sir. From an individual or HUF, I got it as a gift. Or I got this asset in succession, inheritance, devolution. I got this asset on account of distribution, also not required. I got an asset on account of transfer to a revocable or irrevocable trust. I got this asset as a transfer between subsidiary company and holding company, 100% between them the relation, provided the transferring company is Indian company. Transfer of assets between amalgamation, transfer of assets between demerged company and resulting company. So these points are majorly enough. Mainly for us, individual taxation is what tested in exam. For us, mainly individual taxation is what majorly tested in capital gain. So individual related provisions alone, if you are strong at, that's more than enough. Getting it? Gift, succession, transfer of a irrevocable or irrevocable trust. These are all individual related provisions. If these 3 provisions, if you understand, that's enough. Sir, I got the capital asset as a gift, sir. I got it under will, succession, inheritance. Getting it? Now, what is the cost of acquisition? Because I didn't buy the asset. Cost of acquisition is cost to previous owner. What is it? Cost to previous owner. What is cost of acquisition? Cost of acquisition shall be cost of acquisition to previous owner. Your previous owner would have bought that, right, at some money. At what price he bought? That itself is treated as you purchased. That itself we treat it as you purchased it. Suppose, sir, my previous owner, no, he purchased it 95-96 year at 10 lakhs, sir. In 2007-2008, I got inherited. Now, and I sold this building in 2024-25, sir. I sold it in 2025. So let us assume cost of acquisition is 10 lakhs. Okay, there is a market value concept on 1/4/2001. Okay, let's ignore for the time being. Just look at the provision. I am talking mainly here indexation point. Into numerator, index number 2024-25, 360 numerator, denominator, when the asset is held 95-96. I told you, when the asset is purchased before 2001, 2002 index number you should take. But remember, you should take 7-8 index number. You should take what number? 7-8 index number. Why 7-8 index number? Because this is the year in which you got the ownership of the asset. This is the year in which you first held. Indexed cost of acquisition formula, cost of acquisition into CII of the year of transfer divided by CII of the year in which asset is first held by the SSE, or 2001 to whichever is later. Yes or no? But remember, all these cases are covered in another section, 2 subsection 42A. There is another section, 2 subsection 42A. What that section says, that is about period of holding. That section says period of holding. What that section says at the introduction will go. At the introduction of the chapter only it will be there. Yes, you see. If you remember, we already completed, nature of asset, long term or short term, how to decide long term, how to decide short term, yes or no, we already completed. So when an asset is treated as long term, when an asset is treated as short term, it depends upon period of holding. Period of holding means what? From when I got the asset, when I sold it. That gap, if it is up to 12 months, it's a short term. If it is up to 24 months, it's a short term. In case of before amendment, up to 36 months logic is also there. Then also it's a short term. Suppose if the holding period is more than 12, more than 24, more than 36, as the case may be, then it's a long term. And remember, after amendment, we have only 2 criteria: 12 months, 24 months. That's it. Beyond 12 months, it's a long term. Beyond 24 months, it's a short term. Now, what are the assets considered for long term? Listed securities, units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. Any other assets, 24 months is the criteria. Correct? Now, when you're determining, when you are computing period of holding, generally period of holding will be considered from date on which I acquired the asset till the date on which I sold it. But there are some cases where previous owner holding period will be considered. Previous asset holding period will also be considered. What is previous owner holding period? Previous asset holding period. Both will be considered. Now, look at this. For example, assets became property of the SSE. Asset became property of the SSE by 49(1). 49(1) means what? Gift, will, inheritance, succession, succession, inheritance, conversion of HF property into individual property. In all these cases, 49 subsection 1. Getting it? I will once again repeat in 47. In 47, we will get the same points once again. If at all you are getting asset into your hand by you are not purchasing. Somebody purchased and you received the asset as an inheritance, as a gift, as a will. Then previous owner holding period shall also be considered. Very simple. My father purchased asset in 2023-24. Some land he purchased. In 2024-25, I inherited. What is it? I inherited. And I sold the land immediately. Now, don't say the gap is less than 24 months. Because you inherited when 24-25. Very simple. Very simple. For example, my father purchased the land on 1st October 2022. Okay, he purchased a land. So, who purchased it? The previous owner, father purchased. Later, on 30th March 2025, 30th March 2025, it was gifted to me, and on the same day I sold. On the same day I sold to somebody else. Now, what is the holding period for me? Asset when I got 30th March. On the same day I sold. Means one day only I am owner. One day only I am owner. It's a short term. No, you should not compute like this. Since you got it as a gift, inheritance, succession like that, when previous owner purchased 1st October, from the date till the date you sold, from the date when your previous owner purchased till the date when you sold, this period is considered as period of holding by you. This period is considered as period of holding by you. Are you getting it? Now, he purchased in 1st October 2022 and I inherited on 30th March and I sold it on 30th March. Let us assume inheritance, this is sale date. This is sale date. I inherited on 30th January, let us assume. I inherited on 30th January. I sold it on when? 30th March. Generally, period of holding means what? When I got the asset, 30th January. When I sold it, 30th March. The holding period is 2 months. Since it is less than 24 months. Since it is less than 24, we naturally think what? It's a short-term capital asset. Wrong. This is not how you should do. Generally, period of holding means these 2 dates only. That is correct. Suppose on 30th Jan only I purchased the land. Then I sold on 30th March. Period of holding is 2 months. Perfect. But you didn't purchase it. You got it as a gift, you got it as a will, you got it as an inheritance, you got it as succession, which is covered under 49 subsection 1, which is covered under 49 subsection 1. Then what is cost of acquisition? Cost to previous owner. My father purchased it at 10 lakhs. What is period of holding? Don't compute it from when you purchased it, when you got it. Compute it from when your previous owner purchased. Remember, you didn't buy, you just got it as a succession, you just got it as an inheritance, you just got it as a gift. Getting it? When they bought, 1st October they bought. So from 1st October 2022 to ultimately when you sold 30th March 2025, what is the time period? More than 24 months. Therefore, it's a long-term capital asset. Therefore, it is a long-term capital asset. Able to understand? Therefore, it is a long-term capital asset. Now, since it's a long-term capital asset, when you are computing capital gains, indexation is available, right? When you are computing capital gains, indexation is available, right? If at all indexation is available, if at all indexation is available. Cost of acquisition is what? Cost to previous owner. My father purchased it 10 lakhs. So cost to previous owner into numerator, index number of year of transfer, in which year you transferred, 24-25, 363. Denominator, in the year, index number of the year in which first held by the SSE. Array, I also got this as inheritance in 24-25 only, 363 only I'll put. New denominator also what number I'll put? 363. Therefore 10 lakhs only indexed cost. However, Manjula Jesha High Court, there is a court case called Manjula Jesha Bombay High Court case. What that case is, you know, when you are considering holding period, when the previous owner purchased, that year onwards you are considering, right? Then why can't indexation be claimed from that year? That's a logic. Where the High Court says it is absolutely logical. Where the High Court says it is absolutely logical. 10 lakhs multiplied by 363, the year in which you sold the asset. Denominator, from when we are computing period of holding for you, 2022-23 onwards. In this example, in our example, 2022-23 onwards, we are considering period of holding. From that year onwards, you should consider indexation. So 2022-23 index number, whatever is there, put that index number. This should be given as an alternative answer in your exam. In your exam, don't write this as a main answer. Write it as an alternative answer. Must and should you should write. In the note point, I told right how to present the capital gain problem. In the note point, cost of acquisition. Alternatively, indexation can be claimed from the year in which previous owner acquired the asset or 2001 to whichever is later. Yes or no? When the previous owner acquired, as per Manjula Jesha Bombay High Court judgment. Understood or not? Everybody? That's it. Now, so if at all asset became property of the SSE under 49(1), previous owner holding period, cost shall also be cost to previous owner. Suppose I purchased it, sir, I didn't get it from anybody, I earned hard-earned money, I purchased it. Then when you purchased, from that date only holding period, whatever the cost you paid, that is only cost of acquisition. Simple, able to understand. Next, sir, inventory is converted into capital asset. Remember, it's not vice versa. Capital asset is converted into inventory. No, not that. I'll do one thing. I will discuss this at a time at 45 subsection 2. I will directly discuss at a time at 45 subsection 2, because conversion of capital asset into inventory, how to tax it. Conversion of inventory to capital asset, what's the tax treatment? Both I will discuss at a time. Yes or no? Now, shares, financial assets. Right shares, bonus shares means what, you know? I directly got from the company. See, when I purchase in open market, is it called as a bonus share? When I purchase in the open market, is it called as a bonus share? Secondary market? When I purchase in secondary market any right share, is it called as a right share? No. When the word bonus and right will used in the before a share, only when it is directly allotted by company. If shares are allotted by the company directly to me, period of holding will be considered from date of allotment. Same way, specified security, sweat equity shares, we will consider only from the date of allotment. Right renouncement. What is a right renouncement? I'll do one thing. Right renouncement, right shares, bonus shares, cost of acquisition, holding period, both I will discuss. At cost of acquisition, 55 section is there, right? Special circumstances cost, there we will discuss. Okay, then electronic gold receipts, conversion of gold into EGR, conversion of EGR back into gold. In all these cases, period of holding of gold, period of holding of EGR, both will be considered. So what is this EGR taxation? Very simple. Okay, suppose I have a physical gold. Mr. Ram is having something called physical gold. He converted this into electronic gold receipt. This gold was purchased by him on 1st January 2020. He purchased it on 1st January 2020, and he converted into EGR on 2nd February 2023. He converted into EGR on 2nd February 2023. Now this EGR is sold. This EGR is sold. Let us assume on 4th August 2024. 4th August 20. Let us apply 4th July. Better. Let's apply 4th July. It was sold on when? 4th July. Now 4th July I sold EGR at 20 crore. You know, at the time I purchased it was 5 crore. At the time when I purchased the gold it was 5 crore. At the time when I sold this EGR it is 20 crore. Now what I sold actually EGR. What is the full value of consideration? 20 crore EGR minus what is the cost of acquisition? Cost of acquisition of EGR is nothing but cost of acquisition of gold, which is 5 crore. Now you got a capital gain which is 15 crore. But you should not do like this. First you should see when the transfer date. Transfer date is on 4th July. The transfer date is on 4th July. 4th July means CII of the year of transfer divided by CII of year of acquisition of EGR. Acquisition of EGR. Remember, you know now how you acquired this EGR? Because you have a gold. Gold is converted into EGR. Able to understand? Now whether this EGR is a long-term asset or short-term asset. By the way, what is the criteria applicable for EGR? Before amendment 36 months. After amendment 24 months. Before amendment is 36 months. After amendment 24 months criteria is applicable. Now sir, I got this EGR in 2023 February. I sold it in July 2024. Less than 24 months. Less than 24 or less than 36. Short term. No. When you are computing EGR holding period, gold holding period also should be considered. That's what, you know, conversion of gold into EGR include the period for which such gold was held prior to conversion into EGR. When I purchased this gold actually 1st January 2020, I sold ultimately EGR when 4th July. The gap, if you see, more than 36 months. More than 36 months because the transfer happened before amendment date. Because transfer happened before, in this example transfer happened before 23rd July. Therefore 36 months is the criteria. More than 36 months is a long term. So accordingly indexation is available. CII of year of transfer 24-25 and CII of the year in which asset is first held by the SSC. EGR is purchased when 22-23. 22-23 number you should put. But as per Manjula Jesha case you can put 19-20 number. As per Manjula Jesha case you can put 19-20 number also. Are you clear? All of you. Now sir, EGR I sold, right? Somebody else purchased EGR, sir. Somebody else purchased EGR. When I sold EGR, actually I sold EGR to, you know, some beam. I sold EGR to beam. When I sold 4th July, I sold, sir. 4th July 2024, beam purchased this. Yes or no? Now he went and redeemed the EGR with the gold. He went and redeemed the EGR with gold. You know when he redeemed, you know, 10th August 2026. He redeemed it on 10th August 2026. And remember, conversion of EGR into gold is not a transfer. It's not liable for capital gains tax. Conversion of EGR into gold is not a transfer. You're not getting any money. You're just converting. EGR is a digital gold. You're now converting into a physical gold. That is not taxable. Now, you converted into gold, right? You converted into gold. Who? Beam converted into gold. He purchased EGR from RAM and later converted in 2026 August into gold. Able to understand? Now this gold he ultimately sold on 1st April 2027. He ultimately sold it on 1st April 2027 or else 1st April 2028 he sold it on. 1st April 2028 he sold at what price? You know, 30 crore. You know, when he purchased, you know, he purchased at 10 crore. He purchased at what price? 10 crore from RAM. Later he converted into gold. At the time when they converted into gold, no, that time market value of the gold is what, you know, 15 crore. They will give you all this information in exam, but you should avoid it. Conversion of EGR into gold is not a transfer. This gold ultimately sold at what price? 30 crore. Now beam has to compute capital gains. Full value of consideration 30 crore minus cost of acquisition. He purchased at 10 crore, right? 10 crore. Is indexation available? Yes. Since no, indexation is not available. Indexation is not available. Why? He sold it when? He sold when the gold? 1st April 2028. Since the gold is sold after 23rd July 2024, indexation is not available. Moreover, what is the criteria for deciding this holding period? Long term or short term? 36 months or 24 months? 24 months. Because the transfer is happened on or after 23rd July. Remember, criteria for deciding long term, short term is not the purchase date, but the sale date. When the asset is sold, accordingly the logic has to be applied. Accordingly the criteria has to be applied. If the sale is before 23rd July, 36 months logic. If the sale is on or after 23rd July, 24 months logic. Able to understand. That's it. Easier taxation is also over. Easy. That's it. Now, there are some transactions which are not treated as transfer. There are some transactions which are not treated as transfer. What are they? Important points I'll cover. Any transfer of capital asset. By whom? Individual and HUF under a gift, will or irrevocable trust is exempted. This is an important amendment. This is an important amendment which is applicable for the first time from 24-25 previous year onwards, which is applicable for the first time on May 25 exams, September 25 or Jan 26. Getting it? Earlier, transfer of capital asset by gift by any person is exempted, but now gift given only by individual and HUF is exempted. Gift given only by individual and HUF is exempted. Before amendment, gift given of ESOPs, that is fully taxable. Suppose an employee is there, he got ESOP securities from the company. When he was allotted ESOP, at the time of allotment itself, it was taxable for him, right? At the time of allotment itself, it was taxable for him under income from salary. Market value on the date of exercising the option is the value which is considered for valuation of perquisite. Getting it? That itself is treated as cost of acquisition for him. Now later, when he gifted to somebody or sold to somebody, doesn't matter, gift or sale or doesn't matter, ESOP gifting is taxable. Normally, if you gift any asset, not taxable. It is not a transfer. But if you are gifting ESOP, which you got from company, if you are gifting it to somebody, it is taxable in the year of gift itself. Now, that gift taxing, ESOP gift taxing is there, right? It is removed now. It is removed now. Very simple. Transfer of ESOP under gift will is treated as transfer up to assessment year, nothing but up to 31st March 2024. It is treated as transfer up to 31st March 2024. Which one? ESOP gift is transfer. But if at all ESOP is gifted by you on or after 1st April 2024, and if you are individual and HUF, you are gifting ESOP securities which you got, still it is main provision only will apply. So you are just gifting a capital asset, you are an individual, you are a HUF, you are gifting something called capital asset on or after 1/4/2024, fully exempted, not at all taxable. Subsequently, the person who got the gift, right, he sold it. Then what is cost of acquisition for him? Cost to me. Cost to me is what? In case of ESOP, market value considered at the time of perquisite valuation, or the asset at which I purchased it. Able to understand? That's it. So gift provision has been changed. Under capital gain, gift transfers has been changed. Any gift from 1st April 2024 is exempted only if the gift is made by individual or HUF. Exemption also includes ESOP gifting. Before 1st April 2024, gift by anybody is exempted. However, gift by employee of ESOP and specified security is taxable if the gift is before 1st April 2024. Understood summary or not? That's it. Then these are all amalgamation subsidiary companies not required. In our regular class we detailedly discuss. That is more than enough. Next one, redemption of sovereign gold bonds is exempt. Redemption of sovereign gold bonds is exempted. But anyhow, this I will discuss when I'm discussing capital asset definition. Capital asset definition, unlike generally we can start discussion with capital asset definition, but we didn't do that. We will discuss it last, because in revision, this is how the technique. In revision, what is the main focus on? Main focus is on understanding the entire application of the capital gains, understanding how to solve the problem, all that. Later on, this capital asset, what is capital asset, what is transfer, this and all nothing, because this everybody will understand. Point what they don't understand is holding period of holding to be how to consider, cost of how to consider, how to apply indexation, transfer date is when, before 23rd, after 23rd. This is where many will confuse. Able to understand? That's it. And you remember, conversion of gold into EGR and vice versa, both are treated as exempted transfers. Yes or no? Next, transfer of capital asset under reverse mortgage. What is reverse mortgage? I think I'm not explaining it. Getting it? Here one important point. If you are transferring a house under reverse mortgage to a financer, housing finance company or bank, whatever, the transfer is exempted. Further, when you transfer house under reverse mortgage, you get monthly sum amount or you get a lump sum amount under reverse mortgage. That entire loan amount received is also exempt from tax. Simple. Next. Now again, come back to cost of acquisition. Now let's come back to cost of acquisition. Cost of acquisition in specified circumstances. Cost of acquisition in specified circumstances. Now you remember ESOP, cost of acquisition of specified securities or sweat equity shares which are referred under 17 subsection 2. 17 subsection 2 is talking about perquisite valuation. If an employee got ESOP or specified security under employee from the employer, now that asset later he sold it. What is the cost of this asset? At the time when you got allotment, no, perquisite valuation purpose, market value will be considered, right? That itself is cost of equity. The market value used for perquisite valuation. That's it. Now, sometimes no, shares and debentures is what you purchase. Later it will be converted into some deposit certificates or some other share. Then new asset cost of acquisition is what? Old asset before conversion, what is the cost? That one only. Same way, cost of acquisition of equity shares received on conversion of preference shares. Now you are selling equity shares, but I didn't buy this equity share. I actually bought preference share. Then cost of acquisition will be preference share. Holding period also will be considered from the date of purchase of preference shares. Yes or no? Then this one we understood. Amalgamation, demerger, resulting company points not required. From exam point of view, not that important, but read it. Once you read it, okay, in revision I'm not covering because there is much more valuable important content which I'm going to cover. Next, we already discussed enough in depth on regular class. In amalgamation, all these points we discussed enough in regular class. Next, now coming to cost of acquisition of property which is taxed under 56 subsection 2. Cost of acquisition of property which is taxed under 56 subsection 2. Very simple. Sir, I sold a land and building. I sold a land and building at 20 crore. Okay. How I got this land and building, you know? There are two methods. One, I got it as gift. Gift from relative. Gift from relative. Or I got it as a gift from taxable sources. From taxable. Sir, what is a gift from taxable source? Gift from relative is a non-taxable gift. Gift from anybody else is a taxable gift. Suppose no, I got it as a gift from my relative. That is exempt for me under other sources. This is covered under 49 subsection 1 for the purpose of capital gains. Whereas if I am receiving gift from somebody else, if I am receiving gift from somebody, 49 subsection 4 is applicable. What is applicable? 49 subsection 4 is applicable. What is this? Generally, I got an asset as a gift and I sold it later. Generally, what is cost of acquisition? You immediately say cost to previous owner. When you should apply cost to previous owner? I received this gift, right? That time it is exempt for me. That time it is exempt for me. Even the previous owner also, for a previous owner also, it is not taxable when he is gifting me because it is covered for him under transfer. For him it is exempted and for me it is exempted, both. I'm receiving the gift which is exempted. Later I'm selling it. That time, what is the cost of acquisition? Cost to previous owner. Suppose, look at this situation. I got gift from my friend or from somebody. I got from somebody, not a relative. That is fully taxable for him, for me. That is fully taxable for me. How much is taxable? Either stamp duty value or fair market value on the date of gift, which we will discuss in gift provisions. That much is taxed for me in other sources. 56 subsection 2. When it is taxed, you know, whenever I got the gift, it is fully taxed for me as income. Now that land, I am selling it to somebody. What is the cost of acquisition? Not cost to previous owner. It is not cost to previous owner. Cost of acquisition will be when I got the gift, how much income is taxed for me? That income is treated as not even income. The value considered for calculating income under other sources. It is similar to perquisite. It is similar to ESOP perquisite is there, right? Market value considered at the time of employment, at the time of allotment. Similar way, what is the market value of the capital asset considered? What is the stamp duty value of the capital asset considered when you received the gift? For taxation of gift under 56 subsection 2 clause number 10. That value is cost of acquisition. When the gift I received, you know, that is taxable for me at the time when I received. Suppose when I received the gift, that time it is exempt for me. That gift is covered under 49(1) mode. Gift which I received is taxable for me. That gift is covered under 49 subsection 4. Many will confuse. In problem, suppose they gave you in 2021-22, a friend he gave you a gift. That time stamp duty value is, let us assume 1 crore. He purchased at 10 lakh. And the same gift now you received, right? 24-25, you sold it for 5 crore. 99.99% student, full value of consideration 5 crore minus cost of acquisition, cost to previous owner 10 lakh they'll put. Wrong. Cost to previous owner is what? 1 crore. Why? At the time when my friend gifted me, the value of the gift is 1 crore. So that's it. Because no, since I received from my friend, that time it is taxable for me. That time it is taxable. And remember, if a gift received is under 49 subsection 4, previous owner holding period we will not consider. We will consider only from the date on which I received the gift holding period to decide whether the asset is a long term or short term. This is gift provision. Once again, watch it later. You will understand. Okay. Repeat mode. You watch it once again. You repeat it the video. You repeat the video. You will get it for sure. Absolutely. Next. Next. Cost of acquisition of inventory. All this I will come back to it. Okay. Then what is cost of acquisition of various assets under various circumstances? Sir, intangibles, straight away cost of acquisition shall be purchase price. If it is self-generated, straight away nil. Sir, I acquired the asset under 49 subsection 1, sir. Then cost of acquisition will be cost to previous owner. Suppose if previous owner cost you are unable to ascertain when he acquired this asset, check it out. That time market value, take it, which is very rare, not that important. That note point is getting it. Then sir, financial assets, sir. Let's talk about financial assets. What is the cost of acquisition? Original shares, which I directly bought from the company in IPO. Cost of acquisition is amount paid to the company. Right shares, sir. I directly paid to the company. Amount paid to the company. Bonus shares allotted, sir. Cost is nil. However, if the bonus shares are allotted before 1st April 2001, then cost of acquisition will be fair market value on 1st April 2001 or actual cost, which is nil, whichever is higher. So naturally, what will come? Market value. See, here there is a thumb rule in capital gains. If any capital asset is purchased by you or purchased by previous owner as referred under 49 subsection 1, if at all they acquired this asset before 1st April 2001, cost of acquisition is equal to actual cost at which they purchased before 2001 or market value on 1st April 2001, whichever is higher you can take. That benefit is given. That's a benefit. So cost of acquisition is equal to actual cost to the previous owner before 1st April 2001 purchased or market value on 1/4/2001, whichever is higher. Suppose you purchased, previous owner himself purchased in 2003 for after 1/4/2001, or you purchased it in after 2001, market value on 1/4/2001 is to be ignored. Market value has to be ignored. Further, suppose if it is a land and building, you purchased a land and building before 1/4/2001. Previous owner purchased a land and building before 1/4/2001. Whoever it is purchased, it's a land and building. What is the cost of acquisition for land and building? You see here, cost of acquisition for land and building is what? Cost of acquisition shall be, you see, cost of acquisition shall be market value on 1/4/2001 subject to maximum of stamp duty value as on 1/4/2001. So actual cost or FMV on 1/4/2001, whichever is higher you take, but it is restricted to stamp duty value on 1/4/2001 directly. Immovable property only stamp duty value maximum limit is there. Remaining all other assets, what is cost of acquisition, how much you paid, or market value on 1/4/2001, whichever is higher, you can take that. Getting it? Other land and building. Other land and building means what? See, if land and building is acquired before 2001, that land and building. Others means what? Acquired on or after 2001. Actual cost. Cost of acquisition shall be actual cost. Whether you purchase or previous owner purchase or whatever it is, actual cost. Are you clear? Next. Bonus shares. Okay. So generally bonus shares cost is what? Nil. But if bonus shares are allotted before 1/4/2001, as I already told, general rule cost 0 or market value on for 1/4/2001, whichever is higher. That's it. And remember, since we are considering cost of acquisition itself is market value on 1/4/2001 of the asset, any improvement incurred before 1/4/2001 we are ignoring. Why are we ignoring improvement cost before 1/4/2001? Very simple. We are directly taking market value of the asset itself. Full asset market value we are taking on 1st April 2001. Full asset includes what? Improvement cost which is already incurred. So improvement expenditure before 1/4/2001 shall be ignored. Cost of acquisition, if asset is acquired before 1/4/2001 by you or previous owner, cost of acquisition shall be actual cost or market value, whichever is higher. Any asset it might be, but not for intangibles, not for depreciable. Intangible assets 1/4/2001 benefit is not there. Depreciable assets 1/4/2001 benefit is not there, because depreciable assets we go computation of capital gains as per block of asset. Are you getting it? 1/4/2001 benefit is not available if at all you are computing capital gains under 50 series. 1/4/2001 benefit is available if you are computing capital gain under 48, 46, 46A. Able to understand? That's it. Sir, what about bonus shares cost of acquisition? I already told bonus shares cost of acquisition is always 0. However, there is another date which is very important. Before 1st February 2018 or 31st January 2018, where a landmark amendment happened. Now you know 112A section, right? In that, what are there? Listed equity shares, listed equity oriented mutual funds, units of business trust, correct? Listed equity shares, equity oriented units of business trust, yes or no? You know, all these assets, no, once upon a time, if they are long term, capital gain is exempted fully under 10 subsection 38. Once upon a time, capital gain is fully exempt under 10 subsection 38. What if I am a shareholder? Listed shares I have, bonus, non-bonus, forget about it. Listed shares I have. I thought I bought it with a view to get an exemption. If it's a long term, capital gain is fully exempted. But suddenly in 2018, Finance Act 2018, what it says, with effect from 1st April 2018, with effect from 1st April 2018, 112A section is applicable. Capital gain is taxable at 10% that time. Right now, capital gain taxable at 112A is what rate? 12.5%. If the asset is transferred on or after 23rd July 2024, correct? So that time exemption is there. Suddenly exemption is withdrawn. Now everybody got furious. How come you can withdraw the assumption? Long-term capital gain is exempted. On that assumption only I bought the shares in the Indian company. Otherwise I would have not bought. All that they started arguing. So what the finance minister said, what the income tax department did, what the income tax act has been done. Don't worry. As on 31st March, sorry. As on 31st January 2018, see, from 1st February, exemption is not there. 112A section is applicable. As on 31st January, whatever market value is there, take it as cost of acquisition. Happy? Take it as cost of acquisition as on the market value. See, if at all you sold it before, on or before 31st January, if at all you sold it on or before 31st January, entire amount you got is exempt, right? Whatever market value there on 31st January, take it as cost. Indirectly, am I giving exemption or not? Indirectly, am I giving exemption? Take it as cost. You sold it later at 20 crore. Market value on 31st January of the bonus share is 10 crore. Take it as cost. 10 crore only tax me. Indirectly, what am I saying? After 31st January, any appreciation in the market value, that only I will tax it. Up to 31st January, any market value appreciation, I will not tax you. Correct? Yes or no? So, what is the cost of acquisition of any share? Not necessarily bonus share, I'm telling you here. Any share, including bonus shares. What is the cost of acquisition? The cost of acquisition will be actual cost. For bonus, it is nil. Or market value on 1/4/2001. Getting it? If at all the shares were allotted before 2001, consider that. Compare that with market value on 31st January 2018 or actual consideration, whichever is lower. Getting it? So this second point you compute, first point you compute, whichever is higher. That will be taken as cost of acquisition. Whether it is a bonus share or listed equity share, doesn't matter. Suppose you see listed equity share, equity oriented mutual funds, units of business trust, which are acquired before 1st February 2018. Cost of acquisition will be what? Higher of 1 or 2. Here actually nil accidentally printed. Leave it. Okay? Because you acquired it. Getting it? If it is bonus, nil will be there. If it is other shares, purchased one, purchase value will be there. Actual cost, market value on 1/4/2001. 2001 logic is applicable when if the asset is purchased before 1/4/2001. So whichever is higher, between these two, whichever is higher, you take that amount, compare that amount with market value on 31st January or consideration, whichever is lower. Able to understand. See, consideration, actual consideration means what? Suppose in 24-25 you are selling it. At what price you are selling? That consideration you should take. That consideration you should take. Able to understand. Now this consideration or step 1, whichever is higher. That's it. So minimum cost, how much they are giving? Minimum cost they are giving how much? You know, market value on 31st January. Indirectly by giving market value benefit, what are they telling you indirectly? Take that much exemption. Able to understand. All of you? That's it. Then capital asset received on distribution under liquidation. This I will discuss along with liquidation. 46 section is there, right? That time I will discuss. Sir, any other capital asset, sir? I purchased it before 1st April 2001 or previous owner purchased it before 1st April. Very simple. Cost of acquisition shall be higher of actual cost, market value as on 1/4. That's why for bonus shares, anyhow, cost of acquisition is nil, right? Nil or FMV means FMV. Are you getting it? That's it. Then cost of the property in the hands of the previous owner cannot be determined. That's okay, not required. Already we covered this. Okay, not required. That's it. Cost of acquisition provision is over. Now remember 31st January fair market value. What do you mean by fair market value? As on 31st March, if it's a trading day for the share, Share is trading on a stock exchange, then highest price whatever is there on the date. Suppose on 31st January that share is not traded, or stock market is holiday on the day, highest price on the preceding day. What if it is a unit, not a listed share, but it is a unit? Net asset value on the date of transfer. Net asset value on the date of transfer. That's it. Okay. To that extent, it is more than sufficient. This understanding is sufficient for cost of acquisition, cost of improvement, all that able to understand. That's it. So with this, cost of acquisition is predominantly covered, period of holding is predominantly covered, cost of improvement is also predominantly covered. Clear, all of you? Yes. Just 1 minute. Yes. Let's continue. Now we are discussing now 45 section. Let's cover 45 section. You know, generally charging we have in 45 these sections. 45 subsection 1, which is what? Charging section. 45 subsection 1A, which is actually destruction, demolition, yes or no, that one. 45 subsection 2, conversion of capital asset into stock in trade. 45 subsection 5, compulsory acquisition of capital asset. Then apart from that, we have 2 more cases, 46 and 46A. Correct? Once we cover all this, then we will think of, we will discuss about exemptions under capital gains. Okay, 54 series. Now, 45 subsection 1. What is 45 subsection 1? Any profits and gains arising on transfer of capital asset is exempt. Sorry. Any profits and gains arising on transfer of capital asset is liable for capital gains in the year of transfer. Whereas 45 subsection 1 says what, you know, suppose my capital asset got destroyed. My capital asset got destroyed and I received compensation from insurance company. I received compensation from insurance company. You know, my asset got destroyed in when, you know, 22-23. Year of destruction is what? 22-23. And that is to be treated as year of transfer. That shall be treated as year of transfer. But you know what? Insurance company paid me compensation only in 24-25. Insurance company paid me compensation only in 24-25. When I will compute capital gains, 24-25 I will compute. We will compute capital gains in 24-25. So previous year 24-25 we will compute capital gains. Full value of consideration is equal to amount received. Full value of consideration is equal to amount received, this much. Okay, minus cost of acquisition. Since remember, destruction happened in 22-23. Year of year of transfer is before 23rd July. Nothing but indexation is available. Correct? Cost of acquisition into CII of year of destruction. Correct? Because year of transfer is treated as year of destruction. Denominator CII of year in which first held by the SSC. Year in which first held by the SSC. So that much. Able to understand? So this is how you should compute capital gains in case if you are receiving any compensation from insurance company on destruction of capital asset. Then 45 subsection 2. 45 subsection 2. Conversion of capital asset into stock in trade. Conversion of capital asset into stock in trade. What is the tax treatment for conversion of capital asset into stock in trade? Remember, we are converting capital asset into stock in trade, not stock in trade into capital asset. First, let's look at this scenario. If you are converting stock in trade into capital asset, it is treated as sale in PGBP. It is treated as sale in PGBP. It is treated as sale. Suppose I purchased this stock in trade. Whenever I purchase doesn't matter. But I converted on 10th August 2022. I converted into capital asset. In 22-23 previous year, in 22-23 previous year, market value on conversion is there, right? That is treated as sale value under PGBP. Charging section 28 itself says that market value of inventory converted into stock in trade on the date of conversion is straight away treated as sale value in PGBP. No, very good. Sir, you converted in which year? 10th August. Now I sold it, sir. I sold it. You know, when I sold it, 5th December 2024, I sold this. 5th December 2024, I sold this. By the way, what is this? It's actually jewelry. It's actually jewelry. Originally it is inventory. Now converted into capital asset. Finally it is sold when? 5th December. Now holding period shall be computed. Holding period shall be considered from the date of conversion. Holding period shall be considered from the date of conversion because the jewelry became capital asset for the first time only on 10th August 2022. So only from 10th August 2022 till 5th December 2024, gap is more than 24 months because I am selling when 5th December. Capital asset is sold on 5th December 2024. Asset is transferred on or after 23rd July. So the criteria is what? 24 months. What if the asset is transferred before 5th July? Then the criteria is 36 months. If the holding period is less than 36, it's a short term. Otherwise, it's a long term. But since the jewelry is sold on 5th December, which is on or after 23rd July, 24 months is the criteria. I got this on 10th August, sold it on 5th December, more than 24 months. Therefore, it is a long term. Yes or no? Full value of consideration. I sold it at 5 crore. At the time of conversion, it is 2.5 crore minus cost of acquisition 2.5. Indexation is not available in this example. Because transfer is on or after 23rd July. Straight away balance 2.5 is long term capital gain, which is straight away taxable at 12.5%. Correct? Why indexation? I transferred it on 5th December 2024. That is only for immovable property. Okay. So for immovable property, option scheme is there. For others, it is not there. Only for immovable property, individual or HUF only. At the time of tax computation, option scheme is there. For any other assets, no option scheme. Yes or no? Straight away, no indexation. That's it. So this is regarding inventory converted into capital asset. Now the question is, capital asset is converted into stock in trade. This is what covered in 45 subsection 2. I purchased this asset in 2000. I purchased this asset when I purchased this asset in same dates. Let us take. I purchased this asset on 25th September 2022. I purchased this asset on 25th September, not September. Let us take April. Better. Let us take April, 25th April 2022, I purchased. I converted this. 2021, I will take better. 2021. I converted this into stock in trade on 30th June 2023. 30th June 2023, I converted it into stock in trade. Okay. Remember, this is also jewelry only. Year of transfer is what? Date of transfer is what? 30th June, because that is the date on which capital asset lost its identity. Capital asset lost its identity when 30th June. So date of conversion is 25th April to 30th June. Getting it? So year of transfer is what? 23-24. Year of conversion is also 23-24, but that year it is not taxable. As per 45 subsection 2, conversion of capital asset into stock in trade is not taxable in conversion year. You know what? I sold this stock in trade. Ultimately in 24-25. Remember, what I sold is stock in trade. Directly PGBP head of income is applicable. At what price I sold? 10 crore. Sir, what is its cost? Sir, purchase price is what, sir, in business? What is the purchase price, sir, to compute business profit? Very simple. On conversion date, what is the market value? On conversion date, what is the market value? Market value is equal to, that time it is 5 crore. Market value on conversion date is how much? 5 crore. That itself is treated as purchase cost in accounting. Business. Balance 5 crore is business or profession related income, PGBP. Not only that. Remember, capital gains you didn't compute. You purchased this at 1 crore only. Ultimately you sold it at 10 crore. Actually total profit is what? 9. How much you taxed in PGBP? 5. Remaining 4 should be taxed where? Capital gains. How it should be taxed? In capital gains, full value of consideration is equal to fair market value on date of conversion. What is market value on date of conversion? 5 crore. When the conversion happened? 23 or 24 or 23-24. When the conversion happened? 23-24. But you should compute capital gains in which year? 24-25, because 24-25 is the year in which stock in trade is ultimately sold. Conversion of capital asset into stock in trade is not taxable in the year of conversion, but taxable in the year in which stock in trade is ultimately sold. That is most important. But remember, conversion of stock in trade into capital asset, when the capital asset is sold, is not relevant. Conversion area itself, PGBP income will be computed. Whereas conversion of capital asset into stock in trade, year of sale, only in the year of sale of stock in trade, capital gains are also computed. There is a difference here. Yes or no? Now 5 crore minus, sir, what is the cost of acquisition? This I purchased at 1 crore, balance 4 crore is capital gain. And remember, you converted in 23-24. Since the conversion is in 23-24, date of transfer is in 23-24, before 23rd July. Before 23rd July means, jewelry means 36 months is the criteria. From purchase date to conversion date, if the gap is more than 36 months, then it's a long term. If it's a long term, indexation is available. If it is not a long term, indexation is not available, because date of transfer means what? In this case, date of conversion, date of destruction, date of compulsory acquisition. Computation you might be doing in 24-25. When you are doing computation is not relevant. Date of transfer is relevant for indexation. Date of transfer is relevant for, date of transfer is relevant for determining whether asset is a long term or short term or period of holding, all that. Yes or no? That's it. Then 45 subsection 5, compulsory acquisition of capital asset. Compulsory acquisition of capital asset. Compulsory, for example, no, in 22-23 previous year, central government acquired my property under compulsory acquisition, either under law or by central government or by even RBI. Because of some reason, compulsory acquisition happened. Because of some reason, compulsory acquisition happened. When happened? It is 22-23. Okay, you know how much compensation decided? 100 crore they decided. My compensation, how much is decided? 100 crore. You know, I purchased this asset in 2019, 2020, I purchased. This asset is purchased by me when? 2019, 2020. I purchased this at 20 crore. I purchased this at 20 crore. Government compulsorily acquired it 22-23. Compulsory acquisition is a transfer. How much is the full value of consideration? 100 crore. How much is the cost of acquisition? 20. Capital gain is what? 80. I will talk about indexation, don't worry. So 80 is the capital gain. When this computation we shall do? This computation we shall do when this 100 crore is released to me. Actually, this 100 crore is released to me when 24-25. It is released to me when 24-25, which means capital gains tax I will not do in 22-23. I will do capital gains computation in 24-25. I will do capital gain computation in 24-25. Getting it? So in 24-25 we will compute. But remember, date of transfer is 22-23. Before 23rd July 2024, before 23rd July 2024, for that asset, whether it's a long term or short term, it depends on 12, 24, 36. Accordingly, is it long term or short term, you decide. If it is a long term, indexation is also available. Index number in the numerator, 22-23 number you should put. Cost of acquisition, all that as usually whatever we discussed. Computation alone will be done in year in which you receive the compensation. Computation alone we will receive, computation alone we will do in the year in which it is received. Able to understand? Next. So 45 subsection 5 is also over. Easy or not? 45 subsection 5 understood? By the way, in 45 subsection 5 we have few more points. Wait, I will show you directly. Because you also have to see this book also compulsorily. Enhanced compensation part is there, right? Enhanced compensation. Enhanced compensation, sometimes you might get. Enhanced compensation is taxable when in the year in which enhanced compensation is received. You see, additional compensation is taxable in the year in which additional compensation is received. Original compensation is taxable in the year of receipt. Yes or no? But what is the date of transfer taxability? Applicability is when if a capital asset is acquired by central government under compulsory acquisition. What is cost of acquisition? Sometimes you also receive what? Enhanced compensation. Enhanced compensation is separately taxable at the time when that is separately received. For that, what is cost of acquisition improvement straight away? Nil. Yes or no? Now, sometimes 45 subsection 5, what happens, 20 to 23 government acquired. Compensation amount is not decided. Compensation amount is not decided. In 24-25 year, they paid me 50 crore money. So just keep it 50 crore. They paid me 50 crore. But compensation, I don't know. Full value of consideration, I don't know. Full value of consideration is decided when, 25-26. 100 crore it is decided. Original compensation, how much it is decided? 100 crore. Now, since I already received in 24-25 50 crore. But in 24-25, even though I received, I can't compute capital gains because full value of consideration is not possible. Remember in the entire capital gains chapter, if consideration cannot be decided, cost of acquisition cannot be decided, even though capital gains head of income apply, you can't compute capital gains. You can't compute capital gains. If you cannot compute capital gains, you can't pay. You no need to pay tax. That's a problem in the income. That's a problem in the act. Two situations: if consideration cannot be determined, or second one, if acquisition cost cannot be determined, you cannot compute capital gains. If you cannot compute capital gains, capital gain section itself will, capital gain head of income itself will not apply. Able to understand? Now, see here, 45 subsection 5, 20 to 23 year government acquired. 20 to 23 financial year government compulsorily acquired. 24-25, I received compensation. But that's not the final compensation. Final, we also don't know how much it is. But temporarily advance they paid me. But in 25-26, original compensation 100 crore decided. Now taxability will be in 25-26 previous year. Transfer happened in 20-23 only. Taxability will be in 24-25 previous year. Able to understand? Same way, later additional compensation also given in 27-28. Then that year 27-28, it is taxable. Now in 25-26, 100 crore is decided, right? 100 crore is consideration minus cost of acquisition. At what price you purchased it? 19-20 year I purchased it. Cost. Indexation if applicable, take indexation. Minus cost of improvement. Then you will get gross capital gain. Then what you will get? Gross capital gain. That's it. Able to understand. Next. Next. Now that is 45 subsection 5. Now let us discuss 46A, buyback. Let us discuss 46A, which is buyback. So what is buyback of securities? What is buyback of securities? Now buyback, the section is divided into two parts. Okay, one is buyback of specified securities. Buyback of specified securities other than shares of domestic company. Other than shares of domestic company. Shares of domestic company. What is it? Shares of domestic company. Buyback. Companies are doing buyback of what? Some securities they are buying back other than shares of domestic company. And buyback provision on domestic company shares. So what is the provision? Buyback of specified securities by the company. Simple. My shares in the hands of shareholder, it is taxable. In the hands of shareholder, it is taxable. What is full value of consideration? Buyback amount. How much amount you are getting in buyback? Minus what is cost of acquisition? You purchase the shares at the time of purchase. Whatever is there, you reduce it. Then balance is long-term capital gain or short-term capital gain depending upon the holding period. Over. Able to understand? Suppose if it is a shares of domestic company, listed, unlisted, whatever, listed, unlisted of domestic company. Getting it? If the domestic company is buying back, here is an important amendment. When the buyback happened, is it before 1st October 2024 or on or after 1st October 2024? You should check out 1st October 2024. Is it before 1st October 2024 on or after 1st October 2024? I think dates when I'm telling you 1st October 24 also I wrote, I guess so. Four dates I think this 1st October also I mentioned. So before 1st October 2024, if at all any buyback happened, you got money, right? Your shares are cancelled, right, on buyback? Nothing. Fully exempted. What is it? Fully exempted under 10 subsection 34A. And the company which is buying back, right, they will pay buyback tax under 115 series. Some taxation is there which we will discuss in CA final. Understood or not? Now the provision, you see, so cruel provision, so cruel. The provision is very cruel. If at all buyback happened on or after 1st April 2024, company paid you buyback amount. Company paid you buyback amount 10 crore. Straight away that is taxable under income from other sources. Straight away it is taxable under income from other sources as dividend. It is treated as what? deemed dividend. It is treated as deemed dividend. 2 subsection 22 clause F, which is newly added, straight away the buyback amount is taxable after, in other sources if the buyback is on or after 1st October 2024. If the buyback is on or after 1st October 2024. Suppose, this is, now by the way, to get this 10 crore, I paid money and purchased shares. No, I purchased 6 crore worth of shares. These 6 crore worth of shares cancelled to me. And I received buyback loan 10 crore. Straight away 10 crore is taxable. What about my cost of acquisition? Don't worry. Under capital gains, full value of consideration, take it as 0. If buyback happened on or after 1st October 2024, take full value of consideration 0 under capital gains. What is the cost? 6 crore, reduce it. The balance result will be 6 crore, short-term capital loss or long-term capital loss or whatever. Please set off and carry forward as per 70, 71, 74 sections. Nothing but we will discuss this in set off and carry forward provision, which is a cruel provision. Loss under the head capital gains, loss under the head capital is you cannot set off with other heads of income. You can only set off with capital gains. What if I don't have a capital gain? This entire cost of acquisition becomes useless. Tell me, I purchased shares at 6 crore, later I got 10 crore, profit is only 4, right? But you are taxing me 10 crore in other sources. And you are giving me deduction. You are giving me deduction in capital gains. But I can't set up these two, right? It's so bad provision. It's the worst provision. Getting it, worst amendment did for buyback. It's very, nowadays what companies has to do, if at all they want to distribute money, don't buy back. Distribute as dividend happy. Distribute it as dividend happy. If shareholders want to sell the shares, they will sell in the open market to somebody and compute capital gains and claim 6 crore reduction, which is good. That's it. This is amendment in 46A. Under 46A, if any buyback of shares by domestic company happened on or after 1st October 2024, under the head capital gains, cost of acquisition of those shares shall be reduced from full value of consideration, which is to be taken as 0. The resultant figure is always a loss, long term, short term, set off and carry forward accordingly. Buyback amount is directly taxable under income from other sources, 2 subsection 22 clause number F. Set. 46A is also over. Are you clear? Then let's look at slump sale. Once we cover slump sale, exemptions I will discuss. Just a minute. Where is slump sale section? 120? That's it. Yes. Now look at the slump sale. Now slump sale. So 50B slump sale. What is a slump sale? Very simple. You are selling one of your business segment, one of your business unit, one of your business undertaking, one division, one strategic business unit, one business vertical in GST. Now in business vertical concept is removed in GST, but anyhow, one of your division. You are not selling entire business. One division you are selling. Suppose you are having 3 divisions in your business. One division is dealing with manufacturing, one division is dealing with providing services, one division is dealing with some other activity. Services, what you are dealing with, you are selling it to somebody. You are not selling each and every asset inside that. You are selling service division itself fully. That is treated as what? Slump sale. Now, in a slump sale, how to compute capital gains? Straight away I have given here computation. In problem, they will give you at what price the unit is sold, at what price the division is sold, they will give you actual sale value, they will give you that. They will also give you market value of the unit sold, market value of the division sold, they will give you whichever is higher. What is consideration you have to take in slump sale? Deemed full value of consideration, market value of the asset, whichever is higher, nothing but FMV of asset transferred. Don't worry about the wordings here. They will give you an exam. FMV of the unit sold, FMV of the division sold, they'll give you. FMV of the consideration received, they will give you. How much you received consideration, they'll give you. That you keep it. Minus transfer expenses, they will give you. Reduce it. Then what you will get? Net consideration. What you will get is net consideration. From that, Generally, how to compute capital gain? You should reduce cost of acquisition and cost of improvement so that you will get a capital gain or capital loss. Now, what is the cost of acquisition and cost of improvement? You are selling a division, right? Inside that, so many assets and all were there, right? Each and every asset cost you should total it. No. Cost of acquisition is net worth. Cost of acquisition in case of a slump sale is net worth of the undertaking. Whatever undertaking is there, right? That net worth is to be taken as cost of acquisition. How to calculate this net worth? Very simple. How to calculate net worth? Net worth is calculated very simple. Total assets minus liabilities. Very simple. Assets minus liabilities. Now assets. How to consider the values? Suppose if it is a depreciable asset under income tax, then WDV value of that asset you should take. Remember, when you are computing just a minute. Yes, sir. So now look at this. Yeah, sorry for the interruption. Now, total assets minus liabilities is equal to net worth. Now, net worth for depreciable assets, you should take what? WDV value. Remember, in PGBP, we compute assets block wise. Asset wise, we will not have details. In slump sale, no, some assets of a block only we will be selling. So that time, how to compute WDV? They will give you original cost details in the question. Minus, assume that is the only asset in the block. Assume that it is the only asset in the block. So calculate depreciation for every 31st March. Calculate depreciation for every 31st March from the date of its purchase. For every 31st March. Full rate or half rate. First time on first year it is either full rate or half rate. Second 31st March onwards, full rate. So suppose asset is purchased in 2019-20 year. Full rate. 2021 full rate. 21-22 full rate. 22-23 full rate. 23-24 full rate. 24-25 you sold it. In slump sale you transferred it. 24-25 don't apply depreciation. Very simple. For the year in which you are selling the asset and for the year in which you are selling the division, never apply depreciation for that year. Very simple logic. Getting it? So original cost minus depreciation as per WDV method. So you will get written down value. That value, depreciable asset value. Then, sir, self-generated asset, sir, value is to be nil. Any capital asset where deduction under 35 is claimed, sir, the value is to be taken as nil. Any other capital asset like land, stock in trade, current assets, goodwill, everything, book values. What is it? Book values. Debtors, creditors, cash and cash equivalent, everything, book values. Minus liabilities. Liabilities means what? Third party liabilities, all that. You reduce it. Then what you will get is called as net worth. That net worth is taken as what? Cost of acquisition and cost of improvement. Now you see sale value minus cost of acquisition is equal to capital gain. Actually slump sale is nothing but a goodwill taxation. Slump sale is nothing but a goodwill taxation. Whatever goodwill you are getting in accounting, this is actually called as what? Goodwill. Any amount I am receiving beyond my net worth, beyond my net asset value is treated as what? Goodwill. This is actually a goodwill taxation provision, section 50B. And remember, whether this is a long term or short term, this is the question. See, what are we selling in slump sale? We are selling the division. When the division opened, check out. When the division opened, operations check out. When it is sold, check out. More than 36 months, long term. Less than 36 months, short term. Sir, 36 months, after amendment 24 months only, no? No. For slump sale, 36 months, less than 36 months, that is told in the 50B section itself. So in 50B, there is no change happened. Right now, on or after 23rd July, listed securities, units of equity oriented mutual funds, units of Unit Trust of India, zero coupon bonds. For them 12 months. Any other capital asset 24 months. On or after 23rd July if the transfer is. However, the 24 months logic will not apply to slump sale. For slump sale, 36 months is the only criteria that is applicable. Clear? All of you? That's it. Slump sale is over. Slump sale is over mainly. Okay. Now let's look at exemptions. Now let's look at exemptions under capital gains. You know, we have totally, you know, these exemptions, you know, 54B, 10 subsection 37, 54D, 54EC, 54F. 54D I will not discuss. Remaining all other I will discuss. And 54H I will discuss. Capital gain account scheme I will discuss. If at all we cover all these sections, that will be over. Now let's look at 54. What is 54 section says? Suppose I sold a long-term capital asset. I sold what? Long-term capital asset, which is a house property. What I sold? House property I sold, which is a long-term capital asset. Where the income for me until I sell, no. That income is taxable under which head of income? House property head of income. Sometimes in exam they'll give you compute total income problem. They'll give you what they will give you. You know, you have a house property. You sold it on 1st October. The house property they will give you compute total income up to 30th September. Income from house property has to be computed for 6 months annual value. Then on 1st October capital asset is transferred, so capital gains has to be computed. So many will compute only capital gains because capital gain information is given. House property information they will forget because 6 months you are owner of the house property. For 6 months you should compute annual value. That's it. You sold house property, okay, which is a long term, okay. You are getting a capital gain. You are getting a capital gain. You will get exemption. You will get exemption. If you remember 48 format, full value of consideration minus transfer expenses is equal to net consideration minus cost of acquisition minus cost of improvement, then you will get gross long-term capital gain. Gross capital gain. From that you can claim one deduction, 54 series exemptions you can claim. Then you will get balanced taxable capital gain. Now we are discussing that 54 series exemption. If at all you got a gross capital gain, if you invest that amount in another house property, you invest in another house property, you will get exemption. Now, where I should invest, what I should invest, within what time I have to invest, this is the question. Very simple. You should invest in another house property. Now here investment is linked with the amount of capital gain. Here investment is linked with the amount of capital gain. Suppose gross capital gain, long-term capital gain is more than 2 crore. Then you can purchase only one house in India. You can only purchase one house. You can buy 2, 3, no problem. But you will get exemption only for one. But remember, in 54F also, you will get exemption only if you buy one property. But there you should not buy second house. In 54, you buy any, but you will get exemption only for one. But under 54F, you should not buy any number of your choice. You should only buy one. That one only you will get exemption. Remember 54F? Yes. So 54, exemption is available only if you invest in one house where the capital gain is exceeding 2 crore. Now within what time you should invest? 2 years from the date of transfer in case of purchase, 3 years from the date of transfer in case you are constructing it, or if you want to purchase, you can purchase in advance also before transfer date. First you purchase an asset and keep, then you sell the old house property. This exemption also can be claimed. Yes or no? Next, sir, capital gain is less than or equal to 2 crores. My gross gain is what? Less than or equal to 2 crore. Then you have 2 house property options. Then you can invest in 2 houses. Same time limit. 1 year before, 2 years after the date of transfer for purchase, 3 years after the date of transfer for construction. Time limit is same. Getting it? Now, 2 houses you can buy. For the 2 houses you can get exemption. Remember, once the SSE claimed exemption for 2 houses one time in any one assessment year. For 2 houses you claimed exemption at a time. You are not eligible in your lifetime for claiming exemption for 2 houses once again. Next time onwards, when you are selling a house, again you are buying a house, one house only you can claim exemption. Able to understand. Now remember, what is the maximum exemption? How much amount invested and how much is the capital gain, whichever is lower. Remember, maximum exemption shall not exceed 10 crore. Maximum exemption shall not exceed 10 crore. How do we do this computation? Suppose I sold my old house, 20 crore I sold, minus cost of acquisition of this house is 10 crore. My long-term capital gain is what? 10 crore. Now I have to invest this 10 crore in another house. Since my capital gain is more than 2 crore, I can only invest in one house to get exemption. Getting it? You invest in multiple, you don't get exemption for multiple. You will get exemption only for one house purchase. Suppose one house itself I costed me 9 crore. So balance 1 crore is taxable. This 9 crore exemption I can claim. Able to understand. This is how you should compute. Now, now, for the new house, there is a lock-in period. You are purchasing new house, and claiming exemption, right? For that, there is a lock-in period of 3 years. What will happen if you sell that new house within 3 years? Very simple. When you are selling that new house, within 3 years, you will compute capital gain rate on that anyhow. You will compute capital gain on that rate. Consideration, sir, new house, in our example, new house I purchased at 9 crores, sir, and I sold this in 25-26 year itself, sir. Full value of consideration of new house is what? Sorry, I sold it at 15 crores, sir. Next year, I got a very good money, I got a very good deal. I sold it at 15, sir. Minus, what is the cost of acquisition? 9 crore is the cost, sir, at which I purchased. Minus, exemption you claimed, no. Exemption you claimed earlier, no. And now after claiming exemption, you are selling within lock-in period. earlier given exemption will be cancelled. How they are cancelling it here? Generally they need to retax it separately, but they are not retaxing. Under 54, 54B, 54D, under 54, 54B, 54D, in all these three sections, earlier given exemption, they will not retax it separately. They will reduce it from the cost of acquisition. What is the cost of acquisition? 9 crore. How much exemption you claim? 9 crore only you claim. Balance cost is 0. So indirectly 15 crore is taxable on sale of the new house subsequently within the lock-in period. In this way they are retaxing. Whereas in 54EC, 54F, retaxation will not be done like this. Retaxation will be done separately, which is the right way of doing it. But under 54, 54B, 54D, they used these wordings. What? If the new asset is sold within the lock-in period, the new asset will be taxable. The new asset at the time of computing capital gain on the new asset from the cost of acquisition, old asset capital. I mean, from the cost of acquisition, earlier given exemption will be reduced. So this is the wordings which they used. In exam you should present like this. Suppose if the new asset is sold within lock-in period, compute capital gains on the new asset, full value on the new asset, how much? Less transfer expenses, how much? Remember, if it's a new house property means even section 50C also you should apply and check that time. Yes or no? Then minus transfer expenses, you will get net consideration. Cost of acquisition. In our example, cost of acquisition is what? 9 crore. Exemption claimed is what? 9 crore. Balance is 0. If on this balance, if some amount is there, indexation will be available on this. But anyhow, since these will be on or after 23rd July, indexation is not available. So cost of improvement, reduce it. Then finally, you will get balance capital gain or balance capital loss to be taxed. Be able to understand, all of you. Now let's look at capital gain account scheme. What is a capital gain account scheme? Very simple. See, you sold a house. Now you got a capital gain of 10 crore. You got a capital gain. Remember, under 54F, the exemption is amount invested in new house, either 1 or 2 as the case may be, or capital gain, whichever is lower. That much only exemption available. That too, amount invested beyond 10 crore don't consider. Amount invested beyond 10 crore don't consider. Indirectly under 54 exemption cannot exceed 10 crore. Able to understand. Now capital gain account scheme. What is a capital gain account scheme? Very simple. Sir, in 24-25 year I sold a house, sir, and I got a capital gain of 10 crore, sir. I need to use this to buy another house, right? I need to use this 10 crore worth of money to buy another house, right? What is the time available? 2 years, 3 years is there. But I should file IT return by 31st July. I should file IT return by 31st October, due date. By due date, you didn't spend any single rupee. Department is saying only one thing. By due date, either buy or construct. No problem. You have 3 years time, no? Don't wait up to that. You construct. You don't want to construct. You have 3 years option. You want to use the 3 years option. Then do one thing. Whatever capital gain is there, whatever exemption you want to claim, that amount deposit in a bank account. That bank account name is called as bank account opened under capital gain account scheme. By what time you should deposit here? By due date mentioned under 139 subsection 1. By due date mentioned under 139 subsection 1, you should deposit in a bank account. You should deposit in a bank account mentioned under 139 subsection 1, or you directly purchase a house, construct a house on or before 139 subsection 1. Either you purchase or you deposit in bank account, whatever it is, but by due date it must happen. If at all you deposit the amount in capital gain account scheme by due date, whatever amount you deposited, whatever gain you have, whichever is lower, that much you can claim exemption, subject to maximum of 10 crore. Able to understand, all of you. Now remember, from this capital gain account scheme, as per the time limits given in the section, 3 years from the date of transfer, 2 years from the date of transfer for purchase, within these time limits, from this account you withdraw the money and then spend. For sure you have to spend it for purchase or construction. Suppose, sir, time limit is over, sir, still some amount is left in account, sir, bank account, unutilized amount in capital gain account scheme, what I should do? On that amount, if you claimed exemption at the time of deposit, retax it. On that amount, if you claimed exemption earlier, at the time of depositing into account, you claimed exemption, you got exemption, that amount, then retax it. Simple. Able to understand. Capital gain account scheme, unutilized amount, straight away retax it. No, that's wrong. If at all exemption is claimed earlier on the deposit amount, then only it is retaxable. Able to understand. That's capital gain account scheme logic. Okay, capital gain account scheme is applicable for all sections except 54 EC. Except 54 EC, because in 54 EC you should invest in bonds within 6 months. That's 54 EC or not? All of you. Now let's look at 54 easy. 54 easy. Now let's look at 54 easy. I'll come back to agricultural land, all that later. 54 easy. What are you selling? Any long-term asset. You are selling any asset, but it should be long-term. You got a capital gain. Okay, no problem. You got a capital gain. What you have to do? Sir, I don't want to pay tax on this capital gain, sir. What I have to do? Invest that. Invest the gain amount. Where should I invest? Invest in specified bonds. Within what time, sir? 6 months only from the date of transfer of the original asset. From the original asset transfer date, 6 months. What is a specified bond? Bonds issued by National Highway Authority, bonds issued by Rural Electrification Corporation, bonds issued by Power Financial Corporation. PFC means what? Power Financial Corporation. Bonds issued by IRFC, Indian Railway Financial Corporation. 4 types of bonds: NHAI, Rural Electrification, Power Financial Corporation, National Highway, Indian Railway Financial Corporation. These 4 entities related bonds you buy. Whatever amount you paid here for purchasing these bonds, within 6 months only you purchase, you will get exemption. So whatever amount you invested within 6 months in these bonds, that much amount is exempted. Maximum exemption cannot exceed 50 lakh under 54 EC. Under 54 EC you can't claim. Suppose, sir, I am selling a house property, sir, long term, sir, and I buy house property, sir. 1 or 2 houses, as the case may, I will buy and claim exemption. Can I also simultaneously invest in 54 EC bonds and claim exemption both? Yes, you can claim. So that's what here we have given as a diagram. Able to understand? All of you. Now, what is the lock-in period for bonds? 5 years. Within 5 years from the date of investment in bond, you should not sell it. You should not keep them in loan also. You cannot keep them in loan also. If you sell or keep them in loan, earlier given exemption up to 5 lakhs exemption is there, right? That is fully retaxable. In the year in which you sell it, in the year in which you kept them as a loan, that time it is fully retaxable. Able to understand? Then that is 54 easy. Now 54F. 54F is a little different section. Now, for example, look at 54. Look at 54. Look at 54. Suppose, sir, I sold house. I sold house. For example, I sold house for 20 crores, sir. I sold house for 20 crores, sir. House I sold. House I'm selling. I'm telling you, house. Minus cost of acquisition, some 15 crores, sir. My capital gain is what? 5 crore. Under 54, I should buy another house, right? If I invest 5 crore in another house, one house only, because it is more than 2 crore. If I invest in another house, entire 5 crore I can claim exemption, right? How much I should invest to get 5 crore exemption? 5 crore only. But under 54F, original asset you are transferring is any long-term capital asset other than house property. What you are selling originally? Any property, but not house property. But not house property. Sir, I am selling a land, sir. I am selling jewelry. I am selling listed equity shares. I am selling equity oriented mutual funds. I am selling business trust units. I am selling some assets, sir. Yes, any asset is covered under 54F. I am selling some asset, but it is a long term. Minus, okay, long term. At what price you sold? Full value of consideration 20 crores, sir. Minus what price you purchased it? That land, sir, I purchased it at 15 crores, sir. What is the capital gain? 5 crore. Now in 54F, what you should purchase? Under 54F, what you should purchase? You should purchase house property. Original asset, any asset other than house. Investment in house property. Whereas 54, original asset, house property. Investment in also house property. Whereas in 54F, original asset, any asset other than house. Asset you are going to purchase must be house. Now, house property you need to purchase. In order to claim exemption, you need to purchase house property. How much you should invest? If you want to get 5 crore exemption, entire 20 crore you should invest. Here, exemption is linked with long-term capital gain into amount invested divided by net consideration. Long-term capital gain 5 crore. Net consideration is what in our question? 20 crore. Amount invested. Sir, I invested entire 20 crore, sir. No. Amount invested beyond 10 crore shall be ignored. Amount invested beyond 10 crore shall be ignored. Sir, I invested entire 20 crore and bought the house. Doesn't matter. 10 crore only I will consider amount investment. So accordingly, 2.5 crore only exempted. How much is exempted? 2.5. So balance 2.5 is taxable as a capital gain. Understood or not? Suppose now SSE also bought bonds 54 years. That also you claim exemption. No problem. Able to understand. Further. Sir, I didn't invest 10 crore, sir. I didn't invest 20, sir. I invested only 5 crore, sir. Then accordingly exemption will be 1.25 crore. That's it. So exemption under 54F is not amount invested directly. Amount invested divided by net consideration. That proportionate you will get exemption from capital gain. Able to understand? And remember, in 54F, amount invested more than 10 crore shall not be considered. Getting it? Which means the sections are drafted only with a view to help normal taxpayers, not high rich affluent people. Able to understand? That's it. So that's 54F. Now in 54F you have few different conditions. By the way, individual and HF only. 54 is also applicable for individual and HF. 54F is also applicable for individual and HF. Resident to non-resident doesn't matter here because there is no specification. Able to understand? Now conditions. New asset you should purchase. What? One house property in India you should purchase. Same time limit given under 54. 1 year before, 2 years after, 3 years after, all that. The SSE must not own one house on the date of transfer. You are selling some land, right? That time how many houses you can have in your name? One house only you should have in your name. If at all you want to claim 54F exemption, 54F exemption if you want to claim, already how many houses you can be owner? Only one house. Now you are claiming 54F exemption by investing in another house, right? That must be your second house. Maximum either it should be a first house or it should be a second house. Okay, fine. Sir, I invested in claimed exemption, sir. I want to buy another house, sir. Don't buy. 2 years, don't buy. 3 years, don't construct third house. If at all you are doing another purchase of house or another, see, simple. You sold land, within 2 years or within 3 years, only one house you buy or construct. If you buy 2 houses or 3 houses, for example, you will not at all get exemption under 54F. Suppose you bought one house and claimed exemption. In the same 2 years gap, later after claiming exemption, you bought another house. It's a condition violation. Earlier given exemption will be retaxable. That's 54F. Able to understand. Now here also capital gain account scheme is applicable as usual. Capital gain account scheme is applicable. Now how much amount I should deposit in capital gain account scheme? How much exemption you want? Accordingly, how much amount you should invest in net consideration proportion? That proportion only you have to invest in capital gain account scheme. Here I have given examples. In the book I have given examples. Please go through these examples. That will be over. Able to understand. 54F is over. Now 54B and urban agriculture land. I am talking about urban agricultural land. There are 2 sections dealing with exemptions. 10 subsection 37, 54B. Sir, what I am selling is an urban agricultural land. What I am selling is a urban agricultural land. Sir, it is sold under compulsory acquisition. It is sold under compulsory acquisition. Remember, this urban agriculture land is used by me for agriculture purpose for 2 years. This urban agriculture land is used by me for 2 years for agriculture purpose. Agriculture purpose, 2 years we are using it. Urban agriculture land. 2 years we are using. SSE or his parents or the HUF, they are only using past 2 years. Now it was sold to government under compulsory acquisition. Fully exempt. Straight away exempt. Urban land, remember, if it's a rural land, there is no question of capital gains at all. Sir, I am selling it to somebody else, sir, not government under compulsory. I am normally selling, sir, urban agriculture land. Now, can I get any exemption? Yes. Within 2 years, by purchase another agriculture land. What is it? Purchase another agriculture land. This new land you are purchasing, right? This may be urban or this may be rural. Doesn't matter. You buy a new land, you will get exemption. How much amount you will get exemption? How much amount you invested in the new land? That much amount is exempted. Able to understand. Now, new agriculture land, lock-in period is what? 3 years. Same way in 54F also, new house property, lock-in period is what? 3 years. In 54F and 54EC, both the cases, if the asset is sold in lock-in period, it is retaxable separately. Earlier given exemption is retaxable separately. Under 54B, retaxation will be like 54. How it is retaxable under 54B? Suppose I am selling new land within lock-in period. I will compute capital gains on the new agriculture land, right? Provided if it is an urban land. Then while computing capital gains, cost of acquisition will be there, right? From that cost of acquisition, earlier given exemption will be reduced. Balance cost will be reduced from the sale consideration, and balance will be liable for capital gains tax. Yes or no? No. Sir, what if I invested in new land and the new land is a rural land? Rural land is sold within lock-in period. No tax treatment. Earlier given exemption is not taxable. Since it's a rural land, new land, no tax treatment at all. That is 54B 10 subsection 37. Are you clear? That's it. Now finally there is a section called 54H. What is 54H talking about? See, when any capital asset is compulsorily acquired, when any capital asset is compulsorily acquired, you will receive compensation somewhere later. But under 54, 54B, 54EC, in all these cases, you should compute time limit from which date? From date of transfer you should compute. Capital gain account scheme also you should for the same year only you should deposit. No. Sir, my asset is compulsorily acquired. I did not get single rupee. You are starting, you are saying, you are starting computation of time limit already. Computation of time limit will not be from the date of transfer. In case of transfer by compulsory acquisition, computation of time limit for investments in new asset will not be from the date of transfer. They will be computed from the original. They will be computed from the date of receiving the compensation. They will time limit computation will start. Time limit computation will start from the date of receiving the compensation, not from the date of transfer. Thank God they gave a benefit. That is what 54H is talking about. Able to understand? That's it. Predominantly capital gains is over. Only one section I didn't cover is 46. 46 I will discuss in income from other sources. Liquidation topic is there. Liquidation topic at that time I will discuss 46 section also. Distribution of capital asset by the liquidation. Distribution of capital asset by the company under liquidation. You know, in period of holding, date of liquidation will be the right. After the date, shares holding period we will not consider. Now, assets distributed on liquidation to shareholder, right? Market value of the asset on the date of liquidation minus deemed dividend is full value of consideration minus cost of acquisition is equal to shares acquired by the shareholder in the company. Balance is capital gain. Able to understand? Now, sir, the asset which I got now in liquidation, I sold subsequently. What is the cost of acquisition for that asset? Sale value, I know. Cost of acquisition is what? Market value you considered at the time of distribution. Market value you considered at the time of distribution. That itself is the cost of acquisition. Able to understand? Previous owner, company holding period will also be considered as part of my holding period when I am computing holding period to decide whether the asset is a long term or short term. That's it. Anyhow, once again, this liquidation topic I will cover it. Income from other sources revision. Almost we spent close to 3 hours on capital gains. Only revision. That too, how intense I did. Getting it? That too, we did all illustrations roughly. Some random numbers we took and then did that. You apply this logic and solve your problems. I'm telling you 99% you will be done. Clear? That's it. Yes. Now let's begin income from other sources revision. Income from other sources revision. In other sources, only one provision dealing with default tax regime is allowances received by MPs and MLS. Is generally exempt under 10 subsection 17, but in default tax regime that is not exempt. So in other sources, typically many provisions are not affected by default tax regime. Capital gains literally zero. Default tax regime has no impact on capital gains. Correct? No. Income from other sources. Now see. So in what are the incomes that are specifically taxable under other sources? Very simple. If it is not covered under earlier head of incomes, that is straight away covered under other sources. Now the most important income is what? Dividend. So if at all you are getting a dividend, whether a company is getting which is involved in investment activities, dividend trading activities, doesn't matter. Whether a normal individual is getting this, doesn't matter. Dividend income is always taxable under other sources. And dividend includes deemed dividend. Deemed dividend is defined under 2 subsection 22. In that first and foremost amendment is clause number F is added. Okay, this is for the first time applicable for May 25 exams. This point is something I already told in capital gains, 46A buyback. Remember in buyback we discussed one point. If a company is buying back the shares, domestic company buying back its shares on or after 1st October 2024, any amount the company gave on buyback, that amount received by the shareholder is straight away taxed as income from other sources as deemed dividend. Sir, what about the shares purchased by him in the company? That is treated as cost of acquisition in capital gains. Full value of consideration is taken as zero. It will be a capital loss which will be set off against only capital gains and carry forward to other years. And on that, there is a problem given in this book. You can easily understand. Refer capital gains revision and then see this problem. You will understand capital gains revision and other sources. Both you cover. Now, so any sum paid, any sum just a minute. Any sum paid by domestic company for purchase of its own shares on or after 1st October 2024, whatever the amount you are receiving is straight away treated as deemed dividend. It's straight away treated as whatever amount you are receiving is straight away treated as deemed dividend. Getting it? Now, dividend includes deemed dividend. So what are they? Suppose company is giving any amount, company is distributing any asset to shareholders. How much is treated as deemed dividend? To the extent of accumulated profits. TEOAP means what? To the extent of accumulated profits. Whatever accumulated profits are there, up to that it is treated as dividend. Now sometimes no company, instead of giving cash or asset, they will issue shares. For example, they are giving debentures, they are giving deposit certificate free of cost to shareholders. Preference, equity, doesn't matter. Market value of the security is treated as dividend. Up to how much? Accumulated profits of the company. Sir, preference shares, bonus shares we are giving, sir. That is also treated as dividend. But equity shareholders, if at all a company is giving bonus, it is not treated as dividend. To equity shareholders, there is simple logic. Even if the company is giving bonus, there is no accumulation of liability for the company if equity shares are given. But if preference shares are given, company liability increases. Preference shares can get tomorrow for sure that extra amount. Yes or no? That's it. Liquidation. On liquidation, here please add the word any distribution on liquidation. Here please strike off here the cash received. What is it? Cash received. Now company, when the company is liquidating, on liquidation they might distribute anything. Anything means what? Assets or cash, anything they may distribute. If asset is distributed, market value please consider. If cash is distributed, cash received you consider. Total market value plus cash received, total it up to accumulated profits of the company, tax it as deemed dividend. Tax it as deemed dividend. For example, here there is a link with section 46 to subsection 22 clause number C. In capital gains division, I kept this pending. Getting it? Sir, I have purchased shares of the company by paying 10 crore rupees, sir. Now the company distributed me 20 crores, sir, on liquidation. On liquidation, company distributed me how much? 20 crores, sir. I got assets, some assets I got, some cash I got, total value 20 I got, sir. Company profits are approximately 8 crore were there. Accumulated profits are how much? Approximately 8 crore were there. Now out of 20 up to 8 crore, I will straight away tax it as dividend. What about the remaining amount? 12 crore. This is treated as consideration under capital gains. In capital gains 40, they will tell you amount received, market value of the asset received minus 2 subsection 20C deemed dividend 8. The amount is difference is treated as consideration minus cost of acquisition how much? 10 crores, sir. So balance 2 crore is capital gain. Now here most important point, when the liquidation is announced, that is most important. Liquidation date is treated as transfer date. If the transfer date is before 23rd July, then indexation is available. If the liquidation date is on or after 23rd July, then indexation is not available. Remember that. Easy. So next, sir, company is reducing its capital, sir, and because of reduction they are distributing, sir, either cash or kind of whatever, everywhere cash kind, everything is covered. Getting it? So it is treated as dividend to the extent of accumulated profits before the reduction. Suppose, sir, I'm a shareholder in a closely held company. Closely held company is a company in which public is not substantially interested. Suppose in a company, if public has a substantial interest, then that's a widely held company. Deemed dividend provision will be applicable here for closely held company. Yes or no? Sir, there is a closely held company, sir. Instead of receiving it as dividend, cash or distribution, I am taking it as a loan. Even loan taken by you is treated as dividend. Up to how much? Up to accumulated profits, provided the shareholder must be a key shareholder. Key shareholder means what? Holding 10% or more voting power. Holding 10% or more voting power. Remember, preference share is not considered as voting power. So if a preference shareholder is getting loan from the company, deemed dividend section will not be applied. If equity shareholder is getting a loan from the company, deemed dividend can be applied only if the equity shareholder is having 10% or more voting power. And remember, if at all the loan is given by a company whose business itself is giving loans, this provision will not apply. Able to understand? This provision will not apply. Further, if amount or loan or advance is given to shareholder for purchasing raw material from him tomorrow, later date, it's a trade advance. Trade advance is not covered under deemed dividend provisions. Able to understand? By the way, here reduction on capital, C and D, reduction on capital and liquidation, distributions are there, right? If at all any amount is distributed to preference shareholders who are not having any participative rights, that is not treated as dividend. Some clarifications you see. Shares distributed to I mean, any distribution under C, liquidation or reduction on capital to any shareholder not entitled to participate in surplus, that is not treated as dividend. Buyback before 30th September, not treated as dividend. Trade advances, not treated as dividend. Shares distributed by resulting company, getting it, that is not treated as dividend. What is accumulated profits? All profits of the company up to the date of distribution by liquidation or reduction or whatever reason, up to the date of giving the loan or advance or whatever. Able to understand? Next. Now remember, once you are getting dividend, to get this dividend, you might have incurred some expenditure, right? Whatever expenses you incurred, you can claim deduction. But maximum expenses that you can claim deduction in case of dividend income cannot exceed 20% of the dividend income. 99.99% of the cases, students will forget this provision. If dividend is there, expenditure is there, dividend 10 lakhs, sir, expenditure 3 lakhs incurred, sir, they will claim deduction straight away. 20% checkpoint you should apply whenever you are claiming deduction towards expenses for earning dividend income, getting it, whatever expenditure it is, doesn't matter. Maximum deduction cannot exceed 20% of the income. Further, you will not at all get deduction for any expenditure if at all dividend is in the form of buyback of shares. 222 clause F. Able to understand? Next. And remember, in 2 subsection 22 clause F, one more important observation is there. Here, accumulated profit logic is not there. 2 subsection 22 clause number F, accumulated profit is not there. Whatever amount you got in buyback, fully taxed as dividend. Able to understand? Next. Then there are many other incomes which are taxable under other sources. Casual incomes, winnings. Winnings, no, not a big complicated thing. So from winnings, no, you cannot claim any expenditure. No chapter 6A, basic exemption limit and all you can't. But remember, 87-year rebate can be claimed. 87-year rebate can be claimed even on winnings related tax component. Okay. Then, sir, I received compensation, sir, on compulsory acquisition. That compensation is already taxable under capital gains, sir. 45 subsection 5. As per that, we will compute. Now, that compensation is received late by me. For that, government is paying interest, sir. That interest amount is taxable in the year in which it is received only on cash basis. Now, how much deduction available? I spent so much, sir. That and all doesn't matter. Flat 50%. Sir, I did spend single rupee also. Doesn't matter. Flat 50%. Then, sir, I forfeited advance. In capital gains also we discussed. If forfeiture is on or before forfeiture is before 1st April 2024, reduce it from cost of acquisition and actual transfer of the capital asset later on. If forfeiture is on or after 1st April 2014, straight away tax it in other sources in the year in which it is forfeited. Then there are some incomes which are taxable only under IFOS or PGBP. If it is not taxable, and I mean if PGBP is not applicable, this is not a big deal. Okay, I'm not discussing it here now. Sir, banks, you know, they will invest in securities either because of SLR or non-SLR. What about that interest? That interest is always taxed under PGBP. Getting it? Next up, we have gift taxation, life insurance policy. I'll come back to it little while later. Okay. Next, amount received under life insurance and gift. In other sources, these are the 2 provisions which are major, bit complicated. Rest of the provisions are very easy. Residual income. Okay. Salary received by MPs, MLAs, straight away taxable under IFOS. Allowances received by them, exempted. By the way, remember, allowances received by them is exempted only under optional tax regime. It is not exempt under default tax regime. Sir, apart from this, sometimes we also receive family pension. Family members of the deceased individual might get pension from the husband's employer. Now, this pension is called as what? Family pension. How much is family pension is fully taxable in other sources in the hands of the legal heir, but they can claim deduction for that. Okay, 1/3 of the pension amount or 15,000 rupees, whichever is lower. In case if you are going for optional tax regime, or suppose I am declaring income under default tax regime, then 1/3 of the pension, 1/3 of the pension amount or 25,000 rupees, whichever is lower. So default tax regime link is one more is there here. Getting totally 2 links in other sources. Default tax. One is MPs, MLAs, allowances. Another one is 25,000 family pension. Yes or no? However, family pension received under the following circumstances fully exempted. Received by armed forces family members. Received by an awardee of Paramveer Chakra, Veer Chakra, all that. Commuted pension received from LIC. That is also fully exempted. Easy or not? Now, sir, for getting other sources income, I am incurring so many expenses, sir. Can I claim deductions of whatever expenses I incurred? Yes, you can claim. For family pension, deduction is already specified. For interest on compensation, deduction is already specified. For dividend income, deduction is already specified. Sir, remaining incomes I have, sir. Lottery income, you can't claim any deduction. Sir, remaining incomes I have, sir. Whatever reasonable expenses you incur, repairs, maintenance, everything, that and all, you can claim. Only few conditions. It should not be personal. It should not be, if TDS expense is not deducted, 100% or 30% disallowance as usual will apply. Payments to related person, unreasonable amount you will not get deduction. Payments in cash exceeding 10,000 or exceeding 35,000 to a transporter other than prescribed modes, deduction is not allowed. No deduction for winnings income. Easy or not? That's it. Then there are some exemptions under other sources incomes. Sir, I am getting post office savings interest, sir. Don't use the word bank here. Savings bank interest, we use the word generally, but it's not a bank. Post office savings interest income I'm getting, sir. How much is exempted? 3,500 rupees is exempted. Suppose post office interest is 20. Suppose I'm getting 25,000. 3,500 is exempt. 21,500 is only taxable under IFOS. That too under optional tax regime. In chapter 6A, 80 TTA up to 10,000 I can claim further deduction. Able to understand? That's it. So remaining all are easy. Interest on NRE account, not NRO. NRE account interest amount is fully exempted. If at all because of disaster, government is giving you compensation, local authority giving you compensation, state government is giving you compensation, that is fully exempted. And scholarships received, fully exempted. Yeah, awards and rewards received in public interest like Bharat Ratna, Paramveer, Bharat Ratna, Padma Bhushan, Padma Vibhushan, Padma Shri, all these gallantry awards people, fully exempted. Able to understand. Now we are only left with two provisions. One is gift provision, another one life insurance policy provision. First let me discuss gift provision, which is easy. Gift provision first we will cover. So see, gift also sometimes many students are doing mistakes only because structure they don't understand. Now you are getting a gift. First straight away don't compare with 50,000 limit, all that. First decide from where, from whom you are getting the gift, source. Gifts are two types: taxable source gift, exempted source gift. What are they? Exempted source gift. First decide source, taxable source, exempted. If it is exempted source, straight away ignore it. Straight away ignore it. What are exempted sources? Received from relative is exempted. Suppose gift is received by a trust from an individual for the benefit of the relative of that individual. Then trust is receiving gift, no, that is fully exempted. Gift received on the occasion of marriage, not marriage anniversary, not birthday, not Sashti Purti and all. Okay. Next, any property or amount received on will or inheritance, that is fully exempted. In contemplation of death of the payer, it is fully exempted. Gift received from local authority, gift received from fund, foundation, universities, gift received from trust or institution registered under income tax, charitable trust, we call it as fully exempted. Gift which is, if for the transferor, when he gifted you, it is not taxable for him under capital gains. For you, it is exempted. Able to understand? And gift received for COVID-19 treatment, now it is not that relevant. This provision is not that relevant, so I'm not covering it. Okay. Next, who is a relative? Relative means, you see, okay, 7 categories of people are called as relative. For me, my spouse is a relative. Spouse, brother or sister is a relative. Spouse, ascendants and descendants are also relative. Like spouse, ascendant means what? Parents, grandparents, great grandparents, children, grandchildren, great grandchildren. Descendant means yes or no. Now this is about my spouse and their relatives. They are also relative to me, my spouse side. Now from my side, my brother or sister is relative. Okay. And brother or sister of my parents, mother's brother or sister, father's brother or sister, they are also relative to me. Any linear ascendant and descendant, my parents, my grandparents, great grandparents, my children, grandchildren, great grandchildren, and spouses of all these people are also relatives to me. Able to understand? Now here one point, remember, gift relative definition will be applied from recipient perspective. You received from relative, that's it. Now for example, no, my nephew is there, my sister's daughter or my brother's son or daughter is there. I received from them the gift. They were not covered anywhere in the list. They are not covered anywhere in the list. For me it is taxable. I gave a gift to them. I gave a gift to nephew. From my nephew point of view, I am a relative because I am his parents' brother or sister. Therefore, for her it is exempted. For my niece or nephew, it is exempted. Able to understand? So, gift definition shall be applied from recipient perspective, not from the giver's perspective. Able to understand? That's it. By the way, in this provision, gift is received by anybody, not necessary. This section 56 subsection 2 clause 10 is applicable for anybody. Are you getting it? Now, suppose if the gift is from exempted sources, in the problem they'll give you list of gifts. Exempted sources, keep it aside, ignore it. Remaining gifts are there, right? They are all taxable sources. Remaining gifts, no, categorize into 5 categories. Remaining gifts, divide them into 5 categories. How much is the money gift? From taxable source only, by the way. Keep all money gifts aside. Sir, I got movable property as gift, sir. Movable property means what? Car, TV, all that? No, only 8 type of movable properties are considered. 8 type of movable properties are considered. Shares and securities, jewelry, archaeological collection, drawing, painting, sculpture, any other work of art and bullion. Only 8 kind of assets are considered. Getting it? Now, have you received any of these 8 kind of assets? Yes, sir, I received, sir. Okay. Have you received them without consideration? Sir, I received some without, sir. Some inadequate, sir. So, split them. Inadequate cases, keep them separate. Without consideration cases, keep them separate. So, without consideration separate, inadequate consideration separate. Sir, I also got a gift of immovable property, sir. Without consideration, keep it separate. Inadequate consideration, keep it separate. Divide the gifts into 5 categories. Yes, sir, I divided, sir. Now, money. Total it. Total money received from taxable sources. Total it. Is it exceeding 50,000? Yes, fully taxable. If money is taxable, movable property is also taxable. No, there is no link. Now, sir, movable property, sir. I received some 3 gold rings, sir. Okay, without consideration, sir. All the 3 gold rings put together, what is the market value? Check out. 3 put together, aggregate, cash, aggregate, movable property, aggregate. Sir, exceeding 50,000, sir. Then entire market value is treated as taxable value. Sir, I purchased some gold ornaments, sir. Market value 10 lakhs, sir. But I paid only 7 lakhs, sir. 3 lakhs is inadequate portion. Okay, so aggregate value minus consideration paid is equal to how much in this example? 3 lakhs. Is it more than 5 lakh 50,000? Yes. Then that entire 3 lakhs gift portion is fully taxable. Remember, taxable amount is always gift portion only. In order to tax it, 50,000 limit we check. Able to understand? All of you? Sir, I received a ring, sir. Market value 40,000 without consideration. I purchased a gold chain, sir. Market value 1 lakh. I paid 60,000, sir. Here 40,000 benefit is there. Here 40 is there, sir. Can I totally then tax it? No. This is without consideration. You should tax it separately with 50,000 limit. Inadequate consideration has a separate limit. Sir, I am getting immovable property, sir. Immovable property gifting will be gift provision we apply each property wise, whereas movable property aggregate we apply. For immovable property wise we apply. Immovable property means what? Land, building or land and building. Okay, sir, I got immovable property without consideration, sir. Look at the stamp duty value. Stamp duty value means which date, sir? Without consideration means registration date. If consideration is there for getting immovable property, then look at the agreement stamp duty value, look at the registration date, see whether advance is there on the agreement, see whether advance is paid by other than cash. In such a case, SDV on agreement date will apply. If it is without consideration, straight away registration date, because consideration itself is not there. So now if STV of that property is exceeding 50,000, which is received as fully free of cost, yes, then entire STV is taxable value. Sir, I purchased immovable property, sir, at less than stamp duty value. Then gift provision I can apply. Only one condition should be satisfied. Stamp duty value must be more than 110% of the consideration you paid. Sir, stamp duty value paid is more than 110%. Yes. Now calculate free portion. Is it more than 50,000? Yes. That free portion is taxable. That's why how they expressed it. Sir, I purchased removable property, sir. Some portion gift is there, sir. Pakka STV 1 crore, sir. I purchased it at 92 lakhs. 8 lakhs gift is there. Don't straight away compare it with 50 and then tax it. Now 8 lakhs, you purchased it at 92, right? Into 10%, how much? 9.2. Array, 10% variation not an issue in the property purchases. We will not tax it. If the variation is more than 10%, if it is variation is more than 10%, then the gift provision can be applied. Now when you apply the gift provision, free portion is how much? Is it more than 50? Yes. Then entire that free portion is fully taxable. Yes or no? You understood this point? So indirectly how the section is expressing this: I purchased a house, sir. I purchased removable property, sir, at a price less than stamp duty value. And the difference amount is more than 10%, sir. And the difference amount is moreover more than 50,000, sir. Then gift provision can be applied. Now what is the free portion? STV minus actual is equal to free portion, fully taxable. Re-listen once again slowly, you will understand the logic. Here many students confuse if this adjustment comes in the question. Able to understand? Remember, gift provision attracts only if the asset received is a capital asset for the recipient. That's it. Entire gift provision is over. Now we are only left with one more provision, that is Life insurance policy. That is life insurance policy maturity amount. Just 1 minute. Yes. Now, suppose no immovable property is there. For example, gift immovable property. Okay. Simple example I'll tell you. Okay. Suppose stamp duty value applicable. That may be agreement value or registration, whatever it is, depending upon the scenario. That is 1 crore, sir. Whereas actual consideration is 90 lakhs only I paid, sir. Now, free portion is how much? 10 lakh. Many students compare it with 50,000, they will fully tax it. No, you should not straight away do that. If free portion 10 lakhs, right? Is it more than 10% of actual consideration? Yes, sir. Condition satisfied. Then, is the free portion more than 50,000 also? Yes, sir. Is it more than 10% also? Yes, sir. Then entire 10 lakhs is taxable. Okay. Suppose, sir, I purchased it for 93 lakhs, sir. Free portion is how much? 7 lakhs, sir. Is it more than 10% of actual consideration? No. Free portion, though 7 lakhs is there, since it is less than 10% of actual consideration, nothing is taxable. Able to understand? Next. Amount received under life insurance policy. Amount received under insurance policy. You know, see, insurance policy, if you are getting any amount, no, it is again divided into 2 types. Taxable maturity amounts, non-taxable maturity, exempted maturity amounts. Exemption is covered under 10 subsection 10D. Now, exemption is covered under 1010D, whereas 1010D do not cover exemptions for the following. Keyman insurance policy maturity amount is always taxable. Okay, and if at all we have taken insurance policy on one fellow who is dependent on us, he is a disabled person. Okay, for his safety only we received insurance, but he died at first, and I received maturity amount. For me, it is fully taxable. That is 80DD subsection 3, which we will once again cover in chapter 6A deductions. Getting it? Now, sir, I have an insurance policy, sir. I have insurance policy, which I purchased it on before 2003, sir. 1st April 2003, before I purchased it, sir. Now in 24-25, I'm receiving maturity amount. Insurance policies maturities will be 40 years, 50 years duration. So this question will be there probably. I purchased insurance before 1/4/2003, sir. Suppose no, if the SS is receiving on death, suppose if the family members are receiving on death of the person, that is always exempt, irrespective of amount. That is always exempt. That's why term insurance policies, no, they are always exempt, because term insurance maturity amount is received only by legal heirs. In term insurance, maturity will not be there. Only legal heirs will get it. Remember, we are talking about the life insurance policies other than ULIP policies. ULIP policy taxation is not there in CA income. Now, coming to sir, life insurance policy maturity amount I am getting, sir. Maturity amount means what? Either sum assured you will get plus bonus also you will get. Whatever it is, both put together we call it as maturity amount. Remember, here they never said. Here, you know, 1010 you see, sum received under life insurance policy, they say, though the section heading we use maturity, surrender value is also covered here. Suppose you purchased insurance policy, after 5 years you surrendered it and you are getting money. That is also covered under 10 subsection 10D scope. That is also covered under this discussion. And in ICA book it is clause number 13. Actually in ICA book it is given as clause number 12. So in ICA book it is printing mistake. Fine. Now, sir, I received some amount, sir, under insurance policy. What is the tax treatment? Tax treatment is dependent upon when you purchased the policy. Sir, I purchased policy before 1/4/2003, sir. Now you are getting some money, fully exempt, always. Always exempt. Sir, I purchased insurance policy between 1st April 2003 to 31st March 2012. 1st April 2003 to 31st March 2012. If this is the period in which I purchased this, it is exempt only if the premium does not exceed 20% of the sum assured. So you have taken the policy between that period, right? Every year how much premium you are paying, check out. Is it less than or equal to 20% of sum assured? Yes. Then maturity amount or surrender value, whatever you are receiving now, fully exempt. Sir, I received a policy on or after 2013. I received a policy on or after 2013. 10% of sum assured. Or else let us look at, sir, I purchased a policy on or after 2012. On or after 2012. Exemption is applicable only if the annual premium does not exceed 10%. Every year premium paid is not exceeding 10%. Yeah, straight away exempted. Suppose now disabled persons, no, from 1st April 2013, the percentage limit is increased to 50. Now, most confusing part of the section is for policies issued on or after 1st April 2023. For policies issued on or after 1st April 2023, the exemption is subject to 2 conditions. The exemption is subject to 2 conditions. Very simple. First condition, 10% criteria you apply. Disabled person, 15% criteria you apply. First condition. Second condition, if at all SSE has taken only one policy on or after, if at all SSE has taken on or after 1st April 2023, only one policy he purchased. That policy premium for any year does not exceed 5 lakh, and the annual premium also does not exceed 10% or 15% as the case may be. Premium does not exceed 10%, amount does not exceed 5 lakh in any year, then that related maturity amount or surrender value is fully exempt. This is very simple. Until 2023, before any insurance purchase, any insurance policy purchased, even though very good amount, good policies, commercial policies, high premium policies, income tax department is giving exemption irrespective of amount. But now high premium policies they want to tax it. That's why they kept a limit of 5 lakhs premium limit. They kept a 5 lakhs premium limit. What is this 5 lakhs premium limit? Suppose I purchased a policy on or after 2023 1st April. Annual premium shall not exceed 10%. That is one condition. 2. Amount of premium shall not exceed 5 lakh. Only if these two conditions are satisfied, maturity amount is exempted. Now, since if it is single policy 5 lakhs premium, SSE is what they started doing. So SSE what they might do, they will take multiple policies. Now, if at all SSE has taken multiple policies, it's okay, you take multiple also. For all the policies put together, how much premium you are paying? Is it exceeding 5 lakh? Yes. Yes or no? In any 1 year it is exceeding, that's enough. Then exemption is available only for those policies whose aggregate premium does not exceed 5 lakh. Okay, at the option of the SSE. Which insurance you want, which policy you want to claim exemption is your choice. But at your option, aggregate premium shall not exceed 5 lakh. Able to understand. Now, we have given ICA problems. ICA, in study material, IFOS problems were there. But anyhow, I have already uploaded previously when I made this particular amendments video in the previous, my old video is directly solved from ICA book. Getting it? So that video link I will show you on the YouTube. You just watch it if at all you have a doubt on this. Very neatly, very clearly explain this entire provision. Able to understand. Next. By the way, 5 lakhs premium you are considering, right? That should be considered excluding GST. You should not include GST and then see. In exam, they will confuse you, including GST. Exclude GST component and see. Is it less than 5 lakhs? Yes. Then exemption is there. Multiple policies put together, premium is more than 5 lakhs. 6 lakhs you are paying. Up to 5 lakhs worth of premium related policies amount maturity only exempted. That's it. Easy or not? Entire life insurance policy is also over. Now, sir, I got amount. No, it is not exempt, sir. If it is not exempt, what is the tax treatment? It is taxable. How much you will tax it? How much I will tax it, sir? How much amount received? First identify. How much amount received? First identify. Minus, sir, whatever premiums I pay, no, that also I'm getting back in this. The premium when I pay, no, I did not get any deduction, sir, in income tax also. I did not get any deduction. I got 1 crore money, sir, now. I paid in the past 20 years, 25 lakhs premium, sir. I got 5 lakhs only deduction. 20 lakhs I did not get deduction at all in the past 20 years. 1 crore minus 20 lakh, the deduction which you did not get for the premium paid, reduce it. Then 80 lakhs only tax. Over. With this, entire income from other sources is also over within half an hour. Okay. If you do once again resolve the problems which we did in test your knowledge, past exam questions in our regular class, whatever, once again you just go and resolve it. I am telling you, you use this revision and once again solve it, you will master on the income tax. Clear? That's it. Heads of income is completely over. Basic concepts over, residential status over, heads of incomes over. Literally up to now whatever we covered is having a weightage of 40 marks approximately. Minimum what? 40 marks out of 60. 60 is with choice. Okay, minimum I'm telling you, minimum 40 marks weightage we covered. Getting it? Now we still have chapter 6 deductions, return of income, TDS, TCS, alternate minimum tax. Okay, these provisions, advanced tax, if these provisions are also revised, entire income tax revision will be over. Clear? That's it. Now let's revise clubbing of income. Okay, remember clubbing is you will not get a direct question sometimes. You will get it as part of a total income question or as part of some other question. Sometimes clubbing and set off and carry forward together they will ask 6 marks question. That's the weightage. I always tell you, it's not the problem how many you solve, it's the clarity in the provision. So everywhere now when I'm discussing, I will give a simple example so that you will understand clubbing provision easy. Clubbing provision, actually if you look at the income tax original study material, income of other SSEs included in the total income of the individual. This is what? Income of other SSEs included in the total income of the individual. This is the chapter heading. Nothing but others are getting income. but that is tax in your hand. That is why it is called as what? Clubbing. Able to understand? Now, what are the sections that we have in clubbing? We have the following sections in clubbing. Okay, look at this. At the end of the chapter, I'm giving a diagram. So 60 club, what are the sections we have in clubbing? So we have totally three sections. We have totally three categories: 60, 61 to 63, then 64. In 64, we have various categories. 64 subsection 1, 64 subsection 1A. 1A is dealing with minor income, clubbing of minor income, minor children income. 1, it has again 5 subsections. Subsection 2, remuneration to spouse. Okay, then subsection 4, subsection 7, subsection 6. Okay, remuneration 7 only. I think it is 7 only. Subsection 4, subsection 7, gift to spouse, directly or indirectly. Then we have 6 and 8. This is gift to daughter-in-law. These are the provisions. Then we have another section called 64 subsection 2, conversion of self-acquired property into HUF property. That's it. These are the sections that we have in our syllabus in clubbing. Now, what are they? What is that section 60 is talking about? Very simple. Transfer of income without transfer of asset. What is it 60 is talking about? Transfer of income without transfer of asset. That income is taxable in the hands of the transferor. Straight away the income is taxable in the hands of the transferor. Very simple. I have shares in a company. I am eligible to receive dividend from the company. I told company, dear company, I have a security guard to his daughter who is studying in so and so. She need money. The dividend amount, don't pay me. Directly pay the dividend amount to the daughter of my security guard or my son. Okay, I mean, pay the dividend amount to my brother's son. Pay the dividend amount to my sister's daughter. Pay the dividend amount to my grandfather. Simple. I told the company, don't pay me dividend, pay the dividend to them. But who are the owner for the shares? I am the owner. What am I actually transferring? Am I transferring shares? No, I'm only transferring income to them. That income is treated as application. That is treated as application of money. That income is taxable still in your hands only. You can't escape tax on that. That income is taxable in your hands only. So if I have an asset, on the asset I am getting some income. That income alone I am diverting to somebody. Still, I am only treated as owner of the income, and that income is taxable in my hands only. That's it. That is section 60. Next, revocable transfer. Now, if I only transfer income, department is taxing in my hands only. I got an idea. I will do one thing. I have a building. I have a land. I have some shares in a company. I transfer those properties to my friend, my brother's children, or to my wife only, or to my mother or father. Somebody I transferred property. But in that property transfer deed, I mentioned one condition. Whenever I want, I can take back that. Whenever I want, I can take back that. Getting it? This is called revocation power. What is this called as? Revocation power. This is called revocable transfer. Revocable means what? You transferred, but you can take it back. No. That is called revocable transfer. If at all you are transferring any asset with a condition of revocation of the asset or revocation of income, any of it, even part of it only you have a right to revoke. Still, the transfer is treated as revocable transfer. And even though the asset is in their name, even though income is they are only receiving, but power on that asset is ultimately with you because you can revoke it back again. Income is taxable in the hands of the transferor only. Income is taxable in whose hands? Transferor only. Income arising on revocable transfer of asset. Income arising on revocable transfer of asset is taxable in the hands of transferor. Are you clear? Now, there is a section called 62. What that section says? If transfer is made by a trust that is irrevocable during beneficiary lifetime, or a transfer is not revocable during transferee lifetime. Very simple. I transfer. In the deed, there is a clause. I cannot get back the asset during their lifetime. In the transfer deed, clause is there, condition is there. What condition? I can't get back the asset during lifetime. Their lifetime, I don't have any right on that asset. Then the asset is theirs. Income they are getting. Income is taxable in their hands only. It is not taxable in my hands, because the transfer which I made is not treated as revocable transfer, because I cannot revoke during the lifetime of the beneficiary. However, beneficiary died after 5 years. 6th year I am getting back my asset and my income. 6th year onwards again it is taxable in my hands, because beneficiary is no more. Now I got back my asset. From now it is taxable in my hands only. Clear? Able to understand? That's it. So that is regarding revocable transfer. 61, 62, 63. Easy or not? Then 64. Now when you're discussing, no, here in 64 many students will have a doubt. Now 64 subsection 1 1a. First you should compute as per 1. After computing as per 1 only you should compute 1a, because section order is that only. Because no, minor income is taxed in whose hands? In the parents' hands whose total income is higher. Subsection 2, if you see, remuneration in an entity where the spouse has substantial interest. There also one point is there, if both husband and wife are having substantial interest, then in whose hands clubbing will apply? First exclude this income. Calculate husband income separately, wife income separately. Whose income is higher? Add in their income. Yes or no? After adding this income, then minor income will be added. Are you getting it? That time I will check again, father income higher, mother income higher. Accordingly 1a. Indirectly, in a same year, spouse income is subject to clubbing under clause 2. Minor income is also subject to clubbing in the 1a. Ignore those both. Compute father income, mother income separately without including spouse income, without including minor income, without including these two. Calculate father, mother, husband, wife income. Whose income is higher? In their income, spouse remuneration, tax it. Minor income also, tax it. Yes or no? Easy or not? Here's a confusion. Very rare this confusion comes. Clear or not? Yes or no, everybody? Yeah. Now what is remuneration to spouse? Very simple. You know, remuneration to spouse in the individual's entity. There is a company, there is a partnership firm, there is an LLB. In that entity, I have substantial interest. I have substantial interest. Substantial interest means what? Minimum 20% profit sharing ratio. If it is a company, I have 20% voting power minimum. Then it means I have substantial interest. In that company, you know, my wife is working. She is getting salary. Per annum, she is getting 12 lakhs. Monthly, she is getting 1 lakh salary. Monthly 1 lakh, right? What is the total salary? 12 lakhs. Minus standard deduction 50,000 or 75,000, depending upon optional scam, depending upon tax regime, 50, 75, reduce it. Balance income is what? 11 lakh 50, 11 lakh 25, as the case may be. That income is taxable in the hands of the husband, because husband has ownership in the company. Because husband has ownership. Suppose no, wife is there, she is only having ownership in the company, she is only working in the company. Income is taxable for her only. But husband is having ownership, but wife is drawing money. Or wife is having ownership in the company, husband is drawing salary. Department assumes because your husband or wife is having ownership in the company, you are getting this money. Otherwise, you don't have that much talent and all. So this is completely a tax planning. We will tax that money in the hands of the spouse who has ownership in the company. You clear? So if one spouse is having substantial interest in one organization, in the same organization other spouse is working, then other spouse, whatever remuneration she is getting, salary, whatever she is getting, first compute income from salary, tax it in the hands of the other spouse who has a substantial interest. But this clubbing do not apply. This clubbing will not apply. If the spouse is getting remuneration because of her qualification, because of her experience, skill and all, then clubbing will not apply. Are you clear? All of you. Now a question arises. Sir, if both husband and wife are having substantial, both of them are getting in remuneration from the entity, both of them are not having any talent, skill and all. Purely tax manipulation purpose. They are getting some salary income. First compute husband income from salary, wife income from salary, compute as usual. First compute salary income, all that compute. Net income. Now, keep these two incomes aside. First, husband, wife, whatever income they are getting from the company, keep that aside. Other incomes, total it for them. Whose income is higher, check out. In their hands, club both the incomes. Now, once in a particular year, in the hands of one spouse, if the income is added, forever in the next year also, in the hands of same spouse, income will be added. Income will be taxed. Yes or no? Getting it? So, that's what all the points I've given. Once income is included in the hands of one spouse, the same will be applied in the subsequent year unless assessing officer deems it necessary to change. Are you clear? That's it. Then, income arising to spouse on asset transferred. Here I transferred an asset. Income is arising to spouse on asset transferred. It is not remuneration to spouse. Remuneration to spouse provision is over. Now what happened, I gifted one asset to my wife, or wife gifted to husband, whatever. Now on the gifted asset, it may be cash, it may be property, it may be house property, anything. Suppose if it is a house property gifted to spouse, 27 deemed ownership concept will apply. As per 27, it's not clubbing. You are only treated as owner. In your hands only house property income will be computed. Yes or no? Sir, it's not house, sir. Some other property. Or cash, sir. I gifted cash to my wife. Or I gifted some asset to my wife. And she is getting income on that. Income on transferred asset, gifted asset is taxable in the hands of the transferor. Are you getting the point? Now, suppose I gifted her one car. She is renting that car and getting every month 1 lakh profit. 12 months into 1 lakh profit will be taxable in my hands because the car is mine. 12 lakhs is taxable in my hands. But 12 lakhs amount she is only enjoying. You know what she did? That entire 12 lakhs she kept in bank. And now she is getting interest. She is getting dividend also. That income I didn't transfer. That income I didn't gift. That she is only earning on her own. That is not subject to clubbing. Income generated. What is it? Income generated from accretion of the transfer is not subject to clubbing. For example, I gave a land to wife. Wife is getting rental income. Then the rent is only subject to clubbing. But what she did, that rent again she invested in bank FD. That is not subject to clubbing. Are you clear? Everybody? That's it. Now, so when an asset is transferred from one spouse to another without consideration or inadequate consideration, then it is clubbed in the hands of the transferor. Clubbing will not apply if at all the asset is transferred to live separately. In a divorce related scenario, if at all both husband and wife are transferring any asset, on that any incomes they are getting, that is not subject to clubbing. Similar condition is there for house property in 27 also. If house property is transferred to wife in an agreement to live apart, or house property is transferred adequate consideration, deemed ownership concept will not apply in house property. We already covered in house property division topic. For house property, 27 will apply. Yes or no? That's it. Sometimes I gave cash to her. Cash. Or my wife gave me cash. Or I gave cash to her. Whoever it is. But what she did, she did not keep it as a deposit in bank. Suppose if I give a cash to her, she deposited in bank, interest she is getting, clubbed in my hands, correct? But she didn't deposit. She invested in a sole proprietary concern. Suppose she invested that money in partnership form. From partnership form, she is getting remuneration. Interest on capital. That interest on capital is taxable in my hands. How much is taxable? How much is allowed to the firm? That much is only taxable. But she invested in sole proprietary business. She invested in sole proprietary. In that business, her capital is also there. Now, she is getting profit. She is getting profit from the sole proprietary business. How much is subject to clubbing? Total business investment, how much identify? Numerator, how much is the value of the asset transferred? How much is the value of the asset transferred? Proportionate income. Proportionate is what? Value of the asset transferred. I gifted how much? divided by business investment total how much, in that proportion for that year whatever profit is there, right, that is subject to clubbing. For example, total business amount, 10 lakhs she invested in the total business, but out of this 5 lakhs is my gift. For 24-25 year she made a profit of 5 lakhs. In this 5 lakhs, how much is treated as income from my gifted amount? 5 lakhs is my investment, right, which is I gifted, right? 10 lakhs is total, right? For 10 lakhs profit, 5 lakhs she got. Now 5 lakhs investment, how much it is? 2.5 lakh is subject to clubbing. However, one condition. This 5 lakhs when you gave, 24-25 year you're talking about, right? This 5 lakhs when you gave, I will see first. If at all it is given on 1st April 2024 only, you can put in numerator like this and subject to clubbing. On 1st April of the year, no, or on the date business started. Suppose if the business is started this year only, on 1st day of the business I will see how much your gifted money is there. Suppose business is long back she started, I gifted her on 10th April 2024, and for 24-25 she made a profit of totally 5 lakhs in that year. Total capital is 10 lakhs. As on 1st April, how much is gifted amount? I gifted on 10th April only. 1st April I didn't give any gift. 1st April 0. Clubbing will be 0. Clubbing will be 0. For a particular year, if at all in the business there is a profit, that profit proportionate investment is subject to clubbing only when the gifted amount is there from first day itself. If gifted amount is not there on the first day, clubbing will not apply. Clubbing will not apply if the gifted asset is not there on first. For example, 25-26, okay, 24-25 clubbing is 0. 25-26 position I will tell you. 25-26 she made a profit of 10 lakhs. 10 lakhs she made. And you know what? In 25-26, actually total capital is 10 lakhs, right, last year? Plus last year profit how much, 5 lakh. Last year profit 5 lakhs. Total capital is how much? 15 lakhs capital is there in the 25-26, and for that year she got 10 lakhs profit. How much is my gifted money? As on 1st April 2025, my 5 lakhs is there as it is. Yes or no? I gave 5 lakhs, that is there as usual. 5 lakhs is gifted. So 5 lakhs divided by 15 is equal to 3,33,333. This is subject to clubbing in the hands of transferor. Are you clear? Like this, there is a problem in MTP, RTP, previous exam questions or illustration, which we solved in our regular class already. Clear? 2 problems we solved on this. Confident or not? Okay, you also can solve this question in our question bank. It is there. You can download and then solve. So you can just download our website, Shrestha for CMA. In that question bank, free resources will be there. Inside that P3A, inside that question bank will be there. You just download and then solve it. Clear? Easy. Then same logics will apply. Same logics will apply even if you are transferring to son's wife. But when you are transferring to son's wife, no. Suppose if you are transferring house property also, no. House property is also covered under 64 only. For suppose if I transfer house property, 27 will apply. Remaining assets, 64 will apply. For daughter-in-law, whether I transferred house property or whether I transferred normal asset, which section is applicable? 64 only applicable. Correct? Here in the above it is spouse, here it is son's spouse. That's the only difference. At the end of the day, income is taxable in the hands of the transferor. That's it. Last section in this chapter, 64 1A. 64 subsection 1A. Very simple. I am having minor children. They are getting income. It is straight away taxable in the hands of the parent. Which parent? Mother or father? Whose income is higher, check out. In their income, tax it. First time when you are clubbing only, you should check this point. Once it is clubbed in the hands of the mother, first time, because mother income is higher in that year. Second year, third year, fourth year, from until he became major, his income is taxable in the hands of the mother only. Yes or no? Once a minor income is clubbed in the hands of one of the parent, next assessment years also that minor child income is clubbed in the hands of the same parent until they attain majority. whether a person, whether children is minor or not, as on 31st March you should see. As on 31st March, 18 years not completed. That's it, minor. For that year, is the children drawing any income? Yes, sir. Club it in the hands of the parent. Now here, when you are clubbing, 1500 exemption available under optional tax regime. How much exemption is available? 1500 exemption is available under optional tax regime. Suppose if at all the parent is filing return of income under default tax regime, 10 subsection 32, 1500 exemption will not apply. This 1500 exemption is per minor child. Suppose if 3 minor children income is added, then 3 times into 1500 you will get, that too if it is only optional tax regime. Now minor income is straight away taxable in the hands of the parent. Now how this minor is getting this income? Anyway, it doesn't matter. He is getting income, that's it. That income is taxable in the hands of the parent. However, if minor is getting income by special skill, talent, getting it, or if the minor is suffering from 80U disability, if minor is suffering from 80U disability, we will not apply clubbing. Then the income is taxable in the hands of minor only. He will have a PAN number, you will file IT return as a guardian, that's it. On behalf of minor, you will file IT return on minor PAN number only. As a guardian, you will file the return, that's it. Able to understand? All of you. Now, you will get one question. Minor, he participated in one chess competition. He got 10 crore money. He got prize money 10 crore. Okay. The 10 crore is subject to clubbing in the hands of the parent? No. Because it's a special skill and talent. The 10 crore is taxable for minor only. And what he did, cleverly, that entire 10 crore he invested in a shares of a company. Now company is paying dividend to him. 1 crore dividend he got in 1 year. 1 crore dividend he got in 1 year. Same year 1 crore dividend also he got. That dividend income is taxable in the hands of the parent. Why? Sir, it's out of special talent and special skill. No. 10 crore money is out of special talent and skill. This dividend income, he did nothing. He just invested 10 crore, he got dividend income. Dividend income, for getting that dividend income, did he apply any skill and talent? Nothing. That is taxable. Very simple. Minor's active income, manual labor, skill, disability, when these are all there, the income is called as active income. If minor's active income is taxable in his hands only. Minor is getting passive income. He's doing nothing, but he's just getting income. Passive income is taxable in the hands of the parent. That's a simple rule. Minor's active income is taxable in the hands of the minor. Passive income is taxable in the hands of the parent. Sir, parent gave asset at free of cost. Actually, minor bought a house from me. Bought a car from me. He paid me money and bought the car. Still, on the car, he is getting rental income taxable in the hands of the parent. Are you clear? Suppose if at all minor is doing business with skill and talent, then that business income is not taxable in the hands of the parent. Simple. Minor getting income. Yeah. Which income? Active income means he is performing work. His skill, talent, disability. Passive income means interest, dividend, all this. These are passive. Passive incomes are taxable in the hands of the parent, whose total income is higher before including minor's income. 64 subsection 1A. Able to understand? Now remember, in house property there is one point. House property transfer to minor child other than minor married daughter. Parent is treated as deemed owner. 1500 exemption does not apply there. Able to understand? Suppose if the house property is transferred to minor married daughter, deemed ownership concept will not apply, but 64 1A clubbing will apply. If minor married daughter house property is transferred, clubbing under 64 1A will apply. With this, clubbing is over. 64 subsection 2 and all not that important, so I am not covering it. Okay. Now there is a difference in 61, revocable transfer in 64. Remember, in 64 subsection 1 clause 2, if I transfer to my wife inadequate consideration, yes or no, I am treated as, for me it is taxable, that income is correct. Suppose I sold my wife. Sorry. I sold to my wife. Okay. Yes. I sold to my wife. Okay. I sold to my wife some asset. I took money adequately from her and I sold. Okay, come back. Yeah. Slip of tongue. Yeah. So I sold a car to my wife. She's earning some income. She paid me money and she purchased a car from me. Out of paying adequate, she purchased. But when I'm selling itself, I told her I will get back the asset whenever I want. It's a revocable transfer. If it is a revocable transfer under 61, consideration is there or not doesn't matter. I am treated as owner directly. In my hands only that income is taxable. Remember under 61, 62 to 63, even if adequate consideration is there, if revocation condition is there, it's a revocable transfer, straight away income is taxable in the hands of the transferor, whether consideration is adequate or not. Sir, I transfer it for inadequate consideration. Inadequate. Then 64 will apply. Clear all of you? Everyone? That's it. Then, so with this clubbing is over. Okay, see 26 minutes hardly. Clubbing is completed. Able to understand? Every point I touched. Everywhere example also I gave. Correct? That's it. Now set off and carry forward. Just a minute. Yes, let's begin set off and carry forward revision. Okay. In set off and carry forward, no, we have totally these many sections. 70 intra-head set off, 71 inter-head set off, 71B carry forward of house property loss, 72 carry forward of normal business loss, 32 subsection 2 carry forward of unabsorbed depreciation loss, and carry forward of unabsorbed capital expenditure on scientific research, carry forward of unabsorbed capital expenditure on family planning, all that similar treatment under 32. Okay, then we are going to discuss 73 carry forward of speculation loss, 73A carry forward of specified business loss related capital expenditure. Yes or no? Revenue expenditure for specified business, no, it's 8 years only always. Specified business related capital expenditure. Getting it? Actually, specified business all types 80, I mean infinite only. Okay, revenue capital no need to bifurcate. Actually, 70 specified business under 35 AD, they're mainly talking deduction about capital expenditure. Yeah, 73A, yes or no? Minus 74 capital losses, long-term capital or short-term capital loss. Then 74A, we have a loss from owning and maintaining race horses. Totally these are the sections. And finally there is a section called 80 which talks about due date for filing IT return, which talks about in order to carry forward the loss you must find the return of income within due date. These are the sections. Now suppose SSC is having multiple sources within same head of income. Suppose I have multiple houses. Now from few houses I have a loss after reducing interest. From few houses I have a profit even after reducing interest. Remember, under optional tax regime only interest on self-occupied property can be claimed as deduction. For let out and deemed let out property, you can always claim interest deduction. No limitation on that. For self-occupied house only, you can claim deduction. You can claim deduction towards interest only in optional. Under default tax regime, you can't claim. No, very simple. Within a head of income, if I have multiple sources, like I have multiple businesses in PGBP, I have multiple capital gains income, capital losses. Very simple. Loss from one source, I can set off with income from another source. In the same head, within the same head I will set off. Income and loss I can set off. One source I have a loss, another source I have income, I can set off. But there are certain restrictions. Speculation business loss, you can set off only with speculation business income. If you have a speculation business and there is a loss from that, you can only set off with speculation business income. What is speculation activity? In PGBP, I have not revised it actually, but you can read that and then cover. In our PGBP discussion introduction, there is a speculation business means what? Hedging is not a speculation. Shares derivatives is not a speculation. Commodity derivative is not a speculation. These three are not treated as speculation. And a company whose principal activity is trading, whose principal activity itself is investing, loans and advances, for them also buying and selling of shares is not treated as speculation. Banks, it is not treated as speculation. Are you getting it? So for banks and all, speculation concept will not apply. For companies which are exclusively involved in investing business, for them speculation concept do not apply. And for other people, derivatives is not a speculation, commodity derivatives is not a speculation, hedging contracts is not a speculation, forward contract is not a speculation. That's it, over. Speculation concept also over. Speculation means what? Buying and selling of shares without delivery. I buy the share and sell without taking delivery. Nothing but intraday transactions. They are all intraday transactions. That's it. Now, speculation, if I have a loss, I can set up that, but only with speculation business profit. Suppose I have a speculation loss, but I have another business, normal manufacturing business, I have a profit there. I can't set up these two because speculation loss I can set up only with the speculation gain. Suppose I have a specified business loss. Specified business means 14 specified businesses are there. Under PGBP, I have a loss from them. Incomes minus revenue expenditure minus capital expenditure, 100% reduction is equal to I have a loss. No problem. You can set off it only with another specified business. Only. Suppose I have a loss in 3-star hotel and I have a profit in hospital with 100 beds. Set off. Sir, actually, 100 beds hospital is there, right? I am not claiming 3580 deduction, sir. It's a specified business only, but I'm not claiming deduction under 3580. Is that income still eligible to set off this loss? Yes. See, they are saying specified business loss, you can set up only with specified business profit. They are not giving any condition like, are you claiming deduction under 3580? They are not at all asking that. If it is a specified business loss, set up only with specified business income. That's it. Are you clear? Next. Sir, I'm having a long-term capital loss. Suppose under capital gain set off income, no, I sold shares, long-term shares, I got a loss. I sold land and building, short-term, I had a profit. Can I set off these two? They both are within the same source, no? Long-term capital loss, it can be set off only with the long-term capital gain. Same like speculation and specified. Speculation business loss, specified business loss, they can be set up only with the respective incomes. Long-term capital loss can be set up only with the long-term capital gain. Same way, sir, I am owning and maintaining race horse. From that I have a loss. How to calculate loss from owning and maintaining race horse? How to calculate loss from that? Very simple. You know, loss is equal to, did you participate in any winning and won the money? Check out. Yeah, I won. I won some money. And did you incur revenue expenditure for maintaining the race horses? Yes, I spent a lot of money in the full last 1 year. I spent so much on feeding the horses, all that. But in one race, I won money. So I won money, approximately 1 crore in the race. But feeding the horses and all, 2 crore I spent. 1 crore is loss. This is called as loss from owning and maintaining race horse. You know, these people who are owning and maintaining race horses, no, they incur revenue expenditure. That revenue expenditure will be used for calculating loss under other sources. Their income is what? Winning money. If at all they win something in the horse race, no, that winning we will consider. Winning we will consider only on gross basis. Winning minus that one. Sir, in this year, no winning, sir. Everything loss only. Only entire expenditure I spent on horse maintenance. Remember, for calculating loss, no, only revenue expenditure on maintaining the horse you should take. You should not take race horse loss. Horse races we participated and there I incurred loss. That is to be ignored always. That is to be ignored. I spent money on maintaining the horse. That you consider. Income from winning minus money maintained on horses is equal to balance. If still loss, then that is called as what? Loss from owning and maintaining. And that loss you can set off only with the same income from owning and maintaining race horses. Suppose, sir, in agriculture, no, if there is a profit, you are ignoring because agriculture income is exempted. If there is a loss, what about it? That is also ignored. If you are getting profit, we are ignoring because it's an exempted source. If you are getting loss also, it is to be ignored. Loss from exempted source shall be ignored. That's it. 70 section is over. Then 71, which is talking about interhead adjustment. What is interhead adjustment? Very simple. Loss under one head of income can be adjusted with income under another head. See, right now, what I did, within the same head, I have some houses and all. I have businesses. I tried set off. By the way, tell me, I have a normal business loss. Can I set off with speculation business income? Restriction is for speculation loss. Normal business loss, no restriction. Yes or no? Is there a normal business loss discussion here? So I can set off normal business loss with any source of income within the same head of income. Can I set off short-term capital loss with long-term capital gain? Yes. Where is restriction here on short-term capital loss? Here restriction is there only for speculation loss, specified loss, long-term capital loss, loss from owning and maintaining resource. No restriction for other incomes. For other losses, I can set off with other incomes comfortably. Yes or no? No. Suppose I set off the loss. I still have a loss. I can set off with other heads of income. You see, I have given very clearly material here. You see here, only one point I've highlighted here, and house property point I've highlighted with a green background. Rest of the points you see, same white background. What does it mean, Under optional tax regime, under default tax regime, for normal business loss, speculation loss, specified loss, long-term capital loss, short-term capital loss, for all of them, the treatment is same. Whether it is optional tax regime or default tax regime, it doesn't matter. House property loss. If I have a loss under house property head, first set off with other house property incomes. You still have a loss, huh? Set off with other heads of income. Set off with other heads of income only under optional tax regime. You can set off with other heads of income only under optional tax. That too, how much you can set off? 2 lakh. Suppose, sir, I'm going with the default tax regime, sir, and I have a loss under house property. You can't set off. First of all, in default tax regime, you will get a loss under house property only for LOP, DLOP. You will not get loss for SOP. Why? SOP, you can't claim deduction at all. If NAV is equal to 0, you can't claim deduction towards interest under default tax regime. No deduction towards interest for SOP, UOP, where NAV is equal to 0. So loss is not at all possible in default tax regime for self-occupied house, unoccupied house. Loss is possible only for let out property, DLOP, where interest on borrowed loan is more than net annual value. Net annual value minus 30% deduction. Then still you give interest on loan. If the resultant figure is negative, then that's a loss from house property. Now that loss, if you still have, even after set off with other heads note, by the way, in default tax regime, you can't set off with other heads. You can't set off with other heads. But in optional tax regime, you can set off with other heads of income. Yes or no? And I told you, under optional tax regime, still have a house property loss, sir. What I can do? You can carry forward for 8 years. After setting off with other heads up to 2 lakh rupee, I can still carry forward for how many years? 8 years. Under default tax regime, ICA book contains a mistake. I am telling you once again, it's a mistake. Don't again ask me below comment saying that, sir, why it is not, it is given in ICA book, it is not carry for. No, it's a mistake. It's a mistake. That's it. And I spoke in the regular class. I showed in the regular class. I opened act and showed it's a clear-cut mistake. Yes or no? In the ICA book, they said house property loss cannot be carry forwarded, which is actually a blunder mistake. Getting it? You can carry forward. This point is given in ICA book, which is wrong. Very simple. Under default tax regime, house property loss you can't carry forward. Why? Under default tax regime, which loss you can't carry forward? That loss which you cannot claim deduction. In default tax regime, if you can't claim, you can't carry forward. Or if you can claim means you can carry forward. If you can claim means you can obviously carry forward. Yes or no? Restriction of not carry forward is there for what? You know, disallowed losses, disallowed expenses, unabsorbed depreciation and all, you can't carry forward further. For those kind only it is there. Yes or no? So under default tax regime, if I have a let out property, deemed let out property, default tax regime, and I have a loss from that let out or deemed let out property, I will first set off with other heads. No, set off with other heads is not permitted. You can carry forward. If you cannot carry forward, then why deduction they will give? Deduction for LOP, DLOP is unlimited, no? Under default tax regime, they will give deduction, no? If they are giving deduction, then why they are giving deduction without carry forward, right? Fundamental question. So you can still carry forward. In ICA book, it is wrongly given. In ICA book, it is wrongly given. In one of the MTP, it is wrongly given. Actual provision is you can carry forward. In exam, if the same question comes, what to do? You write an answer in such a way, point rate. Write not carry forward. Below write alternative answer. As per the provisions of the law, it can be carry forwarded. But in the ICA study material, it was given not carry forwarded. You just write that. That's enough. Are you getting it? 99.99% ICA will give right answer only. ICA will go for right answer only. Means it can be carry forwarded. Able to understand. So, house property loss. Can I claim deduction for LOP, DLOP interest? Yes. If there is a loss, can you carry forward in default tax regime? Yes, you can carry forward. Sir, what about self-occupied property? Array for self-occupied, unoccupied, where NAV is equal to 0, you can't claim interest deduction itself. When you can't claim interest deduction itself, how come you carry forward? There is no question of carry forward for self-occupied, unoccupied. Sir, what about optional tax regime? Optional tax regime, self-occupied, unoccupied, interest you can claim deduction. Loss is there. Set off with other heads of income up to 2 lakhs. Still loss is there. Carry forward for 8 years. Sir, let out and DLOP, sir. I have claimed interest, sir. I have still loss. Set off with other heads of income. Maximum 2 lakhs only. Balance loss. Carry forward. That's it. I spoke about set off, self-occupied, unoccupied, let out, deemed let out. Both under optional tax regime, default tax regime. I spoke about set off. I spoke about carry forward. Clear? Next, sir, I have unabsorbed normal depreciation loss, sorry, normal loss. Immediately, whenever PGBP loss information, suppose no, in the question, they spoke about business loss. Suppose you are computing PGBP income in the current year, you got a loss. Immediately what you should do, suppose you got a loss of 10 lakhs. You got a loss of 10 lakhs under PGBP. Add back depreciation. Add back depreciation. How much depreciation? For example, 15 lakhs is the depreciation. Now business income is profit. Before depreciation, you have a profit. After depreciation, you have a loss, which means this entire loss is because of depreciation. This entire 10 lakhs is treated as depreciation loss. This entire loss is treated as depreciation loss. You can carry forward for infinite number of years. No restriction on that. Are you getting it? No restriction. You can carry forward infinite number of years. Depreciation loss, we call it as. It is nothing but loss due to capital expenditure. Similarly, if at all, very simple, compute business loss. First compute income from PGBP as usual. Claim depreciation, claim additional depreciation, optional tax regime. Suppose if it is default tax regime, claim normal depreciation only. Don't claim additional. Okay. Claim scientific research expenditure, capital expenditure, family planning capital expenditure. Every deduction you claim as usual. No compromise at all. You got a loss. How much? 10 lakhs. You got a loss of how much? 10 lakhs. Now add back depreciation. Sir, depreciation is 7 lakhs, sir. Now add back capital expenditure on scientific research, which is some 3 lakhs. Now add back capital expenditure on family planning. Now you see, when you are adding back, it became only 0, which means because of depreciation, you don't have a loss. Okay, I mean, you have a loss. Actually, you have a loss. Yes or no? Now add back, family planning on capital expenditure, 2 lakh. Oh, if at all you didn't claim all these capital expenditure, you have a profit of 2 lakh. After claiming deduction, you have a loss. After claiming all these deductions, you have a loss. Now, what do I call it as, 5 lakhs is depreciation loss. This 5 I will give 2, no. First I will give priority to depreciation. Still 5 lakhs. So, mine 2 minus 7 lakhs depreciation. But 2 lakhs only I will claim. So, my business profit, my revenue profit is equal to, my revenue profit is only 2 lakhs. Actually, before claiming this, whatever profit is there, that is revenue profit after reducing revenue expenses. After reducing revenue expenses. Now I am reducing capital expenditure related deduction. Now I am reducing what? Capital expenditure. One of the capital expenditure deduction is what? Depreciation. Another capital expenditure deduction is what? Scientific research. Another one is what? Family planning. Now 5 lakhs is depreciation loss. 3 lakhs is scientific research capital expenditure loss. 2 lakhs is family planning related capital expenditure. These 3 losses, you can carry forward infinite. You can carry forward infinite. No restriction on that. Able to understand. Very simple. You have a business loss, some amount. This is not fully your business loss. This includes some revenue loss as well as capital expenditure related losses. Find out capital expenditure related losses how much. Are you getting it? Now, for this business loss, add back capital expenditure deductions you claimed. What are the capital expenditure related deductions? Depreciation, scientific research, family planning. If there is a profit, means from business revenue activity, you have a profit. You don't have a loss. The loss is completely because of capital expenditure. Suppose after adding back also, you still have a loss business, then that is exactly called as business loss. That business loss, what you can do? You can set off with business loss. You can set off with other heads of incomes. Happily, you can set off business loss with other heads of income except salary. Whether optional tax regime or default tax regime, same provision except, sorry, not this is actually depreciation loss. Okay, normal business loss. You can set off against any head of income except salary. Sir, what about depreciation related loss? That also you can set off with any head of income except salary. Sir, depreciation has 2 parts. Additional depreciation loss is there. I am telling you, this breakup you will not find anywhere. In the ICA book is not there. Anywhere also you will not find. This clarity is very important for you. Yes or no? Because set off and carry forward, if an exclusive question comes, they will twist here only. I have additional depreciation also in. Yeah, that additional depreciation loss you can set off with any head of income except salary. See, first you will always set off with PGBP. If you don't have PGBP profit, brought forward depreciation, if you don't have PGBP, then you will set off with other heads except salary. Under default tax regime, additional depreciation, if at all anything is there brought forward, you cannot set off with other heads, because additional depreciation shall be added to opening WTV. Additional depreciation shall be added back to opening WTV. Yes or no? 115 BAC, it will be added to opening WTV. That's it. Now, after still, set off with other heads and all, still have a additional depreciation loss under optional tax regime, carry forward. Still have a normal depreciation loss under optional tax regime, carry forward. Business loss, carry forward 8 years. How many years you will carry forward? 8 years. Okay, suppose normal business loss, I can carry forward for 8 years under optional tax, under default tax. Okay, what about additional depreciation loss? Happily carry forward under optional tax, but default tax you can't carry forward. It will be added to WTV, block of asset will be added. Normal depreciation loss, carry forward, carry forward. That's why you see here in house property, additional depreciation, specified business loss. Only for these three, the provision, the treatment of loss is different in optional tax and default tax. Now, sir, I have a specified business loss. Sir, you can carry forward any number of years, but under optional tax regime, you don't get any deduction at all. Yes or no? Therefore, the brought forward specified business loss shall be ignored and cannot be carried forwarded further. Yes or no? Sir, I have a speculation loss. Sir, I have a speculation loss. What about speculation loss? Array, you can only set up with speculation income. If you don't have speculation income, only you can only set up with speculation income. You can only set up with speculation gains. You can't set up with other heads also. So, if at all any loss is there, carry forward for 4 years. Carry forward for 4 years. Correct? Sir, I have a specified business loss. What about this? You can set up only with specified business profit. Sir, this specified business, it's a specified business, but it is not eligible to claim deduction, sir. If they are not claiming 3580 deduction, it doesn't matter. You can set up with specified business income, not an issue. So loss under specified business